Namaste, my dear students, and a very warm welcome to the Deep Dive.
Namaste, everyone.
Today, we are going on a truly important journey together. Yes, a journey into the fascinating world of how your money can actually grow. And importantly, how we measure that growth.
Yeah.
Think of it like learning the fundamental rules of a game before you step onto the field.
That's a great way to put it.
Just like in a game of cricket, maybe. If you don't understand how runs are scored or how wickets are taken.
How can you really enjoy it?
Exactly. How can you truly appreciate the game or even play it well? Financial knowledge is, it's like that rule book for your money.
Precisely. And what a wonderful analogy. In the world of finance, my dear students, we often talk about rates and returns.
We hear those words all the time.
We do. And these aren't just fancy words. They are the very foundation upon which your financial future is built. Really.
It's so important.
Whether you are saving up for, let's say, a new bicycle, or maybe planning a big family wedding, thinking about your own future, or even your children's higher education. Understanding these numbers, these financial scores, let's call them, is absolutely critical.
Critical.
We are here today to be your friendly guides, step by patient step, to ensure you grasp every important nugget.
Yes.
Our mission is to empower you with this knowledge so you can make smart, confident decisions for your very own financial journey.
Yes. Our mission for today's deep dive is exactly that. To take all this important financial information and make it simple, relatable, and perhaps even a bit fun.
Hopefully.
We will look at the different ways money can grow, the various methods we use to measure that growth, and crucially, why choosing the correct measurement is just like picking the right tool for a specific job.
That's a good one.
You wouldn't use a screwdriver to hammer a nail, would you?
No, definitely not.
Similarly, you need the right financial tool for the right financial question. So, are you ready, my bright students, to unlock some of the secrets of rates and returns?
Let's begin.
Let's begin to unpack this together. So let's begin with a term you have all heard countless times in your everyday lives. Interest rate.
Oh, yeah.
We hear it everywhere, don't we? When someone talks about home loans or car loans, or even when we put our savings into a bank fixed deposit.
Correct.
When you keep money in your savings bank account, the bank tells you they will give you an interest rate. But what does this interest rate really mean? Is it just a single, simple number?
That's a very good question to start with. An interest rate, my dear students, is fundamentally the cost of borrowing money.
Okay.
Or, conversely, the reward you receive for lending it.
Cost or reward?
Yes. It is the compensation you either pay for using someone else's money or the compensation you receive for letting someone else use yours. But what's fascinating is that this single number, this R value we often see, can be seen through three very important lenses, almost like three different interpretations, depending on the situation.
Three interpretations, okay.
The first interpretation, my dear students, is the required rate of return.
Required rate of return. Okay.
Yeah, what does this mean? This is the minimum return you simply must receive from an investment to make it worthwhile for you.
The minimum you need.
Exactly. Imagine you are saving for your cousin's grand wedding, which is maybe 2 years from now.
Okay.
You have Rs $50,000 that you plan to put into a fixed deposit, but you know that to cover your gift and maybe your travel expenses, you absolutely need that Rs $50,000 to grow to at least Rs $55,000.
You have a target.
You have a target. So you require a certain percentage return from that fixed deposit, don't you? That minimum percentage, that hurdle your investment must clear for you to be satisfied. That is your required rate of return. If the bank offers less than that, you might have to look for another option or perhaps even reconsider the size of your gift.
Right.
Your personal financial goal, shaping what you need from an investment.
I understand. It's like setting a minimum score you need to get on an exam to pass the class.
Right.
You need that minimum return to achieve your financial goal. Otherwise, the investment simply isn't good enough for your purpose. So, what is the second way to look at this R?
Very well understood. The second interpretation, my students, is the discount rate.
Discount rate, okay.
This concept helps us understand what money you might receive in the future is truly worth today.
Future versus today.
Yes. Think about it like this. 1,000 rupees you have in your hand today is generally worth more than 1,000 rupees promised to you 1 year from now, isn't it?
Yes, that makes sense.
Why? Because you can use that money today.
Yeah.
You can invest it, you could buy something you need, or simply enjoy it. So if someone promises you Rs 10,000 1 year from now, How much is that promise actually worth to you today?
Good question.
If we use a discount rate of, say, 5.26%, it means that the R's 10,000 you get in 1 year is equivalent to having R's 9,500 today.
Okay.
We use this discount rate to bring future values back to the present. We discount them. This makes them comparable so we can make smart decisions right now.
So we can compare fairly.
Exactly. It helps us evaluate if a future payment is truly attractive enough compared to getting a smaller amount today.
So it's like comparing apples and oranges across different times. Very clever. And what is the third important interpretation, my students?
The third interpretation, which is very profound, I think, and often overlooked, is opportunity cost.
Opportunity cost.
Opportunity cost. I've heard this one.
Yes, this is the value, the benefit you give up when you choose one thing over another. Every decision we make has an opportunity cost.
Everything.
Pretty much. Let's use our previous example. If you have RMR's 9,500 today and you decide to spend it all on a brand new fancy smartphone, a very tempting choice for many, I'm sure.
Very tempting.
You're giving up the 5.26% interest you could have earned by putting that money into a savings account or a fixed deposit for a year. That 5.26% you could have earned. That is your opportunity cost of choosing to consume now to buy the smartphone.
So the cost is what I missed out on. Precisely. You chose the smartphone, and in doing so, you gave up the potential earnings. It is always the value of the next best alternative that you didn't choose.
That's a really powerful way to look at our choices, isn't it? It makes you think twice about those impulse purchases, doesn't it?
It really should.
Gotcha. So, my dear students, let's think about this. If your father says to you, Beta, if you put this money in the bank, you will get 6% interest. Which kind of rate do you think that 6% is for him from these three interpretations we just discussed? Which one feels most relevant for his decision-making? Think about what he might be hoping to achieve or what he might be giving up.
Yes, think deeply about that. He might see it as his required rate of return if he has a very specific savings goal, perhaps.
Like saving for a pilgrimage, maybe.
Exactly. Or for a new household appliance. Or it could represent the opportunity cost if he chose to spend that money on something else instead of saving it.
Right.
It truly depends on his individual perspective and what his financial priorities are at that moment, doesn't it?
It really does.
Very well done thinking through that. Hashtag 1.2. What makes up an interest rate? The premium ingredients.
Now, my dear students, an interest rate isn't just one plain number that appears out of nowhere. Oh, no.
No, not at all.
It's like a special, delicious mix of different ingredients, you could say, each adding its own unique flavor and texture to the final dish.
I like that.
Like a well-made biryani, maybe? It has many elements that come together to form that perfect, complex taste.
That is an excellent analogy, my friend. We can indeed break down any interest rate into a real risk-free interest rate and then a set of premiums.
Premiums, okay.
Yes, premiums that compensate lenders for taking on different types of risk. The formula, though it looks a bit long, is quite straightforward once you understand each part. Are you ready?
Let's hear it.
R's. Real risk-free interest rate plus inflation premium plus default risk premium plus liquidity premium plus maturity premium.
Wow.
5 parts, 5 key ingredients. Let's understand each one of these ingredients in detail now.
Okay.
First, we have the real risk-free interest rate.
Real. Risk-free.
Yes. This is the most basic part, the pure fundamental rewards you get for simply waiting to receive your money back. It assumes a perfect world.
Which doesn't exist.
Exactly. A world where there's absolutely no risk of losing your money and no inflation eating away at its value. Think of it as the pure rent your money earns just for being lent out, for someone else using it for a period of time.
Just for waiting.
Just for waiting. It reflects people's natural preference for having things now rather than later.
So if we lived in a perfect dream world with no risks and no rising prices, this is what our money would earn just for waiting. Sounds quite ideal, doesn't it?
Indeed. But we don't live there, so next we add the inflation premium.
Inflation. We know about that.
We certainly do. This premium compensates you, the investor, for the loss of your money's purchasing power due to rising prices, which we call inflation.
Things getting more expensive.
Exactly. Imagine the price of your favorite gulab jamuns. If they cost Rs 20 today, but are expected to cost Rs 22 next year because of inflation.
Gulab jamuns.
Your interest earnings need to cover that MS2 increase, just so you can buy the same amount of gulab jamuns next year.
I see.
This premium protects you from inflation, quietly eating away your earnings. If your money doesn't grow by at least the inflation rate, you're effectively getting poorer, even if the numbers in your account look bigger.
That's a very important point.
Very important. Then there is the default risk premium.
Default risk, like someone not paying back.
Precisely. This is an extra compensation you demand for the chance that the borrower might not pay you back at all or might delay their payments significantly.
Right.
Think about this. If you lend money to your very reliable best friend, who always pays back on time, always true to their word, you might charge them very little or maybe even no interest, right?
Maybe just thank you.
Perhaps. But if you lend money to a new acquaintance, someone you don't know very well, you might certainly charge them a higher interest rate because there is a higher default risk, isn't there?
Yes, absolutely.
That extra charge, that cushion you build in, that is the default risk premium.
So it's all about trust, isn't it? The less trust or certainty about repayment, the higher the premium you ask for. What about the next ingredient, my student?
It's very much about trust. The next ingredient is the liquidity premium.
Liquidity. Like how easily you can get your cash back.
Exactly. How easily and quickly you can convert your investment back into cash without losing significant value. Let's consider a common example. Selling your gold jewelry.
Okay.
Generally, it's quite easy to sell quickly at the market price without a big discount if you need cash immediately, isn't it? That's high liquidity.
Yes, usually.
But imagine trying to sell a piece of inherited land in a very remote village quickly.
That could be difficult.
It could be very difficult. You might have to accept a much lower price because it's not easy to find a buyer immediately, and the whole process takes time. The difficulty in selling quickly without a loss means you need a higher return if you choose to put your money there.
So you get paid extra for the potential hassle.
That's right. That extra return, that extra compensation for the inconvenience is the liquidity premium.
Makes sense. And the last one.
And finally, we have the maturity premium.
Maturity, like how long the investment lasts.
Exactly. This premium compensates you for locking up your money for a longer period of time. Think about bank fixed deposits again. A fixed deposit for 1 year usually offers a lower interest rate than a fixed deposit for 5 or 10 years. Why do you think that is, my students?
More can go wrong in 10 years than in 1 year.
Precisely. It's because the longer your money is tied up, the more risk you face from unexpected changes. Changes in the market, in the economy, or even in your own personal needs.
Right.
For example, overall interest rates might rise significantly, but your money is stuck earning that older, lower rate for many more years. So you expect higher compensation for that longer commitment, for that increased uncertainty.
So you want more reward for the longer wait and risk?
That's it. That extra compensation is the maturity premium.
Okay, got it.
Now, a quick important note. The sum of the real risk-free rate and the inflation premium is often combined and called the nominal risk-free interest rate.
Nominal risk-free. Okay.
In practical terms, this nominal risk-free rate is often approximated by the interest rate on very short-term government debt in a country. For instance, in India, a 90-day government bonds interest rate.
Like a treasury bill.
Exactly, like a T-bill. Its rate reflects this nominal risk-free rate for 3 months. It's considered risk-free because the government is very, very unlikely to default on its payments.
Hopefully.
And it's short-term, so there's less exposure to those long-term market risks and maturity premiums we just talked about.
Wow, so many different layers to just one simple number. It's truly like a complex and flavorful recipe, isn't it?
It really is.
Acha, so my dear students, imagine this scenario. If you were to lend money to your uncle for his small Kirana shop, and he promises to pay you back after 5 long years, what 2 premiums, apart from the basic real rate and inflation, do you think you would definitely want to add to your interest rate? Think carefully about the risks involved here for you, the lender.
Good question. Think about Uncle's shop and the 5 years.
What comes to mind?
You are thinking absolutely correctly to consider those risks. You would certainly want a default risk premium because, even though it's your uncle, it's a small business, right?
Yes.
And there's always a chance of unforeseen difficulties in repayment. Small businesses face challenges.
True.
And you would also definitely want a maturity premium because you are locking up your money for a full 5 years.
5 years is a long time.
It is. It's a considerable amount of time during which many things can change in the economy, in his business, maybe even interest rates generally. So you would expect extra compensation for that longer commitment and the uncertainty it brings.
Default risk and maturity premium. Got it.
Very insightful thinking, my students.
Wonderful. To really solidify our understanding, Let's look at a concrete example with some hypothetical numbers. Let's make it real.
Yes, let's do that.
We have 5 different hypothetical investments here, each with its own characteristics and interest rates. It's like comparing different fixed deposit schemes maybe, or different loan offers available in the market. Each one has its own unique conditions.
Exactly, my students. Let's imagine these are different ways you could invest your hard-earned savings. Let's call them investment 1 through 5, and they have varying maturities, levels of liquidity, and levels of default risk.
Okay, 5 options.
First, let's compare investment 1. It has a 2-year maturity, high liquidity, low default risk, and offers 2.0% interest. Got that.
2 years, high liquidity, low risk, 2%. Okay.
Now let's look at investment 2. Also 2-year maturity, same low default risk, but this one has low liquidity, and it offers 2.5% interest.
So the only difference is liquidity. One is high, one is low.
Exactly. Both have the same 2-year maturity and the same low default risk. The only difference is their liquidity. Investment 2 has low liquidity, and notice it offers a higher interest rate, 2.5% versus 2.0%.
Okay, 0.5% more.
What does that 0.5% difference tell us, my students?
It must be the payment for low liquidity.
Precisely. It is clearly the liquidity premium. It means you are being paid an extra 0.5% because it might be harder for you to sell this investment too quickly without losing value if you suddenly needed the cash.
Yeah.
You are compensated for that inconvenience.
So, if you want your money readily available and easy to access, you generally get a lower return. Makes sense.
Yes.
But if you're okay with your money being a bit stuck for a while, you might get a little more interest.
That's the trade-off, my dear students.
Yeah,
absolutely. Now let's move on and look at investment 4.
Okay, investment 4.
This one has an 8-year maturity, high liquidity, low default risk, and offers 4.0% interest.
8 years, high liquidity, low risk, 4%. Got it.
And compare it with investment 5, also 8-year maturity. But investment 5 has low liquidity and high default risk, and it offers a much higher 6.5% interest.
Wow, 6.5%. Okay, so same 8 years, but low liquidity and high default risk this time?
Exactly. Both have an 8-year maturity. However, investment 5 has those 2 key differences compared to investment 4, low liquidity and high default risk.
Right.
Now, from our previous comparison between investment 1 and 2, we already figured out that a low liquidity feature seems to command about a 0.5% premium in this market, didn't we?
Yes, we did.
Okay. Now, the total difference in interest rates between investment 5, 6.5%, and investment 4, 4.0%, is a full 2.5%.
Right.
6.5 minus 4.0.
Correct, 2.5%.
So if we know that 0.5% of that difference is likely accounted for by the liquidity premium,
then the rest must be for the default risk.
exactly. The remaining 2.0%, which is 2.5% minus 20.5%, must surely be the default risk premium. This means you are getting paid an extra 2.0% for taking on the additional risk that the borrower in investment 5 might not pay you back as promised.
That's a big premium for default risk.
It is. It shows it's considered a significant risk. It's a considerable compensation for that higher level of risk.
So you can clearly see how these different ingredients, these premiums, add up to create the total interest rate that you see. Very clear. Gotcha. Now here's a little challenge for you, my dear students. Let's consider investment 3.
Okay, number 3.
It has a 7-year maturity, it has low liquidity, and it has low default risk. Its interest rate, which we will call R3, is unknown. Based on everything we've just learned from the other investments, can we estimate a reasonable range for what its interest rate, R3, might be?
Acha, let's put our thinking caps on and figure this out together. Investment 3 has low liquidity and low default risk.
Like investment 2.
Yes, similar to investment 2 in those aspects, but its maturity is much longer, 7 years, compared to investment 2's 2 years.
Right, 7 versus 2.
So immediately, we would expect investment 3 to have a higher maturity premium than investment 2, correct?
Yes, longer time, more premium.
Right, and therefore it should have a higher interest rate than investment 2's 2.5%. So R3 should definitely be above 2.5%. That's our lower boundary.
Okay, above 2.5%.
Now let's consider another angle. What if investment 3 had high liquidity? Let's just imagine for a moment.
Okay.
If it were high liquidity, it would be somewhat similar to investment 4, wouldn't it? Investment 4 is 8 years, high liquidity, low default risk at 4.0%.
Right, but investment 3 is only 7 years.
Exactly. Because investment 3 has a slightly shorter maturity, 7 years versus 8 years for investment 4, its rate would likely be a little less than investment 4's 4.0% due to a slightly smaller maturity premium, maybe 3.8% or 3.9% perhaps.
Maybe.
However, remember, investment 3 does have low liquidity. It's not high liquidity.
Ah, right. Low liquidity.
And we know that low liquidity adds about 0.5% premium in this market, right?
Yes.
So if we take that hypothetical rate of maybe 3.9% if they had a high liquidity and add the 0.5% liquidity premium.
That would be 4.4%.
Around that, yes. Maybe 4.4% or 4.5%. So combining all these thoughts, it should be higher than 2.5% because of longer maturity than NV2, and probably around or slightly below 4.5%.
Yeah.
Similar maturity range to NV4, but with the added low liquidity premium.
So somewhere between 2.5% and 4.5%?
That seems like a very reasonable estimated range for R3 based on the information we have. This example really shows how complex real-world interest rates can be as all these premiums interact.
It does. But understanding them helps us make perfect sense of the market.
Absolutely.
Wonderful. You see, my dear students, how knowing these components helps us understand even complex scenarios. So let's try another one, a practical one.
Okay.
If you saw 2 home loans available in the market today, one from a very big, very well-known bank, maybe like SBI or HDFC.
Okay, established banks.
And another loan from a new, much smaller finance company you haven't heard much about. Both are offering the exact same loan term, say 20 years. Which one might have a slightly higher interest rate, and why would that be the case?
Big bank versus small new company. Same loan term.
What do you think?
You are thinking absolutely on the right track. The smaller, newer finance company would likely have a slightly higher interest rate.
Why is that?
Why? Because from the lender's perspective, the bank or the finance company giving the loan, there is a perceived higher default risk premium associated with a newer, smaller company compared to a large, established, and very stable bank.
Ah, the stability matters.
It does. The lender wants to be compensated more for that increased risk, however small, that the smaller company might potentially face difficulties or might not manage its loan book as conservatively.
So higher perceived risk means higher interest rate.
Generally, yes. That's the default risk premium at work. Very insightful, my students.
All right, so we have now understood what an interest rate is and all its wonderful components, those premium ingredients. That was quite a bit.
It was, but very important foundation.
Very important. Now let's move on to the concept of returns. Once you've invested your hard-earned money, how do you actually know if it's truly growing?
Yes, the result.
Exactly. It's like checking the scoreboard in a cricket match. You want to see if your team's score is going up, right? Or if your favorite batsman is hitting those 4s and 6s. That increase in score, that's your return on your investment. How much did your money score?
Right. That's absolutely right, my students. When you invest in a financial asset, you usually have 2 main ways your money can grow. 2 sources of return.
Okay.
2 ways. First, you might get periodic income. This is like the regular salary or maybe pocket money you receive every month.
Regular payments.
Yes. For investments, this could be dividends from shares, which are basically a share of the company's profits paid out to you as a shareholder.
Okay, dividends.
Or it could be interest payments from bonds, which are essentially regular payments you receive for lending money to a company or the government.
Yeah.
This part is called your income yield.
Income yield. Got it. What's the second way?
The second way your money grows is through a change in the price of the asset itself.
Ah, the value changing.
Exactly. Just like the price of vegetables at the market can go up or down day by day.
Sometimes very quickly.
Yes. The price of shares or bonds or even property can also fluctuate. If the price goes up from what you originally paid, you have capital gain. That's good news.
Yes.
If the price goes down, unfortunately, you have a capital loss.
Not so good.
Not so good. Your total return on an investment is the sum of these 2 components. The income you received, like dividends or interest, and any capital gain or loss from the price change.
Income plus price change.
That's your total return. You always want both of these to be positive, ideally.
Of course.
For example, imagine you buy shares in a company, say Infosys. That company might give you a share of its profits every year in the form of a dividend that's your income yield.
Okay.
And then over time, the price of the Infosys shares you hold might go up in the stock market. That's your capital gain.
Yeah.
Both of these together, the dividend income and the increase in share price, contribute to your total return.
So I need to look at both parts.
Absolutely. This total return is what truly tells you how well your investment has performed overall. #TAG 2.2, holding period return, HPR, the simple score.
My dear students, the simplest and most straightforward way to measure your return is called the holding period return, or HPR. Simple name, simple idea.
Yes.
It's like looking at the score after just a single day of a cricket test match. It tells you exactly what happened in that specific time frame. No complications, just a clear picture for that period.
Yes, HPR is indeed the return you earn over a single specific period, the holding period. It could be just 1 day, 1 week, 1 month, or even as long as 5 years, whatever period you define.
Okay.
The formula is quite simple and very intuitive. R, price at end price at beginning, plus income received price at beginning.
End price minus beginning price plus income, all divided by beginning price.
Yeah.
Seems logical.
It is. Let's take an example to make this crystal clear for everyone. Suppose you bought an asset, let's say 1 share of a company, for Rs 100 today.
Okay, Rs 100, got it.
After 1 year, you sell it for Rs 105. And for simplicity, let's assume no other income like dividends was received during this year.
Okay, just price change.
Your HPR, in this case, would be 105, 100, under 100, that's 5, 100, which equals 5%. Simple, isn't it?
Yes, 5% gain.
Your capital gain was RWA, so it's a 5% return on your initial Rs 100.
Okay, now what if there was income?
Good question. What if, at the end of that same year, you also received Rs2 as interest or dividend from that asset?
Okay.
Then your total return, your HPR, would include that income. It would be 105, 100 plus 2, 100.
So 5 plus 2, 100.
It's exactly 5 plus 2, 100 equals 7. 100 equals 7%. The 7% now includes both your capital gain, the Rs5, and your income yield, the Rs2. That's your total HPR for the year.
Very clear.
Now, we can also calculate HPR over multiple years. But here's a key point. You don't just add up the annual returns, you have to account for the powerful effect of compounding.
Compounding again.
Always. If you have annual returns for year 1, year 2, and year 3, let's call them R1, R2, R3, the overall multi-year HPR is calculated by linking them geometrically. The formula is R1 plus R1, A1 plus R2, A1 plus R3.
Multiply the 1 plus return factors, then subtract 1.
That's it. For example, imagine a mutual fund had returns of 14% in year 1. Pretty good.
Yes.
Then it faced a loss of negative 10% in year 2. Not so good.
Ouch.
And another small loss of negative 2% in year 3. Its 3-year holding period return would be calculated as 1 plus 0.12 or M.10 at 0.1.02.
Okay, let's see. 1.14 times 0.90 times 0.98.
Exactly. If we calculate that, 1.14 at 0.905. Then we subtract 1.00558. Then we subtract 1.00558.
Which is 0.558%.
Very small.
Very small indeed. So after 3 years, even with that good first year, your investment actually grew by only about 0.5% overall because of the later losses. This calculation clearly shows how positive and negative returns compound together over time to give you your total growth for that entire holding period. That example clearly shows how ups and downs combine over time. It's not just an average. So my dear students, let's try a simple one for you. Ready?
Go ahead.
If you buy a share for Rs 100, and after 1 year its price is Rs 110, and you also received Rs 5 as a dividend during that year, what is your total holding period return? Take a moment and work it out using the formula.
End price, beginning price, plus income divided by beginning price.
What do you get?
Very good. Your calculation should be 110, 100 plus 500. That's 10 plus 5, 100, which is 1,500.
So 15%.
Exactly, 15%. You earned a total of 15% on your initial investment over that 1 year, combining the price gain and the dividend. Excellent understanding. Hashtag 2.3 arithmetic mean, return the simple average. Good for 1 period insights.
My dear student, sometimes when you have returns for many periods, let's say over several years, and you just want a quick, easy average, maybe for a rough idea. This is where the arithmetic mean comes in. It's the simplest average we learn in school, isn't it? Like taking the average marks for your last 3 tests.
Yes, exactly.
You just add them up and divide by the number of tests.
Correct, my dear students. For returns, you simply add up all the holding period returns for each period, like each year, and then divide by the total number of periods.
Simple addition and division.
Very simple. For example, if you had those returns we mentioned earlier, negative 50% in 1 year, then 35% in the next, and 27% in the 3rd year. 3 years.
Okay, negative 50 plus 35 plus 27.
The arithmetic mean is simply negative 50% plus 35% plus 27% 3. That's 12% 3 equals 4% per year.
So the simple average is 4%.
Yes. It is definitely easy to calculate and is what most people instinctively think of as an average. But here's a crucial point, a small warning, if you will, about the arithmetic mean.
Okay, what's the catch?
It mathematically assumes that you invested the same amount of money at the beginning of each period.
Which is rarely true in real life, is it?
No, my investment value changes each year because of the returns. Precisely. Because of compounding, your investment base changes. And because the arithmetic mean ignores this changing base, it often tends to be a little bit higher than what your actual portfolio growth would have been over those multiple periods.
Ah, so it can be misleading for actual growth?
It can be, especially if returns fluctuate a lot. It tends to overstate the actual performance unless all your returns were exactly identical, which almost never happens.
So when is it useful then?
It's best used when you want to estimate the average return you could expect over a single period horizon in the future. Like, what's a typical return I might expect in any given year based on past history? It's a decent forward-looking estimate for one period, but not always the best reflection of past cumulative growth.
So it's good for a quick estimate, a typical year's return maybe, but perhaps not for the full, true picture of how your money actually grew over time.
You've summarized it perfectly.
Acha, so my dear students, if your investment grew by 10% in year one and then by 20% in year two, what's the simple arithmetic average return for these 2 years? Quick calculation.
10 plus 20 divided by 2.
Yeah.
That's right. It's a very straightforward calculation. You would add 10% and 20% to get 30%, and then divide by 2 years, which gives you 15%. Simple, isn't it?
Very simple.
But always remember what we just said about its limitations, especially for judging long-term actual growth. Don't let the simplicity fool you completely. Hashtag 2.4 geometric mean return the true growth rate, the power of compounding.
Now, my dear students, this is where it gets really interesting. And honestly, this is where many people get confused. So let's take our time.
Yes, this is a very important concept.
The arithmetic mean is simple, yes, but as we saw, it doesn't quite capture the magic, the true power of compounding. That amazing phenomenon where your earnings from one period start earning more money in the next period. For the true picture of your wealth growth over time, we need the geometric mean.
The geometric mean.
Think of it exactly like your savings bank account. The interest you earn gets added to your balance, right? And then the next interest payment is calculated on that new higher balance. That's compounding in action. The geometric mean captures that effect.
Excellent point and a truly insightful way to put it. The geometric mean return provides a much more accurate picture of the actual compounded growth of your portfolio over time, precisely because it correctly accounts for this compounding effect.
So it shows the real growth journey.
Exactly. Using the same returns as before, adding 50% in year 1, 35% in year 2, and 27% in year 3. Remember, the arithmetic mean was 4%.
Yes, 4%.
Now, the geometric mean is calculated using that formula we saw for a multi-period HPR. Plus R1x, 1 plus R2x, 1 plus R3, 1 NN. Here, n is the number of years, which is 3.
Okay, so 1.50 x, 1 plus 0.35, x, 1 plus 0.27, 13, 1.
Precisely. Let's calculate this step by step. First, multiply the 1 plus return factors inside the bracket. Put 0.50 as 1.35, x 1.27.
Okay, more 0.5 times 1.35 is 0.675 times 1.27 gives 0.85725.
Perfect. Now, we need to take the cube root of this number because there are 3 years. So 0.8572513. Do you have a calculator handy?
Let's see. The cube root of 0.85725 is about 0.9500.
Exactly. 0.950. Finally, we subtract 1.950011, gets them at 0.0500.
Which is minus 5%.
Yes, a negative 5.00% annual compound return.
Wow. That's completely different from the 4% arithmetic mean.
It is a very significant difference, isn't it? And it's because the geometric mean shows you the true compound rate of return your money experienced. Let's look at why this is so important with that simple example of your money actually growing, using euros like the source did.
Okay, the euro example.
Imagine you start with a capital of ER 1.00. In year 1, you have that terrible negative 50% return. Your balance becomes EUR 1.000, 1.50, quince EUR 0.50. Oh dear, you lost half your money.
Painful.
In year 2, you get a 35% return, but this 35% is calculated on your new reduced balance of EUR 0.50. So your balance becomes EUR of 0.50. 1 plus the 0.35, EUR 0.6750, still less than you started with.
Still down.
In year 3, you get a 27% return. This is calculated on EUR 0.6750. So your final balance becomes EUR 0.6750. 1 plus learned plus U7, EUR 0.8573.
So after 3 years, starting with €1, you actually ended up with less than 86 cents.
Exactly. Your initial EUR 1.000 actually became EUR 0.8573. Now, remember, the arithmetic mean is 4%.
Yes.
If you had simply applied that 4% arithmetic mean each year, your balance would have been EUR 1.08, 1.043. That calculates to EUR 1.1249.
Much higher. EUR 1.12 versus EUR 0.86.
Much higher. That figure, EUR 1.1249, is way off from your actual ending balance of EUR 0.8573. The arithmetic mean clearly overstates your actual growth in this case.
Clearly.
However, what was our geometric mean?
Minus 5%.
Right. Now, if you apply the geometric mean of minus 5% each year, your balance would be EUR 1.00 by 00, 1.00, 0.950, 0.9573.
0.95 times 0.95 times 0.95 is 0.85737.5.
Which is almost exactly your actual ending balance of EUR 0.8573.
Wow, it matches perfectly.
This confirms without a shadow of a doubt, my dear students, that the geometric mean is the true compound rate of return. It accurately reflects how your investment has actually grown over time, taking into account all the ups and downs and the powerful effect of compounding.
That's a fantastic demonstration.
The general rule to remember, my students, is that the geometric mean is always less than or equal to the arithmetic mean. They are only equal if all the returns in your series are exactly the same, which is very rare.
Okay.
And the more volatile your returns are, meaning the more they jump up and down, the more unpredictable they are, the bigger the difference between the arithmetic and geometric means will be.
So volatility makes the difference bigger.
Yes. And that's why the geometric mean is absolutely crucial for understanding historical, cumulative investment performance, especially for long-term investments, where compounding is the absolute key factor for wealth creation.
This is a really important distinction for all of you, my dear students, because it clearly shows the difference between a simple average and the true actual growth of your money over time. Acha. So, my students, why is the geometric mean often a much better way to look at how your long-term investment has performed, especially if you just leave your money invested and don't make any withdrawals or additions? Think about what happens with your earnings each year and how they contribute to the next year's earnings.
Excellent question, my bright students. Why is it better?
Tell us again.
The reason is precisely because the geometric mean correctly accounts for compounding. This means that any earnings or returns you get from one period, be it interest, dividends, or capital gains, are added back to your principal investment. They become part of the base for the next period.
So your money grows on itself.
Exactly. Then, the next period's return is calculated on that new, larger amount. The geometric mean accurately calculates this true compound growth rate, giving you a realistic and honest picture of your overall long-term performance and your actual wealth creation. It tells the true story of your money's growth. Hashtag tag 2.5 harmonic mean return for averaging ratios, the cost averaging champion.
Now, my dear students, we have one more special type of average to discuss called the harmonic mean.
Ah, yes, the harmonic mean.
It's a bit different from the other two. Think of it like this. If you want to find your average speed for a journey where you travel the first half of the distance at one speed and the second half of the distance at another speed, you use the arithmetic mean. But if you travel for the first half of the time at one speed and the second half of the time at another speed, you use the harmonic mean to find the average speed, right? No, wait, I got that mixed up.
It's easy to get mixed up. The harmonic mean is used when you average rates or ratios, particularly when the denominator is what you're averaging over.
Yeah.
Like price per unit.
Okay, averaging rates or ratios, like price per share.
Exactly. The harmonic mean is particularly useful when you are averaging rates like price per share, especially when you are dealing with situations where you invest a fixed amount of money over time, but the price of what you are buying keeps changing.
Fixed amount of money, changing price.
Yes. It tends to give less weight to unusually large values in the rate, like very high prices, making it good for data sets that might have extreme highs or lows, especially when the quantity purchased changes inversely with price.
Okay. How is it used in investing?
A very, very important application of the harmonic mean in investing, my dear students, is in cost averaging, specifically dollar cost averaging, or as we commonly know it in India, rupee cost averaging.
SIPs, systematic investment plans.
Exactly. This is a strategy many of you might use or hear about, especially with systematic investment plans, or SIPs, which are incredibly popular for mutual fund investments in India.
Yes, many people do SIPs.
So imagine you decide to invest a fixed amount of money, say RS1000, every month in a particular stock or a mutual fund. Fixed RS1000 every month.
Okay.
Let's say in month one, the share price or the mutual fund unit price, NAV, is RS10 per unit. You invest your fixed RS1000, so how many units do you buy?
1,000 divided by 10. 100 units.
Correct. You buy 100 units. Now, in month two, let's say the market goes up and the price rises to Rs15 per unit. You still invest your fixed Rs1000. How many units do you buy this month?
1,000 divided by 15. That's 66.67 units.
Exactly. 66.67 units. You buy fewer units because the price is higher.
Right.
Now, let's calculate your actual average price paid per unit over these 2 months. Your total money invested is Rs 1,000
Hmm.
plus Rs 1,000, Rs 2,000. Your total units bought are 100 units plus 66.67 units equals 166.67 units.
Okay, 2,000 rupees invested, 166.67 units bought.
So what is your actual average price paid per unit? You divide the total money invested by the total units bought.
Yeah.
Rs 12.
Exactly,
That's it.
12 student. That is your actual average cost. Now, what if you had simply taken the arithmetic average of the prices? The price was Rs 10 in month 1 and Rs 15 in month 2.
10 plus 15, 2 will 25, 2 equals 25, 2 is 12, 5, 0. But you can clearly see the actual average price you paid was only Rs 12, lower. And this Rs 12 is precisely what the harmonic mean tells you. The formula for the harmonic mean of n values by 1 by 2xn is n 1 by 1 plus 1 by 2 plus 1 by plus 1xn. In our case, n is 2, ec 1, 10 by 2 plus 15.
So 2 on n 10 plus 1 15.
Yes, that's 2.1 plus 0.06667 equals 2.16667.
Calculate 2.
Divided by 0.16667.
It's
12.
Exactly, Rs 12.
Exactly. So for investments like SIPs in India, where you consistently invest a fixed amount of money regularly and the price of the investment changes, the harmonic mean is the correct and most accurate way to calculate your average purchase price per unit.
That's why SIPs work well over time. You average out the cost.
That's the principle.
Yes.
It's effective because you automatically buy more units when the price is low and fewer units when the price is high, which often helps reduce your average cost per unit over the long term compared to investing a lump sum. This is why SIPs are so popular and beneficial for disciplined long-term investing.
Fascinating.
Just so you know, there's an important general relationship between these three means we discussed. Remember, arithmetic, geometric, harmonic.
Yeah.
The harmonic mean is always less than or equal to the geometric mean, which in turn is always less than or equal to the arithmetic mean. Harmonic, geometric, arithmetic.
Okay, H less than G less than A.
They will only be exactly equal if all the values in your data set are identical, which rarely happens with prices or returns.
That's a fantastic real-world example, my dear students. It truly shows why knowing these different averages is so vital for smart and effective investing, especially with popular methods like SIPs. Acha, so my bright students, let's try a quick question on this.
Yep.
Imagine you decide to spend Rs 500 every single week on groceries. Fixed amount, Rs 500.
Okay.
And the price of, say, potatoes changes each week, sometimes high, sometimes low. Which type of average arithmetic, geometric, or harmonic would best tell you the average price per kilogram you actually paid for potatoes over the month? Think about how much money you're spending, fixed, and how much quantity you're getting, variable.
Fixed spending, variable quantity, changing price, which mean reflects the average cost per unit.
Yeah.
Excellent thinking, my students. The harmonic mean would be the most appropriate in this scenario
Why again?
because you are spending a fixed amount of money, Rs 500, to get a variable amount of potatoes each week, depending on their changing price per kilogram. Just like our SIP example, the harmonic mean correctly reflects your average cost per unit, rupees per kilogram in this case, when you are making fixed value purchases at varying prices. Very good.
Now, my dear students, we come to a very important distinction in measuring performance, especially important if you ever have someone managing your investments for you, like a mutual fund manager.
Yes, evaluating performance.
We need to measure performance, but we need to look at it from different angles, because how you experience a return might be quite different from how you should judge your manager's actual skill.
Two different questions, really.
Exactly. It's like asking, did the cricket team play well and win the match? That's one question. Versus asking, did my individual contribution as a player help the team win, considering exactly when I batted and when I bowled and how many runs I scored or wickets I took?
The team result versus the individual player's impact.
Precisely. These are two different perspectives on performance, aren't they? And both can be valid, but they tell you different things. Hashtag tag 3.2 money-weighted return, MWR. Your actual earnings, your decisions included.
So the first perspective is the money-weighted return, MWR. This is truly like your personal scorecard, my student.
My scorecard. Okay.
It reflects the actual return you earned on your specific investment portfolio, taking into full account the exact timing and the exact amount of any cash you put into the investment or took out of it. All your personal cash flow decisions matter here.
So my deposits and withdrawals affect this number.
Greatly. It is very similar in concept and calculation to finding the internal rate of return, or IRR. You might hear about IRR in more advanced finance discussions, especially for evaluating projects or private investments.
IRR, okay.
Think of IRR as the unique discount rate that makes the present value of all your cash inflows, like withdrawals and the final portfolio value, exactly equal to the present value of all your cash outflows,
Mm-hmm.
like your initial investment and subsequent deposits. It's a way of saying, given all my specific deposits and withdrawals at specific times, what was my personal average annual rate of return?
So it's tailored to my actions.
Entirely.
Yeah.
It's all about your specific cash flows and how they affected your personal return experience.
Okay, can we have an example?
Let's imagine a scenario. You invested Rs 100 in a mutual fund at the very beginning of year one. Then, seeing some opportunity perhaps, you added a large sum of Rs 950 at the beginning of year two. Later, maybe you needed some money, so at the end of year two, you withdrew Rs 350.
Okay, 100 in, 950 ins, 350 out.
Correct. Now, let's say the fund itself had a challenging first year with a loss of 35% in year two and 27% in year three.
So bad start, then good recovery for the fund.
Yes. Now, think about your timing. You invested a large amount, that Rs 950, right before the fund had a good year, that 35% return, and you withdrew money after that good year.
Right, my big investment benefited from the good year.
Exactly. Your personal timing of these investments and withdrawals matters a great deal here for the MWR. In this specific example, even with that terrible manifold 50% loss in the first year for the fund, your money-weighted return could turn out to be as high as 26.11%.
Wow, 26%. Even with the fund losing 50% in year one.
Yes, because your larger investments were timed, perhaps luckily, perhaps skillfully, just before the periods when the fund performed much better. The MWR reflects that benefit you received due to your timing.
So it tells me what I actually earned.
Precisely. This calculation tells you, the individual investor, what you personally earned on your investment journey, considering your specific actions. However, and this is a very crucial point, the money-weighted return is not a good measure to compare different individuals or, more importantly, to evaluate fund managers.
Why not?
Because your MWR depends entirely on your unique decisions about when to add or withdraw money. The fund manager has absolutely no control over when you decide to contribute your Diwali bonus or when you need to withdraw funds for a house down payment, right?
No, that's my decision.
So, while the MWR is very personal and relevant to you, it's not a fair or universal yardstick to judge the manager's investment skill compared to another manager because it's heavily influenced by factors outside their control, namely your cash flow timings.
That's a great distinction, Acha. So my dear students, think about this. If you invested a lot of money into a mutual fund when it was performing exceptionally well, and then only a small amount when it wasn't doing so great, would your money-weighted return likely be higher or lower than the fund's overall performance for that period? Think about how your personal timing affects your earnings in this case.
Yes, you put more money in during the good times, less in the bad times. What happens to your MWR?
It should be higher, right?
Yeah. You've got it, my bright students. Your money-weighted return would likely be higher than the fund's underlying performance. Why? Because your larger investments were made during the periods when the fund performed well, effectively magnifying your personal earnings from those good periods.
My good timing boosted my result.
Exactly. This means your personal timing aligned beautifully with the fund's good performance, boosting your individual MWR. Very astute observation. Hashtag 3.3, time-weighted return, TWR, the manager's scorecard.
Now, my dear students, if the MWR is my personal scorecard influenced by my actions, how do we fairly evaluate the fund manager? For that, we need a different and fairer approach. The time-weighted rate of return, TWR.
TWR.
Yes.
This is the true measure of their skill, we could say, because it purposefully removes the effect of your deposits or withdrawals. It isolates the manager's performance.
That's the key idea.
It's like evaluating a bowler's performance in cricket based purely on how many wickets they took and how few runs they conceded per over bowled.
Their economy rate and strike rate? Exactly. Regardless of whether the captain chose to give them more overs in easy matches or tough matches or when they bowled, the manager only controls the bowling, the investment decisions, not necessarily when they get the bowl, when money comes in, or how many overs they get, how much money they manage at different times.
Exactly. A perfect analogy. The TWR measures the compound rate of growth of a single unit of currency, say 1 rupee invested in the portfolio at the very beginning and left there.
As if no money came in or went out.
Precisely. It essentially neutralizes the impact of those cash flows, your deposits and withdrawals, that are outside the manager's control. It allows us to compare different fund managers fairly, as if they all managed the same initial amount for the same period, without the client-initiated cash flows distorting the picture of their skill.
So how is it calculated then if it ignores my cash flows?
It doesn't ignore them, but it accounts for them differently. To calculate the TWR, we follow three very important steps.
Okay, 3 steps.
Step 1. Price the portfolio. You need to determine the value of the portfolio just before any significant amount of money is added or withdrawn by the investor.
So value it right before a cash flow event.
Yes. This action effectively breaks the entire investment period into smaller subperiods, defined by the timing of these external cash flows. Imagine taking a snapshot of the portfolio's value every time money comes in or goes out.
Okay, break it into chunks.
Step 2. Calculate HPR for each subperiod. Once you have defined these subperiods based on the cash flows, you find the simple holding period return, HPR, for each of these smaller periods. This tells you precisely how well the portfolio performed purely based on the assets under management during that specific uninterrupted time, isolating the manager's performance within that chunk of time.
HPR for each chunk. Got it.
Step 3. Link compound the HPRs. Finally, use the geometric mean, there it is again, to link or chain these subperiod HPRs together to get the overall time-weighted return for the entire measurement period.
Geometric mean of the subperiod returns.
Exactly. This gives you the compound growth rate of the portfolio, as if there were no intermediate cash flows distorting the measurement, truly reflecting the manager's performance over time.
Okay, let's try that dividend stock example again, the one in USD from the source.
Yes, let's revisit that example. You bought one share for USD 200 at the beginning, time
Right.
T0. At time T1, end of year 1, you bought another share for USD 225. At time T2, end of year 2, you sold both shares for USD 235 each. And you received a USD 5 dividend at the end of year 1 on the first share and USD 10 total dividends at the end of year 2. USD 5 per share on 2 shares.
Okay, got the cash flows, now the TWR steps.
Step 1. We need to value the portfolio just before the cash flow at T1 when you bought the second share. At T1, the first share was worth USD 225, and you received USD 5 dividend. This marks the end of our first sub-period.
Okay, subperiod 1 is year 1.
Step 2. Calculate HPR for this first sub-period, year 1. You started with USD 200. The value just before the next investment was USD 225, plus you got USD 5 dividend. So the HPR for year 1 was ending value, beginning value plus income. Beginning value 225, 200 plus 5. 230, 200 equals 15%.
15% HPR for year 1.
Okay. Now for the second sub-period, year 2. At the beginning of year 2, just after buying the second share at T1, your total investment was 2 shares, USD 225 share, USD 450.
Right, USD 450 invested at start of year 2.
At the end of year 2, T2, you received USD 10 in total dividends and sold both shares for USD 235 each, making a total ending value of 235 plus 10 USD 470 plus 10 USD 480, including dividends received at the end. Or if we consider the sale proceeds and dividends separately, ending value was 235 plus 470, income was 10. So HPR for year 2 is ending value, beginning value plus income. Beginning value 470, 450 plus 10, 450, 20 plus 10, 450 is 30, 450. That's 1 in 15, which is 6.67%.
Exactly. The HPR for year 2 was 6.67%.
Okay, so year 1 HPR says 15%, year 2 HPR 6.67%.
Right.
Step 3. Now, we link these two subperiod HPRs using the geometric mean to find the overall TWR. The formula is 1 plus HPR 1, 1 plus HPR 2, 12, 1.
So 1 plus 0.15, a 1 plus 0.667, 12, 1.
Yes. Let's calculate this slowly. 1.15, 1.0667. Now we take the square root of this since there are 2 periods. 1.226705.
Square root of 1.226705 is about 1.107567.
Perfect. Finally, subtract 1.1.107567. 1 equals 0.107567.
Which is approximately 10.76%. So the TWR is 10.76%.
Correct. Now let's contrast this with a money-weighted return, MWR, for this very same example, which the source calculated as 9.39%.
So TWR, 10.76% is higher than in year 2, 6.67%. The TWR gives equal weight to the manager's performance in both periods. However, the MWR was lower because you, the investor, invested more money, bought the second share, just before the period of weaker performance, year 2. Your timing of adding more money before the weaker year pulled your personal MWR down.
So TWR ignores my bad timing. Exactly. It reflects the manager's performance purely. 15% in year 1, 6.67% in year 2, leading to a compounded average of 10.76%. This is precisely why TWR is the preferred industry standard measure for evaluating and comparing portfolio managers. It truly reflects their investment skill, independent of when client money flows in or out.
That distinction is so important, isn't it? It's about giving credit where credit is truly due, based purely on the manager's skill in handling the money, not my luck or decisions.
Absolutely.
Acha, so my dear students, final check on this. If you are a judge, maybe working for an investment consulting firm, evaluating two different mutual fund managers, which return measure should you look at to compare their actual investment skill, completely unaffected by when you or other clients decided to add or remove money from their funds, MWR or TWR?
The manager's skill, unaffected by client actions. Which one is it?
It has to be.
That's absolutely right, my students. You should look at the time-weighted return, TWR. It is the most accurate and fairest way to evaluate a manager's investment skill because it removes the influence of client deposits and withdrawals, which are entirely outside of the manager's control. It focuses purely on how well they managed the money that was under their care, period by period.
Excellent. My dear students, we've covered a lot on calculating returns. Now let's look at some important adjustments and special cases. First up, comparing returns over different time periods.
Yes, this is very common.
Imagine you pay your electricity bill monthly, but your neighbor pays quarterly. How would you compare who's actually paying more per year for the same usage, maybe?
You have to put them on the same footing.
Exactly. You need to make them comparable, don't you? You would probably convert both amounts to an equivalent annual figure. That's exactly what annualizing returns helps us do in finance, making fair comparisons. Hashtag tag 4.1, annualizing returns, making different periods comparable.
Exactly, my students. Investments can earn returns over all sorts of different periods, sometimes just a few days or weeks or months or even many, many years. To compare them fairly, especially if you want to understand what the equivalent yearly return would be, we convert them into an annualized return.
So we scale it up or down to a one-year equivalent.
That's the idea. The general formula using compounding is R annual equals 1 plus R period, C1. Here, R period is the return you got over the specific period, like a week or a month. And C is the number of those shorter periods in a full year.
C is the compounding frequency per year.
Okay, let's see some examples to make this very clear for you. Suppose you earned a small but mighty 0.2% return in just 1 week. How impressive would that be if you could maintain it over a whole year?
Okay, 1 week is the period. How many weeks in a year? 52. So C, 52.
Yeah, so the annualized return would be 1 plus 0.002521. Calculate. 1.002 raised to the power of 52.
1.00252 is about 1.1095.
So 1.1095, 1.1095, or 10.95%. So that small weekly return translates to a very good potential annual return if it could be sustained.
If. Big if.
Very big if. Let's try another. What if you earned 0.4% return over a period of 15 days?
Okay, period is 15 days. How many 15-day periods in a year? That's 365.15.
Exactly. C equals 365.15, which is approximately 24.33. So the calculation is 1 plus 0.004366514, or 1.00424.331.
1.004 to the power 24.33 is roughly 1.1020.
Right, so 1.1020, 1 is equal to 0.100, or 10.20%. Again, a strong potential annual return extrapolated from a short-term gain.
Okay, that's for periods shorter than a year. What if it's longer?
Good question. What if your holding period return is actually longer than a year? For instance, you earned a 20% total return over an 18-month period.
Right, or think of it this way. 1 year, 12 months is 12, 18, or 23 of an 18-month period. So C in our formula, 1 plus R period, C1 becomes the number of years, which is 12, 18, or 23.
So C is the number of years this time. Yes, when annualizing a multi-year return, C becomes 1T, where T is the total time in years. Here, T 1.5, so C 11.5 equals 23.
Yeah.
The formula becomes 1 plus R period, 1T. So 1 plus 0.2, 11.5, 1, or 1 plus 0.20 to
Yeah.
1.
Okay, 1.20 to the power 23, that's about 1.1292.
Correct. So 1.1292, 1 equals 0.1292, or 12.92% per year. So an 18-month total return of 20% is equivalent to earning about 12.92% compounded annually.
Makes sense.
However, my dear students, here's a very, very important caution again, a big warning sign.
What is it this time?
Annualizing short-term returns, like that weekly 0.2% or 15-day 0.4%, assumes that this short-term performance can be repeated perfectly, consistently, over a whole year.
Which is very unlikely.
Extremely unlikely. If you earn 5% in 1 week because of some sudden market surge or good news, it's highly, highly improbable you'll earn 5% every single week for the rest of the year. That would lead to an annualized return of 1.05521, which is over 1,200%.
That's unrealistic.
Absolutely not. So you must use annualized short-term returns with this huge limitation firmly in mind. It shows the potential if repeated, but not a prediction. You can't hit a 6 on every ball in a cricket match, can you?
No, definitely not. Some days are just better than others. This is a very common mistake people make, to think a quick gain will just repeat forever.
It is. Be very skeptical of annualized short-term numbers.
That's a crucial warning indeed. We often get carried away by those quick wins, don't we? So, my dear students, if your investment gives you a steady 1% return every month, what's your approximate annualized return? And what's that important caution you should remember about this calculation, considering what we just discussed about annualizing short-term gains?
1% per month, 12 months in a year. What's the annualized rate? And the big but.
Yes.
Very good. If you earn 1% every month, the compounded annualized return would be 1.0112.1. That's about 12.68%. Many people might just approximate it as 1%. 12 equals 12%, which is close but ignores compounding.
Okay, around 12, 13%. And the cost.
The important caution is that this calculation assumes that you will perfectly earn 1% every single month for all 12 months, and that you will also reinvest those earnings perfectly at the same rate. This perfect consistency is highly unrealistic in the real world of investing, where returns fluctuate constantly. So while it gives you a number, 12.68%, remember its very strong assumption about perfect repeatability, which is almost never true. Hashtag 4.2, continuously compounded returns for technical models.
This next one, my dear students, is a bit more technical. You probably won't calculate this for your own bank FD, but it is used quite a lot by finance professionals for complex models and calculations.
Yes, it's more theoretical but useful.
It's called continuously compounded return. It's like measuring something with infinite precision, where interest is compounding not just daily or hourly, but constantly, every tiny fraction of a second.
That's a very good way to put it, my friend. A continuously compounded return is derived using natural logarithms, the n button on your calculator. It's a theoretical concept that assumes compounding happens an infinite number of times over a period.
Natural logs.
Okay.
How does it work?
If your holding period return, HPR for a period, is R, the equivalent continuously compounded return, let's call it RCC, is RCC equals ln1 plus R.
ln1 plus HPR.
Yes. For example, if your HPR for a week is 0.04 or 4%, the equivalent continuously compounded return is ln1 plus 0.04 equals ln1.04 if you calculate that.
ln1.04 is 0.039221.
Right. So the continuously compounded return is 3.9221%. Notice it's slightly less than the discrete 4% HPR. This is always true for positive returns.
Okay. Why bother with this complicated thing then?
The beauty and the main reason financial experts use continuously compounded returns is that they're additive over time.
Additive, what does that mean?
It means if you have the continuously compounded return for period 1, RCC1, and for period 2, RCC2, the continuously compounded return for the total period, period 1 plus period 2, is simply RCC1 plus RCC2. You just add them up.
Oh, unlike regular HPRs where we had to multiply 1 plus R1 plus R2.
Yeah. Exactly. With discrete HPRs, you have to do multiplicative compounding. With continuously compounded returns, you can just add them. If you have daily continuously compounded returns, you can simply sum them up to get the weekly or annual continuously compounded return.
That sounds much easier for calculations over many periods.
It is. This additive property makes them very convenient for building mathematical models, especially in areas like option pricing, like the Black-Scholes model, and risk management. It greatly simplifies the math behind many advanced financial theories and calculations, making them much cleaner and more tractable.
So, my dear students, why might a financial expert prefer to use continuously compounded returns when doing very complex calculations, even if it's not how we normally think about our own everyday investments in our bank accounts? Think about that special mathematical property we just mentioned.
Why additivity is so useful? Precisely. The main reason, my students, is their additive property over time. This simplifies calculations greatly, especially when chaining returns over multiple periods or building complex financial models that require summing up effects over time. It makes the underlying mathematics much cleaner and more efficient for technical analysis, even if it feels a bit abstract compared to how we see our everyday bank statements. Hashtag 4.3 gross versus net returns the fund's view versus your wallet's view. My dear students, let's now discuss returns with respect to something very practical. Fees and expenses. This is a very, very important point for you as an investor because fees, even small ones, can significantly eat into your actual earnings over the long term.
Yes, those hidden charges.
They can add up. So we need to distinguish between two types of returns here. First, we have gross return.
Gross return before costs.
Mostly. Gross return is the return earned by an asset manager before deducting their management fees, like the fee and mutual fund charges, any administrative expenses, or any taxes. However, it does usually account for direct trading expenses like brokerage commissions or stamp duty paid when buying selling shares,
Why include trading costs but not management fees?
because those trading costs are considered an integral part of generating the return you have to trade to make investment changes. The management and admin fees are more like the overhead cost of running the fund operation.
Okay, so gross return is mainly useful for.
Gross return is the right measure if you want to compare the pure investment skill of different asset managers. Think of it as the fund's raw score before the umpire's fees, management fees, and stadium maintenance costs, admin fees, are deducted. It tells you how well the manager performed purely in picking and managing the investments themselves.
Aisha, so if I'm trying to figure out which manager is truly better at making money from the market, ignoring the different charges and fees their funds might have, I should look at their gross return. Is that right?
Exactly, that's right. It gives a clearer picture of their investment acumen. Now, on the other hand, my students, we have net return.
Net return, this must be after costs.
Yes. This is what the investment vehicle, like your mutual fund, actually earned for you, the investor, after deducting all those managerial and administrative expenses from the gross return.
So this is what lands in my account.
Pretty much.
Yeah.
Before taxes, at least. As an individual investor, this net return is the return that truly goes into your pocket, into your investment account statement. So it's often what you care about most when tracking your own wealth.
That makes sense.
Sometimes you might notice smaller mutual funds even waive parts of their fees temporarily, especially when they are new. Why? To make their net returns look more attractive and competitive compared to larger funds, because they know investors focus heavily on this final take-home number.
Marketing strategy using net returns.
Can be. So to summarize, the gross return is primarily for comparing the skill of different managers, maybe for selecting a manager. But the net return is for understanding what you personally received in your investment account after all the fund's operational charges. Both are important for different purposes, depending on the question you're asking.
Gotcha. So my dear students, if you want to know how good your mutual fund manager is purely at picking stocks and making smart investment decisions, should you look at the gross return or the net return? And why? Tell me again.
And your skill.
Picking stocks.
Which return shows that better?
Gross or net?
You're thinking like a very smart investor, my students. You should look at the gross return. Why? Because it reflects their pure performance and investment skill before any management and administrative costs are deducted. These costs can vary between funds for reasons unrelated to investment skill, and they are often outside the manager's direct control regarding their day-to-day investment decisions. Gross return isolates their ability to pick the right stocks and manage the portfolio effectively. Very well done. Hack, tag, 4.4 pre-tax versus after-tax nominal return. What the government takes.
My dear students, we've talked about fund fees, but there's another hand reaching for a share of your earnings. The tax man.
Indeed. Taxes are a certainty.
We all know that what we earn isn't always what we get to keep, right? It's just like looking at your salary slip. You see your gross salary, the big number, but then there are all these deductions listed. Provident fund, maybe professional tax, and definitely income tax. And what you actually take home in your hand, the net salary, can be quite different.
Yes, the in-hand amount.
This is very similar for your investments, too.
Exactly. Up until now, when we talked about gross and net returns, we've mostly been discussing pre-tax nominal returns. That is, returns before any taxes on those returns are considered.
Okay, pre-tax.
But taxes can significantly reduce what you actually receive from your investment earnings. The after-tax nominal return is your total return, usually based on the net return from the fund, minus any allowance for taxes payable on your dividends, your interest income, and your capital gains.
So it's net return minus taxes.
Essentially, yes.
Yeah.
And remember, in India, the tax rules can be complex. Capital gains, the profits you made from selling investments, might be taxed differently from income, like dividends or interest. And capital gains themselves won't be taxed differently depending on how long you held the investment short-term versus long-term gains often have different rates.
Yes, the tax rules change sometimes, too.
They do. Now, smart fund managers sometimes even try to minimize the tax liability for their investors. They might do this by choosing certain types of investments that are more tax efficient, like certain bonds or equity funds held long-term, or perhaps by trading less often to avoid triggering short-term capital gains taxes, which can be higher than long-term ones.
So the manager can influence the tax impact somewhat.
They can try, yes.
Yeah.
It's called tax-aware investing. But ultimately for you, the individual investor, the after-tax return is what truly matters for your final wealth accumulation, for your actual purchasing power increase.
Makes sense. Can we see an example?
Absolutely. Let's say your mutual fund gives you a net return after its fees of 15% in a year. That sounds excellent, doesn't it?
Very good.
But then, suppose according to the tax laws, you have to pay a 20% tax on that investment earning.
Okay, 20% tax rate on the 15% gain.
Yes. So your after-tax return is not the full 15%. The tax amount is 20% of 15%, which is 0.20 is 15%, goes 3%.
So 3% goes to tax.
Exactly. Your after-tax return is then 15% net return, 3%.
Yeah.
Tax will be 12%. So for every 100 rupees you earned after fund fees, 3 rupees went to taxes, leaving you with only 12 rupees of actual gain in your pocket from that 15% net return. It's a significant difference that directly impacts your final wealth.
It certainly is. 15% sounds much better than 12%. That's a very clear illustration of how much the tax implications can affect our take-home earnings. Acha, so my dear students, quick calculation. If you earn 10% net return on your investment, but the government takes 20% of those earnings as tax, what is your after-tax return that truly comes to you and stays in your pocket? Calculate it quickly.
10% earned, 20% tax on the earning. What's left?
Yes.
Very quickly, you can calculate that. The tax amount is 20% of 10%, which is 0.20 multiplied by 10% is 2%.
Right, 2% is the tax.
So your after-tax return is 10%, net return minus 2%. Tax equals 8%. This 8% is the amount that truly increases your wealth and your ability to buy things after paying the government's share. Good job. Hashtag tag 4.5 real returns, your true purchasing power. My dear students, we've talked about fund fees, we've talked about taxes. But beyond these explicit costs, there's another hidden factor, a silent thief, that constantly reduces your actual purchasing power. Do you remember what it is?
Is it inflation?
Exactly. Inflation. We talked about the inflation premium as an ingredient in interest rates earlier, and it's also absolutely crucial for understanding your investment returns properly. The real return tells you what your money can actually buy after accounting for the effect of rising prices.
So return adjusted for price increases.
Precisely. It measures the increase in your actual purchasing power. It's very useful for comparing returns over different time periods when inflation might have been different, or even across different countries where inflation rates might vary greatly. It gives you a true sense of wealth increase.
How do we calculate it?
The relationship between your nominal return, which is the return before adjusting for inflation, like the pre-tax or after-tax nominal returns we just discussed, and your real return is approximately given by the Fisher equation. A simplified version is 1 plus real return, 1 plus nominal return, 1 plus inflation. Then you solve for the real return.
Okay, divide 1 plus nominal by 1 plus inflation, then subtract 1.
That's the calculation. Let's take an example. Suppose your investment gives you an after-tax nominal return of 8%. Sounds reasonably good.
Yes, 8% after tax seems okay.
But let's say the inflation rate in the economy during that same period, the rate at which prices of goods and services are rising, is 2.1%.
Okay, 8% nominal return, 2.1% inflation.
Your real return, your true increase in purchasing power, would be calculated as 1 plus 0.08, 1 plus 0.021.
So 1.08 divided by 1.021 minus...
1.08, 1.021 is approximately 1.05778. Then 1.05778.
Which is about 5.8%.
Exactly. Roughly 5.8%. This 5.8% tells you how much your purchasing power has truly increased. So, while the numbers in your investment account grew by 8% after tax, the cost of living also went up by 2.1%, meaning your actual ability to buy goods and services only increased by 5.8%.
That's much lower than 8%.
It is, and this distinction is especially critically important when you're saving for long-term goals. Think about your child's higher education 15 or 20 years from now, or your own retirement perhaps 30 years away.
Right, long term.
If your real return isn't positive or is very low, your future self might find that all the money you saved buys significantly less education or retirement comfort than you had originally anticipated. Inflation is a powerful eroding force over long periods.
That's a critical point for any long-term planning because inflation is always silently eating away at our money's value, isn't it? Even a small percentage each year adds up hugely over decades.
Absolutely. It's the silent killer of purchasing power.
Acha. So, my dear students, why is it so important, perhaps the most important perspective for long-term goals, to look at real returns instead of just nominal returns when you're saving for something far off in the future, like your child's education 15 years from now? Tell me why this matters so much for planning.
Why focus on real returns for the long term?
Yes.
Wonderful question. It's because real returns tell you how much your purchasing power will actually increase over time, after completely accounting for the eroding effect of inflation. If you only look at nominal returns, you might feel rich on paper, seeing your account balance grow nicely. But if inflation has been consistently high over those 15 or 20 years, your accumulated money might buy significantly less education or fewer goods and services than you had anticipated when that future goal arrives. Real returns provide a much more honest, realistic, and accurate picture of your true wealth growth and your ability to afford your future goals. It's about what your money can actually do for you. Hashtag tag tag 4.6, leveraged return, amplifying gains and losses.
This last concept for today, my dear students, is a bit more advanced. Maybe not for everyone starting out, but it is very, very important to understand, especially for those who might consider borrowing money to invest. Using leverage.
Yes, leverage. A powerful concept.
It's like using a powerful magnifying glass on your investments. It can make things look much bigger.
Mm-hmm.
Both the good outcomes and, unfortunately, the bad ones, too. It amplifies everything.
That's a perfect analogy, my friend. A magnifying glass for returns and risks. Leverage in finance means precisely using borrowed money debt to increase the potential returns and risks of an investment.
Borrowing to invest.
Yes. You can do this in relatively simple ways, like taking a loan against property or shares from a bank to buy more shares or invest in another property. Or it can be done through more sophisticated financial instruments like futures contracts or options, where you can control a large asset value with only a small amount of your own money put down as margin.
Okay. How does it affect returns mathematically?
The key formula for calculating leveraged return, let's call it RL, is RL equals RP plus VB VY RP RD. Let's break that down.
Okay, RL equals leveraged return. What are the other parts?
RP is the return on the portfolio or asset itself, what your investments earned before considering the loan. VB is the value of borrowed funds, the loan amount. VE is your own equity, your own money you're invested. And RD is the cost of borrowing, the interest rate you pay on the loan, the debt cost.
Okay, RP plus borrowed equity, portfolio return debt cost.
Exactly. Now here's the crucial point, my students, and please listen very carefully to this. If your portfolio return, RP, is higher than your borrowing cost, RD, then the term RPRD is positive.
Right, you're earning more than you're paying in interest.
In that case, using leverage, having borrowed funds, VB, will amplify your gains. The second part of the formula adds a positive amount to your portfolio return.
So leverage boosts my return.
Yes. For example, imagine you have a Rs 10 lakh portfolio that earns 8%. RP at T%.
Yeah.
You funded this with Rs 7 lakh of your own money, VE 7 lakh, and borrowed Rs 3 lakh, VB 3 lakh, at a 5% interest rate, RD 5%.
Okay, RP 8%, RD 5%, earning more than the cost.
Your leveraged return, RL, would be 8% plus 3 lakh, 7 lakh, 8%, 5%. That's 8% plus 12.4286, 3%.
0.4286 times 3% is about 1.286%.
Right. So RL equals 8% plus 1.286% is higher than the portfolio's underlying return, 8%. The leverage magnified your gain. This seems very attractive, doesn't it? More return.
It does seem attractive, but there's always a but, isn't there?
There is indeed a very big BUT, my dear students. What happens if your portfolio return, RP, is lower than your borrowing cost, RD?
If the investment earns less than the loan interest.
Exactly. For instance, if your portfolio earns only 4%, RP 4%, but you're still paying 5% interest on your loan, RD 5%, then the RPRD part of the formula becomes 4% to 5%. It's negative.
Okay, negative difference.
Now, that negative difference gets multiplied by your leverage ratio, VBDE, and subtracted from your portfolio return. Leverage will now amplify your losses or reduce your gains even further.
So the magnifying glass works both ways.
Precisely. It is truly a double-edged sword. If your portfolio return is lower than your borrowing cost, leverage makes a bad situation worse. It can accelerate your losses significantly, turning a small loss or a small gain into a much bigger loss on your own equity.
So while it offers the potential for much higher returns, it significantly increases your risk of much larger losses too.
That's the heart of leverage. Higher potential reward comes with significantly higher potential risk. You must be very, very cautious when using borrowed money to invest. Understand the risks fully.
That's a powerful reminder that high potential returns often come hand in hand with high risks. Acha. Some of your students, final check on this advanced point. If you borrow money to invest and your investment earns less than what you are paying in interest on that loan, what will happen to your overall return compared to if you had not borrowed at all? Think about that magnifying glass effect we discussed.
Earning less than the interest cost. What does leverage do then?
Yes.
Absolutely right, my students. Your overall return will be even worse than if you had not borrowed at all. Why? Because in this negative scenario, where RP is less than RD, leverage actively amplifies the negative outcome. You're not only potentially losing money on the investment itself if RP is negative, but you're definitely paying interest on borrowed money that isn't generating enough income to even cover its own cost. It truly accelerates your losses on your equity. So remember, always be very, very cautious with leverage. Understand it before you use it. Hashtag tag tag outro.
Wow. What a deep dive we have had today, my dear students. Truly into the nuts and bolts of rates and returns.
We covered a lot of ground.
We really did. We have carefully unpacked what an interest rate truly means, thinking about it as a required return, a discount rate, or an opportunity cost. We explored all the different premium ingredients that make it up, from the real risk-free rate to those important premiums for inflation, default risk, liquidity risk, and maturity risks.
Yes, understanding those components is key.
Then we learned about various ways to measure how our investments grow, from the simple holding period returns
The basic score.
to the crucial geometric mean that correctly accounts for compounding over time, giving us the true growth rate.
Very important, the geometric mean.
And even the specialized harmonic mean, which is so useful for understanding your average cost when you do regular investing, like SIPs.
Yes, the cost averaging champion.
We also saw how important it is to distinguish between your personal earnings, reflected in the money-weighted return,
Your scorecard.
and a manager's actual investment skill, which is better measured by the time-weighted return.
The manager's scorecard.
And finally, we touched upon how very real-world factors like fees, gross versus net, taxes, pre-tax versus after-tax, inflation, nominal versus real returns, and even borrowing money, leveraged returns, can significantly change the real picture of your earnings and your ultimate purchasing power.
Indeed. Our primary goal today, my dear students, was to give you a strong, clear foundation. Not just for memorizing formulas, no.
No, not just formula.
But for truly understanding what these numbers mean in your everyday financial life, how they connect to your goals, your decisions, your future. Remember, knowledge is power, especially when it comes to managing your money wisely for yourself and your family.
So well said. So, my dear students, the next time you hear someone talk about their investment returns or you read about it in the newspaper, you now have the knowledge and the tools to ask them a smart question. Which return are we talking about here? Is that the money-weighted, the time-weighted, or maybe even the real return after taxes and inflation?
Asking the right questions.
Asking the right questions. And that, my bright students, is the true mark of a truly informed and intelligent financial mind. You now have a stronger foundation to ask smarter questions and make better financial decisions for your own future. That was our hope for today.
Keep learning, my dear students. Keep questioning everything. Keep digging deeper. And keep building that strong financial foundation, brick by brick. Remember, financial knowledge is truly a superpower in today's complex world. Until next time, take great care and keep exploring the fascinating world of finance.
Goodbye for now, my dear students. Take care.
Namaste, my dear students, and a very warm welcome to our special deep dive lesson today.
Hello, everyone.
Imagine we are all sitting together, perhaps in a comfortable space, ready to learn something truly foundational for our financial journey. Today, we're going to unravel some of the most important concepts in the world of money. Concepts that are not just for experts, mind you, but for everyone.
Indeed. Today, we are going to embark on a fascinating journey, right into the very heart of finance. We'll be exploring something called the time value of money. It's a bit like understanding how money breathes and grows over time, much like a small sapling growing into a strong tree. We will take all your notes and sources and simplify them piece by piece so you can build a very strong foundation. Think of it as laying the bricks for a magnificent building, one by one, making sure each brick is perfectly placed.
Yes, we have a wonderful set of materials to guide us through this important topic. Our mission today is quite clear. First, we want to understand the fundamental idea of how the value of money changes with time. That's key. Then, we will learn how we can calculate the current worth of future money, what we call present value, especially for important financial instruments like bonds and stocks. After that, we will explore how to figure out the hidden implied return, or growth that these investments might be secretly promising you. Almost like reading between the lines, isn't it?
Yes, yes.
And finally, we will discover a very elegant and powerful principle called cash flow additivity. This helps us understand why prices are what they are on the market and, importantly, how to spot if something is priced unfairly.
Ah, yes.
It's going to be a real eye-opener, I promise you, a real aha moment.
Don't worry if these terms sound new or a little intimidating, my young friends. We will go very slowly, explaining each concept with simple, everyday examples, just like we do in our classes. Think of it as preparing for a big family wedding. You start saving money years in advance. No.
Right.
But the money you save today is not exactly the same as the money you will have years later, because what you can buy with it, or how much more it could have grown, might change. This lesson is about making sense of such changes. Let us begin this important session.
Okay, let's begin. Let's start by understanding the very first and most fundamental concept, the time value of money. TDM, we sometimes call it. Have you ever noticed how 100 rupees you have today feels more valuable, more concrete than, say, 100 rupees you might receive next year, perhaps as a promise for a future gift? That feeling, that intuition you have, is precisely what time value of money is about. It's the powerful idea that money available now is worth more than the identical sum in the future, simply because of its potential to earn more money over time. It can be invested, you see. It can grow.
Exactly. Let's make it even more relatable. An everyday example. Imagine you promise your younger brother 100 rupees for helping you with chores. Okay. If you give him 100 rupees today, he can immediately run to the market and buy his favorite cricket ball, or perhaps some nice jalabis.
Yes.
But if you promise him 100 rupees next year, well, that same 100 rupees might buy him a slightly smaller cricket ball, or maybe fewer jalabis. Why? Because prices might have gone up a little due to inflation.
Inflation, right.
Or, consider this. If he had the 100 rupees today, he could have put it in a small savings account, maybe in the post office, and earned a little interest, making it grow to, say, 105 rupees by next year. So 100 rupees today is fundamentally more valuable than 100 rupees a year from now. Makes sense, no? This crucial idea is captured by two key terms: present value, PV, and future value, FV. Present value is the value of money today, right now, in your hands. And future value is the value of that same money at some point in the future after it has had time to grow. The discount rate, or interest rate, we usually denote it as R, is what connects them. It acts as the bridge that allows money to travel through time, so to speak.
A bridge, I like that.
And T is simply the number of periods, usually years, but could be months or quarters over which this money grows or is discounted. The simple formula to see how much your money will be worth in the future is FVT equals PV times 1 plus R raised to the power of T. FVT equals PV 1 plus RT.
Yep.
Here, that 1 plus R multiplier, it captures the interest earned each period. And when you raise it to the power of T, it shows how that interest compounds over T periods, leading to, well, potentially exponential growth. It's like planting a small seed, your PV, that grows bigger, the FV over time T, with the right nourishment, which is R. And conversely, if you want to know what a future amount of money is worth today to bring it back to the present you use, PV equals FVT divided by 1 plus RT. PV equals FVT, 1 plus RT.
You're dividing now.
Exactly. Here we're discounting that future amount back, essentially reversing the compounding process to find its present-day equivalent value. This is incredibly useful for making smart decisions about future financial goals, like saving for college or retirement.
Okay, so my intelligence students, let's test your understanding quickly. If you have 500 rupees today and you decide to put it in a fixed deposit at the bank, will its value be more or less than 500 rupees 1 year from now? Think about the interest you earn. What do you think? More or less?
More, yes.
Yeah.
Precisely. It will certainly be more than 500 rupees next year. Why? Because of the interest you earn. That interest adds to your principal, your initial 500 rupees, and then that new larger amount starts earning interest too. This is the magic of compounding, a fundamental force in finance.
It really is.
You've grasped the basic concept of the time value of money, and that's an excellent start. Well done. Now let's take this understanding and apply it to something very practical in the financial world. Fixed income instruments. Think of these as a formal promise, very much like a loan, actually. When you, as an investor, buy a fixed income instrument, you are essentially lending money to someone. It could be a large company like Tata or Reliance or even our own government.
Right.
In return, they promise to pay you back your original money. We call this the principal or face value plus some interest over a predetermined period. The discount rate that we use to value these instruments is often called the yield to maturity, or YTM for short. This YTM is a crucial concept. It represents the total return an investor expects to earn if they hold the bond exactly until it matures. And importantly, assuming all the interest payments they receive are reinvested at the very same rate, it gives you a single annualized rate of return for the bond, a way to compare different bonds. We will explore 3 common ways these promises, these bonds, are structured, plus a very common type of everyday loan that uses these very same principles.
First, let's consider a very straightforward type of fixed income instrument called a discount bond. This is like a very simple promise. Imagine you buy a special ticket today for a smaller amount, say 70 rupees. And in the future, maybe after 5 years, you get a larger single payment back, maybe 100 rupees. The important thing is there are no regular interest payments in between. Nothing. The entire return you earn comes from the difference between what you paid today, 70 rupees, and the larger amount you receive at maturity, 100 rupees. That 30 rupees is your earning. This is why it's also called a zero-coupon bond, because there are no coupons. Coupon is just the old word for the interest payment. So zero coupons means no intermediate interest payments along the way. It's a bit like buying a savings certificate from the post office, maybe, where you pay a lump sum now and get a bigger lump sum later.
That's a good analogy. Let's take a very real and practical example from our own India. Suppose our Indian government issues a bond that promises to pay INR 100 in 20 years. Okay, a long time. This INR 100 is the face value or par value of the bond. It's the amount you will receive at maturity, guaranteed by the government. Now, if the market's YTM, or discount rate, which is the rate investors currently expect to earn on such a long-term government bond, is, let's say, 6.70% per year.
Okay, 6.7%.
What should an investor pay for this bond today? We use our present value formula, PV gil F, FV 1 plus RT. So PV was IR 100 divided by 1 plus 0.067 raised to the power of 20. When we calculate this, let me see, it comes to approximately INR 27.33.
Wow, just 27 rupees.
Yes. Just 27 rupees and 33 paise today buys you a guaranteed 100 rupees 20 years from now. Isn't that interesting? You pay significantly less than the face value. The bond discounts that future 100 rupee payment back to today's price. This illustrates the incredible power of compounding over 2 decades. It makes even small amounts grow significantly.
Especially when backed by a government's promise, which is considered very safe.
Precisely. This is how patient, long-term investors secure future value for goals like retirement or their children's higher education. Now, let's think about how the price of this bond changes over time if interest rates remain constant. This is important. The price, PV, of this bond will gradually increase over time, getting closer and closer to that 100 rupees final payment. This gradual increase has a name. It's called accretion, or pull to par.
Pull to par. Like it's being pulled towards the 100 rupees.
Exactly. For example, if you hold this bond for 3 years, now with only 17 years remaining until maturity, its price would naturally rise to INR 33.21, assuming the rate stays at 6.7%. This INR 5.88 increase from your initial INR 27.33 investment, that's the implied interest you've earned over those 3 years, simply by holding the bond.
Just by waiting.
Yes, just by waiting. It's like watching a small sapling growing taller each year, adding value over time without you having to do anything extra. But, and this is a very big but, what happens if interest rates change in the market?
Ah, yes.
This is a crucial point for bond investors. If the market's discount rate, the YTM, suddenly jumps, say, to 7.70% from 6.70%.
So rates went up.
Yes, rates went up. Then the bond's price would drop significantly. If the price of our 20-year bond falls to INR 22.68, for example, that implies the market's required interest rate has jumped to 7.7%. This clearly shows an inverse relationship between bond prices and interest rates.
Inverse, meaning they move in opposite directions.
Yeah. Exactly. When interest rates go up, existing bond prices generally go down, and vice versa. When interest rates fall, existing bond prices rise. It's like when the price of onions goes up in the market, the value of the onions you already bought feels less, in a way. The value of your existing bonds is affected by new market rates. This is a key risk for bond investors, interest rate risk.
Interest rate risk, okay.
We've even seen unusual examples with negative interest rates in some developed markets, like with German government bonds. In July 2016, Germany issued 10-year bonds at a negative yield of minus 0.05%.
Negative? How is that possible?
It meant investors actually paid slightly more than they would get back at maturity. For instance, EUR 100.50 for a EUR 100 principal payment in 10 years. This isn't usually a profitable investment in the traditional sense, no.
No.
It signified unique market conditions. Often when investors are prioritizing the safety of their capital above everything else, perhaps during times of high economic uncertainty or deflation fears, they were essentially willing to pay a small premium just to keep their money safe with the German government.
Wow. Paying for safety.
Yes. Then, if that same bond later trades at, say, EUR 95.72, the YTM for a new investor buying at that lower price becomes positive again, maybe 1.12% for the remaining period. So the implied return changes based on the current price.
Okay, my bright students, a quick check. If you buy a discount bond for, say, 70 rupees today, and it promises to give you 100 rupees back after a few years, is that generally a good deal for you as an investor or not?
Yes.
Yes.
It is.
And thinking about the name, what does the discount part in discount bond actually mean? Why is it called that?
It means you are paying less than the face value. No.
Exactly.
Precisely. It is indeed a good deal. You're making money. And discount means you pay less than the bond's face value or par value today. You're catching on quickly, my young financial wizards. This fundamental understanding will serve you well.
Okay, next, let's move to a more common type of bond called coupon bonds. These are probably what most people think of when they hear the word bond. This is like a loan where you, the investor, don't just wait for one big payment at the end, like the discount bond. Instead, you get small, regular interest payments throughout the life of the bond. We call these coupons. It's an old term from when bonds actually had physical coupons you had to clip and present to get your interest plan.
Yes. I remember those days.
So you get these regular coupons, maybe every 6 months or every year. And then at the very end, at maturity, you get your main principal money back as well. Think of it like maybe renting out a room in your house. You get regular rent payments, and eventually, if you sell the house, you get the main value back. But here, the rent is the coupon, and the house sale is the principal repayment.
That's a good way to think about it, yes. To calculate the price, or present value, of a coupon bond, it's a bit like putting together a puzzle with many pieces. The price of a coupon bond is the sum of the present values of all these small, regular interest payments, the coupons.
All of them?
Yes, all of them, brought back to today's value, plus the present value of the final big principal payment that you receive at maturity. The formula for this looks a little long, perhaps, but don't be intimidated. It's just adding up many small pieces. It's PV equals PMT1, 1 plus R1 plus PMT2, 1 plus R2 plus R, all the way to the last period, plus PMTN plus FVN, 1 plus RN.
Lots of terms.
Yes. Here, PMT is each periodic interest payment, the coupon. FVN is the final principal payment, the face value you get back at maturity. R is our discount rate, or YTM. And N is the total number of payment periods until maturity. Conceptually, it's just adding up the present value of each future cash flow the bond gives you. Let's use an example to make it clearer. Imagine a bond from the Greek government. It has a face value of EUR 100, and it pays €2 every year as a coupon for 7 years.
Okay.
€2 a year for 7 years. And then, at the end of 7 years, it returns the €100 principal back. Now, here's a very important rule, something to remember always. If the bond's coupon rate, in this case, €2 on 100, so 2% equals the yield to maturity, YTM, that the market expects, which let's say is also 2%.
Coupon rate equals YTM.
Yes. If they are equal, then the bond's price at issuance will be exactly EUR 100. It will trade at its face value or par value. It's perfectly balanced.
Okay, that makes sense.
Now, what happens if the YTM changes after the bond has been issued? Let's say market interest rates rise. If the market's required return, YTM for this Greek bond rises, say, to 3.532% from the initial 2%.
So rates went up again.
Yes. Then the price of the bond will drop below 100. It will drop to EUR 93.091, approximately. This represents a capital loss for an investor who bought it at EUR 100 and now sees its market price fall. This again shows that inverse relationship we discussed. Higher interest rates in the market mean lower prices for existing bonds. It's like when the price of gold suddenly drops, the gold you bought earlier is now worth less in the market if you were to sell it today.
Right, that capital loss.
Now, many bonds, including some issued by our own Indian government, pay interest semi-annually.
Semi-annual.
Meaning twice a year, rather than annually. So the coupon payments are split into 2, and you receive them every 6 months. So if our 20-year Indian government bond, the one with the 100 rupee face value, has an annualized coupon of 6.70%.
Okay.
It actually pays half of that, which is 3.35 rupees every 6 months.
Oh, okay. 3.35 every 6 months.
Yes. And over 20 years, how many periods is that? It's 20 times 2, so 40 periods.
40 periods, right.
If the annualized YTM is also 6.70%, which means 3.35% every 6 months to match the payment frequency, the bond's price is again INR 100 because coupon rate equals YTM.
Par value again.
Yes. But if the annualized YTM jumps to 7.70%, meaning 3.85% every 6 months,
Higher rate.
The price of this bond would fall to INR 89.88. See how important the interest rate is? Even a small change can affect the bond's value significantly. And remember, when compounding semi-annually, you must adjust both the annual interest rate by dividing by 2 and the number of periods by multiplying by 2 to reflect the half-year intervals correctly in your calculations. Very important detail.
Got it. Adjust both rate and time. Okay, so my keen students, quick check again. If a bond pays you regular coupons, like those small steady payments, and then your main principal money back at the very end, Is that considered a fixed income instrument? Yes or no?
Yes.
Yes, it is. And what does it mean for the payments if a bond is described as paying semi-annual coupons? How often do you get paid?
Twice a year.
Twice a year. Very good. You're following along brilliantly and grasping these important distinctions. Excellent. Now, some bonds are very special, almost magical, you could say. They're called perpetual bonds,
Perpetual meaning.
meaning they never mature, they promise to pay you interest forever. Literally an endless stream of small payments.
Forever.
Forever, without ever giving your principal back. It's like owning a piece of land that gives you rent every month forever, without you ever selling the land itself.
Ah, okay, like an endless river of income.
Exactly. Imagine a river that flows endlessly, never drying up, always providing water. That's the idea of a perpetual bond. They're quite rare, but they exist.
For a perpetual bond, because the payments go on forever, the present value formula becomes wonderfully simple, really simple. It's just PV equals PMTR.
That's it. PV equal PMTR.
That's it. Here, PMT is the fixed payment you receive periodically, forever, and R is the discount rate, your required rate of return, or the market's YTM. So, for example, if KB Financial, a company, issues a bond with a 3.30% quarterly coupon, which means it pays KRW 0.825 per 100 KRW face value every 3 months.
Quarterly, okay.
And this bond trades in the market at KRW 97.03. We can calculate the implied YTM. Using our simple formula, we know PV is 97.03 and PMT is 0.825. The R in the formula is the periodic rate, so the quarterly rate. So 97.03 equals 0.825 or quarterly. Solving this gives us a quarterly rate of about 0.85%. To annualize it, we multiply by 4. So the annualized YTM is approximately 3.40%, 0.85% 4.
I see.
This means that for every KRW 0.825 coupon received quarterly, the market expects an annualized 3.4% return, and the bond's price of KRW 97.03 reflects that expectation. It's a direct relationship.
So think about the name again, perpetual bond.
Yeah.
Does it ever end? Does it have a maturity date? What does perpetual mean in this context?
No maturity date. Goes on forever.
Exactly. You've got it. Perpetual means it goes on forever, without a maturity date. Fantastic. This makes them quite unique in the world of bonds. Finally, under this fixed income umbrella, we have a very common type of financial instrument or structure called annuities or level payments. This is something many of you or your parents might already be familiar with in your daily lives. Think of your home loan, your mortgage, or even a car loan. You pay an EMI, right? Equated monthly installment.
Yes.
You pay a fixed amount every month, correct? That fixed amount, that EMI, actually includes both the interest you owe on the outstanding loan and a bit of your original loan amount, which we call principal repayment. Over the life of the loan, something interesting happens. The interest part of your EMI goes down and the principal part goes up, even though the total payment is fixed. It's a bit like your electricity bill sometimes, where the total bill might be fixed under some scheme, but the breakup of charges might subtly change month to month. Maybe more for usage one month, more for fixed charges another, but the total stays steady until the loan is paid.
That's a great way to put it. It's a fixed total payment, but the composition changes. The formula to calculate this fixed periodic payment, let's call it A for annuity payment or EMI, is A equals R, PV1, 1 plus RT.
Looks a bit complex.
It does, but let's break it down. A is your fixed periodic payment, like your EMI. R is the interest rate per period. So if it's a monthly EMI, R is the monthly interest rate. PV is the initial loan amount, the present value of the loan, and T is the total number of payment periods, like the total number of months. Let's illustrate with a very common example, a home loan. Suppose you're buying a house or apartment worth, say, 1 million USD, and you take a loan for 80% of its value. So the loan amount, PV, is USD 800,000.
Okay, $8 lakh loan.
Yes. If this loan has an annual interest rate of 5.25% and a repayment period of 30 years, first we need to convert these to monthly terms because EMIs are usually monthly. So the monthly interest rate, R, is 5.25% divided by 12, which is 0.004375. And the total number of months, T, is 30 years times 12-month year, which equals 360 months.
360 payments.
That's exactly. Plugging these values, PV 800,000, RG 0.0375, T equals 360, into our annuity formula, your monthly payment A would be USD 4,417.63. This is your fixed EMI for the next 30 years.
Okay, fixed payment.
Now let's look at how that fixed payment of USD 4,417.63 breaks down over time. This is the interesting part. In the very first month, a large part of your payment, USD 3,500, which is simply 800,000, 400,4375, the interest interest on the full loan amount, goes towards interest. A relatively small part, only USD 917.63, which is 417.63 minus 3,500, goes towards repaying your principal.
Most of it is interest initially.
Yes. But as months pass, because you're slowly paying down the principal, the outstanding loan amount reduces, so the interest component of your payment shrinks month by month. Consequently, the principal component of your fixed payment grows until the loan is fully paid off at the end of 360 months. This is a very practical and important application of how the time value of money works in our everyday lives. It determines how much you pay each month for your big purchases like homes or cars.
Okay, final check on this section. When you pay your monthly home loan EMI, does the interest part of that payment stay the same every single month, or does it change over time?
It changes, no?
It changes, yes. And importantly, why does it change? What's happening to the loan?
The principal reduces.
Exactly. You're absolutely right. It changes. The interest part reduces over time. This happens because each month, as you make a payment, a portion reduces your outstanding principal balance. Since interest is calculated on the remaining principal, as that principal reduces, the interest charged also reduces. You're getting this. Well done. This shows you how these financial concepts directly influence your daily expenses and long-term financial planning. Okay, great work, everyone. Having explored the world of fixed income instruments like bonds, where the payments are generally predictable, let's now turn our attention to a different kind of financial landscape: equity instruments.
Equity, meaning ownership.
Precisely. These are basically stocks or shares of a company. When you buy a share of, say, Infosys or HDFC Bank, you become a small owner of that company, a part of its big family, a co-owner, however tiny your share might be. And as an owner, you have a claim on the company's assets and its future earnings. And you might receive a share of the company's profits, which are distributed to owners as dividends.
Dividends, okay.
Unlike bonds, which have a set maturity date when the principal is returned, stocks usually don't have a maturity date. They can stay outstanding indefinitely, truly making you a long-term partner in the company's journey, almost like owning a small part of a family business that you hope will grow and prosper forever.
Yes, and to value a stock, we fundamentally use the same time value of money principles we've been discussing, just like with bonds. Here, we discount the expected future dividends, the cash flows you expect to receive as an owner, back to today's present value. However, there's a key difference. Unlike bond interest payments, which are usually fixed or follow a set schedule, company dividends can change. They often grow over time if the company is doing well.
Hopefully grow.
Hopefully, yes. So, we need to consider how these dividends might grow. We will look at 3 common ways or models for dividend growth, because that expectation of growth greatly affects the stock's value and how we calculate it. It's like valuing a piece of agricultural land its worth. Depends not just on the crops it produces today, but what you expect it to produce or grow in the future, year after year? No.
Yes. Future potential is key. Okay, the simplest case for valuing a stock based on its dividends is when a company pays a fixed dividend forever, never changing the amount.
Just the same amount every year?
Exactly, year after year. It's like a small, steady income stream from your investment, just like that perpetual bond we discussed earlier, remember? PV, PMTR. Imagine a small, very stable, traditional Kirana store, a corner shop, that perhaps gives you a fixed profit share every month without fail for as long as you own a part of it. This provides a very predictable stream of income, though it doesn't grow.
Right. The formula for valuing a stock with constant dividends is indeed very similar to our perpetual bond formula. PV equals DR.
D for dividend this time.
Exactly. Here, D is the constant dividend per share that you expect to receive each period, usually annually, and R is the investor's required rate of return. This R is what you, as an investor, expect to earn for taking on the specific risk of owning this particular stock. Remember, stocks are generally riskier than government bonds, so R for a stock will usually be higher than R for a bond.
Higher risk, higher required return. Makes sense.
Precisely. So if Shipline plc, for instance, pays a fixed dividend of GBP 1.50 per year, and investors require a 15% return for investing in similar companies with similar risk profiles, then the stock price, PV, should be GBP 1.50 divided by 0.15.
1.50 divided by 0.15, that's 10.
Which comes out to GBP 10.00. Simple, isn't it? D divided by R, it tells you the fair value of a stock providing a never-ending fixed income.
Okay, quick check, my diligent students. If a company consistently gives you a fixed dividend amount every single year, is its value, according to the simple model, decided only by that fixed dividend amount and your expected return from it? Yes or no? Yes. Absolutely correct. In this simple model, yes. It's a straightforward calculation showing the direct relationship between the income stream and the required return. You've understood this foundational idea perfectly. But as we know, most companies, especially good ones, don't just pay a fixed dividend. They try to grow their profits over time. And therefore, their dividends usually grow too.
They want to give more back to the owner.
Exactly. So a more realistic and widely used model is when dividends are expected to grow at a constant rate, which we denote as U for growth forever. It's like a child growing taller at a steady pace every year, adding a few inches consistently. This constant growth factor adds significantly to the value of the stock because you're not just getting a fixed amount, you're getting an increasing amount each year.
Yes. Here, the next dividend, let's call it dt plus 1, dividend at time t plus 1, is calculated as today's dividend dt times 1 plus g. So next year's dividend is today's dividend plus the growth percentage. The stock price formula for constant dividend growth changes slightly. It becomes known as the Gordon growth model, a very famous formula. PV equals dt plus 1 RG.
PV equals dt plus 1 divided by R minus G.
Okay. It's crucial here that R, your required rate of return, must be greater than G, the dividend growth rate. Think about it. If growth G were larger than or equal to your required return R, the denominator RG would become 0 or negative.
And you can't divide by 0 or a negative number to get a sensible price?
Exactly. The formula would give an infinitely large or meaningless price. So for this model to work, R must be greater than G. Which makes sense. Growth can't outpace the required return forever in a stable model. Let's use our Shipline PLC example again. Its current dividend, DT, is GBP 1.50. Let's assume it's expected to grow at a constant rate G of 6% annually, and your required return are still 15%. First, we need the next dividend, dt plus 1. That's GBP 1.50, 1 plus 0.06, GBP 1.59.
Okay, 1.59 next year.
Now, plugging this into our Gordon growth model formula, PV equals 1.59, 0.15, 0.06. The denominator is 0.15, 0.06, 0.76, much higher than the 10 we got before. Yes. See, a growing dividend makes the stock significantly more valuable than if the dividend were constant. Remember, it was GBP 10.00 with constant dividends. It's like owning a small business that keeps earning you a little more profit each year. That growth makes it far more appealing and valuable.
So my sharp students, if a company's dividend is expected to grow steadily, does that generally make its stock more valuable or less valuable compared to a company with a fixed dividend, assuming everything else, like the required return, is the same?
More valuable, definitely.
More valuable. That's right. Growth is highly valued in the stock market, just as growth is valued in any business or even in a family's income. It reflects a positive outlook for the company's future earnings. Now, let's be even more realistic. Companies don't usually grow at a single constant rate forever, do they?
No, that seems unlikely for most.
Right. Usually, new or innovative companies might grow very fast in their early stages. Think of a new tech startup, like a young cricketer making quick runs in a T20 match, maybe, building momentum quickly.
Fast initial growth?
But then, as they mature, as competition increases or their market saturates, their growth naturally slows down. It settles into a more steady, sustainable pace, like a seasoned player batting for a longer innings, focusing on stability.
Yes, that makes sense. Growth rates change over a company's life.
Exactly. This is where the changing dividend growth rate model comes in. We often use what's called a two-stage model. Stage 1, an initial period of high, perhaps supernormal growth. Stage 2, followed by a period of slower, constant, sustainable growth into the long term, like the Gordon model we just saw. This provides a much more nuanced and hopefully accurate valuation.
Okay, so 2 stages. How do we calculate the value then? This 2-stage model involves, well, 2 main steps conceptually. First, we calculate the present value of all the dividends that you expect to receive during the initial high growth phase. You have to calculate each one individually and discount it back. Second, we need to figure out the value of the stock at the end of that high growth phase. At that point, we assume the stock enters the constant, slower growth phase, stage 2. So we can use our Gordon growth model, PV equals dt plus 1 RG, to find the stock's value at that future point in time. This is often called the terminal value or continuing value.
The value at the end of stage 1.
Yes, but that terminal value is a value in the future. So we must then discount that entire terminal value back to today, to time 0.
Okay, discount the terminal value back to.
Yes. The total stock price today is then the sum of these 2 present values. The PV of all the dividends during the high growth stage 1 plus the PV of the terminal value calculated at the end of stage 1. It's like adding up the value of all the quick runs a player scores in his aggressive initial overs, plus the present value of all the runs he's expected to score in his more measured later overs, the terminal value, and bringing both values back to a total score today.
Okay, makes sense. Combine the two parts.
Let's apply this to Shipline PLC again. Suppose we assume it grows at a high rate of 6% for the next 3 years, stage 1. And then after those 3 years, its growth slows down to a more sustainable 2% indefinitely, stage 2. The required return is still 15%. When we do these calculations, which involve finding the PV of the dividend year 1, year 2, and year 3, all growing at 6%, and then finding the terminal value at the end of year 3 using the 2% growth rate from year 4 onwards, and discounting that terminal value back 3 years to year 0.
Lots of steps.
Yes, it requires careful calculation. The final price comes out to be GBP 13.05.
13.05. So less than the 17.67 we got, assuming 6% growth forever.
Exactly. It's less than the constant 6% growth scenario because the long-term growth rate, 2%, is lower. But this two-stage model is often considered much more realistic for many companies, as very few can sustain extremely high growth rates forever. It helps us capture the typical life cycle of a company's growth pattern.
All right, final check on this part. In a two-stage growth model for valuing a stock, we essentially combine what we learned about constant growth, but we apply it differently for two distinct periods, right? First, there's a period of potentially very high growth, stage 1, and then a subsequent period of lower but more stable long-term growth, stage 2. Is that a correct way to understand it?
Excellent summary. That's precisely it. You're really seeing the bigger picture and how we use different assumptions to model real-world company growth. This approach provides a much richer understanding of a company's potential true worth.
Very good. Okay, my dear students. In Lesson 1, our main objective was calculating the price, the present value, PV, of an investment. We were given the expected future cash flows and a required return rate, and we found the price.
Right. Price was the answer.
Yes. Now, let's flip this around, almost like looking at the other side of a coin. What if we know the current price of a bond or a stock in the market? We see it trading every day. And we also know the expected future cash flows it's supposed to give us, like coupons or dividends. Can we then work backwards to figure out the implied return or the implied growth rate that the market itself seems to be expecting from this investment?
Find out what the market thinks. Yes. Can we decode the market's expectations? Yes, we absolutely can. It's like knowing your total cricket score at the end of the match, say 150 runs, and knowing your average run rate was 6 runs per over. Can you figure out how many overs you played?
Yes. 150 divided by 6, 25 overs.
Exactly. We're doing something similar here, using the known price and cash flows to find the unknown rate, return, or growth. It helps us understand what the market is pricing in or demanding from an investment. Hashtag A, implied return for fixed income instruments.
This is a very powerful application. If you know what you paid for a bond, its current market price, and you know what specific cash flows it promises to give you in the future, a single payment for a discount bond or regular coupons and principal for a coupon bond, you can then figure out the implied return, or that yield to maturity, YTM, that the market is essentially giving you for holding that bond at that price. It's like solving a puzzle where the unknown variable, the answer we're looking for, is the exact interest rate you are truly earning on your investment given its current market price.
For a discount bond where there's only one future payment, FET, at time t, and you know the current price, the formula to find the implied return R, or YTM, is a rearrangement of our PV formula, our FET PV 121.
It looks manageable.
Yes. Let's use the German bond example again. Remember, at issuance in July 2016, it was priced at EOR 100.50 TV, promising EOR 100 FET in 10 years. Plugging these in gave us that negative YTM of 90.05%. The initial investor accepted a tiny loss for safety. Now let's fast forward 6 years to July 2022. That same bond now trades at EUR 95.72, let's call this PV new, with only 4 years left until its maturity, T4, when it will pay EUR 100 FET. What was the initial investor's actual annualized return over those first 6 years if they sold it now at 95.72? Well, they bought it at 100.50 and sold it at 95.72 after 6 years. Their actual return was negative 90.81% annually, a loss.
They lost money.
Yes, because the bond's price fell as interest rates generally rose during that period. This highlights the interest rate risk we talked about. What you actually earn can be very different from the initial YTM if you don't hold to maturity or if rates change. However, for a new investor buying that same bond at EUR 95.72 in July 2022 and holding it for the remaining 4 years until it matures at EUR 100, what is their implied return, YTM? We use the formula again, RR equals 195.72 for 2. This calculates to approximately 1.0%.
So a positive return for the new buyer.
Yes, a positive 1.10% annualized return. This shows that the YTM represents the expected return if the bond is bought at the current market price and held exactly to maturity. It's the market's current required return for that remaining period.
Got it. YTM depends on the current price and time left.
Precisely.
So my astute students, if a bond's market price falls, does that generally mean the implied return, YTM, for someone buying it now and holding it to maturity is higher or lower than before? What does that lower price offer to the new buyer?
Higher return, no.
Higher. Precisely. It means the implied return for the new buyer is higher. A lower price for the same future payment translates into a better deal, and a higher expected return for those buying it cheaper today. You're recognizing how market prices directly impact potential returns, a crucial insight for any investor.
Now, for coupon bonds, figuring out the YTM is a bit more complex. Why? Because you have multiple cash flows.
Right, those regular coupons plus the final principal.
Exactly. You have those regular interest payments, the coupons spread out over time, and then the final principal payment at maturity. It's like calculating the average run rate for a batsman who scores differently in each over maybe some fours, some sixes, some singles, and then also gets a bonus at the end. You need to find a single equivalent rate, the YTM, that accounts for all those varied scores over the entire innings. You need to find a single discount rate, the YTM, that makes the present value of all these future cash flows, all the coupons, PLUS, the final principal, exactly equal to the bond's current market price today.
So we're solving for AM in that long PV formula we saw earlier.
Precisely. But because R appears in the denominator of many terms raised to different powers, you usually can't use a simple algebraic formula to directly solve for YTM like we did with the discount bond.
Okay. Not so easy.
No. Instead, you need to use financial calculators or computer spreadsheets. Like Excel, they employ a process of iteration or trial and error. They basically keep trying different discount rates. Is it 5%? No, that makes the PV too high. Is it 6%? No, that makes the PV too low. Is it 5.5%? Getting closer, until they find the exact rate that makes the sum of the present values of all future cash flows equal to the current market price.
So the machine does the hard work.
Yes, thankfully. Recall the Greek bond example. It paid €2 coupons annually for 7 years, face value 100. Initially issued at par 100 when YTM was 2%. We said that after 2 years, if market rates rose, its price fell to EUR 93.091. At that point, it had 5 years remaining until maturity. For an investor buying it then at 93.091 and holding it for those remaining 5 years, receiving 5 more €2 coupons and a 100-year principal, the implied YTM they would earn is 3.532%.
Which the calculator would find for us.
Which the calculator finds. This 3.532% is the annualized return they expect, assuming they reinvest all their coupons at the same rate. Remember, the actual return for the original investor who bought at 100 might have been negative due to the price fall, that capital loss, showing the risk involved. The YTM, therefore, is what you expect to earn if you buy the bond today at its current market price and hold it until it matures, factoring in all the future payments.
Okay, so my brilliant students, if a bond has multiple coupons paid over time, plus a final principal payment at maturity, would you say that calculating its YTM typically involves a simple, direct formula? Or does it usually require a more advanced tool, like a computer or a financial calculator?
Computer needed, usually.
Exactly. You're absolutely right. It's a bit more advanced calculationally. It typically needs a computer tool or a financial calculator to perform those iterative calculations. You're thinking like a seasoned financial analyst already, recognizing the complexity when multiple cash flows are involved. Hashtag UB. Implied returning growth for equity instruments. Okay, just like we did with bonds, if we know a stock's current price in the market and its expected future dividends, we can try to work backwards. We can try to figure out what return investors are implicitly requiring from that stock to justify its price, or even what growth rate in dividends is implied by its current market price.
Decoding the stock market's message.
Exactly. It's like looking at the market price of a really popular brand of mangoes in the peak season. The high price tells you not just that people value its sweetness, like the dividend, but also perhaps how much they expect the supply to grow next year, or how much more popular they think it will become. The price contains hidden expectations about the future.
A very apt analogy. If we go back to our simplest growing dividend model, the Gordon growth model, PV equals DT plus 1 RG, we can rearrange it to solve for the implied required return, R Enon. If you rearrange that formula, you get R equals DT plus 1 PBT plus G.
R equals D over PV plus G. What does that mean?
It means the required return for a stock is essentially composed of two parts. The first part, dt plus 1 PVT, is the expected dividend yield. It's the next expected dividend as a percentage of the current stock price. It's like the immediate cash return you expect. The second part is G, the constant growth rate of those dividends. This represents the capital appreciation component you expect from the dividends growing over time.
So yield plus growth.
Exactly. Required return, expected dividend yield, plus expected growth rate. So let's use Coca-Cola as an example. Suppose its current stock price, PVT, is USD 63.00, and the next expected dividend, DT plus 1, is USD 1.76. If financial analysts expect its dividends to grow at a constant rate, G, of 4% per year forever, which is a simplifying assumption, of course.
Yes, constant growth forever is rare. Indeed. But using this model, we can calculate the implied required return RRR equals 1.7663 plus 0.04. The dividend yield, 1.7663, is about 0.0279 or 2.79%. So R equals 2.79% plus 4% plus 6.79%. This 6.79% is the implied total return that investors, according to this model and these inputs, are expecting to earn from holding Coca-Cola stock. It combines the cash they receive from dividends, the yield, and the anticipated growth in those dividends over time.
Okay. So my observant students, based on this model, would you say that the total return you expect from owning a stock is primarily made up of two key components?
Yes.
The dividends you receive, yield, and the growth in those dividends. Is that the basic idea?
That's yield and growth.
Yes, that's the basic idea. You've captured the two main components of your earning from a stock in this widely used model. That's a fundamental insight for understanding equity investments.
Now, let's consider another angle. What if we know or assume what return investors are requiring from a stock, and we want to find out what growth rate the market is implicitly expecting from the company to justify its current price, PVT? We can rearrange the Gordon growth model formula again, this time to solve for G. G equals R, dt plus 1 PVT.
Growth equals required return minus dividend yield.
Exactly. The implied growth rate is simply your required return minus the expected dividend yield. Let's go back to our Coca-Cola example. Price is 63 tazers, next dividend is $1.76. Suppose we believe investors require a 7% return from Coca-Cola, maybe because of its perceived safety or market position. Then the implied growth rate G that the market must be expecting to justify the $63 price would be G equals 0.07, 1.76663. We already know the dividend yield, 1.763, is about 2.79%. So G, 2.79%, 4.21%.
4.21% growth.
Yes. This means that if investors demand a 7% return, the company's dividends must be expected to grow by 4.21% annually, forever in this model, to justify the current stock price of $63. Notice, a higher assumed required return, like 7% instead of the 6.79% we calculated earlier, implies that the higher growth rate, 4.21% instead of 4%, must be expected to justify the same current stock price. If investors demand more return for their money, the company must deliver more expected growth to satisfy that demand at the current price.
That makes sense. Higher expectations require higher performance.
Precisely.
My sharp students, consider this. If a stock's current market price is very high, but its expected dividend for the next year is relatively small, meaning a low dividend yield, what does that generally tell you about the market's expectations for that company's future growth?
Yes, sir.
Does it imply very high growth or low growth is needed to justify that high price?
High growth must be expected, no.
Very high growth. Very sharp indeed. It usually implies that the market is expecting a very high growth rate from that company to justify such a high price relative to its current dividend. You're connecting the dots perfectly, understanding how market prices reflect future expectations about growth.
Sometimes, instead of just looking at dividends, investors look at a company's earnings. And instead of just comparing stock prices in rupees or dollars, which can be misleading because companies have different sizes and numbers of shares.
Right. A RS-1000 stock isn't necessarily more expensive than a RS-100 stock.
Exactly. We use something called the price-to-earnings ratio, PE ratio. It's a very, very popular valuation metric. It's calculated very simply. Divide the stock's current price per share by its earnings per share, EPS. Price divided by earnings, PE. Think of it like comparing the price of different apartments using price per square foot instead of just the total price, or comparing different shops by their price per customer served. It helps us compare different companies more fairly on an apples-to-apples basis, even if they have very different total earnings or prices.
A standardized measure.
Yes, a stock with a PE of 20 is generally considered more expensive in valuation terms than one with a PE of 10. It means investors are willing to pay 20 times its current annual earnings for each share, compared to only 10 times for the other company. This higher PE often reflects investors' collective optimism about a company's future earnings growth. Or perhaps it's perceived quality or stability. It's essentially the price you pay today for 1 rupee or dollar of the company's earnings, reflecting expectations about how those earnings will grow.
Okay, PE tells us about market expectations.
Yes. And interestingly, this PE ratio, while based on earnings, can also be linked back to our dividend growth model, providing deeper insights. The formula connecting them looks like this. PVTE is price divided by earnings. That's the PEET, 1 plus GRG.
Row, let's break that down. PVTET is price divided by earnings. That's the PE ratio.
Correct. And look at the term DTET inside the bracket. That's dividend per share divided by earnings per share. What does that represent?
How much of the earnings are paid out as dividends?
Exactly. It's called the dividend payout ratio. It tells us what percentage of profits the company returns to shareholders as dividends. Let's call it payout ratio. So the formula becomes PE, payout ratio 1 plus G, RG.
PE depends on payout ratio, growth rate G, and required return R.
Precisely. This shows that a company's PE ratio is driven by these fundamental factors. A high PE can be justified if the payout ratio is high, though less common for high PE stocks, or if the expected growth rate G is high, or if the required return R is low, meaning investors perceive it as less risky.
This helps us understand why a PE might be high or low.
Exactly. It helps us understand if a stock might be overvalued or undervalued based on its fundamentals, payout, growth, risk return, compared to its current market PE. Let's use our Coca-Cola example once more. Suppose its forward PE, meaning its price is 28 times its expected earnings for the next year, is 28. Its expected dividend payout ratio is 70%, meaning it pays out 70% of its earnings as dividends. And analysts believe its earnings and dividends will grow at a 4% constant rate G. Then, using our formula PE, AE, payout 1 plus G, RG, we can solve for the implied required return R. 28 with 0.70, 1 plus 0.04. Solving this for R gives us approximately 6.50%.
Okay, so a 28 PE implies a 6.5% required return given those payout and growth assumptions.
Yes. Alternatively, if we assumed investors required a 6.50% return, then we could solve for the implied growth rate G that the market is baking into that PE of 28. It would come out to be 4%. This relationship confirms if PE is high, like 28, it must be justified by some combination of a reasonable payout ratio, high expected growth, or a low required return. Now let's bring in our very own Indian stock market index, the Nifty Y50. Suppose the Nifty Y50 index is currently trading at a forward PE of 15, a bit lower than Coke's 28.
Okay, PE of 15 for Nifty.
And let's say the average expected dividend payout ratio for the companies in the index is 60%. And investors collectively expect an 8% return from investing in the Nifty Y50 index. What's the implied growth rate that the market is assuming for these top Indian companies based on these numbers? We use the formula 15 equals 0.60, 1 plus G, 0.08 G. Solving this equation for G gives us an implied growth rate of approximately 4.84%.
So the market expects Nifty Y companies to grow earnings at about 4.8%.
According to this model and these assumptions, yes. It implies that for every 15 rupees of price for 1 rupee of expected earnings, with a 60% payout, investors expect an 8% return and are implicitly forecasting about 4.84% long-term growth. It gives us a fascinating snapshot of the market's collective expectations.
This is truly where it gets really interesting and practical. What if your own analysis, your personal expected return and growth rate for a company don't match what the current PE ratio of the market suggests?
Comparing your view to the market's view.
Exactly. For Coca-Cola again, its market PE is 28, its payout is 70%. But suppose you, after doing your own detailed research, believe it should only earn a 9% return. Maybe you think it's riskier than the market implies, with only 4.5% growth. Maybe you think its best growth days are over.
Okay, your personal estimates are R 9%, GU 0.5%.
Yes. Now let's calculate what the PE should be based on your beliefs using the formula. PE equals 0.7, 1 plus 0.045, 0.09, 0.045. Let's see. Numerator is about 0.7315. Denominator is 0.045. That gives a PE of roughly 16.26.
16.26 is your calculated fair PE.
Yes. But the market PE is 28. A huge difference. This significant difference means that, according to your analysis and your assumptions, the stock is currently overpriced in the market. The market is paying much more PE 28 than what you think it's worth. PC 16.26.
So what would you do?
Well, based on this, you might decide not to buy it. Or if you already own it, you might consider selling it. Or for more advanced investors, you might even consider taking a short position, which is basically betting that its price will fall back toward what you believe is its fair value.
Right, a signal to potentially sell or avoid.
Exactly. This PE ratio and its link to growth, payout, and required return is a powerful tool to judge investments. It helps you form an opinion on whether a stock is cheap or expensive relative to its fundamentals and market expectations, helping you decide whether to buy, sell, or hold. So, my bright students, final check on PE. What does a very high PE ratio generally tell you about the market's collective expectations for a company's future earnings growth? Does it imply optimism or pessimism?
High PE means high optimism, high expected growth.
Absolutely right. It usually indicates the market is very optimistic and expects very high future growth from that company to justify paying such a high multiple of its current earnings. You're connecting these vital pieces of information, which is excellent.
Okay, our final big idea today, my bright students. It's a fundamental principle called cash flow additivity. This simply means that the total present value of a stream of cash flows, like the coupons from a bond, or the dividends from a stock, or even payments from different projects, is just the sum of the present values of each individual cash flow in that stream.
Additivity. Like you can just add them up.
Yes, provided you calculate the present value of each one first. It's incredibly straightforward and intuitive. Think of it like this. If you break down your grand total electricity bill for the year into 12 monthly payments, if you then calculate the present value of each of those 12 monthly payments today and add all those present values up,
You should get the present value of the total yearly bill.
exactly, you'll get the same total present value as if you discounted the single grand total annual bill amount back to today, assuming the timing works out. The sum of the present values of the parts equals the present value of the whole. They are additive. This principle of cash flow additivity is incredibly important because it forms the bedrock for something very crucial in finance called no arbitrage.
No arbitrage. What does that mean?
Arbitrage is basically making a risk-free profit with no investment or effort. No arbitrage means that in an efficient market, such opportunities shouldn't exist, or at least not for long.
Like getting free money.
Essentially, yes. If such an opportunity appears, like being able to buy something cheap in one place and immediately sell it for a higher price somewhere else with no risk, smart investors will immediately jump on it. Their actions, buying the cheap one, selling the expensive one, will quickly cause the prices to adjust, making that risk-free profit disappear. The no arbitrage principle ensures fairness and efficiency in the market. It prevents easy pickings and ensures that assets with the same risk and cash flows trade at the same price. It's like the law of one price.
Okay, so additivity allows us to break things down.
Yeah.
And no arbitrage ensures prices are consistent.
Precisely. Hashtag tag A. Implied forward rates. Using cash flow additivity.
Okay, let's unpack this concept of cash flow additivity and no arbitrage with a simple scenario to make it crystal clear. Imagine you have 100 rupees to invest today, and you are considering two different investment strategies that offer different streams of payments over 3 years. Okay.
Two strategies. Let's hear them.
Strategy 1 is simple. It gives you 45 rupees each year for 3 years. 45, 45, 45. Strategy 2 is different. It gives you 60 rupees in the first year, then 40 rupees in the second year, and finally 32.35 rupees in the third year. 60, 40, 32.35.
Different patterns of cash flow.
Very different. Now, if you calculate the present value of both strategies using a consistent required return of, say, 10% per year for discounting, you'll find something remarkable. Both strategies come out to have the exact same present value. It comes out to 111.91 rupees in today's value for both.
Exactly the same PV. Interesting.
Yes, this means they are economically equivalent, even though their cash flow patterns look very different year to year. From today's perspective, they offer the same value. And to further prove this, if you were to subtract the cash flows of one strategy from the other, year by year, and find the present value of those differences, the net present value of that different stream would be exactly zero.
Zero difference in PV.
Exactly. Demonstrating they are identical in value from a present value perspective. No one strategy is inherently better than the other, given these cash flows and the 10% discount rate. This principle allows the market to function efficiently. So my sharp students, cash flow additivity essentially means that we can simply add up the present values of different individual cash flows that occur at different times to get a total present value for the entire stream. Right? Is it like counting your different bundles of notes and coins and adding them to get the total amount of money you have right now?
Absolutely. That's a perfect way to think about it. Additivity applies to present values. It's like breaking down a big task into smaller, manageable steps, valuing each step in today's terms, and then summing them up to get the value of the whole task today. Superb. Hashtag A. Implied forward rates using Catful additivity. Corrected heading. Now we can apply this powerful no arbitrage idea combined with additivity to calculate something called implied forward interest rates.
Forward rates. Rates for the future.
Yes, interest rates for a future period, but determined today. Imagine you want to invest your money for 2 years. You essentially have two main ways to achieve a 2-year investment horizon using government bonds, and the principle of no arbitrage ensures that both ways yield the same return. Option 1. You invest directly in a bond that matures in 2 years, locking in today's known 2-year interest rate. Let's call it R2. Option 2. You invest for 1 year at today's known 1-year interest rate, R1. And simultaneously, you arrange today to reinvest the proceeds you'll get after 1 year for the second year at a specific rate. This rate for the second year, agreed upon today, is the 1-year forward rate starting in 1 year. Let's call it F11.
So you lock in the rate for the second year today as well.
Yes. The market allows you to do this through various instruments. The no arbitrage principle says that the total return from option 1, investing for 2 years directly at R2, must be equal to the total return from option 2, investing for 1 year at R1, then reinvesting for the second year at the forward rate F11. If they weren't equal, you could make risk-free money. Let's use an example with U.S. Treasury bonds, but the principle applies anywhere. Suppose a 1-year bond yields 2.50% today, R1 yields 2.50%, and a 2-year bond yields 3.50%. Today, R2 equals 3.50%. We can then calculate the implied 1-year forward rate starting in 1 year, F11. This is the rate for year 2 that makes the two strategies yield the same overall return. The formula to ensure no arbitrage is based on equating the future values. 1 plus R22 must equal 1 plus R1, 1 plus F11.
Okay, equating the compounded values.
Exactly. Rearranging to solve for F11, we get F11 plus 1 plus R22, 1 plus R11. Plugging in our numbers, F11 yields 1 plus 0.0352, 1 plus 0.025. This calculates to approximately 4.51%.
So the implied rate for the second year is 4.51%, higher than both the 1-year and 2-year rates today.
Yes. This implies the market expects interest rates to rise between year 1 and year 2. The forward rate reflects this expectation. Now, why does this happen? Suppose this implied forward rate wasn't 4.51%. Suppose it was higher, say 5% available in the market somehow. An arbitrager could immediately exploit this. They could borrow money for 2 years at the lower 3.5% rate using the 2-year bond market, and simultaneously invest for 2 years using the second strategy, 2.5% for year 1 and locking in 5% for year 2.
Earning more than they're paying.
Precisely. Their investment would grow faster than their borrowing cost, creating a riskless profit. That's arbitrage. But as soon as arbitragers start doing this, borrowing at 3.5%, investing via the 2.5% and 5% path, their actions will push the rates. Borrowing demand pushes the 3.5% rate up. Investment demand might push the 5% forward rate down until the arbitrage opportunity disappears and the forward rate settles at the no arbitrage level of 4.51%.
The market corrects itself.
Yes, very quickly usually. We saw this dynamic clearly in real life with U.S. Treasury bonds. For instance, there was a period when the U.S. Federal Reserve was signaling future interest rate hikes. During that time, the implied 1-year forward rate, F11, calculated from bond prices, increased significantly, maybe from 3% to over 3.5%. This change in F11 measured the market's increasing expectation of future rate hikes. So forward rates are not just calculations, they reflect the market's collective forecast of future interest rates, ensuring consistency across different maturities.
Fascinating. So my thoughtful students, if you can invest for, say, 2 years in 2 distinct ways, either directly for 2 years or by investing for 1 year and then locking in a rate for the second year today, the market effectively makes sure that the total returns from both paths are essentially the same, right?
Yes.
And what's the fundamental reason, the powerful principle that enforces this equality? What prevents one path from being consistently better than the other?
No arbitrage.
No arbitrage. That's the spirit. You're absolutely right. The market ensures the returns are the same to prevent risk-free profit opportunities. The market is very clever at balancing things out. Hashtag B, forward exchange rates, using no arbitrage. Now, this crucial no arbitrage principle doesn't just apply to interest rates within one country. It also applies across countries, linking interest rates and currency exchange rates through something called forward exchange rates.
Connecting global markets now.
Exactly. Imagine you have money, say rupees, to invest for 6 months. You're deciding between investing here in India or investing in, say, the United States. You essentially have 2 pathways again, and no arbitrage ensures they should give you the same return in rupee terms. Pathway 1. Invest directly in India for 6 months, earning the Indian interest rate. Simple. Pathway 2. Convert your rupees to US dollars today at the current spot exchange rate. Invest those dollars in the U.S. for 6 months, earning the U.S. interest rate, and simultaneously arrange today to convert the dollars, principal plus interest, back to rupees in 6 months at a specific forward exchange rate that you lock in now.
Locking in the future exchange rate.
Yes. The market, through the no arbitrage principle, makes sure that the final rupee amount you get from both pathways is the same. If they weren't, you could make risk-free profit by borrowing in the cheaper country and investing in the higher return country after accounting for exchange rates.
Let's take a concrete example from the sources. Suppose you have USD 1,000 to invest for 6 months. Option A, invest in U.S. debt, earning 2.0% annualized interest, so 1.00% for 6 months. You'd end up with $1,000, 1 plus 0.01 equals a 501. Option B, convert your USD 1,000 to Japanese yen, JPY, at the current spot rate of, say, JPY 134.40 per USD. So you get 134,400 JPY. Invest this amount in Japan at a much lower annualized interest rate of 0.05%, so 0.025% for 6 months. You'd end up with 134,401 plus 0.0000 with using the 6-month forward exchange rate must be exactly $10, the same as option A.
So 134,433.6 JPY divided by the forward rate must equal $110.
Exactly. Solving for the forward rate gives forward rate equals 134,433.61, then 10 equals JPY 133.0 approx per USD. Note, the source calculation gives 133.096. Slight difference might be due to exact compounding method. The key idea is that the forward rate adjusts perfectly to offset the interest rate difference. This phenomenon, where the interest rate difference between two countries is effectively equalized by the percentage difference between their spot and forward exchange rates, is called interest rate parity, a cornerstone of international finance.
Interest rate parity, okay.
We also observed this dynamic when comparing U.S. versus U.K. interest rates and the USD GBP forward rate. If U.S. interest rates, RUSD, increase more significantly compared to U.K. interest rates, RGB.
Like the Fed raising rates faster than the Bank of England.
Yes. It typically causes the U.S. dollar to trade at a discount in the forward market against the British pound, meaning the forward USD GBP rate, dollars per pound, will be higher than the spot rate. It will take more dollars to buy 1 pound in the future.
Why does the currency with the higher interest rate depreciate in the forward market? Seems counterintuitive.
It's to prevent arbitrage. If the dollar didn't depreciate in the forward market, everyone would borrow pounds at the lower UK rate, convert to dollars, invest at the higher US rate, and convert back at the spot rate, if the forward rate was the same, making risk-free profit. The forward rate must adjust so that the gain from the higher U.S. interest rate is exactly offset by the loss from converting back to pounds at a less favorable future rate. This ensures investors are indifferent between investing in the U.S. or the U.K. once exchange rate risk is hedged using the forward rate.
Oh, the forward rate acts as the balancing mechanism.
Precisely. It balances interest rate differentials across countries. This is how big banks and international companies manage their currency risks and ensure fair pricing across global markets using forward contracts.
Okay, makes sense. So, my globally minded students, let's apply this. If our Indian interest rates are generally much higher than, say, U.S. interest rates, what does interest rate parity imply about the future value of the rupee compared to the dollar in the forward currency market? Would the rupee generally be expected to trade at a forward premium, stronger, or a forward discount, weaker against the dollar?
Forward discount for the rupee, usually.
Exactly. It implies the rupee might be expected to depreciate or trade at a discount in the forward market compared to the dollar. This forward discount balances out the higher interest earnings you could potentially get by investing in India, preventing an easy arbitrage opportunity. You're thinking globally and understanding how these complex market forces balance each other out. Very good. Hashtag CT. Option pricing using cash flow additivity.
Okay, finally today, a very interesting and perhaps slightly more advanced application of our cash flow additivity and no arbitrage principles is in option pricing.
Options, like call options and put options.
Exactly. An option is a financial contract that gives the buyer the right, but crucially, not the obligation, to buy or sell an underlying asset, like a stock or currency or commodity, at a certain predetermined price that's called the strike price or exercise price, on or before a specific date in the future, the expiry date. Because the payoff depends on the future price of the underlying asset, valuing them seems tricky. But we can use our no arbitrage principle cleverly. The key idea is to create a risk-free portfolio by combining the option with the underlying asset itself. This portfolio is constructed in such a way that its final value is known today, regardless of whether the underlying asset price goes up or down.
A guaranteed payoff. How?
By carefully choosing how much of the underlying asset to combine with the option. Once we have this risk-free payoff in the future, we know its present value today, we just discount it using the risk-free interest rate. And since we know the value of the whole portfolio and the value of the underlying asset part, we can deduce the value of the option part by subtraction. It's based on additivity and no arbitrage.
Okay, let's try to walk through an example. Let's use a simplified scenario, often called a binomial model, meaning the price can only go to one of two possible values. Imagine an asset, maybe a share, currently trading at CNY 40. In one period, say a month, this asset price can either go up to CNY 56 or go down to CNY 32.
Okay.
Only two possibilities.
Up to 56 or down to 32. Got it.
Now, let's consider a call option on this asset. This call option gives the buyer the right to buy this share at a strike price of CNY 50 at the end of the period. Let's see its payoff in both scenarios. Scenario 1. Asset price goes up to CNY 56. Your option is valuable. You have the right to buy at 50. You can exercise the option, buy at 50, and immediately sell in the market for 56, making a profit of CNY 6, 56.50. The option payoff is 6. Scenario 2, asset price goes down to CNY 32. Your option is worthless. You have the right to buy at 50, but the market price is only 32. You would never exercise the option. You just let it expire. The option payoff is CNY 0.
So payoff is 6 if price goes up, 0 if price goes down, variable payoff.
Exactly. Now, how to find the fair price of this option today? It's called C0. We create that special replicating portfolio. The trick is to combine buying some amount of the underlying asset, let's say we buy H units, where H is the hedge ratio we need to find, and selling one call option. We want the value of this portfolio to be the same whether the price goes up or down.
Making it risk-free.
Yes, the value if the price goes up is H56. Since we sold the option, its payoff is a liability for us. The value if the price goes down is H32, 0. We set these two final values equal to each other to make it risk-free. H56, 6 is H32. Solving this equation for H, 56 ounce, H is 0.25. So 24 8 6, which means 8 equals 6, 24 equals 0.25.
So the hedge ratio H is 0.25. We need to buy 0.25 units of the asset.
Precisely. If we buy 0.25 units of the asset and sell one call option, let's check the portfolio value. If price goes up to 56, value 0.25, 36 equals 14, 6 will CNY 8. If price goes down to 32, value 0.2532, 0 equals 8, 0 equals CNY 8. See, the portfolio value is CNY 8 for sure. Regardless of whether the price goes up or down, it's risk-free.
Guaranteed payoff of 8.
Since this portfolio has a guaranteed risk-free payoff of CNY 8 in the future, say 1 month, its present value today must be CNY 8 discounted back using the risk-free interest rate. Let's assume the risk-free rate is 5% per period. So PV at portfolio is CNY 8, 1 plus 0.05 equals CNY 7.62, approximately. Now, the value of the portfolio today must also equal the cost of setting it up today. Setting it up involved buying 0.25 units of the asset, costing 0.25 CNY 40 equals CNY 10, and selling the call option, receiving its price, CNOA. So value of portfolio today, cost of stock, price of call option received, 7.62 equals 10 COA. Solving for C0, the price of the call option. C0 equals 10, 7.62, you derive purely from no arbitrage.
Exactly. Using cash flow additivity and no arbitrage, we found the option's price without needing to guess probabilities of the price going up or down. That 0.25 we found is the hedge ratio or delta of the option. Very clever. What about a put option? A put option is the opposite, as you know. It gives the buyer the right to sell an asset at a certain strike price, say CNY 50 again. So using the same underlying asset, price 40 goes 56 or 32, and strike 50. If the asset falls to CNY 32, your put option is valuable. You can buy the asset in the market at 32 and immediately sell it using your option right at 50, making a profit of CNY 18, 50.32. Put payoff is 18. If the asset rises to CNY 56, your put option is worthless. You wouldn't sell at 50 if the market price is 56. Put payoff is 0.
Payoff is 0 if up, 18 if down.
Yes. Again, we can use a similar replicating portfolio approach. This time, maybe we combine buying the stock and buying the put option, or use a slightly different combination. The calculations are similar, involving finding a hedge ratio to create a risk-free payoff. For this specific example, following the same logic, the fair price of the put option, let's call it P0, turns out to be CNY 10. The principle is exactly the same. Create a portfolio whose future payoff is risk-free, the same in all scenarios, by combining the option and the underlying asset in the right proportions, using the hedge ratio. Then, discount that risk-free payoff back to today using the risk-free rate. That gives you the present value of the portfolio. Finally, use the additivity principle, portfolio value, stock value plus option value, to solve for the unknown option price today. It's a fundamental concept in modern finance for pricing derivatives.
Okay, final check on this advanced topic.
Yeah.
For options, are we essentially trying to find a price for them that makes it impossible for anyone to make a risk-free profit?
Yes, the no arbitrage price.
And we do this by creating a special combination of the option and the underlying asset that somehow has a guaranteed predictable payoff in the future, and then we just discount that guaranteed payoff back to today using the risk-free rate. Is that the core idea?
That's exactly it. You've grasped the core idea behind risk-neutral pricing and replicating portfolios for valuing options. It's all about eliminating the possibility of risk-free gains using additivity and no arbitrage. Well done. That was a complex one.
My dear students, wow, what a deep dive we've truly had today. We've covered so much ground, building a strong foundation in finance. We started right at the beginning, understanding the absolutely foundational concept of time value of money. Learning how a rupee today is intrinsically worth more than a rupee tomorrow because of its earning potential. Remember the cricket ball example?
The core idea.
Yeah. Then we moved on to mastering how to calculate the present value of future cash flows, bringing future money back to today's value. We applied this to various types of financial instruments. We looked at fixed income instruments like bonds, whether they were simple zero-coupon bonds, the more common coupon-paying bonds, remembering par value, premium, discount, and semi-annual payments, or even these fascinating perpetual bonds that never mature.
And the annuities, like home loans.
Ah, yes, and annuities with their level payments, like our home loan EMIs. We also applied PV concepts of equity instruments to stocks, where we looked at valuing them based on dividends, considering different patterns. Constant dividends, constant growth using the Gordon model, and the more realistic two-stage growth models capturing a company's life cycle.
Indeed, that covered how to find the price given the cash flows in return. Then we flipped it. We explored how we can work backwards to uncover the implied return, like YTM for bonds or required return for stocks, or the implied growth rate that the market itself expects from these investments just by observing their current market price and expected cash flows.
Decoding the market's message.
Exactly. And we saw how the very useful price-to-earnings ratio, PE, fits into this, helping us compare stocks and understand market sentiment about future growth relative to current earnings. We used examples like Coca-Cola and even our own Nifty Y50.
All right, and how comparing your own analysis to the market's implied view can help identify potentially over or undervalued stocks.
Precisely. And finally, we discovered the powerful unifying principles of cash flow additivity and no arbitrage.
Additivity means we can sum up present values. No arbitrage means no free lunch.
Beautifully put. We saw how these ensure consistency in markets, impacting everything from how forward interest rates are determined between different maturities to how forward exchange rates are set between currencies based on interest rate parity, and even the sophisticated process of how options are priced using replicating portfolios to create risk-free payoffs. You see, finance is not just about crunching numbers on a calculator. It's deeply about understanding these underlying principles: time value of money, additivity, no arbitrage, and how they interact in the real world to set prices and shape expectations.
This knowledge, my young friends, it's truly powerful. It will serve you incredibly well, not just if you pursue a career in finance, but in making smarter, more informed decisions in your everyday life, honestly. Remember, whether you are saving for your higher education, planning a family investment, deciding on a home loan, or even just trying to understand your mobile phone plan or electricity bill payments, these foundational principles of future value, present value, risk, return, and no arbitrage are always at play, guiding the flow of money and value.
They are everywhere.
Keep that curiosity alive, please. Keep asking questions, keep connecting these ideas to the world around you, and keep building on the strong foundation you've started today.
So here's a thought for you to ponder as you reflect on today's lesson, something to carry with you. If understanding the time value of money helps you not just potentially earn more, but also truly control your financial future by making informed choices, does that mean that financial knowledge, financial literacy, is in itself a form of freedom? A way to gain more control over your life's path?
That's a deep thought. Financial knowledge is freedom.
Think about it. Until next time, keep exploring, keep questioning, and keep learning. Namaste, everyone. Well done today.
Welcome everyone to our classroom for today's deep dive.
Yes, a very warm welcome.
Today, we're going to take a journey, a really fascinating one, into the world of financial numbers. Now, I know it might seem daunting at first, like a big, complicated ledger book, perhaps.
It can seem that way.
But we promise we'll break it down for you step by step, just like good teachers should. So it all becomes clear and, hopefully, simple.
That's the goal.
Think about it like this. How do we understand a really exciting cricket match? We don't just look at the final score, do we?
No, never just the final score.
We look at individual player runs, maybe how many boundaries were hit, team scores in different overs, how well the team played together, all these different pieces.
Yeah.
We need tools, you see.
And it's the same with finance. Data has always been a key input for making smart investment decisions. But turning that raw data, just the numbers, into truly useful information, that isn't always straightforward.
No, it takes a bit of know-how.
Exactly. So our mission today is really to give you a foundational toolkit, a set of important concepts that are, I would say, indispensable for anyone, whether you're a young student just starting out or maybe a seasoned investor looking for a refresher.
A toolkit, I like that.
We'll learn how to summarize, how to analyze important aspects of financial returns. We'll focus on where the data is centered, the middle point, then how spread out it is.
The variation.
Yes, the variation, and also what shape its distribution takes. Is it symmetrical? Is it lopsided? And we'll also touch upon how two different things, two variables, might move together.
Okay, sounds like a good plan. Let's begin then.
Let's do it.
So let's begin our lesson with something really fundamental. Understanding where our data tends to, center itself. Where's the middle?
The heart of the data.
Exactly. Imagine you have a lot of numbers. Let's say the daily sales figures for a small Kirana shop in your neighborhood. Day after day, different amounts. How would you describe a typical day's sale? A single number to represent the usual.
That's the key question.
This is what we call measures of central tendency. Finding that typical central value.
Yes. And the most common way, the one you probably know best, is the arithmetic mean. Most people just call it the average.
Right. The average. We use it all the time.
It's everywhere. You calculate it simply by summing up all the observations, all the numbers you have, and then dividing that total sum by how many numbers there are.
Add them up, divide by the count.
Exactly. For a sample of data that's like a small part of a larger group, we calculate the sample mean. We add up all the numbers, let's call them she, and divide by n, the total number of observations.
Okay.
Let's take a very Indian example, something we all love, cricket. Think about calculating the average score of, say, Virat Kohli over 5 matches.
Okay, yeah.
Suppose his scores were 50, 70, maybe a duck, 0, then 180. What do?
We add them all up.
Yeah.
50 plus 70 plus 0 plus 100 plus 80, that's 300.
Perfect. And there were 5 matches. So
300 divided by 5 gives 60. His average is 60 runs.
Precisely. That single number, 60, represents his typical performance across those 5 matches. But there's a property, and sometimes it's a drawback, of the arithmetic mean. It's quite sensitive to extreme values.
You mean those outliers, the very high or very low numbers.
Exactly. Those naughty numbers, as you might call them. Because every number is included and given equal importance, one very large score or one very low score can pull the average quite a bit.
Like that 0 score for Virat.
Yes. So, my dear students, let me ask you, if our Virat Kohli scored that very low 0 in one match, how might that affect his average score compared to if he had scored, say, 50 in that match instead of 0? What do you think? Why is this important for someone looking at maybe investment returns?
That's a really good question to think about. That sensitivity to extreme numbers is exactly why the average, the mean, while useful, doesn't always give us the full picture, does it?
No, it doesn't.
Sometimes we need something that finds the real middle, ignoring those extremes. And that's where the median comes in. It's our second measure.
The middle value.
Exactly. The median is the value of the middle item in a data set. But there's a crucial first step. You have to sort all the items first, either from lowest to highest or highest to lowest. It doesn't matter which way, as long as they are in order.
Sorting is key.
Yes. Now, if you have an odd number of observations, say 11 numbers, the median is simply the value exactly in the middle. The 6th value in this case, after sorting.
Easy enough.
If you have an even number of observations, say 10 numbers, there isn't one single middle value.
Well.
So you take the 2 middle values, the 5th and 6th, after sorting, and calculate their average. That average is your median.
Okay, average of the 2 middle ones for an even set.
Correct. And the big advantage here, the median is not influenced by extreme values or outliers. It's robust, we say. This makes it very, very useful when your data is skewed, lopsided, with a few very high or very low values that would pull the average way off.
It stays stable.
It does. Imagine we are listing the monthly electricity bills for 11 homes in a street. We sort them from lowest to highest. The median bill will be the bill of the 6th home in that list.
right in the middle.
Even if one home had an extremely high bill, maybe they run a small factory from home, who knows? Or another home had an extremely low bill because they were away on vacation the whole month. The median wouldn't really change much. It would still give a good sense of the typical electricity bill for that street, unaffected by those extreme cases.
That's very practical.
It is. So here's a question for you all. Can you think of a situation, maybe when looking at house prices in a colony where there are a few very expensive bungalows alongside more standard houses, why the median house price might be a more representative, a more truthful number than the average house price?
That's a perfect scenario for the median, isn't it? Those few very expensive houses would pull the average up, making it seem like the typical house is much more expensive than it really is for most people living there. The median gives the better picture.
Exactly.
Now, building on this, our third important measure of central tendency is the mode. This one is perhaps the simplest concept of the three.
The most frequent one.
Precisely. The mode is simply the value that appears most frequently in your dataset, the most popular value.
Okay.
A dataset can have one mode, we call that unimodal. It might have two modes bimodal, or even three trimodal. Sometimes, if all the values are different, there's no mode at all.
Ah, okay. So it's possible to have no mode or multiple modes.
Yes, and the mode is unique in another way. It's the only measure of central tendency that we can use with nominal or categorical data. Things that are names or categories, not just numbers, like types of products sold or favorite colors. You can't average colors, can you? But you can find the most popular one.
Right, you can find the modal color.
Exactly. Let's take another simple Indian example. Think of a small roadside lefela, a cart selling different types of fresh juices, maybe mango, orange, and sweet lime, Mosambi.
I can picture it.
If on a typical day they sell mango juice more often than orange or lime juice, then mango would be the mode for their juice sales. It's the most popular juice among their customers.
Simple enough. The one that occurs most often.
Yes. And in finance, looking at the frequency distribution of daily returns for something like the EAA Equity Index, which is mentioned in our source material, the modal interval, meaning the range of returns that happened most often, was found to be between 0.0% and 0.9% daily returns. That was the most common outcome.
So the most frequent daily return fell in that small positive range.
Correct. So let me ask you this, thinking about our restaurant example again. If a particular dish, let's say butter chicken, is ordered the most number of times in a restaurant day after day, what would we call butter chicken in our financial language, using this concept of the mode?
Butter chicken would absolutely be the mode of the dishes ordered, the most popular choice. Now, sometimes those extreme values we talked about, the outliers, they aren't just errors in recording. Sometimes they are real.
Yes, legitimate but rare events.
Exactly. Maybe a sudden market crash or a huge unexpected gain. These naughty numbers can really affect our analysis, especially the mean. So we need to decide how to deal with them. We can't just ignore them always.
True, a conscious decision is needed.
Our source material suggests three main options for handling these outliers. Option one is simply do nothing.
Leave them in.
Right. If the extreme values are real, legitimate occurrences, and understanding them is important for the full picture, maybe understanding potential risks, then we leave them in the data.
Okay, that makes sense sometimes.
Option two, delete outliers. This often involves calculating something called a trimmed mean. What we do here is remove a small stated percentage of the lowest and the highest values.
Trim the edges off the data.
Exactly. For instance, a 5% trimmed mean would mean we remove the lowest 2.5% of the values and the highest 2.5% of the values. Then we calculate the average using only the remaining data in the middle.
So it gets rid of the most extreme highs and lows.
Yes. Option three is a bit different. Replace outliers. This is used to calculate a Windsorized mean. Instead of deleting the extreme values, we substitute them with another value.
Substitute. With what?
Typically, we replace the extreme values with the highest or lowest value that isn't considered an outlier. For example, with a 95% Windsorized mean, we might set all the values in the bottom 2.5% equal to the value at the 2.5th percentile mark. And all the values in the top 2.5% get set equal to the value at the 97.5th percentile mark.
Ah, I see. So you keep all the observations, but you cap the extremes.
Precisely. It reduces their impact without throwing away data points. Think about judging in sports, maybe kabaddi or even diving at the Olympics. You see judges giving scores for
Yes, several judges.
Sometimes, one judge gives a score that is unusually high or low compared to everyone else. To ensure fairness, what do they often do? They remove the single highest and single lowest scores before calculating the final average score for the athlete.
Ah, yes, I've seen that.
That is very much like calculating a trimmed mean. It removes the potential bias of extreme judgments.
A very good analogy.
Our source material shows an example with the EAA equity index. The regular arithmetic mean was 0.035%, but the 5% trimmed mean was higher at 0.048%, and the 95% Windsorized mean was 0.038%.
Interesting. So trimming made the average go up.
Yes. What does that suggest about the outliers they removed?
It suggests the outliers that were removed or replaced must have been on the low side some very negative returns, which were pulling the original average down.
Exactly. So here's the important question for analysts and investors. Why do you think it's so important for financial analysts to carefully consider these options for handling these naughty numbers, these outliers, before making big investment decisions? What could happen if they just ignore them or don't think about them?
That's a critical point. Ignoring them could lead to a very distorted view of typical performance or risk, couldn't it? Making bad decisions based on a skewed average. Now, we talked about the median dividing the data into two equal halves, but sometimes we want to divide our scorecard, our data, into even smaller equal parts. That's where quantiles come in. They help us understand the distribution, the spread, much more precisely.
Linear divisions.
Exactly. Think of quantiles as general term for locations within a distribution that divide it into continuous intervals with equal probabilities. The most common ones are quartiles. These divide the data into 4 equal quarters, so 25% of the data falls in each quarter. Q1, the first quartile, is the point where 25% of the data is below it. Q2 is the second quartile. What's another name for Q2?
That's the median, 50% below it.
Perfect. And Q3, the third quartile, has 75% of the data below it.
Okay, 4 quarters.
Then we have quintiles. These divide the data into 5 equal fifths. Each part contains 20% of the observations.
5 parts.
Deciles divide the data into 10 equal tenths, so 10% in each segment.
10 parts.
And finally, the most granular division, percentiles.
Yeah.
These divide the data into 100 equal hundredths. Each percentile represents 1% of the observations.
Wow, 100 parts.
Yes. So if your exam score is reported to be in the 90th percentile, what does that mean?
It means I scored better than 90% of the other students who took the exam.
Exactly. It tells you your relative standing very precisely. Another related concept is the interquartile range, or IQR. This is simply the difference between the third quartile, Q3, and the first quartile, Q1.
Q3 minus Q1.
Yes. What does that range represent? It represents the spread or the range covered by the middle 50% of your data. It gives you a good idea of the variability in the central part of your distribution, ignoring the extremes.
Ah, the spread of the middle half. Useful.
Very useful. Let's think of an Indian example for percentiles. Like you said, ranking students in your class based on exam scores. Being in the 90th percentile for mathematics tells you immediately you're among the top performers. Or think about planning savings for a big family event, like a wedding. You might mentally divide your total budget into parts, maybe allocating 25% to the venue, 25% to catering, 25% to clothes and jewelry, and 25% to other things. These are like quartiles of your wedding budget, aren't they?
Yes, breaking it down into chunks.
Our source material shows how to identify these quantiles using the EAA Equity Index daily returns. For instance, it showed that the 10th percentile corresponded to a daily return of negative 0.876%. This means that 10% of the daily returns were negative 0.876% or lower.
Okay, that gives a specific point in the distribution.
It does. So here's a question for you budding investors. If a new investment fund advertises that its returns are consistently in the first quintile of its peer group, what does that instantly tell you about its performance compared to other similar funds? Remember, quintiles divide into 5 parts.
First quintile, that means it's in the top 20%. That's very good performance relative to its peers. It's a strong selling point.
Absolutely. A quick signal of being a top performer.
Now, to make all these divisions, the median, the quartiles, the IQR, even those outliers even clearer, we have a wonderful visual tool. It's called the box and whisker plot.
Ah, the box plot. Very useful indeed.
Yes, it's like drawing a concise picture, a summary snapshot of your data's distribution. It shows the median, the quartiles, Q1 and Q3, and the range of the data, including potential outliers, all in one simple diagram, like a visual report card for your numbers.
So how does it work? What are the parts?
Okay, so the main part is the box. This box represents the middle 50% of your data. The bottom edge of the box is the first quartile, Q1, and the top edge is the third quartile, Q3.
So the length of the box is the IQR, Q3 minus Q1.
Exactly. And inside the box, there's a line drawn. That line marks the median, Q2.
Okay, box shows middle 50%, line shows median. What about the whiskers?
The whiskers are lines that extend out from the box. Typically, they extend to the lowest and highest values in the data,
Right.
unless there are outliers.
Ah, so how are outliers handled?
Often, the whiskers are defined to extend only up to a certain point. For example, 1.5 times the interquartile range IQR away from the edges of the box, Q1 and Q3. Any data points that fall beyond these whiskers are then plotted individually as separate points.
I see. So those individual points beyond the whiskers are flagged as potential outliers.
Precisely. It makes them very easy to spot visually. Imagine you're in a supermarket comparing the prices of different brands of, wheat flour.
Many brands, different prices.
A box and whisker plot could quickly show you the price range where most brands fall. That would be the box. The whiskers would show the typical range of prices, maybe for the standard brands. Any brand priced far beyond the whiskers, maybe a very premium organic ADA or one on a massive discount, would show up as an individual point, an outlier.
A very clear way to see the distribution and extremes.
It is. Our source material shows the general structure and then a specific box plot for the EAA Equity Index daily returns. We can clearly see the median return, 0.044%, the IQR, 0.753%, the length of the box, and the upper and lower fences, which define where the whiskers end, with points beyond that marked as outliers.
Very informative visual.
So here's a visual question for you. If you see a very short box in a box and whisker plot, what would that tell you about how much the data points are spread out in that middle 50%?
A short box would mean the middle 50% of the data is tightly clustered together, wouldn't it? Low variability in the central part. Q1 and Q3 are close together.
Exactly. Low IQR.
And these visual tools, these quantile measures we've discussed, they aren't just for textbooks or academic exercises. They are incredibly practical and widely used in the real investment world.
When making actual decisions.
Absolutely. For evaluating performance and developing investment strategies. Investment analysts use quantiles all the time to rank things, the performance of different assets, market indexes, investment portfolios run by different managers.
Comparing managers.
Yes. For example, if a fund manager's performance falls into the 80th percentile compared to their peers, it instantly tells you they performed better than 80% of similar funds. That's much more meaningful than just knowing their absolute return number, isn't it?
It gives context. Relative performance.
Exactly. You might have heard of the Morningstar star ratings for mutual funds?
Yes, the star ratings, 1 star to 5 stars.
Those stars are often directly linked to percentile rankings of performance metrics against peer funds. It's a quick way for investors like you to gauge relative performance. Quantiles are also fundamental in financial research. For instance, researchers often rank companies by their market value, market capitalization, and then sort them into deciles, 10 groups, to compare how small companies perform versus large companies over time. This helps develop strategies based on company size.
Like small cap versus large cap investing.
Precisely. Just like popular car models in India are ranked by their sales numbers, the best-selling models are in the top percentile or decile. Investment funds are ranked by how well they perform against their rivals. This helps investors quickly see if a fund is a top performer or lagging behind. So let me ask you, why is it important for an investor to know if their fund is, say, in the top decile, top 10% of its peer group, instead of just knowing its average return? What extra insight does knowing that decile rank provide?
Knowing the top decile rank tells you it's not just good, it's among the very best compared to its competition. It gives you confidence in its relative strength.
Well put. Confidence and context.
Okay, so we've got a good handle on finding the center of our data, mean, median, mode, and how to slice it up with quantiles. Now let's shift focus. We need to understand not just the center, but how spread out the data is. This is crucial. Let's talk about measures of dispersion.
Yes, dispersion or variability. How much do the numbers jump around?
Exactly. If central tendency tells us the typical value, dispersion tells us how much variation there is around that typical value. And in finance, my dear students, this variability, this spread, is directly linked to understanding risk.
Higher variability often means higher risk.
Precisely. Think about the weather again. Knowing the average daily temperature in, say, Chennai is useful. It's usually warm, right?
Generally, yes.
But knowing how much it varies throughout the year, which is actually not too much, it stays fairly warm, is also very important. Compare that to Delhi, where the average might be okay, but the variation between summer heat and winter cold is huge.
A much wider range.
Yes.
Yeah.
In finance, this variation or range or spread is our measure of risk and uncertainty. How much can our investment returns potentially swing, up or down, from the average we expect? Understanding this is fundamental.
A very clear analogy. Risk is about the potential for variation from the expected. And the simplest, most basic measure of this dispersion is the range.
Simplest. How is it calculated?
It's extremely simple. It's just the difference between the maximum value, the highest number in your data set, and the minimum value, the lowest number.
Max minus min. That's it.
That's it. Very easy to compute. However, its simplicity comes at a cost. The range has limited usefulness, especially in finance. Why? Because it only uses information from two observations, the absolute highest and the absolute lowest.
So it ignores all the data in between.
Completely. It doesn't tell us anything about how the data are distributed between those two extremes. And because it relies solely on the extremes, it's extremely sensitive to those outliers we discussed earlier. One unusually high or low value can dramatically change the range, making it potentially misleading.
Okay. Easy, but not very informative, maybe.
Often, yes. Think about the price of tomatoes in your local market over a month. The range would just be the highest price seen minus the lowest price seen during that month. It's easy to calculate, sure, but it won't tell you if the price was stable most days and just spiked once, or if it was fluctuating wildly every single day. It misses the pattern.
Right, you lose the detail.
Exactly. So if you only know the highest and lowest prices of gold in a year, what important information are you missing about the general movement, the day-to-day or week-to-week stability of gold prices throughout that year?
You're missing almost everything about its journey. Was it a smooth ride or a roller coaster? The range doesn't say. That's why we need measures that actually use all the data points, don't we?
Precisely. We need to incorporate all the information.
This brings us to a better measure called the mean absolute deviation, or MAD.
MAD. Okay.
Now, MAD is a significant improvement over the range because it uses every single observation in your data. What it does is it calculates the average distance of each observation from the mean. But there's a very important step. We take the absolute value of each distance.
Absolute value. Why is that necessary?
Think about it. Some data points will be above the mean, positive difference, and some will be below the mean, negative difference. If we just added up these positive and negative differences, they would tend to cancel each other out. In fact, the sum of deviations from the arithmetic mean is always 0.
So the pluses and minuses would just equal 0. No information.
Exactly. So by taking the absolute value, we ignore the minus signs. We treat all deviations, whether above or below the mean, as positive distances. Then we average these positive distances. This gives us a meaningful measure of the typical deviation from the mean, using all the data.
Okay, average of the distances, ignoring direction.
Yes. Imagine a garment manufacturer in India making trousers. Let's say the average waist size they aim for is 32 inches. The MAD would tell them, on average, how much each pair of trousers waist size differs from that 32-inch target, regardless of whether it's a bit bigger or a bit smaller. It just captures the average magnitude of the difference from the target size.
Useful for quality control, maybe?
Could be. In finance, our source mentions calculating MAD for the MSCI World Index returns. The mean return was 16.40%. The MAD was calculated as the sum of the absolute differences of each year's return from this mean, divided by the number of years. It came out at 10.24%. This means the typical absolute deviation from the average return was about 10.21%.
Okay, a measure of typical spread.
Yes. So let's revisit that critical point. Why is it so important, so fundamental, that we take the absolute value, ignore the minus sign, when we calculate MAD? What key aspect of data variability would we completely fail to capture if we didn't?
We'd fail to capture the magnitude of the spread, wouldn't we? The positive and negative deviations would just cancel out, telling us nothing about how far the data points typically are from the center. Absolute value fixes that.
Perfectly put.
Now, while MAD is useful, the two most fundamental and widely used measures of dispersion in finance, the ones you will encounter everywhere, are sample variance and sample standard deviation. These are really the cornerstones for understanding and quantifying investment risk.
Variance and standard deviation. Okay, the big ones.
Yes. Let's start with variance. Variance is defined as the average of the squared deviations around the mean.
Squared deviations. Why squared? We used absolute values for MAD.
Good question. Squaring the deviations achieves two things. First, like taking the absolute value, it makes all the deviations positive, since squaring a negative number gives a positive result. This prevents the canceling out problem.
Okay, makes them positive. What else?
Second, squaring gives more weight to larger deviations. A deviation of 3 becomes 9 when squared, while a deviation of 2 only becomes 4. So variance is particularly sensitive to outliers, more so than MAD. It emphasizes the impact of larger swings away from the average.
Ah, so it highlights the big differences more.
Yes. Now, there's a small detail in the formula you'll often see when calculating variance for a sample of data, which is what we usually have in finance. Instead of dividing the sum of square deviations by n, the number of observations, we divide by n1.
N1, y minus 1.
It's a statistical adjustment called degrees of freedom. Without getting too deep into the mathematics, dividing by n1 instead of n makes the sample variance a better, more unbiased estimate of the true variance of the entire population from which the sample was drawn. It's a correction that helps our sample statistic be more accurate in reflecting the bigger picture. Just remember, for sample variance, it's usually n1 in the denominator.
Okay, divide by n1 for sample variance. Got it.
Now, variance is mathematically important, but it has a practical drawback. Its units are the square of the original data's units. If your returns are in percentages, variance is in percent squared. What does that even mean? It's hard to interpret intuitively.
Percent squared. Yeah, that's awkward.
Exactly. This is where standard deviation comes to the rescue. Standard deviation is simply the positive square root of the variance.
Square root of the variance.
Okay. And the beauty of this is that taking the square root brings the measure back into the original units of the data. So if your returns are in percentages, your standard deviation will also be in percentages. This makes standard deviation much, much easier to interpret and understand as a measure of risk or volatility.
Ah, back to the original units. Much better.
Much better. Think about our fast bowler in cricket again. We care about his average speed, yes, but also his consistency. Standard deviation helps quantify that consistency. If his average speed is 140 kilometers, a standard deviation of, say, 2 kilometers means his speeds are tightly clustered around the average, very consistent. A standard deviation of 10 kilometers means his speeds vary a lot, sometimes much faster, sometimes much slower. Unpredictable.
More risky for the captain, maybe?
Could be. And the standard deviation is in kilometer, the same units as speed, making it easy to grasp, not squared kilometers per squared hour or something weird like variance would give.
Right. So here's a scenario for you. If you have two different investment options, maybe two mutual funds, both offer the same average return, say 8% per year, but Fund A has a standard deviation of 2% and Fund B has a standard deviation of 10%. Which one would you immediately say is riskier in terms of its return variability, and why does the standard deviation number make that conclusion so clear? Fund B, definitely. The 10% standard deviation is much bigger than 2%. It signals that Fund B's returns are likely to swing much more widely around that 8% average, both up and down. More uncertainty, more risk. The number makes it instantly comparable.
Perfectly explained. Higher standard deviation implies greater volatility or risk, assuming the same average return.
Now, sometimes as investors, we aren't equally concerned about all variability. We might be more worried about the downside, about returns falling below what we need. Is there a measure for that specific worry?
There absolutely is. Standard deviation looks at all variability, positive and negative swings. But often, investors are more sensitive to losses or returns falling short of a goal. That's where target downside deviation becomes very relevant.
Target downside deviation. Focusing on the bad outcomes.
Essentially, yes. It's sometimes called target semi-deviation. It specifically measures the dispersion, the variability of observations only below a certain target return level that the investor sets.
So you define a target first.
Yes, you, the investor, first set a target. This could be 0, meaning you're focused on avoiding losses, or it could be a minimum acceptable return, maybe like a bank deposit rate, say 6% per year.
Okay. Set my minimum acceptable return, then what?
Then you look at your historical return data and you only consider the observations that fall below that target you set. You ignore all the returns that met or exceeded your target.
Focus only on the periods where it fell short.
Precisely. For those below target returns, you calculate how far they fall below the target, square those differences, average them, again, typically dividing by n1 for the number of observations below target, and then take the square root.
So it's like standard deviation, but only calculated using the returns that miss the target.
That's a very good way to think about it. It isolates and quantifies the volatility of the underperformance, the risk of not meeting your specific goal.
Let's take that Indian example again. Saving money for a daughter's wedding. You have a specific target amount you need by a certain date.
A very clear goal.
Your primary worry isn't about saving too much money, is it? Your main concern is falling short of that target.
Absolutely. The risk is not having enough.
So the target downside deviation for your savings plan would specifically measure the risk related to your savings potentially not reaching that crucial wedding goal. It focuses on the negative surprises relative to your target.
A very practical application.
Our source material gives an example of monthly portfolio returns. With a target return set at 3%, the target semi-deviation was calculated to be 2.763%. The overall standard deviation for all returns was 2.958%. The target semi-deviation is lower because it ignores the variability above the 3% target.
It captures only a part of the total risk, the part below the target.
Yes. So why might an investor, maybe someone saving for retirement with a specific income need, be more interested in this downside deviation for their investments rather than just the general standard deviation? What unique insight does it offer for their planning and peace of mind?
It directly addresses their core fear, doesn't it? The fear of not meeting their specific financial goal. Standard deviation includes upside volatility, which they might not see as risk in the same way. Downside deviation quantifies the very risk they are most concerned about managing.
Well said. Focuses the risk measure on the goal.
Now, what if you need to compare the dispersion, the risk, of two very different things? Maybe two investments with very different average returns, or even two things measured in different units. Standard deviation might not be directly comparable then.
Right. Is a standard deviation of 5 rupees on a 10 rupee item more or less risky than a standard deviation of 500 rupees on a 10,000 rupee item?
Yeah.
Hard to say directly.
Exactly. That's where the coefficient of variation, or CV, comes in handy.
Coefficient of variation, CV. Okay, what does it do?
The CV is a measure of relative dispersion. It relates the standard deviation of a data set to its mean. It's calculated simply as the ratio of the standard deviation to the mean.
So CV, standard deviation mean.
Correct. And what does this ratio tell you? It tells you the amount of risk, the standard deviation per unit of average return, the mean, risk per unit of reward, you could say.
Risk relative to the average.
Yes. A higher CV means there's more risk or variability for each unit of average return you expect. The great advantage of the CV is that it's a scale-free measure. Because you're dividing units by units, like percentage points divided by percentage points, the units cancel out. CV has no units of measurement.
No units, so you can compare CVs across totally different things.
Exactly. You can compare the relative risk of things measured in rupees versus dollars or percentages versus kilograms if you wanted to using their CVs. It puts risk on a comparable relative scale. However, there's one caution. C becomes less meaningful or even problematic if the average return, is 0 or negative. Dividing by 0 is undefined, and risk per unit of negative return isn't very intuitive.
Okay. Mainly useful when the average is positive.
Generally, yes. Let's use our cricket team comparison again. Team A averages 200 runs with a standard deviation of 50. Team B averages 100 runs with a standard deviation of 30.
Okay. Team A has higher average and higher absolute spread, SD.
Right. On the surface, Team A seems more variable, SD 50 versus 30, but let's calculate the CV for both. Team A CV equals 5,200 equals 0.25. Team B CV equals standard deviation mean is 0.100 equals 0.30.
Team B has a higher CV.
Yes. What does that tell us? It tells us that Team B is actually more variable relative to its average score. Team A, despite its higher absolute standard deviation, is relatively more consistent compared to its higher average score. It has less risk per run scored.
That's a great insight. Changes the perspective.
It does. Our source gives an example comparing the return on assets, ROA, for two industries. Both industries had the same average ROA of 4%. But Industry A's standard deviation was 5.6%, while Industry B's was 12.1%.
So Industry B had much higher absolute risk.
Yes, and the CV calculation confirmed this dramatically. Industry A's CV was 5.64 equals 1.4U. Industry B's CV was 12.14 equals 3.03. Industry B had more than double the risk per unit of mean return, even though the average return was the same.
Wow, CV really highlighted the difference in relative risk.
It did. So, last question on this. If you are considering investing in a very large established company versus a small new startup, and let's imagine somehow they both seem to have similar standard deviations of profit in absolute rupee terms, how could calculating the coefficient of variation help you decide which one might actually be riskier per rupee of profit generated?
Well, the startup likely has a much lower average profit than the established company, right?
Yeah.
So even with the same standard deviation in rupees, the startup's standard deviation divided by its smaller average profit would give a much higher CV. It would show more risk relative to its profit level.
Excellent reasoning. The CV would reveal the higher relative risk of the startup in that scenario.
Okay, this is great. We've covered the central tendency, and the spread, dispersion. But you mentioned earlier there's another dimension to understanding our data. Its shape.
Yes. the shape of the distribution. We've learned about where our data is centered and how spread out it is. But sometimes just knowing these two things isn't enough. We also need to understand the shape of our data's distribution.
The shape, like what it looks like if we drew a picture of it.
Exactly. Imagine a Gonti, a bell. Knowing its average weight and how much its weight typically varies is good information. But knowing its actual shape, whether it's perfectly symmetrical or maybe a bit lopsided or unusually tall and pointy or short and flat, that's also important, isn't it?
Yes, the shape tells you something about the bell itself.
And in finance, the shape of the distribution of returns tells us a lot about the likelihood of extreme events, those surprises we talked about. It gives us a deeper understanding of the nature of the risk we're taking.
Okay, so let's talk about shape. What's the first aspect?
The first key aspect of shape we look at is skewness.
Skewness, does that mean lopsidedness?
Precisely. Skewness describes the degree to which a distribution is asymmetric or lopsided around its mean. It tells us if the distribution is balanced or if it leans more to one side. There are three main types. First, positive skewness. Here, the distribution has a long tail extending out to the right side. What does this usually imply? It often means you experience frequent small losses or small gains, but occasionally there are a few extreme, very large gains. The tail is on the positive side.
Lots of small outcomes, few big wins. Like a lottery ticket, maybe.
That's a good analogy. For a positively skewed distribution, the relationship between our central tendency measures is usually mode, median, mean. The mean gets pulled higher by those large positive outliers in the right tail.
Okay, mean is highest in positive skew.
Second, negative skewness. This is the opposite. The distribution has a long tail extending out to the left side. This typically means frequent small gains, but with the potential for a few extreme, very large losses. The tail is on the negative side.
Lots of small wins, but a few big drops. That sounds potentially dangerous for investors.
It can be. Here, the relationship is usually mean-median mode. The mean gets pulled lower by those large negative outliers in the left tail.
Mean is lowest in negative skew.
And third, zero skewness. This means the distribution is perfectly symmetric, like the classic bell curve or normal distribution. In this case, the mean, median, and mode are all equal and located at the center.
Balanced, symmetrical, mean, median mode.
Correct. Let's think of an Indian example for skewness. Consider the daily profits of a small-scale seasonal business, like that fireworks shop we mentioned earlier, mostly active around Diwali. For most of the year, it might have small, regular losses or maybe just break-even days. But then, during that short festival period, it brings in massive extreme profits, lots of small negative or zero outcomes, and a few huge positive outcomes. What kind of skewness would this profit distribution likely have?
That sounds like positive skewness.
Yeah.
Long tail on the right due to those big festival profits?
Exactly. Now, our source material mentions that the daily returns of the EA equity index actually showed negative skewness, a value of n-0.4260. What does that tell us about its historical pattern?
Negative skew. Frequent small gains, but with a few extreme losses pulling the average down. That left tail is longer.
Precisely. And mathematically, when we calculate skewness, we use the cubed deviations from the mean. Cubing is important because, unlike squaring, which always results in a positive number, cubing preserves the original sign, positive or negative. This allows the skewness measure to tell us the direction of the asymmetry.
Cubing keeps the sign, tells us left or right skew.
Clever.
It is. So let me ask you this. As an investor, if you are choosing between two stocks and they have the same average return, but one has positive skewness, what might that positive skewness tell you about the kind of surprise or extreme returns you could expect from it? Which one might you prefer if you like the idea of potentially hitting those big, rare wins?
The positively skewed one offers that small chance of a huge gain, that lottery ticket effect, even if most days are just okay or slightly down. The negatively skewed one might feel safer day to day with small gains, but carries the risk of a sudden large loss. Preference depends on your risk appetite, I guess.
Very well summarized. It's about understanding the nature of potential surprises. Okay, so skewness tells us about lopsidedness. What's the other aspect of shape?
The other critical aspect is kurtosis.
Kurtosis. That sounds even more technical. What does it measure?
Kurtosis measures the tailness of a distribution. Specifically, it focuses on the combined weight or thickness of the tails relative to the rest of the distribution. In simpler terms, it tells us how likely extremely large deviations from the mean, both positive and negative, are compared to a standard normal distribution. It's about the probability of outliers.
So how fat or thin are the tails? More extremes or fewer extremes?
Exactly. There are three categories here, too, relative to the benchmark normal distribution. Leptokurtic. This means fat-tailed. If a distribution is leptokurtic, it has fatter tails than a normal distribution. Its kurtosis value is greater than 3. Sometimes analysts talk about excess kurtosis, which is just kurtosis minus 3. So positive excess kurtosis means leptokurtic.
Fat tails. So more extreme outcomes than normal.
Yes. More frequent, extremely large deviations from the mean, both positive and negative. Leptokurtic distributions also tend to be more peaked around the mean, meaning more observations are clustered near the average and fewer are in the shoulders of the distribution.
Okay, more peaked center, fatter tails.
Platykurtic. This means thin-tailed. This distribution has thinner tails than a normal distribution. Its kurtosis is less than 3, or excess kurtosis is negative. Extreme deviations are less frequent than in a normal distribution. These distributions tend to be flatter than normal.
Thin tails, fewer extreme outcomes, flatter shape.
Mesokurtic. This is our benchmark, the normal distribution itself. It has a kurtosis of exactly 3, or excess kurtosis of exactly 0.
Meso means middle, like normal. Okay.
We'll try an Indian example for kurtosis. Think about rainfall patterns in a city that experiences monsoon, like Mumbai.
Okay, Mumbai monsoon.
Usually during the monsoon, you expect fairly steady, predictable amounts of rain on most days. But some years, you get exceptionally heavy downpours, causing floods of very extreme positive deviation, or maybe an unusually dry spell within the monsoon, an extreme negative deviation. If these very extreme events, either floods or droughts, happen more often than a normal statistical model would predict, then the distribution of daily rainfall would show leptokurtosis. It would have fat tails.
Meaning those extreme rain events are more common than we might assume based on a simple bell curve.
Precisely. Our source material visually compares a fat-tailed leptokurtic distribution to a normal one, showing the higher peak and heavier tails. It also mentions that the EAA equity index we keep referring to had positive excess kurtosis, a value of 3.7962. What does this tell us about the frequency of its extreme returns?
Positive excess kurtosis means it's leptokurtic, fat-tailed. So that index experienced more frequent extreme daily returns, both positive and negative, than a normal distribution would suggest.
Exactly right. So, final check on this. If a financial report tells you that an investment's returns show positive excess kurtosis or are fat-tailed, what is the main practical thing you should understand about the potential good or bad outcomes you might experience with that investment?
It means you should be prepared for more frequent large surprises, both potentially large gains and potentially large losses, than you might otherwise expect. Those once-in-a-blue-moon events might happen more often. It increases the perceived risk of extremes.
Excellent summary. Understanding this shape, skewness, and kurtosis is not just academic. It's crucial for practical investment management.
Why is it so critical?
Why shape matters for investments? Because many standard financial models and risk management tools traditionally assume that investment returns follow that nice, predictable, symmetrical, normal distribution, mesokurtic, zero skew.
The easy bell curve.
Yes. But the reality, especially for things like stock returns, is that they often tend to be negatively skewed. More big losses than big gains, and almost always leptokurtic, fat-tailed.
So the real world doesn't fit this simple model.
Often, no. And here's the danger. If we use statistical models or risk calculations that are based on the assumption of normality, but the actual returns have fat tails and are skewness, what happens? We will systematically underestimate the true probability of very bad outcomes, like market crashes, or even very good outcomes, like huge rallies.
We'd be caught unprepared for the extremes because our model said they were rarer than they actually are.
Precisely. It means those extreme events are more common in the real world than our simplified models might lead us to believe. This has huge implications for setting risk limits, calculating portfolio risk, and stress testing strategies.
Let's think of that festival budget example again. If you plan your Diwali spending, assuming everything will go normally, average costs for everything, but you ignore the possibility of a sudden, very expensive, unexpected visitor requiring a big gift, or a major appliance breaking down needing costly repair, a fat tail event in your budget, you might find yourself seriously short of funds. In finance, underestimating these fat tails can lead to unexpected and sometimes catastrophic losses.
A perfect illustration of the risk. So why is it fundamentally risky for an investor to ignore the shape of an investment's return, its skewness and kurtosis, and just focus solely on its average return and its general volatility, standard deviation? What critical layer of understanding about potential financial surprises are they missing?
They're missing the crucial information about the likelihood and direction of extreme events. Average and standard deviation don't tell you if the big surprises are likely to be positive or negative, skewness, nor how frequent those big surprises might be compared to normal expectations, kurtosis. Ignoring shape gives an incomplete, potentially dangerous picture of risk.
Couldn't have said it better myself. A truly vital point.
Okay, this is making so much sense. We've looked at individual data sets, their center, spread, and shape. But in finance, things don't happen in isolation, do they? Investments influence each other.
Rarely in isolation, you're right. Everything seems connected.
So often, the performance of one investment seems to depend on or move with another. How do we analyze this? How do we understand how two friends, or maybe enemies, two variables, move together?
That's the next logical step in our analysis, understanding relationships between variables. This is where correlation comes in. When two friends move together, correlation. Think about basic items in India. The price of dal lentils and the price of roti, or the wheat flour to make it, might tend to move in the same direction generally, wouldn't they? Because they are both essential food staples affected by similar factors like monsoon, government policies, etc.
Yes, they often seem to go up or down together.
Right. Similarly, some financial assets also tend to move in tandem. Others might consistently move in opposite directions. We want to be able to measure this relationship, this co-movement.
How do we start? How do we even see if there might be a relationship?
The best starting point is always visual. We use a scatter plot.
Scatter plot. Okay. Drawing a picture again.
Exactly. A scatter plot is an incredibly useful visual tool for displaying and exploring the potential relationship between two different variables. It's like drawing a picture of their interaction on a simple graph.
How do we make one?
You take your two variables, say variable x and variable y. You plot variable x on the horizontal axis, the x-axis, and variable y on the vertical axis, the y-axis. Each point on the graph represents one pair of observations, one value for x and its corresponding value for y.
So each dot is a data pair.
Yes. Now, you look at the pattern formed by all these dots. If the points seem to cluster tightly around an imaginary straight line, it suggests a strong relationship between the two variables. If the points are just scattered randomly all over the graph, like stars in the sky, it suggests there might be no clear linear relationship.
Pattern means relationship. Scatter means no relationship.
Generally, yes, for linear relationships. Scatter plots are excellent because they let you quickly spot these patterns: positive, negative, strong, weak. Assess the overall range of the data for both variables, and importantly, they also help you visually identify any potential outliers points that lie far away from the general cluster or pattern.
You can see the odd ones out.
You can. Let's take an Indian example. Suppose you plot the daily sales of ice cream from a local shop against the daily maximum temperature in your city. What pattern would you expect to see on the scatter plot?
I'd expect the points to go upwards and to the right. As temperature increases, moving right on the x-axis, ice cream sales also tend to increase, moving up on the axis. A positive relationship.
Exactly. Our source material shows a couple of financial examples. One exhibit shows the returns of the IT sector versus the overall S&P 500 index returns. The points cluster quite tightly in an upward sloping pattern, indicating a strong positive relationship. When the market goes up, the IT sector tends to go up strongly too.
Okay, they move together.
But another exhibit shows returns for the utility sector versus the S&P 500. Here, the points are much more scattered, suggesting a weaker, less clear relationship. Utilities don't seem to follow the overall market as closely. You can also clearly see an outlier point in the IT sector plot, one observation that doesn't quite fit the general trend.
Visuals make it clear.
They do. So think about this. If you plotted the number of warm woolen jackets sold in a store against the daily temperature in your city, what kind of pattern would you expect to see on that scatter plot?
I'd expect the points to trend downwards and to the right. As temperature increases, moving right, the number of jackets sold would likely decrease, moving down, a negative relationship.
Perfect. Scatter plots give you that initial feel, but we often want to put a number on that relationship, quantify its strength and direction.
Yes, a number would be more precise.
For that, we use two related measures. First, covariance, and then the more commonly used and easier to interpret correlation coefficient.
Okay, covariance and correlation. Let's start with covariance. What does it measure?
Covariance measures how two variables covary or move together relative to their respective means.
Move together relative to their averages. How?
Think about it this way. If when variable x is above its average, variable y also tends to be above its average, AD when x is below its average, y also tends to be below its average, then they are moving in the same direction relative to their means. In this case, their covariance will be positive.
Okay, moving in sync gives positive covariance.
Yes, but if when x is above its average, y tends to be below its average, and vice versa, they move in opposite directions relative to their means, then their covariance will be negative.
Moving opposite gives negative covariance.
Exactly. Now, the formula involves multiplying the deviations of each variable from its mean for each data pair and averaging these products, again, dividing by n1 for a sample. The sign, positive or negative, tells you the direction of the relationship. However, the actual size or magnitude of the covariance number is a bit difficult to interpret on its own.
Why is that?
Because its units are the product of the units of the two variables, e.g., rupees times kilograms or percent times percent. The size depends heavily on the units and the variability of the individual variables, not just the strength of their relationship. So a covariance of 100 doesn't necessarily mean a stronger relationship than a covariance of 10 if the variables involved are different.
The number itself isn't standardized. Hard to compare.
Precisely. And that's why we usually move on to the correlation coefficient. This is the standardized version of covariance. It's often called the friendship score between two variables.
Friendship score, I like that. How is it calculated?
The correlation coefficient, usually denoted by R, is calculated by taking the covariance between the two variables, x and y, and dividing it by the product of their individual standard deviations, Sx times Sy. Rxy equals covariance xy.
Oh.
So divide covariance by the product of standard deviations. What does that do? This division effectively standardizes the measure. It removes the influence of the individual variables' units and scales. The result is the correlation coefficient, R, which always ranges between -1 and +1, regardless of the original units.
Always between -1 and +1. That makes it much easier to interpret.
Much easier. It tells you both the direction, positive or negative sign, and the strength, how close the number is to -1 or +1, of the linear relationship between the two variables.
Okay, let's use an Indian example for both. Imagine those two friends again, Rohan and Priya, studying for exams. We look at their scores across different subjects.
Okay.
For covariance.
Mm-hmm.
If Rohan consistently scores higher when Priya scores higher, and lower when Priya scores lower, they generally move together in performance, their scores would have a positive covariance. If Rohan tends to score higher when Priya scores lower, and vice versa, they perform inversely, their scores would have a negative covariance.
Makes sense.
Now for correlation. The correlation coefficient gives their study partnership a score from -1 to +1. A correlation close to +1 means they are strongly in sync high scores for one strongly predict high scores for the other. A correlation close to -1 means they are strongly out of sync high scores for one strongly predict low scores for the other. A correlation close to 0 means their scores have no consistent linear connection. Knowing Rohan's score tells you little about Priya's likely score.
A much clearer measure of the relationship's strength and direction.
Yes. So if two companies in the stock market are said to have a positive covariance in their daily stock returns, what does that tell an investor about how their stock prices tend to move relative to each other?
It tells the investor that generally when one company's stock price goes up relative to its average movement, the other company's stock price also tends to go up relative to its average, and vice versa for down movements. They tend to move in the same direction.
Right. Doesn't tell you how strongly, though. That's where correlation comes in.
Exactly. Covariance gives direction, correlation gives direction and strength on that standardized -1 to +1 scale. Let's explore those correlation numbers a bit more. Let's look at the properties of correlation.
Okay, what did the specific numbers mean?
Understanding this -1 to +1 range is key. A correlation of 0. This indicates no linear relationship between the two variables. Changes in one variable provide no predictive power about linear changes in the other. On a scatter plot, the points would look randomly scattered.
0 correlation, no straight line pattern.
Positive correlation, closer to +1. This indicates a positive linear relationship. As one variable increases, the other tends to increase as well. The closer the correlation is to +1, the stronger this tendency, and the more tightly the points cluster around an upward sloping line on a scatter plot. A correlation of exactly +1 means a perfect, positive, linear relationship. All the data points lie exactly on a straight line with a positive slope.
+1 is a perfect straight line going up.
Negative correlation, closer to -1. This indicates a negative or inverse linear relationship. As one variable increases, the other tends to decrease. The closer the correlation is to -1, the stronger this inverse relationship and the more tightly the points cluster around a downward sloping line. A correlation of exactly -1 means a perfect inverse linear relationship. All the data points lie exactly on a straight line with a negative slope.
-1 is a perfect straight line going down.
Precisely. Our source material has excellent visuals for this in Exhibit 26. Panel A shows a perfect +1 correlation scatter plot. Panel B shows a perfect -1. Panel C shows a 0 correlation with random scatter. The pictures really help understand what the numbers mean.
Visuals are always helpful.
They are. So let me ask you this. If the correlation between the returns of your stock portfolio and the returns of the bond market is found to be very close to -1, what kind of movement would you expect between them day to day? And how could knowing this strong negative correlation be very useful for you as an investor trying to build a balanced portfolio?
A correlation near -1 means when stocks go up, bonds tend to go down, and when stocks go down, bonds tend to go up. They move in opposite directions. This is incredibly useful because combining assets that move inversely can help stabilize the overall portfolio value. When one part is down, the other part is likely up, smoothing out the ride. It's the core idea of diversification.
Perfectly explained. That inverse relationship is key to reducing overall portfolio risk.
But correlation sounds so powerful. Are there any catches, any limitations we need to be careful about?
Oh, absolutely. Correlation is powerful, yes, but it's very, very important to understand its limitations. Misinterpreting correlation can lead to very poor decisions. We need to be careful.
Okay, what are the main things to watch out for?
There are several crucial limitations. Only linear relationships. This is perhaps the biggest one. Correlation, both covariance and the correlation coefficient, only measures the strength of a linear straight line association. Two variables can have a very strong relationship, but if that relationship is nonlinear, curved, their correlation coefficient might be very low, close to 0.
So if the pattern is a curve, correlation might miss it.
Completely. Exhibit 26, panel D in our source, shows a perfect example, a clear parabolic relationship between two variables, but the calculated linear correlation would be near 0, misleadingly suggesting no relationship at all. You need the scatter plot to see the curve.
Always look at the picture.
Always. Second, sensitivity to outliers. Just like the mean and standard deviation, correlation can be quite sensitive to outliers. A few extreme data pairs that don't fit the general pattern can significantly distort the calculated correlation coefficient, either inflating it or deflating it. Analysts might need to investigate or even handle outliers like trimming or Windsorizing before calculating correlation if they suspect distortion.
Those naughty numbers strike again.
They do. Third, and this is a golden rule you must always remember, correlation does not imply causation.
I've heard this one. Just because two things move together doesn't mean one causes the other.
Absolutely fundamental. Just because variable A and variable B are highly correlated, you cannot automatically conclude that A causes B or that B causes A. There might be a third factor causing both, or the relationship might be purely coincidental. Our source gives a great, almost absurd example. A strong positive correlation, 0.824, was found between monthly U.S. retail sales of beer, wine, and liquor and atmospheric carbon dioxide levels over a period.
Wait, drinking causes climate change, or climate change causes drinking? That sounds ridiculous.
It's ridiculous. It's just a chance relationship over that specific time period. One does not cause the other. Building an investment strategy based on the assumption that correlation equals causation is extremely dangerous.
Okay, correlation isn't cause. Got it.
Related to this is the problem of spurious correlation. This refers to correlations that appear to exist in the data but are not real or meaningful in a predictive or causal sense.
Fake correlations. How do they happen?
They can happen purely by chance, especially with large data sets. Or they can arise if you inappropriately mix data from different populations. But a common cause is a hidden third variable that influences both variables you are looking at, creating an apparent relationship between them. For example, we mentioned height and vocabulary size are correlated in children. Does being taller make more words? No. The hidden third variable is age as children get older. Both their height and their vocabulary naturally increase. age causes both.
Ah, the hidden factor.
Yes, investment strategies based on spurious correlations, ones that aren't grounded in solid economic or financial logic, can be very misleading and ultimately fail.
Be very skeptical of correlations without a good reason behind them.
Exactly. And finally, to really drive home why relying only on summary statistics like correlation can be misleading, we have the famous Anscombe's quartet.
Anscombe's quartet, what's that?
It's a classic statistics example shown in our source material, example 7, exhibit 28. Professor Anscombe constructed 4 different data sets. Each data set has 2 variables, x and y. Here's the amazing part. All 4 data sets have identical summary statistics. They have the same mean for x, the same mean for y, the same variance for x, the same variance for y, and the exact same correlation coefficient between x and y.
Identical numbers across the board.
Identical summary numbers. But when you create a scatter plot for each of the 4 data sets, they look vastly different. One shows a clear linear relationship, as the correlation suggests. Another shows a clear nonlinear curved relationship. A third shows an almost perfect linear relationship, but with one huge outlier distorting it. And the fourth shows x being constant except for one huge outlier for y.
Wow. So the numbers look the same, but the pictures were totally different.
Totally different patterns. Anscombe's quartet is the ultimate illustration that knowing just the summary statistics, including correlation, doesn't tell you the whole story. You must visualize your data, for example, with scatter plots, to truly understand the relationship between variables and to spot issues like nonlinearity or outliers that the numbers alone might hide.
That's a powerful lesson. Don't trust the numbers blindly. Always look at the graph.
Always look at the graph. Let's use that Indian example for spurious correlation again. You observe that in your city, during certain months, the number of people wearing traditional Indian clothes increases, and at the same time, the sales of sweets also increase. High correlation.
Mm-hmm.
Does wearing traditional clothes cause people to buy more sweets? Or does eating sweets make people want to wear traditional clothes?
Neither sounds right.
Of course not. What's the likely hidden third variable here?
It's probably a festival season, like Diwali or Eid or something. The festival causes people to wear traditional clothes and buy more sweets.
Exactly. The festival is the confounding variable creating a spurious correlation between clothing and sweets. So last check. If you find that the number of weddings happening in your city is highly correlated with the number of new floral shops opening, does that automatically mean that weddings cause floral shops to open? What else could be explaining the strong statistical connection?
Well, while weddings certainly increase demand for flowers, maybe it's not direct causation for opening new shops. Perhaps both are driven by a third factor, like overall economic prosperity in the city. When people feel wealthier, maybe more weddings happen, and entrepreneurs feel more confident opening new businesses like flower shops. Or maybe population growth drives both. The correlation alone doesn't prove weddings cause the shops to open.
Excellent thinking. There could be underlying economic or demographic factors driving both trends. Always question the why behind the correlation.
This has been incredibly insightful.
We have certainly covered a lot of ground today, haven't we? From understanding the very heart of your data with measures like the mean, median, and mode,
Finding the center.
to grasping its spread, its variability, using range, MAD, variance, and standard deviation, understanding risk.
How much it jumps around.
Then we explored the crucial, often overlooked shape of the data, using skewness and kurtosis, learning about lopsidedness and fat tails.
The chance of surprises.
And finally, we looked at how 2 different pieces of data might dance together, how they relate using covariance and correlation, while also being very mindful of the limitations. These are truly powerful analytical tools.
They really are. It feels like we've learned a whole new language for understanding numbers.
In a way, you have. It's like a skilled chef.
Yeah.
A good chef knows not just the ingredients, but how to perfectly chop them, how to blend them, understanding how they react together under heat to create a truly delicious and balanced dish.
Mm-hmm.
Similarly, a smart financial mind, a good analyst or investor, understands these numerical ingredients, mean, median, standard deviation, correlation, and knows how they interact, what their limitations are, to make wise, well-informed investment decisions.
That's a wonderful analogy. So the next time you, our dear students, encounter a set of numbers, whether it's looking at a cricket scorecard, trying to understand a player's consistency, managing your household budget, or reading an investment report,
Yes.
remember to look beyond just the obvious surface number. Don't just ask what's the average. Ask yourself the deeper questions we learned today. How much does it vary around that average? What is its typical shape? Are there potential big surprises hidden in those tails? And how does this number move in relation to other important things around it?
Those are the critical questions.
Because the answers to these questions, as we've seen, will reveal the true story hidden within those numbers. And understanding that story is what will empower you to make stronger, more confident, more informed decisions in your financial life and beyond. We are truly proud of all the learning you've done today.
Very well done, everyone. Keep asking these questions. Namaste, my dear students, and a very warm welcome to the Deep Dive.
Namaste, everyone.
Today, we are embarking on a really special journey together into the fascinating world of finance and, well, decision-making. Imagine, if you will, that we are about to explore a grand, old Haveli, a beautiful Indian mansion, full of rooms holding secrets and wisdom, and each room, it represents a powerful concept. Together, we'll unlock them, one by one.
Lovely way to think about it.
In life, we're constantly faced with uncertainty, aren't we?
Oh, absolutely. Every day.
Just like trying to predict the exact date of the monsoon rains or how many runs our favorite cricket team will score in today's match.
Yes. Always hoping for the best there.
Making important decisions, especially investment decisions, always comes with its share of unknowns. There's always that what-if moment. Really.
That element of doubt.
But fear not, my students. We are not powerless in the face of this uncertainty. Not at all.
That's the key message. We have tools.
Exactly. Today, we will equip ourselves with some clever tools. Think of them like a trusty compass and a detailed map to help us navigate this world of probabilities. We'll begin by exploring expected values, which is essentially our best guess for the future.
Our starting point, yes.
Then we'll delve into variance and standard deviation to measure the risk. How much our actual results might spread out from that best guess.
Understanding the spread, crucial.
After that, we'll learn how to map out different possibilities using probability trees, like drawing all the different routes on a map to reach a destination.
Visualizing the paths, very helpful.
And finally, we will uncover a very smart way to update our predictions when new information arrives, using something truly remarkable called Bayes' formula.
Bayes' formula, a powerful one.
It's going to be an incredibly enriching and, I think, very practical deep dive.
Indeed, my friends. And please, don't worry if these terms sound a little, maybe, daunting right now.
Yes, don't worry at all.
Our mission today, as your guides through this financial Haveli, is really to help you understand how smart investors, just like brilliant strategists, use simple mathematical ideas to make wise decisions, even when the future isn't crystal clear. We will break down each concept piece by piece, like we are carefully assembling a complex Rangoli design, slowly and clearly, until every pattern, every part makes perfect sense to you.
Step by step.
We will begin our learning path by understanding what an expected value is, essentially, our best forecast for what might happen.
Right.
Then we will learn to quantify risk by looking at variance and standard deviation. These tell us how much our actual results might differ from our forecast, helping us understand the spread of possibilities.
The forecast and the spread.
After that, we will learn how to map out different possibilities and how events might influence each other using those clever probability trees.
Seeing the connections.
And finally, we'll explore how to update our beliefs, how to refine our predictions when new, important information arrives, much like getting a fresh weather report that changes your picnic plans.
Good example.
We will make sure to use examples from our daily Indian life to make it all very easy to grasp and relate to. So take a comfortable seat and let's begin this exciting lesson together.
Wonderful. Let's open the first door in our Haveli then and dive right into our first big idea, which is all about making our best guess for the future. This concept we call expected value.
Okay, expected value. Let's start there.
So, to start, we need to understand a term called a random variable.
Random variable. Right.
Think of it as something whose value can change, in unpredictable ways. For example, imagine you are the owner of a small kirana shop, a corner shop in your neighborhood.
Okay, got the picture.
The number of customers who walk into your shop each day, well, it isn't always the same, is it?
No, definitely not. Some days busy, some days quiet.
Exactly. Some days you might have 50 customers, other days 70, and on a festival day, maybe even 150. We don't know the exact number beforehand, but it can be different each day. That number of customers is what we call a random variable, because its value varies randomly.
Okay, so the value is uncertain beforehand, like the amount of rain we get each monsoon.
Perfect example. Or the number of samosas you sell from your snack stall. Its value is uncertain until it actually happens.
Got it. So anything with an unpredictable outcome.
Precisely. Now, once we understand what a random variable is, we can talk about its expected value. We often write it as EX.
E for expected, X for the variable. EX.
Correct. The expected value of such a random variable is simply a probability-weighted average of its possible outcomes.
Probability-weighted average. Okay, that sounds a bit technical. Let's break that down.
Let's simplify it. Imagine you are running that small fruit stall again. Some days you sell many apples, maybe 100 kilograms. Other days you sell fewer, perhaps only 20 kilograms.
Right. Good days and bad days.
The expected value of your daily apple sales is like figuring out, on average, how many kilograms of apples you can expect to sell. Now, to do this, you wouldn't just take a simple average of 100 kilograms and 20 kilograms, like 100 plus 22. That wouldn't be quite right.
Why not? Why isn't it just the average?
Because some outcomes might happen more often than others. You need to give more importance or weight to the outcomes that happen more frequently. For instance, if you usually sell 100 kilograms on, say, 7 out of 10 days, and only 20 kilograms on 3 out of 10 days.
Ah, okay, so the 100-kilogram days are more common.
Exactly. So your expectation, your expected value, would naturally be closer to 100 kilograms than to 20 kilograms. You weight the outcomes by how likely they are.
I see. So it's an average, but it accounts for the probability, the chance of each outcome happening.
Perfectly put. Let's use another common example from the cricket field.
Oh, always good.
Imagine we are looking at a famous cricket batsman's past scores. Suppose from his previous matches, we know he scores 100 runs about 20% of the time. He scores 50 runs 50% of the time. And unfortunately, he scores 0 runs a duck 30% of the time.
Okay, so we have the scores and their chances.
Now, if you had to guess, what would you expect his score to be on average in the next match, considering these probabilities?
Right, you wouldn't just average 150 and 0. That wouldn't reflect how often he gets those scores.
Exactly. You'd factor in those percentages, the 20%, 50%, and 30%. That's the probability weighting.
Makes sense.
And in the world of finance, investors use this expected value concept constantly, all the time.
How so? In what kind of decisions?
Well, they use it to estimate the potential rewards from different investments. For example, if they put money into a new business venture, what is the expected profit they can foresee? Or they might use it to forecast how much profit a company might make per share. We call that earnings per share, or EPS.
Ah, EPS, a very common term.
Yes. Calculating the expected EPS helps them make informed decisions about where to put their hard-earned money. It helps them move beyond just, guesswork.
Okay, so it provides a calculated forecast.
The simple formula for calculating this expected value, EX, is PX1 times X1 plus PX2 times X2, and so on, for all possible outcomes.
So P is the probability, X is the outcome. Multiply them for each outcome, then add them all up.
That's it, exactly. You take each possible outcome, like scoring 100 runs, you multiply it by its chance or probability of happening, like 20%, and then you add all these multiplied values together.
Like summing up all your weighted possibilities to find the most probable average outcome.
Precisely. So, my dear students, let's try a quick thought exercise. If you play a game where tossing a coin gives you 10 rupees for heads, and there's a 50% chance of getting heads.
Okay, 10 rupees for heads, 50% chance.
And makes you lose 5 rupees for tails, with also a 50% chance of getting tails.
Lose 5 rupees for tails, 50% chance.
What would be the expected amount you win or lose from each toss? Think about it carefully using our formula. Take a moment.
That's a very good question for our students to ponder. Give it a try, everyone. The answer, my friends,
Did
see if
you
you
got
got it. It would be 0.50 times 10 rupees plus 0.50 times minus 5 rupees.
Right, because losing 5 is like gaining minus 5.
Exactly. So that's 5 rupees minus 2.5 rupees, which equals 2.5 rupees. So on average, you can expect to win 2.5 rupees per toss in that game.
Even though you never actually win exactly 2.5 rupees on any single toss.
Correct. It's the long-run average expectation. Now, knowing the expected score of our batsman or the expected profit from an investment, that's certainly a good starting point.
There's always a but, isn't there?
There often is. Let's think about that batsman again. What if sometimes he scores a magnificent 200 runs, a double century, and other times he gets out on a disappointing 0?
Wow, very inconsistent.
That's a very risky batsman, isn't he? His performance is quite unpredictable, even if his expected score is, say, 75.
Right. The average doesn't tell the whole story.
Our expected value tells us the average, but it does not tell us how much the actual outcome might spread out from that average. This spread or variability. In finance, that's what we call risk.
Okay. So risk is about the spread, the unpredictability.
Exactly. It's the unpredictable nature of things, the potential for deviations from what we expect.
So how do we measure this spread?
To measure the spread, we use a concept called variance. It's often denoted as sigma squared, SIX.
Variance, okay. Sigma squared.
This variance measures exactly that spread. In mathematical terms, it's the expected value of the squared deviations from the expected value.
Whoa, that sounds complicated again. Expected value of squared deviations.
Let's simplify. In simple terms, it tells us how much the actual outcomes tend to deviate or move away from our expected average. On average, we square these differences, the deviations, for a couple of important reasons. First, squaring makes all deviations positive. So a score much lower than average and a score much higher don't cancel each other out. We want to measure the total spread, right?
Okay, makes sense. So positive and negative deviations both contribute to this spread.
Yes. And second, squaring gives more weight to larger deviations. A score that's very far from the average gets amplified more than one that's only slightly off. This really highlights the potential for big surprises, good or bad.
Ah, so it emphasizes the extremes more. I see. That seems important for understanding risk.
Very important. Now, if the variance is 0, it means there's no spread at all. Like if our batsman always scores exactly 75 runs in every single match.
No risk there, is there? Certain outcome.
Correct. But if the variance is large, it means the outcomes are very spread out, indicating higher risk, more unpredictability.
Okay, variance measures the squared spread. But you mentioned something else too.
Yes, standard deviation, which is denoted just as sigma. This one is often even simpler to interpret than variance.
Simpler how?
It's just the positive square root of variance. Simple calculation. But the best part is that it is measured in the same units as our original variable.
Oh, that's useful.
Very. For instance, if our expected apple sales are in kilograms, then standard deviation is also in kilograms. Not kilograms squared, like variance.
Right, variance was in dollars squared for the EPS example earlier. Hard to picture.
Exactly. Standard deviation brings it back to the original units. It's like knowing how much your daily cooking ingredient measurements spread out from the ideal recipe. If the recipe calls for 1 kilogram of flour, and your measurements typically vary by, say, 50 grams, that 50 grams is like your standard deviation. It tells you the typical amount of variation you might experience around that 1 kilogram target in the same units.
Okay, that makes it much more intuitive. So standard deviation gives us a typical amount of deviation from the expected value in the original units.
Precisely. It allows investors to move beyond just a gut feeling of risk to a measurable parameter. Very useful for building portfolios.
Expert, that explanation really clarifies why we need more than just the average. It's not enough to know what to expect. We also need to understand the potential range of outcomes, the spread.
Exactly. The full picture.
Now, let's apply these powerful concepts, expected value, variance, and standard deviation, to a real-world financial example from our source material. We have a company called Bancorp.
Bancorp, okay.
And we want to understand their earnings per share, their EPS. Remember, EPS is simply how much profit a company makes for each share of its stock. Generally, higher EPS is good for investors, right? Indicates profitability.
Yes, usually a positive sign.
Okay. Our source provides us with a probability distribution for Bancorp's EPS for the current fiscal year. It lists different possible EPS values and the probability, the chance of each occurring. Let's work through this step by step, just like solving a problem in our notebooks.
All right, let's do the calculation.
Step 1, calculate expected EPS, EEPS. This is our best guess, our forecast for Bancorp's average EPS.
The probability weighted average.
Correct. We take each possible EPS outcome and multiply it by its probability, then sum them all up. Our source gives us these figures. There's a 0.15 probability for $2.60 EPS, a 0.45 probability for $2.45 EPS, a 0.45 probability for $2.45 EPS, a 0.24 probability for $2.20 EPS, and a 0.16 probability for $2 EPS.
Okay, 4 possible outcomes with their probabilities.
So the calculation is EEPS equal 0.15 times $2.16 plus 0.45 times $2.45 plus 0.24 times $2.20 plus 0.16 times $2. Now, we won't read out every single multiplication result here. It would take too long, but you can find the detailed steps in our show notes. The sum of these probability-weighted outcomes gives us an expected EPS of 2.3405 cents.
2.3405 cents, so about $2.34 per share. That's the average expectation.
Yes. So Bancorp expects to earn about $2.34 per share on average for the current fiscal year. This is our central forecast, our best estimate considering all the possibilities and their chances.
Okay, that's our initial forecast, host. But as we discussed, the real insight comes when we understand the variability, the risk.
Exactly. So step 2, calculate variance of EPS. Now for the spread or risk. This number will tell how much the actual EPS might typically vary from our expected 2.3405.
Measure the deviation.
Right. To calculate this, we take each possible EPS value, $2.60, $2.45, etc., subtract our expected EPS, 2.3405, square that difference, remember, to make it positive and emphasize larger deviations.
Okay, the squared deviation part.
Multiply that squared difference by its probability, 0.15, 0.45, etc., and then sum all these results up for all 4 outcomes.
It sounds like a few steps, but it's systematic. Calculate deviation, square it, weight by probability, sum it up.
Exactly. After performing these calculations for each outcome and summing them up, we arrive at a variance of 0.038785.
0.038785, and this is in dollars squared, right?
Yes, dollars squared, which isn't very easy to interpret directly. That's why we moved to standard deviation. Again, the step-by-step numbers are available for you in our show notes.
Precisely. The variance is an intermediate step, but a crucial one. It lays the groundwork for the more practical measure, standard deviation.
Which brings us nicely to step 3. Calculate standard deviation of EPS. This is the more interpretable measure of risk.
The square root of the variance.
Simply take the positive square root of the variance we just calculated. So EPS is the square root of 0.038785, which comes out to approximately 0.1969939 cents.
So let's round that. Roughly 0.20 cents.
Exactly, roughly $0.20. Now this number we can understand more easily.
What does it tell us, that $1.20?
It means that, on average, Bancorp's actual EPS can be expected to vary by about $0.20 from the expected $2.34. So instead of exactly $2.34, it could reasonably be around $2.14 on the low side or $2.54 on the high side.
Ah. Okay, so it gives us a typical range around the expected value,
Yeah.
$2.34 plus or minus $1.20, roughly speaking.
Yes, and this $1.20 standard deviation isn't just a number, it's a critical tool for risk management. For a portfolio manager, for example, it quantifies the potential swing in Bancorp's earnings.
Allowing them to see if it fits their fund's risk level.
Precisely. They can decide if this stock aligns with their fund's specific risk appetite, perhaps balancing it with more stable assets. It helps move beyond a gut feeling of risk to a measurable parameter for portfolio construction. This number truly helps investors gauge the level of uncertainty around the earnings forecast.
Host, that's a very clear way to put it. This $1.20 swing highlights the real-world utility of standard deviation. It's not just theory. Now, my students, consider this scenario. An investor is looking at 2 companies. Company A has a very high expected earnings, let's say $5 per share. Very attractive.
Okay, $5 expected EPS. Sounds good.
But it also has a very high standard deviation, perhaps $1. This means its earnings are quite unpredictable. They could swing wildly.
So high potential reward, but also high risk.
Exactly. Now, Company B, on the other hand, has slightly lower expected earnings, say $4 per share. Still good, but not as high as Company A.
Okay, $4 expected EPS.
But Company B has a very low standard deviation, perhaps only $0.10. Its earnings are very stable and predictable.
Low expected reward compared to A, but much lower risk.
Correct. Host, how do you think an investor should weigh these 2 options? Is it purely about maximizing expected return? Or does risk, that standard deviation, play an equally important role in their decision-making?
That's the million-dollar question, isn't it? Or maybe the $4 and $5 question here.
Ah, indeed. Would it be like choosing between, say, a safe government fixed deposit with stable guaranteed returns, or investing in a brand new startup business with the potential for huge gains but also huge losses?
Expert, that's a classic trade-off investors face constantly, isn't it? There's no single right answer for everyone.
True. It depends on the investor.
For many, especially those planning for long-term goals like retirement or saving for a child's education, stability often trumps speculative high returns. They might prefer less worry.
So they might lean towards Company B.
Yes, the company with lower expected earnings but much lower standard deviation, Company B in your example, might be considered safer or less risky. It's like choosing a path that guarantees steady progress, even if it's not the absolute fastest.
Predictability is valuable.
Whereas Company A, with the higher expected return but higher risk, might appeal more to those with a higher risk appetite. You know, investors who are comfortable with potential losses for the chance of bigger gains. Maybe younger investors or those with other stable income sources.
Different strokes for different folks, as they say. It
Yes.
depends on their circumstances and comfort level.
Exactly. This really highlights that these tools, expected values, standard deviation, don't just give us numbers. They help us understand the very nature, the personality, if you will, of the investment opportunity itself.
Very well said, host. Understanding that nature and your own comfort with it is key. Now let's open another door in our financial LI and move on to our next important tool, probability trees.
Probability trees. Okay, I'm picturing branches.
Exactly. Sometimes, in life and in finance, one event depends on another. For example, the amount of electricity you use for your air conditioner in your home. It doesn't just happen randomly. It largely depends on whether it's a hot summer day or a mild, pleasant one, doesn't it?
Oh, definitely. My electricity bill certainly shows that.
Or perhaps, whether your electricity bill is high depends on how many hours you use the AC. The usage depends on the weather. In finance, similarly, a company's earnings might heavily depend on the general economic environment, whether the economy is growing, shrinking, or staying stable.
Right. One thing affects another. Chains of events.
Precisely. A probability tree is simply a visual diagram, like a tree with branches, that helps us map out all the possible future paths or sequences of events.
Like a roadmap for possibilities.
Exactly. Each branch shows an event and its chance of happening. It helps us visualize the different routes that the future might take, showing how decisions or external factors can lead to varied outcomes. Very useful for complex situations.
Okay, visualizing sequences. How does probability fit in?
This brings us to a very important concept called conditional probability. We often write it as PAB.
PAB, the vertical line means given, right? Probability of A given B.
Perfect. It means, what is the chance of event A happening, given that event B has already happened? For instance, what is the chance of rain if, or given that the clouds are already dark and heavy?
Much higher than if the sky was blue.
Exactly. The information about dark clouds, event B, changes our expectation of rain, event A. That's a conditional probability. Similarly, the chance of reaching your office on time might depend on whether you left during peak traffic hours. The traffic is the condition, B, that influences the probability of being on time, A.
Okay, probability under a specific condition.
And just like conditional probability, we have conditional expected value. We denote this as EXS.
Expected value of X given scenario S.
You got it. This means, what do we expect to happen, our random variable X, if a certain scenario or situation S occurs? For example, think about planning a big Indian wedding.
Oh, yes. Lots of variables there.
What is the expected wedding expense if all the relatives from abroad come, scenario S? That's likely different from the expected expense if only local relatives attend, scenario S complement.
Absolutely. Flights, accommodation, the costs change dramatically based on that condition.
Exactly. The scenario of foreign relatives arriving changes our expectation for the expenses. This conditional expected value helps us refine our forecasts based on specific conditions, making them more precise.
So we can calculate expected values for different branches of our tree.
Precisely. And there's an important rule that connects all this, called the total probability rule for expected value.
Okay, a rule to tie it together.
Yes. This rule, as per our source material, tells us that our overall expectation for something, like bank course total earnings, is a weighted combination of what we expect to happen in different scenarios, like declining or stable interest rates.
The conditional expectations we just talked about.
Correct. Each scenario's conditional expectation is weighted by how likely that specific scenario is to occur, the probability of that scenario. It helps us put all the pieces, all the branches, together to get the overall expected value.
So it's like combining the expected outcomes from each main branch, weighted by the chance of going down that branch in the first place.
Perfectly described. It gives us the complete picture, the overall average expectation, considering all possible paths.
Expert, your explanation of probability trees really paints a picture of how interconnected events are. I can see how they visually clarify those dependencies.
They are very intuitive visually.
Now, to truly bring this to life, let's circle back to our Bancorp example. We calculated their overall expected EPS was 2.34055. How do these interest rate scenarios you mentioned actually branch out and lead to that number?
Excellent question. Let's trace the branches.
We saw earlier how to calculate Bancorp's overall expected EPS. Now let's see how that forecast is built up from different scenarios. We know their earnings are very sensitive to interest rates in the economy.
A key factor for banks, yes.
Imagine we have two big scenarios for interest rates in the coming year. They could be declining or stable. These are our first main branches on the probability tree.
Okay, two main possibilities for rates.
Our source tells us there's a 0.60 or 60% probability that interest rates will be declining, and a 0.40 or 40% probability they will be stable.
P declining, 0.60, P stable, 0.40. They add up to 1. Good.
Now, if rates decline following the 60% branch, Bancorp's EPS could have two further outcomes, two smaller branches, $2.60 with a 0.25 probability within that declining rate scenario, or $2.45 with a 0.75 probability within that same scenario.
Okay, so those 0.25 and 0.75 are conditional probabilities given declining rates, and they also add up to 1.
Correct. Now, if rates are stable following the 40% branch, EPS could be $2.20 with a 0.60 probability within that stable rate scenario, or $2 with a 0.40 probability within that stable rate scenario.
Again, conditional probabilities, 0.60 and 0.4, adding to 1 for that branch.
Right. So we have the whole tree mapped out. Now let's calculate the expected EPS given declining interest rates. This is our conditional expected value for that specific scenario, EPS declining.
Just focusing on that top branch.
Yes. We multiply the possible EPS values by their probabilities within the declining rate environment. 0.25 times $2.60 plus 0.75 times $2.45. Doing the math, this sum gives us 2.4875 cents.
2.4875 cents. So if interest rates do go down, Bancorp can expect a higher EPS, about $2.49 on average in that scenario.
Exactly. That's our conditional expectation for declining rates. Now, let's calculate the expected EPS given stable interest rates, EPS stable.
Focusing on the bottom branch now.
Similarly, we sum the probability-weighted outcomes for the stable rate environment. 0.60 times $2.20 plus 0.4 times $2. This totals to $2.12.
$2.12. So if rates remain stable, the expected EPS is lower, about $2 expected performance. Maybe insightful for them.
Definitely gives a more granular view.
Finally, let's use the total probability rule to combine these conditional expectations and find our overall expected EPS, just like we calculated directly in Part 1. This should tie everything together.
Using SPS plus EXS complement, PS complement. Correct. So EEPS declining times P declining plus EEPS stable times P stable.
Plugging in the numbers.
EPS 2.4875 times 0.60, the probability of declining rates, plus $2.12 times 0.40, the probability of stable rates. When we perform this final calculation, drumroll please, we get 2.3405.
2.3405. It matches perfectly with our first calculation.
Exactly. And this is incredibly important, my students. It shows that our different ways of looking at the same problem, calculating directly, or using probability trees and conditional expectations are consistent.
Like measuring a room with a tape measure versus using a laser device and getting the same result. Builds confidence.
Precisely. This consistency is very important in finance because it confirms that our models and calculations are reliable no matter how we break down the problem or which path we take through our probability tree.
That consistency is indeed reassuring, host. It confirms the robustness of these analytical tools. They really work. Now, my dear students, here's a thought for you related to this. Imagine you are planning a picnic for your family. A nice day out. And, maybe from the weather forecast, there's a 70% chance of sunshine and a 30% chance of clouds.
Okay, 70% sunny, 30% cloudy.
Now, let's say you expect to have great fun if it's sunny, but maybe only okay fun if it's cloudy.
Makes sense. Sunshine helps a picnic.
Host, how would you approach calculating your overall expected fun for the picnic? What steps would you take using the idea of conditional expectations we just practiced, just like we did for Bancorp's EPS? How would you combine those two scenarios, sunny fun and cloudy fun, to get a single expected fun value?
That's a lovely example, expert, and it makes the concept so relatable. It's not about money, but about fun.
Exactly. The logic applies widely.
Okay, to calculate the overall expected fun for the picnic, you'd first need to somehow quantify great fun and okay fun. Maybe assign numbers like 10 for great fun and 5 for okay fun.
Good idea. Assign numerical values.
Then your expected fun if it's sunny, the conditional expectation is 10. Your expected fun if it's cloudy is 5. Then you'd use the total probability rule. Multiply the sunny fun, 10, by its probability, 70% or 0.70, and multiply the cloudy fun, 5, by its probability, 30% or 0.30.
So 1.70 plus 5.30.
Exactly. That's 7 plus 1.5 equals 8.5. So your overall expected fun level on a scale of maybe 1 to 10 is 8.5.
Perfect. You broke down the big picture into smaller probable scenarios, sunny and cloudy, and then combined them systematically using their probabilities. That's the core idea.
It makes planning under uncertainty much more structured. Let's look at one more example from our source material about Bancorp, this time focusing on their operating costs.
Okay, shifting from earnings to costs.
These are like their daily expenses, salaries, rent,
Yeah.
electricity, things like that. And the amount they spend quite naturally depends on how many branch offices they have. More branches usually mean more expenses, right?
Generally, yes. Staff, rent, utilities per branch add up.
Our source provides a simple formula to estimate these costs. Y equals 12.5 plus 0.65x.
Okay, a linear relation.
Here, Y is the operating costs in millions of US dollars, and X is the number of branch offices. You can think of the 12.5 million as their fixed costs, like the basic rent for their headquarters, maybe some central admin costs, which don't change much with the number of branches.
Okay, the baseline cost.
And the 0.65 million per branch represents the variable costs per branch, like staff salaries and utility bills that increase with each new branch open.
That makes sense. $0.65 million per additional branch.
Now, Bancorp currently has 66 branches. So based on this formula, their current estimated cost would be 12.5 cents plus 0.65 times 66.
Let's see, 0.65 times 66 is 42.9.
Right. So 12.5 plus 42.9 equals $55.4 million. This is their starting point, their current baseline operating expense.
It's $55.4 million currently. Got it.
Yeah, let's consider two future scenarios for Bancorp's growth in branches. This will form another probability tree. Scenario 1, high growth with an 80% chance, 0.80 probability. Scenario 2, low growth with a 20% chance, 0.20 probability.
Okay, main branches. High growth, 0.88, and low growth, 0.20.
Now, each growth scenario then leads to different numbers of branches, which in turn leads to different operating costs using our formula. This is where our tree branches out further.
Okay, sub-branches coming up.
Under the high growth scenario, the 0.80 probability branch, there are two possibilities for the number of branches. First, a 50% chance, conditional probability 0.50 of having 125 branches. If they have 125 branches using our formula, the operating cost would be 12.5 cents plus 165 equals $93.75 million.
Okay, high growth, minus 125 branches, minus $93.75 is cost.
And the total probability of this specific path, high growth and 125 branches, is the product of the probabilities along the path, 0.50, 0.50.
40% chance of that specific outcome.
Second possibility under high growth, a 50% chance conditional probability of having 100 branches. If they have 100 branches, the cost would be 12.5 plus 0.65, $100, however, minus $77.50.
High growth, minus 100 branches, minus $77.50 meters cost.
And the total probability for this path is also 0.80, 0.50 equals 0.40.
So another 40% chance. Okay, that covers the high growth branch. 0.40 plus 0.40, 0.80 total probability.
Correct. Now, under the low growth scenario, the 0.20 probability branch, there are also two possibilities for branches. First, an 85% chance conditional probability 0.85 of having 80 branches. If 80 branches, costs are 12.5 flat plus 0.6570 equals $64.50 million.
Low growth minus 80 branches minus $64.50 meters cost.
The total probability for this path is 0.85 equals 0.17.
17% chance.
Second possibility under low growth, a 15% chance conditional probability 0.15 of having 70 branches. If 70 branches, costs are 12.55 plus 0.65 equals $58.03.
Low growth minus 70 branches minus a $58 cost.
The total probability for this path is 0.15 equals 0.15.
3% chance. Okay. Let's say 0.17 plus 0.03, a dual probability for the low growth branch matches.
Exactly. And notice, my students, if we add up all these final total probabilities for the four endpoints of our tree, 1.40 plus 0.40 plus 0.17 plus 0.00.
Here's sum it perfectly to 1.00, 0.80 plus 0.20, 1.0.
Yes. This is an important check to make sure we've accounted for all possibilities correctly in our probability tree. No leaks.
Good check. So we have the costs and probabilities for all four final outcomes.
Now, let's calculate the expected operating costs under each main scenario. These are our conditional expectations again.
Expected cost given high growth and expected cost given low growth.
Right. For the high growth scenario, we combine the costs for 125 and 100 branches, weighted by their conditional probabilities within that scenario, 0.50 each. Operating costs, high growth, E.50, $93.75, plus 0.50, $77.50.
Okay, average of 93.75 and 77.50. That's $85.625 million.
Correct. So if Bancorp experiences high growth, their expected operating costs are about $85.63 million.
Higher costs under higher growth makes sense.
Now, for the low growth scenario, we similarly combine the costs for 80 and 70 branches using their conditional probabilities, 0.85 and 0.15. Operating costs, low growth, E.15, $64.50, plus $0.1558.
Let's see, 0.85, 64, 0.50 is 54.825, and 0.15, $54, 8.7, adding them gives $63.525 million.
Precisely. If Bancorp experiences low growth, their expected operating costs are lower, around $63.53 million.
Okay, we have the expected cost for each main scenario.
Finally, we combine these conditional expectations using the total probability rule to calculate the overall expected operating costs for Bancorp.
Just like we did for expected EPS. Weight each conditional expected cost by the probability of that scenario.
E operating costs high growth times P high growth plus E operating costs low growth times P low growth.
We'll get into the values.
E operating costs equals 85.6250 expected cost in high growth times 0.80 probability of high growth plus 63.5250 probability of high growth plus 63.535 expected cost in low growth times $0.205 million.
Okay, $85.205 million. That's the overall expected operating cost for Bancorp, considering both growth scenarios and their likelihood.
Yes, and this type of calculation is incredibly useful for them, for planning their budget, allocating resources, making strategic decisions about maybe opening those branches or not. It helps them anticipate expenses rather than just react to them when the bills come in.
Absolutely, host. It provides a data-driven forecast for planning. It moves beyond just hoping for the best or fearing the worst. Now, my dear students, let's think about this practical application. Why is it so useful for a company like Bancorp to calculate its expected operating costs, taking into account these different growth scenarios? How can this help them manage their budget effectively? Think about how you manage your monthly pocket money or how your family plans expenses for a big family event like a wedding. What's the practical benefit of this kind of foresight, this calculation?
Expert, the benefit is immense. It's all about preparation, isn't it?
Tell us more.
For a company like Bancorp, knowing their expected operating costs under different growth scenarios allows them to proactively manage their resources. They aren't caught off guard.
How so? What can they do with that number?
Well, if they foresee high growth and therefore higher expected costs, like that $85.6 million under high growth, they can budget for hiring more staff, maybe start looking for new office spaces, or even try to secure better deals from suppliers in advance because they know their needs will increase.
Proactive steps based on the forecast.
Right. And conversely, if they anticipate low growth and lower expected costs, like the $63.5 million, they might decide to tighten their belt in certain areas, look for cost efficiencies, or maybe delay certain expansion plans until the outlook improves.
Avoiding unnecessary spending if growth is slow.
It's much like planning a wedding, as you said.
Yeah.
You wouldn't just assume a single cost. You'd consider different scenarios, perhaps a grand celebration if many more guests confirm, versus a somewhat smaller one if fewer can make it, and you'd budget accordingly for each possibility, maybe having a contingency plan.
Considering the what-ifs.
This proactive planning helps avoid nasty surprises, ensures financial stability, and allows for much smarter resource allocation. It's about managing the future, not just letting it happen.
Excellent points, host. That proactive element is key. Managing the future, indeed. Now, my dear students, we come to our final and perhaps most powerful tool for today. A true gem in our financial Haveli called Bayes' formula.
Bayes' formula. This one sounds important.
It is extremely important, especially in a world overflowing with new information. Sometimes we have an initial idea, a prior belief about something. For instance, you might initially believe that a particular stock will perform well based on past performance.
Okay, our starting hypothesis.
But then, new information arrives. Perhaps the company announces a fantastic new product, or maybe a major competitor releases disappointing results. Something changes.
Right. The world doesn't stand still. News keeps coming.
When this new information arrives, we need a systematic and, crucially, a rational way to adjust or update our initial belief. We can't just stick to our old ideas stubbornly, nor should we completely abandon them based on flimsy news.
We need a logical way to incorporate the new evidence.
Exactly. Think of it like this. Initially, you might think it will rain today, based on the morning weather report. That's your prior belief. But then, as you look out of the window, you see a clear blue sky. That's new information.
And you'd probably change your mind about the rain.
You would. Bayes' formula gives us a structured, rational method for this adjustment. It tells us how much we should change our mind based on the strength of the new evidence and our initial belief. It helps us move from our initial belief, the prior, to a more informed one, the posterior.
Prior belief plus new info, posterior belief, using a formula.
Precisely. It's like getting a new, crucial piece of a jigsaw puzzle and using it to get a clearer, more accurate picture of the overall scene. This formula is sometimes called inverse probability,
Inverse probability. Why inverse?
because often we know the probability of seeing an effect, like symptoms, given a cause, like a disease. Bayes helps us go the other way to figure out the probability of the cause, the disease, given that we observe the effect, the symptoms, or the new information.
Ah, okay. Inferring the cause from the observed effect.
Yes. Now, the simplified formula for Bayes looks like this. Updated P event information, P information event, P information, ec prior P event.
Okay, let's break that down. Updated probability equals a fraction times the prior probability.
Exactly. Let's look at the pieces. Updated P event information. This is what we want to find, our updated belief about the event after getting the new information. This is the posterior probability.
Okay, the result we're after.
Prior P event. This is our starting point, our initial belief about the event before we got the new information.
Our initial guess or estimate.
The information event.
Yeah.
This is the likelihood. It's the probability of observing the new information if the event we're interested in was actually true. How likely is the evidence, given our hypothesis?
Okay, how well does the event explain the information?
P information. This is the overall probability of observing the new information, regardless of whether the event is true or not. It's the base rate of the evidence occurring.
The overall chance of seeing that piece of news?
So the formula essentially says, to get your updated belief, you take your prior belief and multiply it by a factor. That factor is P information event, P information. This factor represents how much the new information supports or refutes your initial event hypothesis compared to the overall likelihood of that information occurring anyway.
Wow, okay, it's a very logical way to weigh how much the new information should change our mind. It's not just gut feeling.
Exactly. It helps us avoid common cognitive biases like overreacting to recent news or ignoring the base rates, which can really cloud judgment in fast-moving markets or any decision-making process.
Let's see it in action with an example.
Let's use a simple example, maybe using frequencies from a survey to make it concrete. Imagine we surveyed 500 companies in a stock index.
Okay, 500 companies.
We found that 100 are technology firms and 400 are non-technology firms. We also tracked their returns for the year.
100 tech, 400 non-tech.
Now, from our survey, we found these results regarding performance. Out of the 100 tech firms, 60 had returns greater than 10%, and 40 had returns less than or equal to 10%.
60% of tech firms did well.
Right. And out of the 400 non-tech firms, 100 had returns greater than 10%, and 300 had returns less than or equal to 10%.
Okay, 100 out of 400 non-tech firms did well. That's 25%.
Exactly. So tech firms were more likely to have high returns in this survey. Now, let's calculate the probabilities needed for Bayes' formula.
Let's define our event as the company is a tech firm, and the new information as the company had returns 10%.
Perfect setup. First, the prior probability, P-Tech. This is the overall chance that a randomly picked company is a tech firm before knowing its return. There are 100 tech firms out of 500 total.
So P-Tech over 100, 500.20 or 20%, our starting belief.
Correct. Now, the conditional probability, PR 10% tech. This is the likelihood term. If a company is a tech firm, what is the chance it had returns greater than 10%?
From our data, 60 out of the 100 tech firms had high returns. So PR 10% tech is 6100.60 or 60%.
Good. Finally, the unconditional probability PR 10%. This is the overall chance that any random company in the entire index had returns greater than 10%. How many companies in total had high returns?
60 tech firms plus 100 non-tech firms. That's 160 companies in total.
Right, out of 500 total companies. So
yeah,
PR 10% equals 160, 500.32 or 32%. This is the base rate of high returns in this index.
Okay, we have all the ingredients. Prior P-Tech, 2 finds 0, likelihood PR 10% tech 0.60, and overall PR 10% 0.32.
Now, here's the question. Suppose you pick a company at random from the index and you were told it had returns greater than 10%. That's our new information. What is the updated probability that this company is a tech firm, given this new information? We want to find P-Tech R 10%.
Time to apply Bayes formula.
P-Tech R 10%, PR 10% tech, PR 10%.
I mean, the number is 0.60, 0.32, 0.2.
Yeah, calculate that. 0.60 divided by 0.32 is about 1.875 times 2.20.
That's 0.375 or 37.5%.
Exactly. See, our belief that the company's a tech firm jumped significantly from our prior belief of 20%.
Up to 37.5% after learning it had high returns.
Yes. The new information that the company had high returns really changed our mind quantitatively and made it much more likely to be a tech company. Why? Because tech companies in our survey were more likely, 60% vs 25%, to have high returns than non-tech companies. the evidence pointed more strongly towards tech.
That's a fantastic example, expert. It clearly demonstrates the shift in belief and how Bayes helps us integrate new data systematically.
It avoids just jumping to conclusions based only on the new info.
Now, my dear students, here's a thought for you. A different scenario. Imagine you have a friend who usually gets good grades in exams. Let's say, based on past experience, you believe they get good grades 80% of the time. That's your initial belief, your prior.
Okay, good grade, 1.80. Okay.
But then you hear some new information. You learn that they spent all night studying for their upcoming exam. That's the new information.
Information, studied all night.
You also know, perhaps from general observation, that students who study all night are very likely to get good grades. Let's say the probability of studying all night if you get a good grade is quite high. Expert for students, how might they use Bayes' formula to update their belief about their friend's grade on the next exam? Specifically, how would they calculate the probability that their friend will get a good grade given they studied all night? P, good grade, studied all night.
Right. What pieces would they need?
Yes, what specific pieces of information would they need to gather and plug into the formula, just like we did for the tech company example? Think about the prior probability, the likelihood term, and the overall probability of the new information.
That's a very practical challenge, host. And it shows how Bayes' thinking applies beyond finance. Okay, students, think about it. To apply Bayes' formula here, you would need 3 key pieces of information, just like before. First, your prior probability that your friend gets good grades. You already have that. P, good grade, 0.80. Second, you'd need the likelihood, that is, the probability of a student studying all night, given that they typically get good grades. P, studied all night, good grade. Maybe high achievers often pull all-nighters. Or maybe not. You'd need an estimate for this.
Okay, how likely is the evidence given the hypothesis?
Third, you'd need the overall probability that any student studies all night, regardless of their usual grade level. P, studied all night. Is it common or rare?
The base rate of the evidence.
With these 3 pieces, the prior, the likelihood, and the overall probability of the evidence, you could then plug them into Bayes' formula to calculate the updated probability, P, good grade, studied all night. It would quantify exactly how much that all-night study session should boost your confidence in their next good grade.
And it prevents us from just assuming, oh, they studied all night, they'll definitely ace it. It forces a more reasoned update based on actual probabilities.
Precisely. It encourages making our assumptions explicit and updating them logically.
Excellent. Now let's apply Bayes' formula to a more concrete investment scenario. Back to finance. Imagine you are an investor in a company called DriveMed, Inc.
DriveMed. Okay.
You've made some initial guesses, some prior beliefs, about their earnings per share EPS for the last quarter before they officially announce the results.
Your expectations before the news hits.
Your prior probabilities are as follows. PEPS exceeded consensus expectations, 0.45. So you think there's a 45% chance they beat the market's forecast. PEPS met consensus expectations, a 0.30, a 30% chance they performed exactly as expected. PPS fell short of consensus expectations, equals 0.25, and a 25% chance they missed the forecast.
Okay, 3 possible outcomes. Exceeded, met, fell short. And the probabilities of 0.45 plus 0.30 plus 0.25 add up to 1.00. Good priors.
Now here comes the new information. The very next day, before the EPS results are out, DriveMed announces that it is expanding factory capacity in Singapore and Ireland to meet increased sales demand.
Expansion news. Usually seen as positive, right? So it gives confidence in future demand.
Exactly. This is new information for us as investors. Naturally, this expansion suggests strong sales, which usually translates to good EPS. It's generally a very positive signal about the company's current performance and future outlook.
Okay, so the information is DriveMed expands factory.
Now, based on your research and understanding of DriveMed and its industry, you need to estimate some conditional probabilities, the likelihoods. These tell us how likely this expansion news would be if each of the EPS scenarios, exceeded, met, or fell short, were actually true.
How likely is the expansion news under each EPS outcome?
Let's say your estimates are DriveMed expands, EPS exceeded consensus. You'll 0.75. So if they did beat EPS, there's a high 75% chance they'd announce this expansion. It fits well. DriveMed expands, EPS met consensus, equals 0.20. They just met EPS. Maybe there's only a 20% chance of expansion, less likely. Perhaps they wait. DriveMed expands, EPS fell short of consensus, equals 0.05. Only a tiny 5% chance of expansion if EPS fell short. Makes perfect sense why expand production if earnings sales were weak.
Okay, those likelihoods seem logical. Expansion is much more likely if performance was strong. P expands exceeded, 0.75. P expands beyond 0.20. T expands fell short, 0.05.
Now, before we apply Bayes' formula to update our belief about EPS, we first need to calculate the overall or unconditional probability of the new information, which is P drive med expands. What's the overall chance of seeing this expansion news before we know the actual EPS outcome?
We need the denominator for Bayes' formula, P information.
Yeah.
And we can use the total probability rule again here, can't we?
Exactly. We sum the probabilities of expansion under each EPS scenario, weighted by the prior probability of that scenario. P drive med expands, P expands exceeded, plus P expands above met, plus P expands above P fell short.
Plugging in the numbers. 0.750, 0.45, plus 0.20, 0.30, plus 0.050, 0.25.
Let's calculate those terms. 0.75, 0.45 is 0.3375, 0.30, 0.30 is 0.36, and 0.05, 0.25 is 0.0125.
Adding them up. 0.3375 plus 0.06 plus 0.0125 equals 0.41.
Correct. So overall, there's a 41% chance of DriveMed announcing this expansion, considering all possibilities based on our prior beliefs and the likelihoods we estimated. P DriveMed expands equals 0.41.
Okay, now we have all the pieces needed for Bayes' formula. We have the prior probabilities for each EPS outcome, the likelihood of expansion given each outcome, and the overall probability of expansion.
Now for the big question, the one Bayes formula helps us answer. In light of this new information, the factory expansion, what is the updated probability that DriveMed's EPS actually exceeded consensus? We want to find P EPS exceeded DriveMed expands.
Our posterior probability for the exceeded outcome.
Using the formula, P exceeded expands, P expands exceeded, P expands.
Plugging in our numbers. 0.75, 0.41, 0.45.
Let's calculate. 0.75 divided by 0.41 is about 1.829 times 0.45 gives approximately 0.823171.
Wow. Let's call that 82.3%.
Look at that, my students. Your belief that EPS exceeded expectations jumped massively from your prior belief of 45%.
All the way up to 82.3%. It's a huge shift.
Yes. The new information about the factory expansion strongly suggests that they beat expectations. This updated probability, 82.3%, is your posterior probability because it comes after considering the new information.
And it's much more informed than your initial 45% guess. Critically, this helps investor make more confident and timely decisions. Maybe buy more stock or hold with greater confidence.
Exactly. It turns news into a quantifiable update of belief.
That's right, host.
Yes.
And the beauty of Bayes' formula is that it allows us to update all our beliefs consistently, not just focusing on one outcome. We should also update the probabilities for met and fell short.
Good point. Let's do that. What's the updated probability that EPS met consensus DriveMed expands?
We use the same structure, P met expand, P expands met, PP met.
Plugging in the numbers, 0.41, 0.30.
Let's calculate. 0.20 for 0.41 is about 0.4878 times 0.30 gives it approximately 0.146341, let's say 14.6%.
Interesting. This probability went down, didn't it? From our prior of 30% down to 14.6%?
Yes, it did. This shows that while the expansion news is positive overall, it actually makes the met expectation scenario less likely compared to the exceeded expectation scenario. The strong news points away from just an average result.
Okay, that makes sense. Now finally, let's calculate the updated probability that EPS fell short of consensus DriveMed expands.
P fell short expands. P fell short.
Plugging in the numbers, 0.05, 0.41, 0.25.
Okay, 0.05, 0.41 is about 0.12195 times 0.25. Gives approximately 0.030488. So about 3.0%.
Wow, down dramatically. From our prior belief of 25% chance, they fell short.
Down to a tiny 3% chance after hearing the expansion news. The expansion news strongly contradicts the idea that they fell short, which aligns with our intuition.
But this is the power of Bayes' formula. It systematically adjusts all our probabilities based on the strength and direction of the new evidence. It gives a complete, updated picture.
And now, my dears, here's that very important check we mentioned. After calculating all our updated probabilities, the posterior probabilities, they must always sum to 1.00. Let's try it.
Okay, our updated probabilities are P exceeded expands 82.3%, P met expands at 14.6%, and P fell short expands at 3.0%. Let's add them using more decimal places.
Updated P exceeded plus updated P fell short. It's 0.8232 plus 0.1463 plus 0.1463 plus 0.0305.
That feels that.
Adding those up, 0.8232 plus 0.1463 equals 0.9695. All possibilities are accounted for in our updated view of the world. Just like the total score in a cricket match must sum up to the final runs, our probabilities must sum to 1.
That's a crucial point, expert. A wonderful way to verify our work and ensure our updated beliefs are coherent. It adds discipline to the process. Now, for one more quick thought experiment for you, my dear students, using this Bayes logic, imagine your friend usually comes home by 6 p.m. Let's say there's an 80% chance of this based on past behavior year prior.
P home by 6 p.m. equals 0.80.
Sure, they might come home by 7 p.m. with a 20% chance. Your P home by 7 p.m. equals 0.20.
Okay, 80-20 split for 6 p.m. versus 7 p.m. arrival. Prior set.
You then get a message that there's a major traffic jam on their usual route home. This is your new information.
New information traffic jam.
Expert. How would our students use Bayes' formula to figure out the updated probability that their friend will be home by 7 p.m. given the traffic jam? Let's say they also know some likelihoods.
Okay, what are the likelihoods?
Let's say they know that a traffic jam is very likely if their friend comes by 7 p.m., maybe 90% chance of a jam explaining a 7 p.m. arrival. So P traffic jam home by 7 p.m. equals 0.90.
Makes sense. Traffic jams cause delays.
But a traffic jam is less likely to be the reason if they come by 6 p.m. Maybe only a 10% chance that a jam occurs, but they still make it by 6 p.m. So P traffic jam home by 6 p.m. equals 0.10.
Okay, we have priors and likelihoods.
How would each piece of information fit into the formula? How would they calculate the updated probability P home by 7 p.m. traffic jam?
That's a great real-life scenario to ponder, host. It shows this isn't just for finance. Okay, students, think Bayes. You'd start with your prior beliefs. P 7 p.m. equals 0.20. You have the likelihoods. P jam 7 p.m. equals 0.90, and P jam 6 p.m. equals 0.10. First, you need the overall probability of the traffic jam, P jam, using the total probability rule. P jam 7 p.m., P 7 p.m., plus P jam 6 p.m., P 6 p.m. That's 0.90, 0.20, plus 0.10, 0.80, 0.18, plus munch equal 0.26. So there's a 26% chance of a traffic jam overall, giving your friend's schedule.
Okay, P jam 0.26.
Then apply Bayes' formula to find the updated probability of a 7 p.m. arrival given the jam. P 7 p.m. jam, P jam 7 p.m., P jam.
0.90, 0.26.
It's calculating. 0.90, 0.26 is about 3.46.
Yeah.
Times 0.20 gives about 0.692 or 69.2%.
Wow. So the belief that they'll be home by 7 p.m. jumped from 20% to nearly 70% because of the traffic jam news.
Exactly. This rigorous approach helps you assess the situation. Maybe you should wait to prepare dinner or delay your plans, moving from a simple guess, oh no traffic, to a statistically informed decision based on how much the evidence supports the late arrival hypothesis.
Very practical indeed.
Now, one last related concept for today. What if you don't have strong initial feelings or prior beliefs about the possibilities? Sometimes we are new to a situation or haven't done much research. We just don't have much information to begin with.
Like starting from scratch. What do you do then?
In such cases, a common approach is to assume all possibilities are equally likely. We assign the same prior probability to each outcome because we have no basis to favor one over the other. This is what experts call using diffuse priors or uninformative priors. We are essentially diffusing our belief equally among all outcomes.
Okay, so if you don't know, assume equal chances as a starting point.
Yes, it represents a state of initial ignorance or impartiality. Let's use our drive med example to illustrate this. What if we started by assuming PEPS exceeded? PEPS met equals, PQS fell short, U equals 13, equal 33.33% chance for all three outcomes.
Okay, diffuse priors. P exceeded 13, P met 13, P fell short 13.
And then the factory expansion news came in. How would our results change? Remember, the likelihoods were peak spans exceeded 0.75, peak spans met 0.20, peak spans fell short 0.05. First, let's calculate the overall probability of drive med expands, P expands, using these diffuse priors. P spans exceeded, plus P expands met, P spans fell short, P fell short.
That's 0.75, 13, plus 0.75, 13, plus 0.05, 13.
We can factor out the 13,
Yep.
0.75 plus 0.20 plus 0.05, 13. The sum in the bracket is 1.00, 13 equals 13.
Interesting. The overall probability of expanding becomes 13 with diffuse priors.
Yes. Now let's apply Bayes' formula to find the posterior probability. PECs could drive at expands using these diffuse priors. P exceeded expands, P expands exceeded, D expands, AP exceeded.
Plugging in the numbers, 0.75, 13, 8, 13.
The 13 in the denominator and the 13 prior cancel out, so we are left with just
0.75 or 75%.
Exactly. See, when your starting beliefs priors are equal or diffuse, the posterior probability for an event becomes directly proportional to its likelihood. Here, P exceeded expands ended up being exactly equal to P expands exceeded.
So the new information essentially takes over completely.
In a sense, yes. It's as if the new information is the only thing guiding your updated belief because you had no initial bias or strong opinion beforehand. This highlights how powerful new, specific evidence can be, especially when you start with a clean slate or an open mind. It truly emphasizes the impact of new evidence in shaping our understanding.
That's a fascinating point about diffuse priors. Sometimes admitting you don't know is the best starting point.
It allows the data to speak more clearly.
And that brings us, I believe, to the end of our deep dive into the fascinating world of probability and uncertainty in finance today, my dear listeners.
It seems we've covered quite a bit. Expected values, variance, trees, and Bayes.
We truly hope this journey through our financial havelai has given you some solid foundations and maybe made these concepts feel less like complex equations and more like, well, practical tools for everyday decision-making, even far beyond the world of finance.
Indeed. Remember, my dear students, understanding risk and probabilities is not just for big investors managing large portfolios. It's useful in so many parts of life.
Like what? Give us some final thoughts.
Well, from planning your career path, considering different job offers with varying salaries and stability, or saving for your child's education, estimating future costs and investment returns, or even deciding which route to take to work to avoid traffic, like our example.
Using probabilities in daily life.
These mathematical ideas simply help you think more clearly. They help you make choices with more confidence, based on logic and evidence, rather than just guessing or going purely on gut feeling. It truly is a skill for life, helping you navigate the uncertainties around you with a calm and logical mind.
Well said. Thinking probabilistically.
So, my friends, as you go about your week, we encourage you to observe. What new information will you encounter? And how might you use it to update your beliefs about something important in your life this week?
A little Bayes thinking in everyday life.
Exactly. Keep observing, keep learning, and keep applying these insights that you've gained today. The world of knowledge is vast, and every step we take together, like exploring this Havelai, builds a stronger foundation for your future.
Beautifully put. Until next time, this is your host speaker.
And your expert speaker, wishing you all the very best on your continuous learning journey. Namaste and goodbye for now.
Welcome everyone to the deep dive. It is truly wonderful to have you join us today. We are about to embark on a fascinating journey, really a deep dive into something, well, quite fundamental in the world of finance. We're going to explore how we measure the risk and the reward of our investments. Now, please don't worry. We're going to break this down into simple pieces, much like, enjoying the perfect cup of chai, just one sip at a time. You see, when we talk about investing our hard-earned money, it's a lot like watching a cricket match, isn't it? As an investor, you're always trying to score runs, you could say. Sometimes you hit a magnificent six. Your returns are fantastic. But other times, well, you might get out for a duck, or maybe the score just isn't what you hoped for. What we truly want to understand is this. What are the average runs we can realistically expect to get from our investment over time? And just as crucial, how much can that score actually vary from those booming sixes to those, well, disappointing ducks?
This variability, these ups and downs, this unpredictable nature of returns that, my dear friends, that is what we call risk in finance. So our mission today, our aim for this deep dive is really to equip you with the knowledge and the smart analytical tools to understand two critical things. First, how to calculate what you can expect to earn from your investments, and equally important, how to quantify just how much risk you are truly taking on. This isn't about just memorizing complex formulas, not at all. It's about making informed choices. Just like, a seasoned cricketer choosing the right shot for the right ball, understanding the pitch, anticipating the bowler. By the end of our discussion today, you'll have a much clearer picture, I hope, of how to approach your own investment decisions with greater confidence. And joining me today, as always, is our brilliant fellow guide, ready to illuminate these concepts and help us connect all the dots.
Hello, everyone. It's truly a pleasure to be here. And I am certainly ready to help you navigate these numbers, not as abstract figures, mind you, but as valuable insights for your financial journey. You might be thinking, okay, where do we even begin? Well, let's start with the, shall we say, the optimistic part of investing, what you hope to earn. The first fundamental concept we'll explore is something called expected return. In finance, we often write this as ERP. Here, R stands for return and P stands for portfolio, which is just your collection of investments. Put simply, expected return is the average outcome you anticipate from an investment or portfolio over a certain period. It's absolutely crucial to understand that this isn't a guarantee. No, not at all. Think it more as a forecast, maybe a carefully calculated estimate, or perhaps the most likely scenario based on the information and probabilities we have. It's what you might reasonably expect, not what is certain to happen. Let's use our cricket example again. Maybe that'll make it even clearer. Imagine your favorite team has a star batsman, A real crowd pleaser, yes. His expected return could simply be his average runs per match. So if in his last 3 matches he scored 50 runs and maybe 60 runs and then 40 runs, his average performance, or what you would typically expect from him per match, is, well, 50 runs. 50 plus 60 plus 40 divided by 3. This average gives us a pretty good idea of his general contribution, doesn't it? Now, in the real world of investments, we might use historical data, past performance, or even different future scenarios with their probabilities assigned to arrive at this expected return figure. Now, when we talk about a portfolio in finance, what we mean is simply a collection of different investments. It could be various stocks, bonds, perhaps even real estate. Much like a delicious Indian dal needs different ingredients, doesn't it? Lentils, spices, vegetables, all needed to make a wholesome meal. Your portfolio might have many such ingredients. And when you combine these different investments, the portfolio's overall expected return isn't just a simple average of each individual investment's expected return. No, it's what we call a weighted average.
Let's take a moment to understand this idea of a weighted average because it's quite important. Imagine you have a certain amount of money, let's say just 100 rupees, to invest. If you put 50 rupees into one stock, maybe 25 rupees into another, and the remaining 25 rupees into a third stock, each of these amounts represents a weight in your portfolio. So the first stock has a weight of 50% or 0.50. The second has a weight of 25%, 0.25. And the third also 25%, 0.25. See, they add up to 100%. The formula ERP equals W1 ER1 plus W2 ER2 plus WN ER2 plus LIBOR in RB. Conceptually means you multiply the expected return of each investment by its proportion, its weight in your portfolio. And then you simply add all those results together. This gives you the total expected return for your entire collection of investments. It nicely reflects how much each part contributes to the whole outcome. Let's take an example that might be quite familiar to many of us. Think of a small kirana shop, the local grocery store in your neighborhood. The shop sells various essential items, rice, sugar, maybe some spices. Each item has its own expected profit margin, right?
Now, suppose rice sales bring in, let's say, 50% of the shop's total expected profit, while sugar brings in maybe 25%, and spices also bring in 25%. The shop's overall expected profit isn't just a simple average of the profit from rice, sugar, and spices. No, it's a weighted average. The profit from rice is weighted more heavily, you see, because it contributes more to the overall business. This is exactly how we calculate a portfolio's expected return. Each investment's contribution is weighted by how much money, what proportion you allocated to it. Okay, let's consider a practical example, one involving a portfolio made up of 3 different types of assets, or asset classes as mentioned in our source material. Imagine a portfolio where 50% of money, so a weight of 0.50, is invested in the S&P 500. This is a broad index representing the largest companies in the U.S., and let's say its expected return of 13%.
Okay, 13%.
Then 25% of the money, a weight of 0.25, is in U.S. long-term corporate bonds. These are essentially loans to companies, and let's say their expected return is 6%.
Lower return, okay.
And the remaining 25%, another weight of 0.25, is in the MSCI EAFE index. This is an international stock market index covering Europe, Australasia, and the Far East. Let's say its expected return is 15%.
Higher again. Interesting.
So to find the overall expected return for this entire portfolio, this mix, we simply apply our weighted average concept. We take each asset's expected return and multiply it by its weight in the portfolio, and we just sum them up. So for the S&P 500, it's 0.50 multiplied by 13%. That gives us 6.5%.
Half of 13, yes.
Exactly. For the U.S. long-term corporate bonds, it's 0.25 multiplied by 6%. That gives us 1.5%.
A quarter is 6.
Correct. And for the MSCI EAFE, it's 0.25 multiplied by 15%, which comes out to 3.75%.
Right.
Now we simply add these 3 values together, 6.5% plus 1.5% plus 3.75%, and we arrive at an overall expected portfolio return of 11.75%. Yes. This 11.75% is the average return you can anticipate from this specific combination of investments. It's a pretty straightforward calculation, really, that gives us a clear picture of the potential reward.
That is a very clear way to calculate what we can sort of hope to achieve on average. Thank you. So just to make sure we are all on the same page, our dear listeners, imagine you are putting together a small portfolio with just 2 investments. Simple. Let's say you dedicate 60% of your funds to stock A, which you expect to return maybe 8% annually, and the remaining 40% goes in stock B, which you anticipate will yield a higher 12% annually. How would you go about determining the overall expected return for your portfolio? Just take a moment to think about how those weights, 60% and 40%, would influence the total outcome. Excellent. I hope that makes sense. Understanding what we hope to get, the expected return, is absolutely essential. It's the first step. But as we discussed earlier, investments aren't always a smooth ride, are they? Not at all. Sometimes they climb high, sometimes they dip low. Much like, well, like a thrilling roller coaster ride you might find at a lively Mela. This inherent variability, this constant uncertainty in the actual returns you get, this is precisely what we define as risk in finance. It's the possibility that your actual returns might be different from your expected returns and, importantly, potentially lower. So the next question is, how do we measure this swing, this variability? We use a concept called variance. We represent it mathematically as senat, that's the Greek letter sigma squared, so senat RP for a portfolio. Variance essentially quantifies how much the actual returns of an investment or a portfolio tend to spread out, or you could say scatter, around their expected return. Let's go back to our cricket analogy. If your star batsman averages 50 runs, right, but sometimes he scores a fantastic 100, and other times he's out for just 10. The variance tells us how much that score can wildly swing from his average of 50. A higher variance means the returns are more widely dispersed, indicating a higher level of risk. Your investment journey might feel quite bumpy indeed if the variance is high. Now, variance itself, the number you get, can sometimes be a little difficult to interpret directly. Its units are squared returns, which isn't very intuitive. So to make it more practical and easier to grasp, we simply take the square root of the variance. And that gives us what we call standard deviation, represented just as sigma p. Standard deviation is wonderful because it's in the same units as the return itself, like percentages. This makes it much easier to understand. You can think of it as the average distance your actual returns might be from your expected return. A higher standard deviation indicates greater unpredictability, more ups and downs, a wider range of possible outcomes. It tells you that your investment could surprise you more often, both positively and negatively. For instance, if one investment has an expected return of 10% with a standard deviation of, say, 5%, and another investment also has the same 10% expected return, but its standard deviation is much higher, maybe 15%. The second one is clearly much riskier, isn't it? Because its returns swing much more widely around that 10% average.
That's a very clear way to explain how we quantify the individual risk, the standalone risk of an investment using variance and standard deviation. But here's where it truly gets fascinating, and this is a really key insight of modern finance. A portfolio's total risk isn't just about adding up the individual risks of each part. No, it's profoundly influenced by how those parts, those different investments, move together. Imagine a musical orchestra. The final sound isn't just created by each instrument playing loudly in isolation, is it?
No, of course not.
It's about how they harmonize, how they play in sync, or sometimes how their sounds clash or complement each other. This intricate dance, this relationship between different investments in your portfolio, is captured by a concept called covariance. Covariance, which we often denote as cov-re-rj, measures how the returns of two different investments, let's call them investment I and investment J, move in relation to each other. Conceptually, it's looking at how they vary together around their respective means. It tells us if they tend to go up or down at the same time, or if they tend to move in opposite directions. The sign of the covariance, whether it's positive, negative, or zero, tells us a great deal. Let's start with negative covariance. If the returns of one investment tend to go up when the returns of another investment tend to go down, their covariance will be negative. Think of it this way. If it starts raining heavily, sales of umbrellas naturally go up, wouldn't they?
Yes, absolutely.
But at the same time, sales of ice cream might go down because, well, people might prefer hot tea or coffee in the rain. So umbrella sales and ice cream sales, in this case, move in opposite directions based on the weather. They would have a negative covariance.
Oh, okay, that makes sense.
Then there's zero covariance. If the returns of two investments are completely unrelated, meaning there's no predictable pattern in how they move together, their covariance is zero. Consider the sales of a cricket bat and the sales of a Diwali firecracker. One is seasonal for sports, the other is for a specific festival. They have absolutely nothing to do with each other.
Right, totally unrelated.
Their movements are independent, so their covariance would be zero. And finally, positive covariance. If the returns of two investments generally move in the same direction, so when one goes up, the other tends to go up as well, and when one goes down, the other also tends to go down, their covariance is positive. For instance, think about Diwali time again. When people are buying lots of sweets for their celebrations, they also tend to buy decorative lights for their homes, don't they?
Yes, they often go together.
Both sales typically rise together during the festive season. So their returns would likely have a positive covariance. So just to check your understanding of this crucial concept, let me ask you, our listeners, if you own shares in a public transport company, maybe a city bus service, okay, and you observe that the value of these shares tends to increase whenever petrol prices decrease because their fuel costs go down, what kind of covariance would you expect the returns of the transport company shares on the price of petrol to have? Would it be positive, negative, or zero? Think about how those two are moving in relation to each other.
That's a really helpful way to visualize covariance. Using those everyday examples really clicks. And this actually brings us to an even more insightful measure, I think. While covariance tells us the direction of how two things move together, its actual numerical value, the magnitude, depends quite a bit on the scale of the returns themselves. If the returns are in very large numbers, the covariance can also be a very large number, maybe thousands or millions. This makes it difficult sometimes to compare the strength of the relationship between different pairs of assets. Is a covariance of 500 strong or weak? It depends. So here's where it gets really interesting and very practical. To make this relationship universally comparable, we use something called correlation. We denote it as RJ, using the Greek letter rho. Correlation is essentially a standardized version of covariance. It cleverly strips away the scale, the units, giving us a pure number. This number tells us both the strength and the direction of the linear relationship between two variables, and its value always falls neatly between -1 and +1, always. This standardization is incredibly useful because a correlation of, say, plus 0.5 means the same degree of positive relationship, whether we're looking at the returns of small local companies or giant international corporations. It's a universal measure. Let's quickly break down what these correlation values signify. A correlation of -1. This indicates a perfect, strong, inverse relationship. It means that whenever one variable goes up, the other goes down by an exactly proportional amount, every single time, like perfect opposites. There is absolute predictability in their opposite movements. For example, imagine a perfectly managed hypothetical stock that always goes up by exactly 1% when the overall market goes down by exactly 1% and vice versa. That's a perfect Menocal 1 correlation. Finding such assets offers incredible diversification potential because one cushions the fall of the other, a correlation of +1. This indicates a perfect, strong, direct relationship. It means that whenever one variable goes up, the other goes up by an exactly proportional amount every single time. They move perfectly in lockstep. Think of maybe two companies that are so incredibly similar, perhaps they sell the exact same product to the exact same customer base, that their stock prices mirror each other perfectly. When one rises, the other rises exactly in step. While this might feel good when both are going up, it offers absolutely no diversification benefit against downturns. If one falls, the other falls right along with it, and a correlation of 0. This indicates no clear linear relationship at all. There's no predictable pattern in how they move together based on a straight line. One variable's movement doesn't really tell you anything predictable about the other's movement. It's like, flipping a coin and then observing the stock market's movement for the day one doesn't influence the other in any predictable linear way. It's important to remember that most real-world assets fall somewhere between -1 and +1. Perfect correlations are extremely rare in reality. So here's another quick thought for you. Imagine you are a student again, and you notice that your score in your science class usually goes up when your math score also goes up. You tend to do well in both together, or struggle in both together. What would you anticipate the correlation between your science scores and your math scores to be? Would it likely be closer to +1, closer to -1, or closer to 0? Think about how they tend to move together.
That's a wonderful way to think about correlation, connecting it to everyday experience. Very good. Now let's connect this crucial idea back to the bigger picture of managing our investments. The overall risk of a portfolio, what we call portfolio variance, remember variances is that not simply the sum of the individual risks, variances of each asset within it. No, it's not that simple. It's far more complex, actually, and crucially depends on all these covariance terms we just discussed, or equivalently the correlation terms. When we construct a portfolio with many different assets, the total risk is heavily influenced by how each asset's return moves in relation to every other asset's return in that portfolio. What's truly fascinating here, and often a surprise to many people when they first learn it, is how important these covariance or correlation terms become as you add more and more investments to your portfolio. Imagine you have a simple portfolio with just 3 different assets, okay? You would have 3 individual risk components, the variances of each asset, and you would have 3 pairs of assets to consider for covariance.
Asset 1 with asset 2, asset 1 with asset 3, and asset 2 with asset 3. That's 3 covariance terms, or 6 if you got cov 1, 2, and cov separately, though they are the same.
Okay, 3 variances, 3 covariances.
Right. But now, imagine you expand your portfolio to include, say, 20 different assets. You would still have 20 individual risk components, the variances. However, the number of pairs, the number of covariance terms you need to consider, it skyrockets. It becomes 20 times 19 divided by 2, which is a massive 190 unique covariance terms.
Wow, that's a lot more.
Exactly. This exponential increase means that as your portfolio grows larger and more diversified, the way your investments dance together, that is, their covariances and correlations, becomes far more critical in determining your overall portfolio risk than the individual risks of each asset considered alone. The relationships between your investments truly dominate the risk profile of a well-diversified portfolio. And this brings us directly to a foundational question in investing. Why do we diversify? Why do investment advisors always suggest not putting all your eggs in one basket? It's much like preparing a traditional Indian thali plate for a meal.
Ah, the thalu example. I like that.
Yes. You have various dishes on the plate, don't you? Perhaps a spicy curry, a mild dal, some cooling yogurt, raita, maybe some rice or roti, and a sweet dish. If one dish, say the curry, turns out to be a little too spicy for your taste, the milder dishes like the dal and the yogurt help to balance it out, don't they?
They do, absolutely. It makes the meal more enjoyable overall.
Precisely. Similarly, in investments, if the returns of different assets don't move perfectly together, meaning their correlation is not a perfect +1, then holding a variety of them can actually reduce the overall risk, the overall volatility of your portfolio. And often, you can do this without necessarily diminishing your expected return. This is the incredible diversification benefit, a cornerstone of what we call modern portfolio theory. It means you can potentially achieve the same expected return, but a less overall bumpiness in your investment journey simply by smartly combining assets whose movements are not perfectly synchronized. Let's quickly revisit our earlier 3-asset portfolio example, the S&P 500, the U.S. long-term corporate bonds, and the MSCI EAFE, to illustrate how this works with actual numbers. Remember the weights. 0.50 for S&P 500, 0.25 for U.S. bonds, and 0.25 for MSCI EAFE. Now, the source material also provides us with a variance of each asset, which is technically its covariance with itself, and crucially, the covariances between each pair of assets. Let me just state the numbers given. S&P 500 variance, 400. Standard deviation would be scored in 420%.
U.S. long-term corporate bonds variance, 81. STD Dev, around 9%. MSCI EAFE variance, or 41. STD Dev low is 21%. Now the relationships. Covariance between S&P 500 and U.S. bonds is 45. Covariance between S&P 500 and MSCI EAFE is 189. And covariance between U.S. bonds and MSCI EAE is 38. Now, when we plug all these numbers, the weights, the individual variances, and these crucial covariances into the full portfolio variance formula, which looks complicated, but conceptually just combines everything. The final calculated portfolio variance for this specific combination of assets turns out to be 195.875.
Okay, 195.875.
Yes. And if we take the square root of that variance to get the portfolio standard deviation, which is our measure of total risk, we find it to be approximately 14%.
14% standard deviation for the whole portfolio.
Now, here's the crucial insight, the power of diversification shown in numbers. What if the returns on these 3 assets were completely independent of each other? What if all those covariances we just listed, 45, 189, 38, were actually 0?
If they didn't influence each other at all.
Exactly. If that were the case, the standard deviation of this portfolio would be significantly lower. It would calculate out to be around 11.52%.
Lower than 14%.
Much lower. The fact that our actual calculated standard deviation is 14% is entirely due to the positive covariances among these particular assets. They tend to move somewhat in the same direction, which adds to the overall risk compared to if they were independent. If, for instance, we had been able to find assets with negative covariances to include, our portfolio risk could have potentially been even smaller than 11.52%. This powerfully demonstrates how intelligent diversification, by combining assets that don't always move in lockstep, lower negative correlation, can genuinely make your investment journey much smoother and less volatile. It helps you manage risk effectively, sometimes even while maintaining the same expected return.
That's a truly profound point, isn't it? The real magic of diversification often lies not just in what you own, but in how the things you own behave together, their interplay. So for you, our listeners, let's pause and think. If your primary goal is to make your investment portfolio less risky, less volatile, should you actively seek out assets that tend to have a high positive correlation with each other? Or should you instead aim for assets that exhibit a low or perhaps even a negative correlation? And most importantly, why does that choice make such a significant difference in your overall risk profile? Think about the Thali example. Okay, now that we have a good grasp on how these numbers interact, expected return, variance, standard deviation, covariance, correlation, and the profound impact of diversification, Let's turn our attention briefly to how we might actually estimate these relationships for the future, because investment decisions are always about the future, aren't they? Not just the past. And then after that, we'll move on to using these concepts to manage a very specific and very practical kind of risk that many of us face in our lives, the risk of not having enough money when we truly need it most.
That's a crucial next step indeed. While we often rely on historical data, looking at past movements, to estimate covariance and correlation, sometimes, especially when dealing with new investments maybe, or unique market conditions ahead, we can also forecast these relationships. We can do this using what we call a joint probability function. This approach is particularly useful when we can imagine different possible future scenarios, different states of the world, and we can assign probabilities or chances to those scenarios actually occurring. It means we explicitly consider the chances of two or more events happening together at the same time. For example, we might ask, what's the probability that both a very strong economy and low interest rates happen together in the same year? That's a joint probability. So a joint probability function simply gives us the probability of two variables, let's say x and y, taking on specific values simultaneously. For instance, notation like px5, y10 would tell us the likelihood, the chance, that variable x is exactly 5 and variable y is exactly 10, both occurring in the same scenario. It helps us model how different factors, like the returns of different companies, might play out together under various potential future states of the world. Let's consider a clear example from our source material. It involves forecasting the potential returns of two hypothetical banks. Let's call them Bancorp and Nubank. The source provides a table that lays out different possible economic conditions for the next year, maybe good, average, and poor, and it assigns a probability to each of these conditions occurring. For example, maybe a 20% chance of good, 50% chance of average, 30% chance of poor. Then, for each of these conditions, the table also gives us the expected return for both Bancorp and Nubank under that specific condition. This whole setup, this table, is essentially our joint probability function for their returns. Okay, first, before we calculate covariance, we need to calculate the overall expected return for each individual bank using these probabilities and scenario returns. This is just like we did for the portfolio earlier. So for Bancorp,
if there's a 20% probability of a 25% return in good condition, a 50% probability of a 12% return in average, and a 30% probability of 10% return in poor, its overall expected return is calculated as 0.2 around 25% plus 0.50, 12% plus 0.30, 10%. That works out to 5% plus 3% plus 14%. So Bancorp's overall expected return is 14%.
Okay, 14% for Bancorp.
Similarly, let's do it for Nubank.
Yeah.
If there's a 20% probability of a 20% return, good, a 50% probability of a 16% return, average, and a 30% probability of a 10% return, its overall expected return is 0.20, 20%, plus 0.50, 16%, plus 4%, plus 8%, plus 3%, plus 15%. So Nubank's overall expected return is 15%.
15% for Nubank. Slightly higher.
Right. Now we have the expected return for each bank, 14% and 15%. To calculate the covariance between Bancorp, let's call its return RA, and Nubank or RB, using these joint probabilities, we apply a specific formula, Formula 8 in the source. Conceptually, what we do is this. For each possible future condition, good, average, poor, we first figure out how much each bank's return in that specific condition deviates or differs from its own overall average expected return, the 14% or 15% we just calculated. Then we multiply these two deviations together for that condition. After that, we multiply this product by the probability of that specific condition actually happening, the 20%, 50%, or 30%. Finally, we add up all these probability-weighted products from each of the conditions, good, average, poor. This accumulated sum gives us the forecasted covariance between RA and RB. It's a systematic way to see how they're expected to co-vary, to move together across different potential future states. Let's apply this step by step to our Bancorp RA ERA 14% and Nubank RB 15% example, using the numbers from the source. Condition 1, good, probability equal to 0. Bancorp's return RA 25%.
Deviation from its mean, almost 2514 equals plus 11. Nubank's return RBQ equals 20%. Deviation from its min, 2015 plus 5. Product of deviation plus 11 plus 5 is plus 55. Weighted product equals plus 55. Probability good. So 55.20 equals 11.
Okay, 11 from the good scenario.
Condition 2.
Yeah.
Average, probability 0.50. Bancorp's return RA equals 12%, deviation 1214, needs of 2. Nubank's return RB was 16%, deviation 1615 plus 1. Product of deviation 0 plus 1 minus 2, probability average 0 is 2.50, using 1.
Rate from average.
Okay, condition 3. Poor, probability 0.30. Bancorp's return RA was 600, deviation 1014, goes 10%, deviation 1015, uses 5. Product of deviations minus 4, minus 5 plus 20, minus 10 minus is plus. Weighted product equals 20. Probability poor plus 6 from poor, exactly. Now, we just sum up these weighted products from all three conditions. 11 from good, plus mode is 1 from average, plus 6 from poor. 11, 1 plus 6 equals 16. So the forecasted covariance between Bancorp and new bank returns, COV-RA-RB, is calculated to be 16. This positive number suggests that, based on these forecast scenarios and probabilities, the returns of the two banks are expected to move in the same general direction. This whole discussion about joint probabilities leads to an important distinction we should touch upon briefly. When two variables are truly independent of each other, meaning knowing the outcome of one gives you absolutely no information about the outcome of the other, like maybe two different cricket matches happening in different cities with completely unrelated teams and weather.
Okay, completely separate events.
Yes. Then their joint probability is simply the product of their individual probabilities, PA and B equal PEPB, if they are independent. What's crucial to understand in finance is that if two variables are statistically independent, they are always uncorrelated. Their correlation coefficient will be exactly 0. However, the reverse isn't always strictly true. Variables can sometimes be uncorrelated, correlation equals 0, without being fully independent, especially if their relationship is nonlinear. But for most practical purposes in portfolio building, we often treat 0 correlation as a sign of low dependency. The key takeaway: independence guarantees 0 correlation.
That's a very thorough explanation of how we can actually look into the future using scenarios and probabilities to estimate these critical relationships like covariance. Thank you. So as a quick check for our listeners once more, if you are attempting to calculate the covariance between the returns of two different companies, maybe an airline and a hotel chain, and you have developed distinct possible economic conditions for next year, let's say, boom, normal and recession, and you know the likelihood, probability of each condition occurring, and you know how both companies are expected to perform their returns under each specific condition, what kind of probability information would you need to use for your covariance calculation? Would you just consider the individual probabilities of each company's returns, or would you need something more comprehensive, like the probabilities of the conditions themselves? Excellent. So we now have powerful tools not only to analyze past performance, but also to forecast future relationships between investments, which is vital. This really moves us from just theoretical understanding towards more practical application and decision making. Now, let's shift our focus, as promised, to a very practical and sometimes, let's be honest, anxious aspect of risk. It's one that applies to all of us, whether we are seasoned investors or just carefully saving up for something important. And that is making absolutely sure we don't fall short of our most important financial goals. So what does all this talk about risk and return really mean for us, the everyday person navigating our financial lives? Sometimes our biggest worry isn't just that our investment might go down in general value, but specifically that it might fall below a minimum amount that we absolutely crucially need at a certain point in time. This particular type of concern, this risk of not hitting a specific target or threshold, is what we call shortfall risk. It's a very real and often very tangible worry for many people. Let me give you an example that I think many might relate to here in India. Imagine you are diligently saving money for a very important family wedding, maybe your daughter's or son's wedding. You've carefully calculated and set a minimum target amount, say 5 lakh rupees, that you absolutely need to cover the basic non-negotiable expenses for the event, the venue, the food, essential ceremonies. Your shortfall risk in this situation is the probability, the chance that your accumulated savings might actually fall below that essential 5 lakh rupees when the wedding day arrives and the bills are due. That's a deep-seated worry, isn't it? It's about the anxiety of not being able to meet a crucial non-negotiable financial need for your family. So in finance, we formally define shortfall risk as the probability that your portfolio's value, or perhaps its rate of return, falls below some predetermined minimum acceptable level, your target, over a specific time horizon, like the date of the wedding.
That's a perfect, very relatable illustration of how shortfall risk impacts our real lives and planning. Thank you for that example. Now, this brings us to a very practical and insightful concept developed to address this exact concern. It's known as Roy's safety-first criterion, named after A.D. Roy, who proposed it. This criterion tells us something quite intuitive, actually. It says that when your primary concern is specifically to avoid falling below a certain financial threshold, that minimum acceptable level, which we often call RL, representing the required level of return or value, then the best portfolio for you is the one that minimizes the probability of your actual portfolio return, RPT, falling below that required level, RL. So our main goal here shifts. It's not necessarily about maximizing the highest possible return anymore. Instead, the goal becomes to minimize the chance, minimize PRPRL. It's about prioritizing security, ensuring you meet that critical need over simply chasing maximum growth. Now, how do we actually implement this? How do we find the portfolio that minimizes this probability? We use a very clever and extremely useful tool called the safety first ratio, or S ratio for short.
The formula for the S ratio is quite straightforward. S ratio equals ERP. Now let's break down each part again to make sure we understand it clearly. ERP is the expected return of your portfolio, what you anticipate earning on average. RL is that crucial minimum acceptable return you must achieve. It's your shortfall level, the threshold below which you absolutely cannot afford to fall for your goal. And the FRNP, as we learned earlier, is your portfolio's standard deviation, representing its overall risk, the typical amount its returns swing up and down. You can think of the SR ratio as representing your safety margin or your cushion. The numerator, ERPRL, tells you how much your expected return is above your critical minimum required level. This is your buffer. The denominator in SR rate represents the risk or volatility, how much that buffer might fluctuate. So the SR ratio essentially measures how much safety buffer you have, expected return above the minimum per unit of risk, standard deviation. A higher S ratio is better. It means you have a larger safety cushion relative to your portfolio's usual ups and downs. And very importantly, a higher SF ratio directly translates into a lower probability of experiencing a shortfall, a lower PRPRL. You are statistically safer from falling below your target. Let's consider another common example from everyday life, maybe involving bills. Imagine your monthly electricity bill. Let's say it usually comes to around €1,000. However, you know that if your income for the month falls below 800, you might struggle to pay, and perhaps the electricity company might even disconnect your power. That would be a critical problem. Here, that 800 level acts like your RL, your absolute minimum acceptable income level needed to cover this essential expense without severe consequences. Your expected return in this analogy would be your usual expected monthly earnings. The SRF ratio would then tell you how safe you are from your earnings falling below that critical 800 mark, taking into account how much your monthly earnings might typically fluctuate, your earnings standard deviation. If your earnings are consistently well above 800 and also very stable, low standard deviation, your SR ratio would be high, indicating a low risk of facing electricity disconnection due to insufficient funds that month. Makes sense?
Yes, that analogy helps clarify the ratio's meaning, buffer versus fluctuation.
Exactly. So in a practical investment scenario, if you were presented with several different investment portfolios or maybe different asset allocation strategies to choose from, you would calculate the SRF ratio for each one using its specific expected return, its standard deviation, and your personal required minimum return, RL. The portfolio that yields the highest SR ratio is considered the optimal portfolio according to Roy's safety first criterion. Why? Because it provides you with the mathematically smallest chance of actually falling short of your vital financial goal. It's a powerful tool for making decisions when avoiding a specific negative outcome is your absolute top priority. What's also quite interesting, and a nice point of connection within finance, is that this safety first ratio, ERP, ERLC, bears a very strong resemblance to another widely used performance measure called the Sharpe ratio.
Ah, yes, the Sharpe ratio. People hear that one mentioned often.
Indeed. The Sharpe ratio is typically calculated as ERP, RFP, where RF is the risk-free rate of return, the return you could get on a virtually risk-free investment, like a short-term government bond. So you can see, if your minimum acceptable return, RL, happens to be equal to the risk-free rate, RFF, then the safety first ratio is mathematically identical to the Sharpe ratio.
They become the same thing in that specific case.
Exactly. This means that a portfolio with a high Sharpe ratio, which measures risk-adjusted return above the risk-free rate, is also inherently designed to have a lower chance of falling below that fundamental risk-free return. So maximizing the Sharpe ratio is essentially a specific application of the safety-first principle, where the minimum acceptable return is set at the risk-free level.
That's a remarkably practical framework. It really helps integrate our understanding of risk and expected return directly into making decisions about crucial real-world goals defined by RL. Let's perhaps walk through a concrete application now, using an example directly from our source material, to see exactly how Roy's criterion helps an individual make a choice. Okay, imagine a client. Let's say she currently holds 8 lakh rupees. The source uses CAD 800,000, but let's use lakhs for familiarity as her investment principle. She has a critical need. She must withdraw 30,000 rupees at the end of the year to cover her children's educational expenses. This is non-negotiable. And her primary concern, her absolute goal, is that she does not want to touch her initial 8 lakh principal for this expense. She wants that principal to remain intact for her long-term future.
Okay, a very common and important goal for many parents.
Absolutely. So the very first step for us is to calculate her shortfall level, her required minimum rate of return, her RL, for this year. What is the minimum percentage return her 8 lakh portfolio must generate so she can withdraw the 30,000 rupees without dipping into the original 8 lakh? It's simply the amount she needs to withdraw, 30,000 divided by her initial principal, 8,000. So 30,000 divided by 8,000. If you calculate that, it comes out to 0.0375. which means her required minimum return, her RL, is 3.75%.
Right, 3.75%. That's the hurdle rate.
Exactly. If her portfolio fails to earn at least 3.75% in the year, she'll be forced to sell some of her principal to get that 30,000 rupees for the education fees. This 3.75% is her absolute lifeline for this specific goal this year. Now, let's say our source provides us with 3 different hypothetical investment allocations, 3 different ways she could invest her 8 lakh rupees. Let's just call them allocation A, allocation B, and allocation C. Each one has its own expected annual return and its own standard deviation, reflecting different strategies and risk levels. Our task using Roy's criteria is to determine which of these allocations is the best for her specific goal, meaning which one gives her the lowest chance of falling below that crucial 3.75% target return. And we do this, as you explained, by calculating the safety first ratio for each allocation. Okay, let's get the numbers from the source, Exhibit 11, and calculate the S ratio for each option. For allocation A, this allocation has an expected return ERP of 25%, quite high, but also a very high standard deviation TUP of 27%, very risky. Her RL is 3.75%, so the S ratio for A is ERP for A or 25%. 3.75%, 27%. That's 21.25 divided by 27, which gives us approximately 0.787 for AFING.
Okay, 0.787.
Now for allocation B, this one is much more conservative. It has a lower expected return ERP of 11%, but also a much lower standard deviation SUPD of only 8%. Her RL is still 3.75%. So the S ratio for B is 11%, 3.75%, 8%. That's 7.25 divided by 8, which gives us approximately 0.90625.
0.90625 for B, higher than A's ratio.
Yes, noticeably higher.
Okay.
Finally, allocation C, this one is somewhere in the middle. It has an expected return ERP of 14% and a standard deviation SOF of 20%. RL is still 3.75%, so the S ratio for C is 14%, 3.75%, 20%. That's 10.25 divided by 20, which gives us approximately 0.5125.
0.5125 for C. That's the lowest ratio of the 3.
Exactly. So now we compare the S ratios. A is 0.787, B is 0.90625, and C is 0.5125. As you can clearly observe, allocation B has the highest S ratio at 0.90625. This means that, according to Roy's safety first criterion, allocation B is the optimal choice for this client with her specific goal. Even though allocation A had a much higher expected return, 25% to less 11%, its extremely high risk, 27% EDD dev, made it less suitable for ensuring she met her minimum 3.75% need. Allocation B offers her the smallest probability of falling below that required 3.75% return for her children's crucial education expenses.
A very clear example of how prioritizing safety changes the optimal choice.
Precisely. Now, you might naturally wonder, okay, allocation B is the best choice, but what is the actual probability that we'll still fall short? It's not zero risk, right?
No, usually not zero. The SF ratio helps us minimize the probability, not eliminate it entirely in most cases.
Right. So using the SF ratio of 0.90625 for allocation B and making a common assumption in finance that portfolio returns tend to follow a somewhat normal distribution, that bell-shaped curve, we can actually estimate this probability of shortfall, PRP 3.75%. Our sources indicate that for an SF ratio of approximately 0.906, or looking it up in a standard normal table, the probability of falling below the threshold is approximately 18.2%.
So about an 18% chance she might still not make the 3.75%.
Correct. There's roughly an 18% chance her portfolio B won't meet her 3.75% goal. But critically, this is the lowest chance among all the options, A, B, C, she considered. She has effectively chosen the portfolio that best protects her against that specific shortfall risk that was her primary concern. It's not about avoiding risk entirely, which is often impossible, but about managing it intelligently in the face of crucial financial needs.
That's a powerful demonstration, really, of how these analytical tools, like the SF ratio, translate directly into helping individuals make better, more goal-oriented financial planning decisions. Excellent walkthrough. Now for our listeners, let's try to connect this back to your own experiences or future goals one last time on this topic. If you are saving diligently for a significant financial goal down the road, perhaps as the down payment on a new house you hope to buy in 5 years, and you have calculated a very specific minimum amount you absolutely need by that date, that's your crucial RL. And you're evaluating different investment portfolios or mutual funds to help you get there. Based on what we've just learned about the Roy's safety first criterion, what is the most important numerical measure or ratio you would want to prioritize maximizing from those portfolios you are considering? What ratio best reflects your need to meet that minimum target safely? And maybe just to broaden the perspective a bit, if we connect this to the wider landscape of financial management.
This kind of safety-first thinking, this focus on downside risk and meeting minimum thresholds, isn't just confined to individual investors planning for weddings or education or house payments. Not at all. Yeah. No, it is actually a fundamental principle used extensively in very advanced financial risk management by large institutions. Think of major banks, insurance companies, large investment firms. For instance, they employ concepts very similar to shortfall risk when they calculate something known as value at risk, or VAR, V-A-R.
VAR, yes, I've heard of that.
VAR is a statistical tool that helps these large institutions estimate the minimum value of losses they might face over a given period, like a day or a week, with a certain level of probability, say 5% or 1%. It helps ensure they have enough capital to absorb potential shocks. They also conduct rigorous stress testing and scenario analysis. This involves modeling how their portfolios might perform, what losses they might incur under extremely unfavorable market conditions, like a major market crash or a sudden spike in interest rates conditions far beyond typical fluctuations. These are all sophisticated applications of the same core principle we've discussed today: understanding, quantifying, and actively minimizing the chance of falling below critical financial thresholds. So the principles you are learning today about managing shortfall risk are truly fundamental to the entire financial world, from a small family savings goal to ensuring the resilience of a global bank.
What an incredible journey we've had today exploring these numbers. It really feels like we've built a strong foundation. We began by understanding how to calculate our expected returns from investments, how much like knowing your favorite cricket batsman's reliable average score. Then we truly delved into the heart of risk by understanding variance and especially standard deviation, quantifying the unpredictable ups and downs, the swings that come with any investment. Most importantly, perhaps, we learned about covariance and correlation, which unveiled the crucial story of how different investments move together, and how the brilliant strategy of diversification, by combining assets that don't move in lockstep, can actually reduce our overall portfolio risk, just like having a variety of delicious complementary items on a thali plate, balancing each other out beautifully.
Exactly. And finally, we explored the very practical and often deeply personal concept of shortfall risk, the worry of not meeting a minimum target, and Roy's safety-first criterion, along with the S ratio. This showed us a clear method for how to choose investments, not just aiming for the highest possible returns, but crucially, choosing them to minimize the chance of not meeting a critical financial goal, be it that essential wedding fund we talked about, vital educational expenses for children, or the dream house down payment. And this, I believe, raises a very important, perhaps provocative question for each of you to ponder as you reflect on your own financial journey after this deep dive. When you look at your own savings or your future investments, what truly holds more importance for you? Is it relentlessly chasing the absolutely highest possible return, accepting the higher risks that might come with it? Or is it ensuring the lowest possible chance of falling below a certain essential safety line, that crucial minimum amount you absolutely need for your peace of mind or a specific goal? And now that you understand these powerful tools like expected return, standard deviation, correlation, and the safety-first ratio, how might they help you make that deeply personal and profound decision for your own financial future?
Think about that, my friends, because ultimately finance isn't just about abstract numbers on a spreadsheet or complex formulas. It's truly about making smart, informed decisions that shape our lives, protect our families, and help us achieve our most important goals. Until next time we meet for another deep dive, please keep learning, keep exploring these ideas, and most importantly, keep investing wisely.
Welcome, welcome everyone to the deep dive. We're so glad you could join us in our classroom today.
Yes, welcome.
Now, have you ever considered, how experienced financial professionals make these big decisions when the future seems, well, so uncertain? It often feels like you need a crystal ball, doesn't it? We look at the markets, we analyze investments, and naturally, we want to know what's coming next. But that future, it remains quite unclear. A landscape of possibilities, really, not certainties.
Indeed, indeed. That search for a perfect crystal ball in finance, well, it's a bit futile, isn't it?
Right.
Trying to predict the exact movement of the stock market or, any specific investment. It's just, by its very nature, impossible. But, and this is important, this uncertainty doesn't mean we just throw up our hands.
No,
Definitely not. Instead, it pushes us to use some very powerful analytical tools that help us understand the range, the spectrum of what could happen, and then we can prepare for those possibilities effectively. Right. Our goal isn't to be fortune tellers, you see. It's more about being exceptionally well-informed navigators in this, constantly changing world of finance.
Precisely. And that's exactly what we are going to take a deep dive into today, right here in our classroom.
Yes.
We'll explore some of the most I think, fascinating and foundational methods that financial experts use to forecast variables and price assets. Think of it like learning to build your own smart framework, a way to think about the future, one that really understands probability and helps you visualize all the different paths an investment might take.
Today, we will try to simplify 3 core concepts, really essential ideas in this field. First, we'll unpack how financial asset prices behave. We'll use something called a log normal distribution. Understanding this is really critical for grasping the nature of how assets move.
Log normal, okay.
Then second, we'll explore Monte Carlo simulation. This is a remarkably versatile technique. It lets us run thousands, even millions, of what-if scenarios. Really helpful for quantifying risk and valuing complex things.
Thousands. Yeah.
Ow.
Thousands. And finally, number 3, we'll look at bootstrapping. This is a clever, data-driven approach. It lets us draw insights directly from our own historical data, our past observations.
Right. Bootstrapping. Okay, these names. Log normal, Monte Carlo, bootstrapping. They might sound a bit daunting at first glance, but please, don't worry.
Not at all.
Our aim here, truly, is to illuminate these concepts step by step. We'll give you clear explanations and, importantly, relatable examples you can easily understand.
Yes, our goal is to give you those aha moments, so you grasp the logic, the power behind these tools without feeling overwhelmed.
Exactly. So, shall we begin our exploration?
Let's start.
First things first. Let's establish a basic building block. What exactly do we mean by a probability distribution?
Good starting point.
At its heart, think of a probability distribution like a very detailed scorecard, or maybe a statistical map.
A map. I like that. Yes. It shows you all the possible outcomes for something specific, an event, a variable, and crucially, it tells you how likely each of those outcomes is to happen. It's a way to organize and visualize uncertainty.
Makes sense.
To make this really concrete, let's use an Indian example. Imagine you are a cricket coach, a very dedicated coach.
Okay, got it. Coach?
And you are meticulously tracking your star batsman's scores every single match. Now, a probability distribution for his scores wouldn't just list them, 0, 10, 50, maybe a brilliant unuttered runs.
Right.
It would also tell you how often, what the probability is of him scoring each of those. Does he frequently get out for a duck? 0 runs.
Hopefully not too often.
Hopefully not. Or does he reliably score a half century? Maybe quite often. This scorecard, this distribution, gives you a probabilistic snapshot of his performance. It helps you understand what to expect in his next innings, you see.
Yes, the likelihood of different scores.
Exactly. It's a tool for understanding the likelihoods. So Are you with us so far? A probability distribution tells us possibilities and their likelihoods.
Yeah. Okay, building on that foundation of distributions. One of the most common, most pervasive probability distributions you'll encounter, really across many fields, science, finance, is the normal distribution. You often see it visually recognized as the bell curve.
The bell curve, right. Very famous shape.
Exactly. Its iconic symmetrical shape peaking right in the middle and then tapering off equally on both sides signifies that values are just as likely to fall above the average as they are below it.
Symmetrical. Okay.
Yes. And the mean, the median, the mode, they all coincide right at that central peak.
All in the middle.
All in the middle. Now, think about a simple example. The heights of all the students in a large classroom or even a whole school.
Okay, heights.
If you were to measure everyone's height and then plot how many students have each specific height, you'd likely see that familiar bell shape emerging.
Right, you would.
Most students will cluster around the average height. Then you'll have fewer students who are much taller, and similarly fewer who are much shorter, at the ends, the tails of the distribution.
Makes sense.
And it's symmetrical because, well, deviations from the average are equally probable in either direction. Someone is just as likely to be, say, 2 inches taller than average as they are to be 2 inches shorter.
Okay, so when we picture that normal distribution, that bell curve, we're really seeing that balanced shape. Most things happen near the middle and extreme values get rarer, but equally possible high or low.
Precisely.
But now,
Yeah.
here is where it gets really interesting and very important for finance. While financial returns, the percentage gain or loss often show characteristics that look like a normal distribution.
Often, yes.
Asset prices themselves. They are almost always modeled using something different, something called a log normal distribution.
Right.
Now, why? Why this difference? It's a critical point.
It really is. And the reason is actually quite straightforward, rooted in reality.
Tell us.
Think about asset prices. A stock price, the price of gold, the price of anything you buy, they cannot fall below zero.
Right.
You can't have a stock price of minus 50 rupees. That makes no sense. Exactly. Or think about your local market. Can the price of a delicious samosa be minus 5 rupees?
Haha, never. I wish sometimes, but no.
No, never. It always has a value of 0 or more. This fundamental constraint, this floor at 0, is precisely where the normal distribution, well, it doesn't quite fit for prices because it does allow for negative values mathematically.
Ah, I see. The normal curve goes below 0 on the left side. Prices can't do that.
That is the key insight. The log normal distribution is inherently bounded below by 0.
Bounded below by 0. Okay.
This means it intrinsically accounts for this non-negativity. Its values will never dip into negative territory. It perfectly mirrors the reality of asset prices.
That makes perfect sense.
And there's more. The log normal distribution is also skewed to the right.
Skewed. What does that mean exactly?
It means it's not symmetrical like the bell curve. Its shape rises quickly to a peak, but then the right side, the upside, stretches out much further. It has a long tail extending upwards.
A long tail on the right.
Ooh, okay. This signifies that while prices can only go down to 0, that's the limit they can theoretically increase very, very high. Indefinitely, almost.
Ah, so limited downside
Yeah.
to 0, but potentially unlimited upside.
Precisely. The distribution isn't symmetrical. It acknowledges this asymmetry inherent in asset growth.
Okay, that's a really important difference from the normal curve.
It is. And the name log normal itself gives us a big clue about its connection to the normal distribution.
Also,
Well, a random variable, let's call it y, like our asset price, is considered log normally distributed if it's natural logarithm.
natural logarithm, like ln on a calculator.
Yes, exactly, ln y. If you take the natural logarithm of y, that resulting value follows a normal distribution.
Oh, so the log is normal.
Exactly, you can remember it just like that. The log is normal. It's like a transformation. You take the log of the price data, and suddenly it looks like a nice symmetrical bell curve.
Okay, interesting. So you transform it, it looks normal, then you transform it back.
In a way, yes. Let's try a simplified analogy. Imagine you are cataloging the prices of different types of lovely Indian sweets from various shops.
The jalebi, gulab jama.
Okay? Yes. Some might be quite inexpensive, maybe 10 rupees. Others, very premium, perhaps 100 rupees or more. If you just plot these actual prices, the distribution might look a bit bunched up at the low end and very spread out at the high end, right? Skewed.
Yes, it will likely be skewed.
But if you were to take the natural logarithm of each of those prices, the log of 10, the log of 100, and so on, those logarithmic values might appear much more symmetrically spread out. They might look more like a normal pattern.
Ah, okay. The logs are more balanced.
Then, when you reverse that log operation using the exponential function, you get back to the actual prices. And those prices, because their logs were normal, are log normally distributed, always positive, skewed to the right, allowing for those big upward swings.
Wow. Okay, the transformation makes the connection clearer. The log is normal.
It's a powerful concept because it lets us use all the well-understood mathematics of the normal distribution for variables that are inherently non-negative and skewed, like prices.
And this distinction, relying on the log normal for prices, you said it's foundational.
Absolutely foundational in quantitative finance.
Yeah.
Think about the very famous Black-Scholes-Merton option pricing model.
Yes, I've heard of that. For pricing options contracts.
Exactly. It's a cornerstone for valuing financial derivatives like options. This model, which calculates the fair price of an option, explicitly assumes that the price of the underlying asset, the stock, the commodity, whatever it is log normally distributed.
It assumes log normal.
Yes. So understanding why this assumption is made, because prices can't be negative, because their growth compounds in a way that leads to skewness, is really crucial for understanding how these complex financial instruments are valued. It's not just some mathematical detail. It shapes how we model risk and potential return.
Okay, that's very clear. So, just to check, friends, can you recall the two main reasons we use the log normal distribution for asset prices instead of the normal one?
Yeah.
Think about that lower limit and think about its shape compared to the bell curve.
Excellent points to remember. Now, let's pivot slightly, but stay connected. Let's talk about continuously compounded returns.
Okay, continuously compounded returns. That sounds complex.
Let's break it down. Simply put, a return is just the profit or loss you make on an investment, right?
Right, gain or loss.
Compounding means you earn returns not just on your initial money, your principal, but also on the returns you've already accumulated. Your money makes money.
Yes. Returns on returns.
Yeah.
The power of compounding.
Exactly. Now, continuously compounded takes this one step further. It implies that these returns are being generated and added to your principal constantly, every single moment, at infinitesimally small intervals of time.
Every instant. Wow.
It's the most precise way to measure growth or decay over time, especially in active financial markets where things change second by second.
Okay, but how can we think about that? An everyday example, maybe.
Sure. Think about your electricity bill at home.
Okay, the electricity bill.
Your electricity meter isn't just checked once a month, is it? It's running continuously. It's calculating your usage every single second, adding it up constantly.
Yes. It's always spinning or digitally ticking up.
Exactly. That constant, real-time accumulation is a good analogy for continuously compounded returns. The value is growing or shrinking, and it's being accounted for at every single instant. It's different from, say, simple interest that might only be calculated once a year.
Okay, that helps. Like the electricity meter running all the time.
Precisely.
And here's the connection, which I think is quite profound. If these continuously compounded returns are normally distributed.
Which they often are, or at least assumed to be in many models.
Right. If we can use that familiar bell curve for the returns, then the future stock prices themselves will naturally follow that log normal distribution we just spent time discussing.
Exactly. There's a direct mathematical link. The price at some future time, t, often written as pt, is equal to the starting price, p0, multiplied by the exponential of the total continuously compounded return over that period. pt equals p0 xpr.
Okay, XPR, the exponential function.
Yes. And if that return, r, is normally distributed, then applying the exponential function xpr car mathematically results in a variable pt that follows a log normal distribution.
So normal returns lead to log normal prices through that exponential link.
It's a mathematical elegance that underpins many, many financial models. It connects the distribution of returns to the distribution of prices.
Very neat.
Now, within this discussion of returns, there's another extremely important concept. Volatility.
Volatility.
Yeah.
We hear that word a lot in finance news.
Yes, you do. And it's not just jargon, it's a precise measure. Volatility quantifies how much an asset's price jumps around, how much it fluctuates or swings over a certain period.
So how much it goes up and down.
Exactly. Mathematically, volatility is defined as the standard deviation of these continuously compounded returns.
Standard deviation.
Okay.
That's a statistical measure of spread.
Precisely. A higher standard deviation, meaning higher volatility, signifies greater price uncertainty. It means larger, more frequent jumps or drops in the asset's value. Lower volatility means the price is more stable, less jumpy.
Okay. Can we have an Indian example for volatility?
Of course. Imagine you live in a place where the weather is extremely volatile.
Okay, volatile weather. Like maybe parts of North India in winter. Or monsoon season.
Could be. One day it's scorching hot, the next day it's pouring with rain, and the day after it's unexpectedly chilly. Big, frequent swings. That's high volatility.
Right, unpredictable.
Conversely, if the weather is always mild, always pleasant, very stable with minimal changes day to day, that represents low volatility.
Okay, steady weather.
In finance, it's the same idea. High volatility means a stock price can swing wildly. This presents potentially higher risk, but maybe also higher reward potential. Low volatility suggests a more stable, perhaps more predictable, price path.
So high volatility is like a roller coaster. Low volatility is like a gentle train ride.
A very good way to put it. Now, one more detail about volatility. By convention, in finance, it's almost always stated as an annualized measure.
Annualized, meaning for the whole year.
Yes. Even if we calculate it based on daily price changes or weekly or monthly changes, we convert it into its equivalent rate over a full year.
Why do we do that?
Standardization, mainly. It allows for easier comparison across different assets or different time periods. If we have, say, the daily volatility, we multiply it by the square root of the number of trading days in a year.
Square root. Why square root?
That's because variances, which is volatility squared, tend to add up linearly over time if returns are independent. Since volatility is the standard deviation, the square root of variance, it scales with the square root of time.
Okay, that's a bit technical, but it scales with the square root of time. And how many trading days do we usually assume?
Typically for financial markets, we use 250 days. This accounts for weekends and major holidays when markets are closed.
Right, not 365, around 250.
Yes. So if your daily volatility calculation gives you, say, 0.01 or 1%, the annualized volatility would be 0.01 multiplied by the square root of 250.
Square root of 250 is roughly 15.8.
Approximately, yes.
Yeah.
So 0.01 times 15.8 gives you about 0.158 or 15.8% annualized volatility. This scaling principle is really fundamental for risk management.
Got it. Daily volatility times square root of 250 gives annual volatility. Let's try to make this even more concrete with an example. Our source material uses shares of Astra International, a company from Indonesia.
Okay, Astra International.
Imagine you are an analyst, maybe a student practicing, and you're looking at its share price movements over just one trading week. Our source gives us the daily closing prices. Let me read them out.
Please do.
Okay, Monday closing price, 6,950 Indonesian rupiah.
6,950.
Tuesday, 7,000 rupiah.
Okay, up slightly.
Wednesday, price dipped to 6,850 rupiah.
Down.
Thursday, saw a further decline to 6,600 rupiah.
Down again?
And finally, Friday, it closed at 6,350 rupiah.
Quite a drop by Friday.
Okay, so over that week, the price went from 6,950 down to 6,350. Now, how do we estimate volatility from this?
Okay, good question. The first step, as we discussed, is to calculate the continuously compounded daily returns for each day there was a change.
Right, the log returns.
Exactly. So for Tuesday's return, we take the natural log of Tuesday's price divided by Monday's price. So ln 7,000,000,6950.
Okay, ln 7,000,000,6950. Let me see. That's about 0.000768, a small positive return.
Correct. Now for Wednesday, it's ln Wednesday's price to Tuesday's price. So ln 6850,7,000.
ln 6850000. That gives roughly nonish 0.03716661, another negative one.
And finally, for Friday, it's ln 660, this Thursday's price. So ln 6350,6600.
Okay, ln is 6350,6600. That's around needs 0.037161, negative again.
Good. So now we have 4 daily continuously compounded returns, 0.007168, and nationally 0.021661, national is 0.037179, and national 0.038615.
4 numbers representing the daily changes.
Now with these 4 returns, our next step is to calculate their standard deviation. This will give us our daily volatility.
Okay, the standard deviation of those 4 numbers. That involves finding the average, seeing how far each number is from the average, squaring those differences, averaging the squares, and then taking the square root. A bit of calculation.
It is. And after performing that statistical calculation, the standard deviation of these 4 returns comes out to be approximately 0.021261.
0.021261. So that's our estimated daily volatility for AFTRA based on just that 1 week.
Based on that 1 week, yes.
Now, how do we annualize this?
We use our rule. We multiply this daily volatility by the square root of 250 trading days.
Okay, so 0.021261 multiplied by the square root of 250, which we said was about 15.8.
Exactly. 0.021261 times the square root of 250 gives us approximately 0.336165.
0.336165.
Or about 33.6% if we express it as a percentage.
Correct. So 33.6% annualized volatility. This figure gives us a rough estimate based on that single week's data of how much Astra's stock price might typically swing around over a full year.
Okay, 33.6%, but is using just 1 week, just 4 returns, really enough. That is a crucial point, and our source material is very clear on this. Using such a short series of data, just 4 daily returns to estimate the expected annual return for Astra, well, that's generally not prudent. It's not advisable at all.
Right on.
Because while volatility, which measures the spread or dispersion of returns, can sometimes be reasonably estimated even from shorter periods, though more data is always better. The expected return, the average direction the price is likely to go, requires a much longer history to estimate reliably.
I see.
With just 4 observations, the inherent randomness, the noise in the data is huge. It completely overwhelms any meaningful signal about the true long-term expected return.
So the ups and downs in just 1 week don't tell you much about the long-term trend.
Precisely. It's like judging a cricket team's expected performance for the entire season based only on the first match they played.
Right. They might have had one really good day or one really bad day. Doesn't mean they'll continue that way.
Exactly. It's far too little data to form a robust, fair, or accurate prediction of their overall season performance. This distinction between estimating volatility and estimating expected return, especially with limited data, is critical in finance.
Okay, that's a very important warning. Short data might give a hint of volatility, but not reliable expected return.
Correct.
And finally, just to connect everything back, if we were to assume that those continuously compounded daily returns we calculated for Astra were indeed normally distributed,
If we made that assumption.
then it naturally follows, theoretically, that the Astra share prices themselves should adhere to a log-normal distribution.
Yes, that theoretical link holds. Normal returns, continuously compounded, imply log-normal prices. It's a fundamental building block we use in many advanced models, from pricing options to managing portfolio risk.
Understood. So thinking about volatility then, if someone told you, maybe in a financial report or on the news, that a particular stock had very high volatility, what would that immediately suggest to you about its price movements? Would you picture something stable and predictable, or more like that roller coaster we talked about?
A good check. It definitely implies the roller coaster, right? Big swings, unpredictability.
Exactly. Now, we've established how prices behave using log-normal distributions and volatility. But how do we actually use this knowledge to make predictions, especially for complicated situations where simple math formulas just don't work?
This brings us to our second major tool, Monte Carlo simulation.
Monte Carlo simulation. Sounds fancy.
It sounds fancy, but the idea is actually quite intuitive. It's an incredibly powerful and widely used technique in investment analysis. Think of it as a very sophisticated what-if game or engine for finance.
A what-if engine. Okay. Can we have an Indian analogy for this one, too?
Let's try. Imagine you are planning a very important event. Let's say a grand Indian wedding for your family.
Okay. A big wedding. Lots of planning involved there.
Indeed. And you want to estimate the total cost, the total expenditure, but there are so many variables, aren't there?
Oh, yes. The number of guests can change, the catering cost per plate might fluctuate, decoration expenses, travel for relatives, maybe some unexpected costs pop up.
Exactly. You can't possibly know the precise final cost in advance. It's impossible.
No, you can only estimate.
But what if you could run, say, thousands of hypothetical scenarios in your mind? Or better yet, on a computer.
Thousands of scenarios.
Yes. Each time, you randomly change the number of guests within a likely range. You randomly adjust the food prices based on possibilities.
Right.
You factor in a random chance of certain unexpected expenses. You do this thousands of times.
Okay.
By looking at the entire range of total costs that emerge from these thousands and thousands of trials, wouldn't you get a much better, much more robust understanding of your potential budget and the risks involved, where it might end up?
Yes. Instead of one guess, I'd see a whole range of possibilities and how likely they are. That sounds much more useful.
That analogy perfectly captures the spirit of Monte Carlo simulation in finance. It's a computational method. It generates a very large number of random samples from probability distributions that we specify, like the normal distribution for returns or the log normal for prices that we just discussed.
Okay, it uses those distributions we learned about.
Yes, and by doing this repeatedly, many, many times, it helps us figure out the likelihood of a whole range of results for investment or portfolio or even a very complex financial product.
So it helps estimate risk and return.
Exactly. It's invaluable for that.
Right.
And crucially, it's used for valuing securities that have intricate features, things where a direct, simple mathematical formula just doesn't exist or is too complicated to solve.
So for the really tricky financial products.
That's where its power truly shines. Think about simulating how a whole investment portfolio might perform over many years, under all sorts of different market conditions, good years, bad years, average years.
Right, seeing the range of possible retirement balances, for example.
Precisely. Or valuing financial products with complex features. Maybe options that depend not just on the final price, but the price path taken, or options with multiple triggers, things called exotic options or structured products.
Things where a simple formula won't cut it.
Exactly. For those, Monte Carlo is often the go-to method. We define our starting assumptions, things like expected return, the volatility we just discussed, maybe correlations between different assets. Then we let the computer run thousands, sometimes hundreds of thousands, even millions of trials.
Millions, wow.
Yes. Each trial generates a unique, plausible path for how things might unfold. By collecting all the results, we get a rich picture, the range of possible values, the probability of certain outcomes, and also how sensitive our result is to the starting assumptions we made. It's much more insightful than just a single number.
Okay, that sounds incredibly powerful. So when we say Monte Carlo helps with what-if analysis, what does that really mean for predicting financial futures? Why is exploring so many random possibilities helpful when things are so uncertain?
It means we embrace the uncertainty instead of ignoring it. We map out the possibilities.
Let's unpack this a bit more with a concrete example, again from our source material. It uses something called a contingent claim.
Contingent claim. That's just a general term, a fancy name really,
Right.
for any financial contract whose value depends on is contingent upon something else. Usually the value of another underlying asset or maybe an event.
Okay, its value depends on something else. And the specific example,
The source uses an Asian option.
Asian option, is it related to Asia?
Only a name. It's a type of exotic option with a particular payoff structure. It pays you if the final stock price, when the option matures, is higher than the average stock price recorded over a specific period during the option's life.
The average price,
Yeah.
not just the final price versus the starting price.
Correct. It depends on the path the price took. So for example, let's say the option matures in 1 year. If at the end of the year, the stock price is 34 rupees,
Okay, 34.
but its average price over that whole year was, say, 31 rupees,
Average was 31.
then the option would pay you the difference. 34 minus 31, which is 3 rupees.
Okay, I get 3 rupees.
But if the final price, 34, was less than or equal to their average price, maybe the average was 35, then the option pays 0, nothing.
Okay. Final price must beat the average price.
Yeah.
This path dependency, depending on the average, makes it tricky to value with a simple formula, right?
Exactly. That's why Monte Carlo is well suited for it.
Now, let's walk through the systematic steps for using Monte Carlo simulation to value something like this Asian option. Our source outlines 6 clear steps. It's like a recipe.
A recipe is a good way to think about it. Let's go through them. Step 1. Specify the quantity of interest.
Step 1, specify what you want to value.
Yes. First, you must precisely define what you are trying to find the value of. In our case, it's the contingent claim, the Asian option. You need to know its rules, how its value depends on the underlying stock price. And importantly, you must also set the starting value of that underlying stock, your known starting point.
Okay, so define the goal, value the option, and the starting point, current stock price. Like in our wedding budget example, the goal is the total cost, and the starting point is our initial savings.
Exactly. Step 1 is about clarity of purpose and initial conditions.
Okay, step 2, specify a time grid.
Step 2, break down the time.
Right. Next, you decide how to divide the total time period that matters for your instrument. Our Asian option matures in 1 year. So we might decide to break that year down into discrete steps, maybe 12 monthly steps.
Or maybe 52 weekly steps or even 250 daily steps if we need more granularity.
Right. We choose the time intervals. We'll simulate the stock price moving from one point in the grid to the next.
This grid structure is essential, especially for path-dependent options like the Asian option, where the average price matters. For a long-term retirement plan simulation, the grid might be in years or quarters.
Makes sense. Break it down into manageable time steps.
Okay.
Step 3, specify data generation method, random draws.
Step 3. This is where the Monte Carlo magic really happens, the random part. Here, you must define how the underlying variable, our stock price, is expected to behave probabilistically. This means making assumptions about the probability distributions of the key risk factors.
Like the stock's returns.
Most commonly, yes. We often assume that continuously compounded returns follow a normal distribution, as we discussed. We need to specify the parameters of that distribution, the expected return, often called mu, and the volatility, sigma.
Okay, assume normal returns with a certain average in volatility.
Then a computer program takes over. It generates a long sequence of pseudo-random numbers.
Pseudo-random, not truly random?
Well, they are generated by algorithms designed to mimic statistical randomness very well. They're deterministic, which is good for repeating experiments, but they behave like random draws from the distribution we specified, the normal distribution.
Okay, computer generates numbers that look random.
Yes. For each step in our time grid, say for each of the 12 months, the computer draws a random number from that specified distribution. These random numbers will drive the simulated price movement for each step.
So it's like the computer rolls the dice 12 times, once for each month, using dice weighted according to our assumed normal distribution.
That's a great analogy. Exactly like rolling weighted dice for each time step.
Got it. Step 4, use simulated values to produce stock prices.
Step 4, build a price path.
Right. Using those pseudo-random numbers generated in step 3, you now construct one complete hypothetical path for the stock price over the entire period.
So starting from the initial price, from step 1, you use the first random draw to calculate the price at the end of the first time step, example, end of month 1. Then from that new price, you use the second random draw to get the price at the end of month 2, and so on.
until you reach the end of the time grid. Example, end of month 12, so you have one possible sequence of 12 monthly prices.
Exactly. This complete sequence represents one single plausible future scenario for the stock price. It's one full trial or run of the simulation, showing how the stock might evolve based on the randomness we introduced.
Okay, one possible future mapped out. Now, step 5. Calculate payoff and present value.
Step 5. Find the value for this path.
Makes sense. For each individual simulated path that you just created in step 4, you now calculate the value of your financial instrument at its maturity date.
For our Asian option example, this means look at the final price on that specific path, calculate the average price along that same path, and then find the payoff. Final minus average if positive, otherwise 0.
Okay, calculate the options worth at the end for that one scenario.
Yes. Then, once you have that future payoff amount for that path, you discount it back to today's value. You calculate its present value.
Ah, present value. Because money in the future is worth less than money today, right?
Yeah.
Due to potential interest or inflation.
Exactly. It accounts for the time value of money. You need to know how much that potential future payoff is worth in today's rupees, considering you could have invested the money elsewhere. It brings all future outcomes back to a common point in time, the present.
Okay, calculate payoff, then find its present value. Got it. Finally, step 6. Repeat and average.
Step 6. Do it again, and again, and again.
This is the core of it, isn't it? You repeat steps 4 and 5.
Generate a path, calculate its present value payoff.
And a huge number of times. You said thousands, maybe hundreds of thousands, even millions of iterations.
Yes, typically a very large number. Each time, the computer draws a new set of random numbers, which generates a new, unique stock price path. And for each new path, you calculate a new estimated present value for the option.
So you end up with thousands of different possible present values for the option, one from each simulated path.
Exactly. You'll have a whole distribution of possible outcomes.
And then, the final step.
You simply take the average of all those thousands or hundreds of thousands of individual present values you calculated.
Just the average.
Just the simple average. That average value serves as your Monte Carlo estimate of the contingent claims, the Asian options value.
Wow. So run thousands of scenarios, get thousands of answers, and the average is your best estimate.
Precisely. The logic relies on the law of large numbers from statistics. As you increase the number of trials, this average value gets closer and closer to the true theoretical value you're trying to estimate. It becomes a very robust and reliable estimate.
Okay, let's relate this back to the wedding budget.
Good idea.
Step 1, define goal, total cost, starting savings. Step 2, plan month by month for 12 months. Step 3, have dice representing random cost changes each month. Guess up, down, discounts, unexpected things. Step 4, roll the dice 12 times. Calculate the budget changes each month. Get one final total cost estimate for that one scenario. Step 5, figure out how much you'd need to save today for that specific future cost. Maybe less relevant for cost, more for asset valuation. Step 6, repeat the whole dice rolling and calculation process 1,000 times. Each time get a different total cost. Finally, average all those 1,000 costs to get your best overall estimate for the wedding budget.
The perfect summary of the process using the analytical. The sheer number of trials allows us to explore that vast range of possibilities and get a solid estimate, fully accounting for the risk and uncertainty involved.
It's quite an ingenious approach. So, just to summarize the core idea again for everyone, in simple terms, what is the main principle behind Monte Carlo simulation? What is it trying to achieve by doing things many, many times using random inputs?
It's trying to map the uncertainty by simulating it repeatedly.
Okay, now let's talk practicalities. What are the main strengths and weaknesses of using Monte Carlo?
Well, its biggest strength, as we've touched upon, is its amazing ability to price complex securities, things that just don't have a neat, tidy mathematical formula.
Like our Asian option or other exotic things.
Exactly. Options with unusual conditions, path-dependent payoffs, multiple underlying assets interacting. Monte Carlo can handle that complexity because it simulates the process directly. Its flexibility is a huge advantage.
Any other strengths?
Yes, it's also excellent for stress testing models. You can deliberately simulate extreme but still plausible market conditions like a market crash scenario to see how your portfolio or derivative position would hold up.
Ah, testing the worst case scenarios.
Yes. And also for sensitivity analysis, seeing how much your final valuation changes if you tweak your initial assumptions, like the volatility or expected return. It tells you which assumptions are most critical.
Okay, flexibility for complexity, stress testing, sensitivity analysis. Sounds very useful. What about the downsides? the weaknesses.
The main thing to remember is that Monte Carlo simulation provides only statistical estimates. They're usually very good estimates with enough trials, but they are not exact, precise analytical results like you might get from a direct formula.
So it's an approximation, a very good one, but still an approximation. Like our wedding budget estimate, very helpful, but probably not the exact final rupee amount.
Exactly. Its accuracy depends on the number of simulations run. More simulations mean better accuracy, but also more computational time and power needed. For very complex models, this can be significant.
It needs powerful computers sometimes.
It can, yes. Another potential weakness is that while Monte Carlo shows you what range of outcomes is possible, it sometimes offers less direct insight into why the value is what it is, compared to an analytical formula where you can see exactly how each input drives the output.
So it tells you what, but maybe less of the why.
Sometimes, yes. There can be a trade-off between the flexibility to model anything and the transparency of a direct formula.
Okay, that makes sense. So final check on this section. If you had two financial products to value one very simple, like a basic bond with a well-known formula, and another extremely complicated one, maybe an option depending on three different factors, for which one would Monte Carlo simulation be the more essential, more useful tool?
Definitely for the complicated one, right? The simple one has a formula.
Right. Where formulas fail, Monte Carlo shines. Okay, let's move to our third and final method for today, bootstrapping.
Bootstrapping. Now, this method also uses repetitive sampling, a bit like Monte Carlo. It involves running many trials, but there's a crucial fundamental difference in where the data comes from.
Okay, a key difference from Monte Carlo.
Yes. Remember, Monte Carlo generated random data based on theoretical probability distributions that we specified, like assuming returns are normal. Bootstrapping, however, works directly from our own observed historical data.
So it uses the past data we actually have, not an assumed mathematical curve.
Precisely. It's a method that essentially says, let's learn directly from our own history exactly as it happened without imposing theoretical shapes.
That sounds interesting. How does it work?
The core idea, it's quite clever, really ingenious. We take our existing sample of historical data, the actual observations we've collected.
Like our list of past daily stock returns.
Exactly. We treat that sample as if it were the entire population representing all possible future outcomes.
Okay, assume our sample is the whole world, so to speak.
For the purpose of the simulation, yes. Then we repeatedly draw new resamples from this original sample. And here's the absolutely critical part. We draw with replacement.
With replacement. What does that mean again?
It means each time we pick an observation from our original sample to include in our new resample, we put it back into the pool before picking the next one. So the same historical observation can be picked multiple times in a single resample, while some other observations might not be picked at all.
So you have your list of, say, 100 past daily returns. You pick one, note it down, put it back. Pick another, it could be the same one, note it down, put it back. Repeat 100 times. That gives you one resample.
Exactly. That gives you one simulated data set, one resample. And this process generates numerous new simulated data sets, all built exclusively from the real historical patterns and characteristics that were already present in your original data. It's considered a non-parametric method because it doesn't assume a specific underlying distribution shape, like normal or log normal.
Okay, non-parametric, no assumptions about distribution shape. Let's have an Indian example for bootstrapping.
Certainly. Let's go back to the idea of owning a small kirana shop.
Okay, our friendly neighborhood kirana store.
Imagine you've been a very diligent shopkeeper and have recorded your daily sales figures every single day for the last, say, 3 months. So you have about 90 data points of daily sales.
Got it. 90 days of sales history.
Now, you want to understand the likely range of sales for the next month, maybe to manage your inventory better or plan your cash flow.
Yes, a forecast would be useful.
Instead of trying to guess if your sales follow a normal distribution or some other pattern, you use bootstrapping. You take all those 90 past daily sales figures, maybe write each one on a little slip of paper.
Okay, 90 chits of paper with sales numbers.
Put them all in a pot or a box and mix them up really well.
Mix them up.
Then you randomly draw out one slip. You record the sales number written on it, and then this is the key. You put that slip back into the pot.
Put it back. That's the with replacement.
Exactly. Then you draw again, record the number, put it back. You do this, say, 30 times for the 30 days in the next month. This sequence of 30 numbers you've recorded forms one simulated month of sales data.
Okay, one possible future month built from pieces of the past.
Precisely. Now, you don't just do this once. You repeat this whole process drawing 30 times with replacement hundreds, maybe thousands of times.
Wow, okay. Keep drawing 30 slips, putting them back each time over and over.
Yes. Each time you get a different sequence of 30 simulated daily sales figures. This generates many, many possible scenarios for your next month's sales, all derived directly and solely from your own shop's actual history. It gives you a forecast range without making assumptions about theoretical distributions.
That with replacement part really is the linchpin, isn't it?
Yeah.
It means that in one simulated month, a really good sales day from your past might show up 3 times, while a really bad day might not show up at all, or vice versa.
Exactly. It mimics the randomness and variability of real life, but critically, it always stays within the boundaries of what you have actually observed in your history. It lets your own data tell the story of its potential future.
It really lets the data speak for itself. So thinking back to our earlier discussion, what would you say is the main fundamental difference between bootstrapping and Monte Carlo simulation when it comes to the source of the random data they use? Where do they get their numbers from?
Monte Carlo uses theoretical distributions, we assume. Bootstrapping uses the actual historical data we have.
Perfect. Now, in terms of the steps involved in using bootstrapping to value something, say, our Asian option again, are the steps similar to Monte Carlo?
Many of the steps in the overall framework are quite similar. Yes, you still need to. Step 1, specify what you're valuing, the option, and the starting conditions. Step 2, set up a time grid, like monthly steps. Step 5, calculate the payoff for each simulated path and find its present value. And Step 6, repeat many times and average the results. That general structure holds.
Okay, the overall flow is similar. So where's the big difference in the process?
The big difference lies squarely in Step 3, the data generation method, and consequently, Step 4, building the path.
Ah, how the random numbers are generated and used.
Exactly. Remember, in Monte Carlo's Step 3, we specified a probability distribution, like normal, and drew random numbers from that theoretical curve.
Right. Assume normal.
In bootstrapping Step 3, we don't assume a theoretical distribution. Instead, we use the collection of observed historical changes in the stock price from our actual past data. This set of historical changes becomes our empirical distribution.
Empirical meaning based on observation.
Yes. So instead of drawing random numbers from a theoretical curve like the normal distribution, we draw them directly from our list of past observations with replacement.
So if we had 100 historical daily returns, for each step in our simulation path, we just randomly pick one of those 100 historical returns and put it back.
Precisely. You use the computer to randomly sample with replacement from your existing historical stock price changes, or returns. These randomly drawn historical changes are then used in Step 4 to build the thousands of new, simulated stock price paths.
I see. So the paths are built using actual historical moves, just stitched together randomly.
That's a good way to visualize it. This is a critical distinction because the outcomes of the simulation are driven not by some assumed mathematical formula, but by the actual recorded patterns, jumps, and behaviors of prices observed in the past. This makes it very appealing when you don't have strong knowledge or confidence about the true underlying data-generating process.
This means, then, that bootstrapping becomes a really valuable tool when you're hesitant to make strong assumptions about the theoretical distribution of your data. Maybe you think normal isn't quite right, but you don't know what is right.
Exactly. Or maybe you simply don't have enough data or theoretical basis to confidently choose any specific theoretical distribution. Bootstrapping bypasses that need. It lets your own history be your guide without forcing it into a predefined mathematical box.
Okay, it uses the data's own shape. So let's think about this scenario. Imagine you have a limited set of historical data for some financial variable. That's not a huge amount of data. And your main goal is to simulate future outcomes, but you really want to avoid making possibly incorrect assumptions about the perfect theoretical distribution. In this situation, which method might seem more suitable? Monte Carlo, relying on assumed distributions, or bootstrapping, relying on the historical data itself, and why?
Bootstrapping seems more suitable there because it doesn't force an assumption.
Right, it uses what you have. Now, let's summarize the strengths and weaknesses of bootstrapping, just like we did for Monte Carlo.
Okay. One key strength is its relative simplicity to implement, conceptually at least. You don't need to estimate parameters like mean and standard deviation for a theoretical distribution. Your main input is just your historical data series.
Simpler setup.
More importantly, bootstrapping offers a very faithful representation of the statistical features like the mean, the variance, the skewness, even unusual bumps or gaps that are inherent in the population implied by your observed sample.
So it captures the quirks of your actual data.
Yes, since a reasonably sized historical sample often captures the essential characteristics of the true underlying process, bootstrapping effectively lets us simulate drawing new samples from that true process by literally resampling from our own existing data. This can be very powerful, especially when the true distribution is unknown or perhaps very complex and non-standard.
Okay, simple. Represents the sample's features well. Good when the true distribution is unknown. What about the weaknesses?
Well, just like Monte Carlo, it's important to remember that bootstrapping also provides only statistical estimates. It gives a probabilistic picture, a likely range, but not a single exact analytical answer.
Still an estimate, not a precise number.
Correct. And perhaps its most significant weakness is its complete dependence on the quality and representativeness of your original observed data.
Garbage in, garbage out.
Well, maybe not quite garbage, but certainly limitations in, limitations out. If your historical data is too short, or if it comes from a very unusual period in the market, like only a crisis period or only a boom period, that doesn't accurately reflect the full range of future possibilities.
Right, if history isn't a good guide to the future in this case.
Then your bootstrap results will inherit those limitations. They might not provide an accurate or reliable picture of future probabilities because the input data itself wasn't fully representative. The outputs are only as good and as representative as the historical inputs you feed into it.
That makes sense. Its strength relying on historical data is also its potential weakness if that data isn't good or relevant.
Precisely.
So final check on bootstrapping. Consider a situation where your historical data for something was known to be very unusual. Maybe it only covered a period of extreme market stress, or maybe it missed some typical seasonal patterns. In that case, would bootstrapping likely give you a highly accurate picture of the future? Why or why not?
Probably not, because the history itself wasn't typical.
Right, the limitations of the past data would carry through. Okay, we've covered a lot of ground today.
We certainly have. Today, we embarked on quite a comprehensive deep dive into some powerful simulation methods used constantly in finance to handle uncertainty.
Yes.
We started by understanding why asset prices are often modeled using that log normal distribution, remembering they can't go below zero and tend to have skewed growth pattern.
Right, the zero bound and the right skew.
Then we explored Monte Carlo simulation. That versatile technique, like planning our wedding budget with thousands of scenarios, allows us to simulate complex situations by drawing repeatedly from assumed theoretical distributions. It gives us a rich picture of potential outcomes.
And we also delved into bootstrapping, a really clever data-driven statistical technique. It leverages our own actual historical data, resampling it with replacement, like understanding our Kirana shop's future sales potential by looking at its own past performance. It lets us make predictions without imposing those rigid theoretical assumptions.
These tools, Monte Carlo and bootstrapping, while different in how they generate their random inputs, are both absolutely indispensable. They help financial professionals make sense of uncertainty and rigorously quantify risk in a world where, let's face it, precise predictions are simply not possible.
So true. Now, what do these powerful concepts, these tools, mean for you, our listeners, in your own financial journey? You might not be valuing complex Asian options every day.
Probably not.
Probably not. But the core principles we discussed, understanding probability, visualizing a range of possible outcomes instead of just one number, and conceptually running what-if scenarios in your mind, these ideas are incredibly powerful and very broadly applicable to personal finance, too.
Absolutely. Consider your own financial planning. When you are saving diligently for your child's future education, maybe years down the line, or when you are meticulously planning for your retirement, perhaps decades away, you are inevitably facing uncertainties, aren't you?
Oh, definitely.
How much will college actually cost by then? What will your income look like in 10 or 20 years? How will your investments really perform over the long run? There are so many unknowns.
So many variables, just like a wedding budget.
Exactly. So, can you maybe start to think about ways you might apply these ideas conceptually, perhaps not with complex software, but just in your thinking, by considering a broader range of possibilities for your future expenses or your income or your investment returns? Could that help you better prepare for the financial journey ahead, making your plans more robust?
That's a great thought. Instead of planning for just one specific inflation rate, maybe consider a range. Instead of one investment return, consider a few scenarios.
That's nicely.
What other random events or, unpredictable variables might significantly affect your personal financial goals? Health issues, job changes, family needs. And how might adopting this mindset of a financial modeler, thinking in terms of possibilities, running little what-ifs in your head, help you prepare for these things, rather than being completely surprised if they happen?
It's about building resilience into your plans.
It is. We really encourage you to reflect on these possibilities. Remember, building a strong foundation in finance isn't just about mastering calculations or memorizing formulas. It's about much more. It's about cultivating confidence, developing resilience, and feeling empowered to navigate an inherently uncertain financial world.
Well said. Keep exploring these ideas, keep learning, keep questioning. Thank you so much for joining us in our classroom for this deep dive today.
Yes, thank you all. Until our next exploration, take care, stay curious, and keep building that financial confidence. Hello and welcome. Think of us as your friendly teachers for today's deep dive. Now, in our daily lives, and especially when we talk about finance, we often need to understand really, really big groups of things.
Yes, absolutely. Maybe all the customers buying things in a market, or perhaps all the shares being traded on a stock exchange. Huge groups.
Exactly. But here's the thing, my dear students. Studying every single one, well, that's usually just impossible, isn't it? Too big, too costly.
Correct. It's like trying to count every grain of sand on the beach. So our mission today in this deep dive is to understand something called sampling.
Sampling. And what's that about?
It's about how we can cleverly, intelligently pick a small group. We call this a sample from that much, much larger group, which we call the population.
Ah, okay. A small group from a big group.
Yes. And then, the important part, we use that small sample to learn valuable things, make good guesses about the big group.
So we'll explore different ways to pick these samples.
We will. And we'll understand a very powerful rule, something called the central limit theorem. It sounds fancy, but it's actually quite magical.
Okay. And you mentioned computers, too.
Yes, some clever computer methods that help us make our guesses, our estimates, even better. Think of it like learning to be a detective now.
A detective. I like that.
Yes. Figuring out the whole story just by looking at a few important clues. That's what good sampling helps us do. Ready to begin our investigation.
Okay, let's start with the very foundation. These building blocks. We use these words population and sample quite a lot. Could you explain first, what exactly is a population in this sense?
Certainly. So think of a population as the entire collection, the whole set of all members of a specific group that we are interested in studying. It's the complete universe for our question at hand.
The entire group. Got it.
Yes. If we want to know something, the population is everyone or everything that fits our description. The whole lot.
Can you give us an example, maybe something from India?
Of course. Imagine cricket. Everyone loves cricket, no. Let's say we want to know the average runs scored by all batsmen in the entire Indian Premier League IPL season.
Okay, all batsmen, the whole season.
Exactly. Then all the batsmen who played in the IPL for that specific season, every single one of them, they form our population. It's everyone we want to know about for this question.
That makes it very clear. The whole group we care about.
Precisely.
So, a quick check-in question for everyone listening. If you, my dear students, want to find out the favorite color of all the children in your entire city, what would be your population in that case? Think about it.
Good question. The answer would be all the children living in your city, right? That's the whole group.
Perfect. Okay, so if that huge group is the population, then what is a sample?
The sample is simply a part, you see. A subset, a smaller selection, taken from that big population.
Just a portion.
Yes. We study this smaller sample to get information, to learn about the larger population. Why? Because studying the whole population is often just too difficult, too costly, or takes far too much time.
Right. Back to your cricket example, the IPL batsman.
Yes, let's go back there. It would be incredibly hard, almost impossible perhaps, to track every single run scored by every single batsman in every single match of the entire season. That's a lot of data.
Way too much data.
So instead, we might pick a sample. Maybe we look at, say, the top 50 batsmen based on their total runs. Or perhaps we only look at batsmen who played more than 10 matches in the season.
Okay, so a smaller, more manageable group.
Exactly. That smaller group, the top 50, or those playing 10 matches, that's our sample. We study them to get an idea about all the batsmen.
Understood. Sample is a part of the whole population. Now, you touched on why we do this, but let's make it explicit. Why do we actually take samples? What are the main reasons?
There are really two big reasons, my dear students. Very important to remember these.
Okay, what's the first one?
The first is simply impossibility. Sometimes we just cannot examine every member of the population. It might be physically impossible, or the population might be, believe it or not, theoretically infinite, or maybe it changes too quickly.
Like trying to count all the fish in the ocean.
Exactly. Or maybe trying to measure the quality of every single drop of water flowing in the Ganges River at a specific moment. You simply can't measure everything.
Okay, impossibility. And the second reason?
The second reason is efficiency. Even if it were somehow possible to look at everyone, it's often not economically sensible. Sampling saves a huge amount of time and money.
Practical reasons. Cost and time.
Absolutely. Think about a local Kirana shop owner, the small grocery stores we all have. Imagine they buy large sacks of rice or dal.
Yes.
Now, to check the quality, do they open every sack and inspect every single grain? Of course not. That would take forever and waste product.
No, they wouldn't do that.
Instead, what do? They take a small sample, maybe a handful from a few different sacks. They check that handful.
Just a small bit to get an idea.
Precisely. This saves them so much time, allows them to check many sacks quickly, and helps ensure good quality without unnecessary wastage. That's sampling for efficiency.
That's a perfect example. Impossibility and efficiency. Those are the key drivers.
Correct.
Now, when we talk about these populations and samples, we are usually interested in certain numbers, certain characteristics. You mentioned average runs earlier. There are special names for these numbers, aren't there? Parameter and statistic.
Yes, very important distinction. Let's clarify this. A parameter, listen carefully, a parameter is a number or quantity that describes the entire population.
The whole group.
Yes, it's the true value, the actual characteristic of the whole population that we are trying to find out. But often we don't know this true value because we can't measure the whole population. It's the ideal number we seek.
Okay, the true value for the population is the parameter.
Right.
And it's often unknown.
Exactly. Now, a statistic, this is different. A statistic is a number or quantity that we calculate from our sample. It describes our sample.
So the number we get from the small group we actually looked at.
Precisely. And here's the crucial link. We use this sample statistic to make an estimate, a guess, about the unknown population parameter. The statistic is our clue.
Can we have an example for this? Maybe with the electricity bill?
Yes. Let's say we want to know the average monthly electricity bill for all homes in Mumbai. That average for all homes, that's our population parameter, the true overall average.
Okay, the big number for all of Mumbai.
But surveying every single home in Mumbai? Very difficult, no. So what might we do? We might survey, say, 100 homes chosen carefully from different areas of Mumbai.
That's our sample, 100 homes.
Yes. And then we calculate the average monthly electricity bill for those 100 homes. That average from just our sample, that is our sample statistic.
Got it. The average from the 100 homes is the statistic.
And then we use the sample statistic, the average from the 100 homes, to estimate, to make an informed guess about the population parameter, the average bill for all homes in Mumbai.
Parameter for population, statistic for sample. And we use the statistic to estimate the parameter. Very clear.
Excellent.
Now, you mentioned we estimate the parameter using the statistic. This implies it might not be exactly the same number. Is there a name for this difference?
Yes, there is, and this is a concept we must understand very well. Whenever we use a sample to estimate something about a population, there will almost always be a difference between our sample statistic and the true population parameter. This difference is called sampling error.
Sampling error, okay. Is it like a mistake? Did we do something wrong?
Good question. No, it's not a mistake in the usual sense. It's not because we calculated wrongly. Sampling error is just the natural expected difference that arises simply because we are looking at only a part of the population, not the whole thing.
So it happens just because the sample isn't the entire population.
Exactly. It's an unavoidable consequence of sampling. By definition, a small part can't perfectly reflect the whole, isn't it?
Let's use the Kirana shop example again.
Okay. Our shop owner takes a sample handful of rice and finds, say, 2 broken grains in that handful. That's his sample statistic, proportion of broken grains in the sample.
Right.
But if somehow he could magically inspect the entire sack, the population, he might find that on average there are actually 3 broken grains per handful throughout the whole sack, the population parameter.
So 2 in the sample, but 3 in the whole sack.
Yes. That difference, 3 minus 2, equals 1 broken grain difference. That is the sampling error. It happened simply because his sample handful wasn't perfectly representative of the entire sack. It's natural variation.
It's not a mistake, just a result of not seeing everything. Understood.
So here's a check-in for our students listening. If a news channel surveys, let's say, 500 people to predict who will win an election, and their prediction based on the sample is a little different from the final election result, which comes from the whole population of voters, what is that difference primarily called?
That would be the sampling error, right? Because their sample of 500 couldn't perfectly match all the voters.
Absolutely correct. You're getting it.
Okay, fantastic. We understand what populations and samples are, why we use samples, and this idea of sampling error. Now, the really interesting part, how do we actually pick these samples? Are there different methods?
Oh yes, many methods. And choosing the right one is very important. Broadly, we can divide sampling methods into two big families, two main types.
Two families. Okay, what are they?
The first family is called probability sampling. The second is non-probability sampling.
Probability and non-probability. What's the main difference?
In probability sampling, every single member of the population has a known and usually an equal chance of being selected for the sample. It's based on randomness, like a fair lottery.
Okay, everyone has a fair shot.
Yes, this is generally the preferred approach, especially in serious research or finance, when you want your sample to be truly representative and you want to make accurate statistical conclusions about the whole population. Fairness and accuracy are key here.
And the other family, non-probability sampling.
In non-probability sampling, the selection isn't based on pure chance. Instead, it depends on other factors, maybe how easy it is to reach people, convenience, or the researcher's own expert opinion, judgment.
So not random selection.
Not random. And because of that, these methods carry a much higher risk of being non-representative. The sample might be biased, meaning it doesn't accurately reflect the whole population.
Okay, that makes sense. Probability sounds more scientifically sound if we want an unbiased view.
Generally, yes, if fairness and statistical accuracy are paramount.
So thinking about that, another check-in question. If we want to ensure fairness and accuracy when selecting students for, say, a school competition or an important survey about school facilities, which type of sampling method do you think would be better, probability or non-probability, and why?
You'd likely want probability sampling, wouldn't you? To give every student an equal chance and avoid any favoritism or bias in the selection.
Exactly. Okay, let's dive deeper into the probability sampling methods first. The fair and square ones. What's the most basic type?
The most fundamental one, the starting point really, is simple random sampling.
Simple random sampling. What does that involve?
It's just like it sounds. Every single element in the entire population has an exactly equal probability of being chosen for the sample. Think of the classic example. Putting everyone's name into a big hat, mixing it thoroughly, and then drawing out names one by one.
Pure chance. Everyone has the same odds.
Pure chance. This method works best when the population you're studying is relatively homogeneous.
Homogeneous, meaning?
Meaning the characteristics of the individuals or items in the population are broadly similar. There aren't major distinct subgroups with very different features.
Okay. So if everyone is quite similar, just picking randomly works well.
Yes. For instance, our source mentions a wireless equipment analyst surveying customers. If they believe their customer base is generally quite similar in their basic needs or opinions, they might just take a simple random sample of customer IDs from their database.
Can we have an everyday Indian example?
Of course. Imagine a housing society is holding a lucky draw for a special prize, maybe a new scooter. Every flat owner's name is written on a slip of paper. All slips are put into a big drum, spun around properly.
Yes, like we see at festivals.
Exactly. And then someone draws out one or a few names. Every flat owner had an exactly equal chance of winning. That's a perfect example of simple random sampling in action.
Very clear. You also mentioned something called systematic sampling, briefly.
Ah, yes, a slight variation.
Mm-hmm.
With systematic sampling, you first put your population in some order, like a list. Then you decide on an interval, say K. You randomly pick a starting point within the first K items, and then you select every Kth item after that.
Like pick a random person from the first 10 in a list, and then pick every 10th person after that.
Exactly. So maybe every 5th person or every 100th transaction. It's often easier to implement than simple random sampling, especially with long lists, and it usually results in an approximately random sample, provided there's no hidden pattern in the list that matches your interval K.
Interesting. Okay, another quick check-in. If you have a list of all your classmates, maybe for a project group selection, and you close your eyes and randomly point to 5 names on that list, What kind of sampling is that likely to be?
That sounds very much like simple random sampling, doesn't it? Assuming your pointing is truly random.
Right. Okay, now what if the population isn't homogeneous? What if there are distinct groups within it?
Ah, now we move to a more sophisticated and often more powerful method. Stratified random sampling.
Stratified. Sounds like layers.
Exactly. This method is used when the population is not homogeneous, but it can be naturally divided into distinct groups or subpopulations. We call these groups strata. Think of them as layers, yes.
Like different classes in a school, perhaps?
Perfect example. Or different departments in a company, or different income brackets in a city. These are natural strata.
So what do we do once we identify these strata?
First, you divide your entire population into these mutually exclusive strata. Every member belongs to exactly one stratum. Then, you draw a simple random sample from within each stratum.
Okay, so random samples from each layer separately.
Yes, and importantly, the size of the sample you draw from each stratum is usually proportional to the size of that stratum in the overall population. So if one stratum is much larger, you take a larger sample from it.
Makes sense to keep the proportions right.
Then finally, you combine all these individual samples drawn from each stratum to create your overall stratified random sample.
What are the benefits of doing it this way? Seems more complex.
It is a bit more work, but it has significant advantages. First, it guarantees that important subgroups, the strata, are properly represented in your final sample. You won't accidentally miss out on a small but important group.
So, better representation.
Yes. And second, because you're accounting for the differences between the strata, stratified sampling often leads to more precise estimates. The overall sampling error is often lower compared to a simple random sample of the same total size, especially if the strata are quite different from each other.
More accurate results. Okay. Where's this used in finance?
Oh, very commonly. Our source highlights its use in bond indexing. Imagine trying to create a portfolio of bonds that behaves just like a very large, complex bond market index. That index might contain thousands of bonds.
Buying all of them would be too difficult or expensive.
Exactly. So portfolio managers use stratified sampling. They divide the entire universe of bonds in the index into strata based on important characteristics.
Like what?
Things like the bond's maturity date, how long until it pays back, its sensitivity to interest rate changes, often measured by duration, or its credit quality rating, like AAA, AA, B, etc.
So they create categories based on these features?
Yes. Our source gives a detailed example. A manager might use 3 issuer types, government, corporate, etc., 10 maturity intervals, 1 through 3 years, 3, 5 years, and 2 coupon categories, high coupon, low coupon.
Okay, multiplying those 3 times 10 times 2, that's 60 different combinations.
Precisely. 60 distinct cells or strata. To ensure their portfolio accurately reflects the diversity of the index, the manager would then aim to select at least one bond, often proportionally more, using random sampling from each of those 60 strata. This creates a smaller portfolio that mirrors the characteristics of the much larger index.
That's quite clever. Ensures all types are included.
It does, although a practical note. Sometimes within a stratum, a manager might add another rule, like only picking bonds that are easy to trade, liquid. This might make it not strictly random in that final step, but it's often necessary for the practical goal of managing the portfolio effectively.
Understood. Real world needs sometimes adjust the pure theory.
Let's take our school example again. Suppose the school wants to survey students about their study habits. Just picking students randomly from the whole school might not give a good picture. Maybe younger students study differently than older ones.
Right, different classes might have different habits.
So the school could use stratified sampling. They divide the school into strata based on class level, class 6, class 7, class 8, and so on.
Okay, each class is a stratum.
Yes. Then, if class 10 has many more students than class 6, they would draw a proportionally larger random sample of students from class 10 than from class 6. Then combine these samples.
This way, the final sample reflects the actual size of each class in the school and ensures opinions from all levels are included fairly.
Exactly. Better representation, likely more accurate overall picture.
Okay, another check-in then. Imagine you want to survey parents about new school uniforms. If you divide the parents into strata based on their child's gender, parents of boys, parents of girls, and then pick randomly from each group, why might that be a better approach than just picking randomly from all parents mixed together?
Well, perhaps parents of boys and girls have different concerns or preferences about uniforms? No. Stratifying ensures both viewpoints are captured proportionally.
Makes sense. Okay, stratification is clear. Is there another main type of probability sampling?
Yes, there's cluster sampling. This one is also about dividing the population into groups, but it works quite differently from stratified sampling.
Okay, groups again, but different. How so?
In cluster sampling, we divide the population into groups called clusters. Ideally, each cluster should be like a mini version of the entire population containing a diverse mix of elements within it.
So, not layers of similar things, but mini populations.
Kind of, yes. Then, instead of sampling from all the groups like in stratified sampling, we randomly select some of the clusters themselves.
Ah, we pick whole groups at random.
Yes, and then once we've selected our clusters, we have two main options. In one-stage cluster sampling, we survey everyone or everything within the selected clusters.
Okay, study the chosen groups completely.
Or, in two-stage cluster sampling, we first randomly select the clusters, and then we take a random sample of elements from within those selected clusters.
So sample within the sampled groups.
Correct. The key difference to remember: stratified samples from all strata. Cluster samples only some clusters, either fully or partially.
Got it. When would we use cluster sampling?
It's often used for very large, geographically spread out populations. Think broad market surveys. Our source mentions surveying individual investors across a large country like the United States.
Trying to reach investors everywhere would be very expensive.
Exactly. So you might group the investors by states or maybe cities. These geographic areas become your clusters. Each city, hopefully, has a mix of different types of investors.
Okay, cities are clusters.
Then you randomly select a few cities, and you conduct your survey only with investors living in those randomly selected cities. That's cluster sampling.
What's the main advantage here?
The biggest advantage is time efficiency and cost efficiency. It dramatically cuts down on travel and logistical costs because you only need to focus your efforts on the few selected clusters. You don't need a master list of every single person in the country, just lists for the chosen clusters.
Big savings, especially for face-to-face surveys.
Huge savings, but there's a downside.
What's that?
Cluster sampling generally yields lower accuracy or less precision for the same total sample size compared to simple random or stratified sampling.
Why is that?
Because the people living within one cluster, like one city, might be more similar to each other than people across the entire population. Also, the few clusters you randomly picked might not perfectly represent the diversity of all clusters. This can lead to a larger sampling error.
So it's a trade-off. Cheaper and easier, but potentially less accurate.
That's the fundamental trade-off, yes.
Can we have an Indian example for cluster sampling?
Surely. Imagine the government wants to do a survey on household spending habits across a large city like Delhi or Bangalore. Visiting every single house is impossible.
Way too many houses.
So they could divide the city into existing administrative units, maybe colonies or mahallas or wards. These are the clusters. Each mahalla likely has a mix of different income levels, family sizes, etc., hopefully reflecting the city's diversity somewhat.
Okay, mahallas, clusters.
Then they randomly select, say, 20 mahallas out of the hundreds that exist, and then they might go and survey every household within those 20 chosen mahallas, one stage. Or maybe they randomly select 30 households within each of those 20 mahallas, two stage.
Much more manageable than trying to cover the whole city.
Much more. It's efficient, but they need to be aware that the spending habits in those 20 mahallas might not perfectly mirror the entire city.
Understood. So quick check then. If you wanted to quickly survey how much people across all of India love Bollywood movies, but you couldn't possibly visit every state, how might you use cluster sampling by selecting just a few states to focus on entirely?
You could treat each state as a cluster, randomly select maybe 5 or 6 states, and then conduct your survey only within those chosen states, right? That would be using states as clusters.
Perfect. Okay, that covers the main probability methods. Now what about the other family? The non-probability sampling methods.
Right. These methods, remember, do not rely on random chance. Selection is based on the researcher's choices or convenience.
And the big risk is bias.
Right.
Not being representative.
That's the main concern, yes. They are often quicker and cheaper, which can be tempting, but you have to be very careful about generalizing the findings.
Okay, what's the first type here?
The most common one is probably convenience sampling.
Convenience. Just like it sounds.
Exactly. You select elements simply because they are accessible or easy to reach. Whoever is readily available gets included.
Like asking the people you bump into first.
Pretty much. The advantages are clear. It's quick and low cost. You can gather data very easily.
But the downsides?
The big disadvantage is limited accuracy and a high likelihood that the sample isn't representative at all. The people who are easy to reach might be very different from the general population.
So you can't really trust the results to apply broadly.
It's very risky to generalize. Convenient sampling is often used in the very preliminary stages of research, perhaps for a quick pilot study just to test a questionnaire or when cost is the absolute biggest constraint.
Our source had an example of this, didn't it?
Yes, in one of the question sets, it mentions an analyst using data from an internal company database simply because it was easy and convenient to access. They didn't randomly select. They just used what was readily available.
Can you give an everyday example?
Sure. Imagine you need to quickly ask people about their favorite snack for a small, informal report. If you just ask your family members, your close friends, and maybe colleagues sitting near you because they are right there.
That's convenient sampling.
Yes. It's convenient for you, but your family and friends' tastes might be very different from everyone else's in the city or country.
Makes sense. So check in. If you're doing a school project and need to interview people about a new school rule, and you only interview the students you happen to see standing right outside your classroom during break time, what kind of sampling is that?
That's definitely convenience sampling. Easy, but maybe not representative of the whole school's opinion.
Got it. What's the other main non-probability method?
The other one is judgmental sampling.
Judgmental. So someone uses their judgment.
Exactly. Here, the researcher selectively handpicks elements from the population based on their own knowledge and professional judgment. They decide who or what should be included because they believe those elements are particularly informative or relevant.
So it's not random, and it's not just convenient. It's based on expertise.
Yes, based on the researcher's expert opinion. The advantage is that it can be useful when expert judgment is critical or when you're under severe time constraints. An expert can potentially go straight to the most important parts of the population.
Like finding the key witnesses.
Something like that. Our source gives the example of a seasoned auditor reviewing a huge number of company transactions. With limited time, they might use their judgment to select only those transactions they believe are most likely to contain errors or be significant, rather than picking randomly.
Okay, the expert focuses their effort.
Yes. But the big disadvantage is the high risk of researcher bias. If the researcher's judgment is flawed, or they have unconscious biases, their hand-picked sample could be very skewed and not represent the population accurately at all. The results are highly dependent on the quality of the judgment.
So it relies heavily on the expert being right and unbiased.
Very much so. Another example. Think of a renowned chef who needs to select the best vegetables from a market for a very special dish. They don't randomly pick vegetables. They use their judgment and experience. They feel them, smell them, look at them to select only the freshest, highest quality ones.
That's judgmental sampling. They're using their expertise.
Exactly. It works for their goal, but their selection represents best quality according to the chef, not necessarily the average quality of all vegetables in the market.
Understood. So last check-in for this section. If a senior teacher has to quickly pick just a few students for a special academic contest, and they pick the students they know are the brightest based on past performance, what type of sampling is that? And what could be a potential drawback?
That would be judgmental sampling. The drawback, maybe they overlook a student who has improved recently or whose potential they haven't fully recognized yet, right? Their judgment might not capture everyone deserving.
Excellent point. Okay, we've covered the different methods. Now let's see how some of these actually perform in practice using that financial simulation example from our source.
Yes, this really brings the concepts to life. Remember the setup. We have daily returns for a made-up Euro-Asia-Africa EAA equity index over 5 years. That's 12,258 days of data. And critically, we know the true average daily return for this whole period, the population parameter, is 0.035%.
That's our target value.
Exactly. So experiment 1 used simple random sampling. They drew samples of different sizes, starting small at NL5, then 10, 20, up to 1,000. For each size, they did it 100 times. And for each sample, they calculated the mean return and compared it to the true mean of 0.035%. They measured the average difference, the mean absolute error.
Okay, how far off was a sample mean from the true mean on average?
Yes. And experiment 2 did the same thing, but used stratified random sampling. They divided the data by year, 5 strata, one for each year, assuming returns might behave differently year to year. Then they drew proportional samples from each year and again calculated the mean absolute error for different total sample sizes.
So comparing simple random versus stratified, what did they find?
The results shown in Exhibit 2 were very insightful. First, for both methods, a very clear pattern emerged. The mean absolute errors quickly shrink as sample size increases.
Bigger samples give more accurate estimates. That makes sense.
It confirms our intuition, yes. The more data points you randomly select, the closer your sample average tends to get to the true population average. Sampling error decreases.
Did stratified sampling perform better?
Yes, especially for the smaller sample sizes. The source clearly states that stratified sampling produced smaller mean absolute errors in those cases. This shows its advantage when the population has known subgroups, like different years here. By ensuring each year was represented proportionally, it gave a more accurate estimate, particularly when the overall sample was small.
So stratification helped reduce the error.
It did, particularly early on. The source does mention that the difference might become less pronounced or even change at very large sample sizes. But for practical purposes, especially with limited resources leading to smaller samples, stratification often offers better precision.
Okay. And what about the idea of enough data? Did the error keep shrinking at the same rate?
That's another crucial finding. While error decreased as sample size grew, it didn't decrease proportionally forever. The results showed there's a minimum sample size needed to limit sample error effectively. But after a certain point in the specific EAAA index example, it seemed to be around 200 to 400 observations. Adding more observations gave little incremental benefit. The improvement in accuracy became very, very small.
So diminishing returns. Collecting vastly more data beyond a certain point didn't make the estimate much better.
Exactly. This is a vital lesson for efficiency. You need a sufficiently large sample, yes, but you don't necessarily need an enormous one. There's a sweet spot where you get most of the accuracy benefit without excessive cost or effort. Understanding this helps analysts optimize their data collection.
Very practical insight. So final check on this section. Based on this experiment, what's the key takeaway about the relationship between increasing your sample size and the accuracy of your estimates? Does just adding more and more data always lead to huge jumps in accuracy, or does the benefit level off? And why is knowing this important for managing resources in finance?
The takeaway is that accuracy increases with sample size, but the rate of improvement slows down. There's a point of diminishing returns. Knowing this is crucial for resource management, you don't waste time and money collecting excessive data if a moderately large sample gives you sufficient precision for your needs.
That simulation really hammered home the importance of sample size and method. Now let's tackle what you called a magical concept earlier, the central limit theorem. Sounds quite grand.
It really is one of the most remarkable theorems in statistics and incredibly useful in practice, especially in finance. It helps us solve a common problem.
What's the problem it solves?
The problem is that often in the real world, we just don't know the actual shape or distribution of the entire population we're sampling from. Is it shaped like a nice bell curve? Is it skewed heavily to one side? Does it have multiple peaks? We usually don't know.
Right. Like the distribution of daily stock returns isn't perfectly normal, is it? It often has fat tails, meaning extreme events happen more often than a normal distribution would predict.
Exactly. Or think about insurance claims, lots of small claims, and a few very, very large ones. Definitely not a normal bell curve. So the question is, if the population isn't nicely behaved, how can we make reliable statistical statements about its mean, for example? How can we build confidence in our sample average?
That sounds like a major hurdle.
It would be, but for the central limit theorem, or CLT, as we often call it.
Okay, so what does the CLT tell us? Lay out the magic.
The CLT tells us something truly amazing, it says. Even if the original population distribution is not normal, it could be skewed, uniform, binomial, anything really. If you take random samples from that population, and if your sample size n is sufficiently large, then the distribution of the sample means will itself be approximately normal.
Whoa, hold on. Let me get this straight. The original data can be weirdly shaped.
Yes.
But if I take lots of big enough samples and calculate the average for each sample,
Yes.
and then I look at the distribution of those averages.
Yes. That distribution, the distribution of the sample means, will look like a normal bell-shaped curve, even if the original data looked nothing like it.
That is kind of magical. The averages smooth things out into a normal shape.
In essence, yes. The process of averaging dampens the extremes and irregularities, and the CLT quantifies this beautifully. It tells us 3 key things about this distribution of sample means when N is large.
Okay. What are the three things?
1, its shape will be approximately normal. 2, the mean of this distribution of sample means will be equal to the mean of the original population. So the sample means cluster around the true population mean.
Good. Our estimates are centered correctly on average.
Yes. And 3, the variance, which measures the spread of this distribution of sample means, will be the population variance divided by the sample size n. So the spread is font.
Okay. What does that variance part tell us practically?
It tells us that as our sample size n gets bigger, the denominator n gets bigger, so the overall variance SON gets smaller. This means the sample means will be clustered more tightly around the true population mean. Bigger samples lead to more precise estimates of the mean.
So bigger N means less spread in the sample means, meaning our sample mean is more likely to be close to the true mean?
Precisely. You've got it.
Our source had a visual for this, didn't it? Exhibit 4.
Yes, a very helpful one. It showed histograms of sample means drawn from those EAA index returns. When the sample size n was small, like 10, the histogram of the sample means looked a bit rough, maybe not perfectly normal.
Okay.
But as they increased into 50, then 100, and especially up to 300, you could clearly see the histogram of the sample means becoming smoother, more symmetrical, and looking very much like a classic bell curve. It's a great visual proof of the CLT in action.
Seeing it makes it much clearer. Now, you mentioned sufficiently large sample size. What's the rule of thumb for that? How large is large enough?
The common rule of thumb, widely used in practice, is that a sample size n of 30 or more is generally considered large enough for the CLT to provide a reasonably good approximation of normality for the sample mean distribution.
Okay. NL30 is the magic number often quoted.
It is. However, a small caution. If the original population distribution is extremely non-normal, like wildly skewed or with very extreme outliers, you might need a sample size somewhat larger than 30 to be safe. But for most practical purposes, N30 is a good starting point.
Why is this theorem so important then? What does it allow us to do?
Its importance cannot be overstated. The CLT allows us to use the well-understood properties of the normal distribution to make inferences about the population mean, even if we know nothing about the population's actual distribution shape. This is huge.
How so? What kind of inferences?
It allows us to calculate confidence intervals for the population mean. A confidence interval gives us a range of values within which we can be reasonably sure the true unknown population mean lies. For example, we are 95% confident that the true average return is between X% and Y%.
So it lets us quantify our uncertainty about the estimate.
Exactly. And it also forms the basis for hypothesis testing, where we can formally test claims about the population mean. Your example is the average return significantly different from 0. We can do all this powerful statistical inference because the CLT assures us the sample mean behaves normally for large samples.
It unlocks a lot of statistical tools that rely on the normal distribution.
Precisely. It bridges the gap between unknown population distributions and the powerful toolkit of normal distribution theory.
Can we have an everyday Indian teacher example for CLT?
Let's try. Imagine you are a teacher and you give a test. The scores of your individual students might be all over the place. Maybe some did very well, many did okay. If you did poorly, the distribution might be skewed, not a perfect bell curve.
Okay, individual scores are varied.
Now imagine you randomly pick groups of, say, 30 students each. For each group of 30, you calculate their average test score.
Okay, average score for each group of 30.
You do this many times, getting many group averages. Now, if you make a histogram, a plot, of all those average scores, not the individual scores, the central limit theorem tells us that this histogram, the one showing the distribution of the group averages, will look like a nice symmetrical bell curve, even if the original student scores didn't.
So the distribution of the averages becomes normal. That's the magic.
That is the magic of the CLT.
Okay, brilliant. So thinking about this, if someone, maybe a financial analyst, tells you they took a sample and found an average value for something like average profit, what's perhaps the first question you should ask them to know how reliable that average is based on the central limit theorem?
You'd immediately ask, how large was your sample?
Right. Because the CLT tells us the reliability, the normality, depends crucially on having a sufficiently large sample size.
Exactly. Sample size is key. Now, related to the CLT is another term, standard error of the sample mean. How does this fit in?
Very closely related. Remember, the CLT told us the variance of the distribution of sample means is, yes, population variance divided by sample size.
Well, the standard deviation is just the square root of the variance, isn't it? So the standard deviation of this distribution of sample means is ESLA, which simplifies to population standard deviation divided by the square root of n. This specific standard deviation, the standard deviation of the sampling distribution of the mean, is what we call the standard error of the sample mean, often just called standard error.
Okay, so standard error is the standard deviation of the sample means. But how is it different from the regular standard deviation of the original data? People often confuse these.
Excellent question, because the distinction is critical. Standard deviation, like for the population, or S is for a sample, measures the dispersion or spread of the individual data points around their average. It tells you how much individual observations typically vary.
How much the data itself bounces around.
Yes. Standard error, on the other hand, measures something different. It measures the precision of our sample mean as an estimate of the true population mean. It tells us how much we expect our sample mean to vary from the true population mean if we were to take different samples of the same size.
So standard deviation is about the data's variability. Standard error is about the estimate's variability or uncertainty.
Perfectly put, standard error quantifies the uncertainty in our estimate due to sampling. A smaller standard error means our estimate is more precise, more likely to be close to the true value.
And the formula you mentioned, makes this clear.
Yes, or since we usually don't know the true population standard deviation, we estimate the standard error using the sample standard deviation. So the formula we typically use in practice is standard error.
Sample standard deviation divided by the square root of the sample size.
Correct. And look at that formula again, SUN. It clearly shows that as the sample size n increases, the denominator n increases, and thus the standard error decreases. Larger samples lead to smaller standard error, meaning more precise estimates. It connects directly back to the CLT.
So more data reduces the uncertainty in our average estimate.
Precisely.
Let's use an example. Suppose I'm trying to estimate the average height of all students in a large university. That's my population mean. I take a sample of 100 students and measure their heights.
Okay.
The standard deviation of those 100 heights would tell me.
It would tell you how much the heights of the individual students in your sample of 100 typically vary around the average height of those 100 students. Are they all close to the sample average, or some much taller and some much shorter?
Okay, spread within the sample.
Yes. Now, the standard error calculated from that sample would tell you.
It would tell me how much my calculated average height from those 100 students is likely to be different from the true average height of all students in the entire university. It's about the precision of my estimate of the overall average.
Excellent. You've grasped the difference perfectly. Standard deviation describes the sample data itself. Standard error describes the uncertainty of the sample statistic as an estimate of the population parameter.
Okay, so thinking about finance. If an analyst wants to know how reliable their estimate of the average return for an investment strategy is, would they look more closely at the standard deviation of the daily or monthly returns, or the standard error of their estimated average return? Why?
They would focus on the standard error. The standard deviation tells them about the strategy's volatility, how much returns jump around day to day, but the standard error tells them how much confidence they can have that the average return they calculated from their sample period accurately reflects the true long-term average return of the strategy. It's about the estimate's reliability.
Got it. Standard error for estimate reliability.
Now, while CLT and standard error highlight the benefits of large samples, we need to discuss a very important warning: the homogeneity trap.
A trap. Sounds ominous. What is it?
It's a situation where blindly chasing a larger sample size can actually lead you astray. The power of large samples, especially for the CLT, relies on a crucial assumption. The samples must come from the same underlying population or process.
Meaning the conditions shouldn't change drastically during the period we are collecting data.
Exactly. If the fundamental characteristics of what you're measuring change over time, then simply pooling all the data together into one big sample might give you a result that is statistically precise, but practically meaningless or even misleading.
Because it's mixing apples and oranges.
Precisely. Our source provides a fantastic cautionary example using the Sharpe ratio. Remember, Sharpe ratio measures risk-adjusted return higher is generally better.
Yes.
So an analyst looks at a portfolio manager. In year 1, the manager used a low-risk strategy, and the Sharpe ratio was 0.22. In year 2, the manager switched to a high-risk strategy. But perhaps by chance or skill in that specific year, the Sharpe ratio also came out as 0.22.
Same Sharpe ratio, but very different strategies.
Exactly. Now, here's the trap. The analyst thinks more data is better and pools the data from both years together to calculate an overall 2-year Sharpe ratio.
Combining the low-risk year and the high-risk year.
Yes. But because the underlying strategy, and therefore the distribution of returns, average return, anti-volatility, was fundamentally different in year 1 versus year 2, they were sampling from 2 different populations of returns.
So pooling them is problematic. What happened?
The misleading result was that the pooled 2-year Sharpe ratio actually dropped to 0.199. This made the manager look worse overall than they looked in either individual year, and potentially worse than a benchmark they might have otherwise beaten.
Wow, so the bigger sample gave a worse, misleading picture.
Yes, because that bigger sample was representative of no population that actually existed consistently over the period. It was a meaningless average of 2 different things. The crucial lesson: sometimes a smaller sample drawn from a stable, homogeneous period is far more informative and reliable than a larger sample that mixes data from fundamentally different regimes.
Don't mix apples and oranges, even if it gives you more fruit.
Excellent analogy. Quality and consistency of the data source, the population, matter just as much, if not more, than the sheer quantity.
Let's try an Indian cricket example. Imagine a batsman played only Test cricket, slow, steady scoring, for 5 years. Then for the next 5 years, he played only T20 cricket, fast, aggressive scoring.
Okay, 2 very different formats.
If you calculate his average runs per innings by just lumping together all 10 years of his scores, Test and T20, would that average be very meaningful?
Probably not very meaningful for understanding his ability in either specific format, right? He comes from 2 different populations of batting style and conditions. Mixing them gives an average that doesn't truly describe his Test performance or his T20 performance. Better to look at them separately.
Exactly. So the most important thing we need to remember about the data we include in our sample, even if we want a very large sample size, is what?
We need to ensure the data comes from a consistent, homogeneous population or process. If the underlying reality changes, we need to be very careful about pooling data across those changes. We might need to analyze the different periods separately.
That homogeneity trap is a really important warning. Okay, we've covered traditional sampling methods and the mighty CLT. What if we have situations where these tools don't quite work perfectly? Maybe our sample is genuinely small, or we need to understand the uncertainty of a weird statistic.
Yes. That's where we turn to some more advanced tools, specifically computer-based resampling techniques. These are very clever ways to get more information out of the sample data we already have.
Resampling, like sampling from our sample.
In a way, yes. That's the basic idea. Sometimes maybe our sample size is less than 30, so we can't fully rely on the CLT. Or perhaps we're interested in the standard error of a statistic like the median, or maybe a complex risk measure for which there isn't a simple mathematical formula like SUNT for the mean.
So when standard formulas fail or assumptions aren't met.
Exactly. Resampling methods use computational power to simulate the process of drawing many samples, allowing us to estimate standard errors or build confidence intervals empirically directly from our data.
Okay, what's the most common resampling method?
Probably the most popular and powerful one today is called bootstrap resampling, or just bootstrap.
Bootstrap, like pulling yourself up by your bootstraps.
That's the analogy. The idea is you use only your existing sample to generate new understanding. The key mechanism in bootstrap is drawing with replacement.
Drawing with replacement. We heard that phrase before, but let's clarify it for bootstrap.
Okay. Imagine you have your original sample, say 12 monthly returns for a stock, R1, R2, R12.
Our original data.
To create one bootstrap resample, you randomly draw 12 returns from your original 12. But here's the crucial part. Every time you draw one return, you put it back into the set before drawing the next one.
Put it back. So the same return could be picked more than once in the new sample.
Exactly. Because you're replacing each pick, your first bootstrap resample might look something like R3, R8, R3 again, R11, R5, R1, R8 again, R12, R5 again, R9, R2, R6. It will still have 12 returns, but some original returns might appear multiple times and some might not appear at all.
Okay, so each resample is the same size as the original, but it's a shuffled version with repetitions allowed.
Perfectly described. Now, what do we do with this resample?
We calculate the statistic we're interested in, like the mean.
Yes. You calculate your statistic, for example, the mean, median, standard deviation, Sharpe ratio, whatever you need, for this first bootstrap resample. Let's say you calculate the mean.
Okay, one bootstrap mean calculated.
Now, here's where the computer power comes in. You don't do this just once. You repeat the entire process. Create a new bootstrap resample by drawing 12 times with replacement, then calculate its mean thousands of times, maybe a long 1,000 times, or 5,000 times, or even more.
Wow. So we end up with thousands of bootstrap means.
Exactly. You generate a large collection, a distribution of these bootstrap statistic values, for example, 5,000 bootstrap means. This collection is called the bootstrap sampling distribution.
And how does this help us?
It helps us estimate the uncertainty. The standard deviation of these 5,000 bootstrap means serves as our estimate of the standard error of our original sample mean.
Ah, so the spread of the bootstrap means tells us the standard error of our original estimate.
Precisely, and we didn't need any complex formula, just the computer to do the repeated resampling and calculation.
That's very clever. What are the main advantages then?
Several big ones. First, no analytical formula needed. This is huge for complex statistics where deriving a formula for standard error is difficult or impossible. Second, it's conceptually simple but powerful, relying on computation. Third, it can offer potential advantages in accuracy in some situations compared to methods relying on assumptions that might not hold.
And it's used in finance.
Widely.
Yeah.
For things like historical simulations and asset allocations, simulating potential future portfolio paths by resampling past returns. Or for gauging an investment strategy's performance against a benchmark, especially estimating the uncertainty around performance metrics when returns aren't normal. It's great for risk management too, like estimating value at risk, RABAR confidence intervals.
Our source had an example with 12 stock returns, right?
Yes. Example 4 clearly shows a few original returns, then demonstrates how a resample is drawn with replacement, showing NANA 0.096 appearing twice in resample 1, and explains how the standard error would be estimated from the standard deviation of many such resample means.
Let's try an everyday example. Imagine you baked a small batch of 10 unique cookies, each a different flavor. You want to estimate the average rating a group of friends might give if they each tried one cookie randomly. You only have these 10 cookies.
Okay, small sample.
How could you use Bootstrap? You could maybe write the 10 flavor names on slips of paper, draw one, note it down, put it back, draw another, note it down, put it back. Do this 10 times to get a simulated tasting resample.
Good. That's one bootstrap resample of flavors tasted.
Then you could maybe assign hypothetical ratings to those 10 tasted flavors and find the average rating for that resample.
Yes.
Then repeat the whole process, drawing 10 with replacement, calculating the average rating hundreds or thousands of times.
Exactly. The distribution of those thousands of average ratings would give you an idea of the likely average rating and its variability, standard error, all simulated from just your original 10 cookies.
Clever. So, quick check. If you only have a small set of data, say 20 observations, and you want to calculate the standard error of the median, the middle value, which modern computer method could help you do this reliably, even though there's no simple formula like SCR for the median standard error?
Bootstrap would be the ideal tool for that.
Great. Now, is there another common resampling technique?
Yes, there's also jackknife resampling. It's a bit older than Bootstrap, but still useful.
Jackknife. How does that work? Does it also use replacement?
No, jackknife works differently. Instead of drawing with replacement, it systematically creates new samples by leaving out one observation at a time from the original data set.
Leaving one out, how does that work?
If your original sample has some observations, you create in new samples. The first new sample consists of all the original data except the first observation. The second new sample consists of all the original data except the second observation, and so on until the nth new sample consists of all the original data except the nth observation.
Okay, so you create in samples, each of size n1, each missing a different original data point.
Exactly. Then you calculate your statistic of interest, like the mean or something more complex, for each of these n jackknife samples.
What is jackknife primarily used for?
Its main traditional use is often to reduce biases in an estimator. Some statistics calculated from samples can have a slight systematic tendency to be too high or too low compared to the true population value. That's bias. Jackknife calculations can sometimes help correct for this bias. It can also be used to estimate standard errors and confidence intervals similar to Bootstrap.
Okay, bias reduction is a key application. How does it differ from Bootstrap in practice?
A few key differences. Jackknife is deterministic. Because the process is fixed, leave out #1, leave out #2, it will give you the exact same results every time you run it on the same data.
Predictable.
Yes. Bootstrap, being based on random drawing with replacement, is random. It will usually give slightly different results each time you run it, though the results should be very similar if you use enough repetitions.
Okay, deterministic versus random. Any other difference?
The number of repetitions. Jackknife naturally requires n repetitions. If your original sample size is n, Bootstrap typically requires many more repetitions, often thousands, to get a stable estimate of the distribution.
So Jackknife might be computationally less intensive if n isn't huge.
Potentially, yes, in terms of the number of distinct samples generated.
All right, so last check-in. If I want to estimate something very precisely, and my main worry is that my calculation method might have some inherent bias, systematically over or underestimating, which resampling method, Jackknife or Bootstrap, is often specifically highlighted for its ability to help reduce that bias.
Jackknife is often specifically mentioned in the context of bias reduction techniques.
Understood. Bootstrap and Jackknife, powerful tools when standard methods aren't enough. Well, this has been an incredibly insightful journey. We've really covered a lot of essential ground in this deep dive today.
We certainly have. We started right at the beginning, making sure we understood the fundamental difference between populations, the entire group we care about, and samples, the smaller part we actually study. And we saw why sampling is so necessary, often due to impossibility or the need for efficiency, saving time and money.
Then we explored the different ways to actually collect those samples. We looked at the probability sampling methods like simple, random, stratified, and cluster sampling, which use chance to ensure fairness and representation, aiming for statistical validity.
And we contrasted those with the non-probability sampling methods like convenience and judgmental sampling, which are often quicker or rely on expertise but carry a higher risk of bias because they don't use random selection.
Then came the big reveal, the central limit theorem. That truly magical idea that even if our original population data is strangely distributed, the distribution of sample means will tend towards a normal bell curve if our sample size is large enough. That unlocks so much statistical power.
Absolutely. And connected to that, we clarified the crucial difference between standard deviation, measuring data spread, and standard error, measuring the estimate's precision. Plus, that vital warning about the homogeneity trap ensuring our data comes from a consistent source before pooling it.
And finally, we peeked into the advanced toolkit of resampling techniques, the clever computational methods of Bootstrap, drawing with replacement, and Jackknife, leaving one out. These give us ways to estimate uncertainty and potentially reduce bias, especially with small samples or complex statistics where formulas don't exist.
So why does all of this matter to you, our listeners, our students? It's not just for finance professionals or statisticians. Understanding these concepts makes you a well-informed individual, capable of making smarter decisions in a world drowning in data.
It really does. Whether you're reading a news report, setting an average income, planning your family budget based on estimated expenses, evaluating investment claims, or even just trying to understand a survey about public opinion, these ideas are everywhere.
Knowing about sampling methods, potential errors, the power of sample size, and how estimates are derived empowers you to ask better questions, to think critically, to not just accept numbers at face value.
It's like having a toolkit for seeing through the noise.
Exactly. So as we conclude this deep dive, my dear students, here's a thought to carry with you. The next time you hear a number presented as an average, the average rainfall, the average return, the average opinion on something,
what questions will you now ask yourself? How did they get that average? Was it from a sample? If so, what kind of sample was likely used? How big was it? And based on all that, how much confidence should you really place in that single number?
Asking those questions, thinking about the process behind the number, that is your superpower. It's the power to truly understand the information shaping your world, not just passively consume it.
We sincerely hope this deep dive has sparked your curiosity and given you a strong foundational understanding of how we make sense of big data through small, intelligent samples.
Keep exploring, keep asking questions, and remember, every piece of knowledge you gain makes you wiser in navigating our complex world. We look forward to our next learning adventure with you all. Namaste, my dear students, and welcome! Welcome to another insightful deep dive.
Hello, everyone.
Today, we are opening the doors to a very special classroom, a classroom where we learn to make smart, data-driven decisions.
Yes, especially when it comes to money matters. Very important.
Think of it as learning the secret language of numbers, to become truly well-informed.
Indeed, my young learners. Our mission today is to demystify a powerful tool. It's called hypothesis testing.
Yes. Hypothesis testing.
It sounds complex, maybe a little intimidating. But by the end of this session, you will understand how it helps us judge whether something we believe to be true about finance or even everyday life.
Like our electricity bill.
Exactly. Whether that belief is actually supported by evidence It's about building a strong foundation, you see, brick by brick.
So whether you're trying to figure out if a new investment scheme is genuinely better, or if your electricity bill truly reflects your usage, this deep dive will give you the tools to approach it with confidence and clarity.
So let's unpack this together, shall we?
Let's begin.
The core idea. What is hypothesis testing?
Okay, let's unpack this. At its heart, hypothesis testing is simply about making decisions using data. That's the core idea.
Yes, informed decisions, not just guessing.
Imagine you are the owner of a small kirana shop, a corner grocery store.
Right, a familiar sight.
You want to know if a new advertisement campaign, maybe you put flyers out, or a small ad in the local paper has truly increased your daily sales.
Has it really worked?
Or is it just, a lucky week? Maybe more people were in town? How do you know for sure?
Precisely. This process is part of what we call statistical inference. It's a big term, but the idea is simple.
Inference. Making a guess based on information.
Exactly. It's like taking a small spoonful of biryani, that's your sample, to judge the taste of the entire pot, which is the population.
Ah, I like that. One spoonful tells you about the whole pot.
We use information from a small group of the sample to make smart guesses about a larger group of the population.
So in our kirana shop example,
the population is the entire universe of daily sales for your shop. All possible sales, past, present, future.
Everything. Okay.
And the sample. That's the specific sales data you collected during the weeks the new ad campaign was running.
Just those weeks. Got it.
It's a small piece of the whole picture.
And what is a hypothesis, you ask? Well, it's like a theory or a statement about our kirana shop sales that we want to test.
A specific claim.
For example, one hypothesis could be, the new ad campaign has not increased my sales.
Or the opposite.
Or, the new ad campaign has increased my sales. These are the two competing ideas we want to test with our data.
Yes. And every time we test a theory like this, we set up two statements. Think of them like two sides of a coin. They have special names.
Okay, what are they?
First, there's the null hypothesis. We write it as H0H0.
H0, null, meaning nothing, no change.
Exactly. It's the status quo. It's the statement we consider true unless our data gives very convincing evidence otherwise.
Yeah.
It usually contains an equals to sign or implies no difference.
Right.
For our kirana shop, H0 would be, the average daily sales have not changed due to the ad campaign. It represents no effect.
This is what we start by assuming.
Right. Yes. And it's often what we want to reject if the evidence is strong enough. We're looking for proof against this no change idea.
Okay, so that's H0. What's the other side of the coin?
That's the alternative hypothesis. We write it HA, or sometimes H1.
Ah, the alternative.
This is what we hope to prove, or the condition we suspect is true. It's the challenge to the status quo.
The exciting possibility.
For our shop, HA would be, the average daily sales have increased due to the ad campaign. This is the change we're looking for evidence of.
So H0 says no change. Ha says there is a change.
Correct. And a key point. H0 and Ha must be mutually exclusive.
Meaning?
They cannot both be true at the same time. Either sales didn't change or they did. Not both.
Okay.
And they must also be collectively exhaustive.
Meaning they cover all the possibilities.
Yes, there's no third option. The sales either changed in the way he describes or they didn't, which is H0.
Got it. Mutually exclusive and collectively exhaustive.
Perfect.
So, my dear students, a little question for you. If your kirana shop sales manager believes the new ad campaign has definitely improved sales, is that belief closer to the null hypothesis or the alternative hypothesis? Take a moment to think.
Which one represents the belief that something has changed for the better?
The 6 golden steps of hypothesis testing.
Just like preparing for a big wedding in the family. There are so many steps, isn't it?
Oh yes, lots of planning, invitations, food, music.
Or getting ready for an important cricket match practice, strategy, team selection.
A clear process.
There are a series of steps we follow to make sure everything goes smoothly. Hypothesis testing also has a clear 6-step process. Makes it easier to follow.
Absolutely. A systematic approach is key. Let's walk through each step one by one, nice and slow, with clear examples.
Step 1.
Step 1, state the hypotheses.
We just discussed this, students. H0 and Ha.
Exactly. Clearly define your null, H0, and alternative Ha hypotheses about the population parameter you are interested in. Remember, H0 is usually what you assume is true initially.
Status quo.
And Ha is what you are trying to find evidence for, the change you suspect.
Okay, step 1, done. What's next?
Step 2, Identify the appropriate test statistic and its probability distribution.
Okay, test statistic. Sounds important.
It is. This is a special number we calculate from our sample data, from that spoonful of biryani.
Right.
Think of it like a cricket scoreboard. It gives you a numerical summary of how a player performed in that match, no?
Yes, runs scored, wickets taken, a summary number.
Just like that, the test statistic summarizes the evidence from your sample regarding your hypothesis. Its value helps us decide whether to reject the null hypothesis.
How? What do we do with this number?
We compare this calculated number to something called a critical value. We'll come to that.
Okay. And the second part? Probability distribution.
Ah, yes, depending on what we are testing.
Like, are we testing the average sales or how much the sales vary day to day?
Precisely. Are we testing a single mean or a variance? Or maybe differences between two means or two variances? And also depending on our data characteristics.
Like how much data we have? Our sample size?
Yes, sample size, or whether we happen to know the whole population's variance, which is rare. Based on these things, we use different test statistics. We mentioned some names: T statistic, chi-square, F statistic.
Different tools for different jobs.
Exactly. And each of these tools, these test statistics, has its own probability distribution. Think of it as its unique shape or its range of typical values if the null hypothesis were actually true.
So, the distribution tells us what values are common and what values are rare for that specific statistic.
You've got it. For example, if we test a single population mean, like our shop's average sales, and we don't know the population standard deviation, which is usual.
We use the sample standard deviation instead.
Correct. In that case, the t-statistic is typically used.
Okay. T-statistic 4 means when population variance is unknown.
Right. Now, for tests concerning a single population variance, maybe checking the consistency of quality in a factory output.
Or the risk of an investment.
Yes. The chi-square test statistic is appropriate. Chi-square for single variance.
Chi-square.
And if we're comparing the variances of two independent populations, like comparing the sales volatility before and after the ad campaign.
We use an F-test.
Correct. F-test for comparing two variances. So choosing the right test statistic and knowing its distribution is step 2. Very crucial.
Got it. Step 1, hypotheses. Step 2, test statistic and distribution. What's step 3?
Step 3, specify the level of significance.
Alpha. The Greek letter L. This sounds important.
It is crucial. This step tells us how much risk we are willing to take of making a specific type of error.
An error. What kind of error?
The error of rejecting a true null hypothesis, saying something changed when it actually didn't. We'll discuss errors more later, but alpha sets our tolerance for that specific mistake.
So it's like setting our caution level?
Exactly. Commonly, alpha is set to 5%, which is 0.05 as a decimal, or sometimes 1%, 0.01.
Okay, 5% or 1%?
If we set always to 5%, it means there's a 5% chance we might wrongly conclude something is true, reject 80 when it isn't.
We accept a 5% risk of being wrong in that specific way.
Precisely. And related to this is the confidence level. It's simply one.
So if alpha is 5%.
Your confidence level is 95%. It's like saying, I am 95% confident in the decision I make based on this test.
Okay, setting the risk level.
Okay.
Step 3. Now step 4.
Step 4, state the decision rule.
The rule for making the final call.
Yes, our clear-cut plan for when to reject the null hypothesis. It involves comparing our calculated test statistic from step 2, calculated in step 5, with a critical value or values.
Okay, you mentioned this critical value before. Where does it come from?
The critical value is a threshold. It's derived from the significance level from step 3 and the test statistics probability distribution from step 2. It marks the boundary of the rejection region.
The rejection region, like the zone where results are too extreme to believe H0.
Exactly. If our calculated test statistic falls into this rejection region, meaning it's more extreme than the critical value, then we reject the null hypothesis.
And if we reject H0?
We say the result is statistically significant. We have enough evidence against H0.
Okay. Compare test statistic to critical value. That's one way. Is there another?
Yes. A very common approach, especially with software, is using the p-value.
The p-value. I've heard of that.
The p-value is the smallest level of significance at which the null hypothesis could be rejected based on your specific data.
Okay. How do we use it to decide?
The rule is simple. If our calculated p-value is smaller than our chosen significance level from step 3, we reject H0.
So if p-value is less than alpha, reject H0.
Yes. If p is low, the null must go.
Huh. I like that. If p is low, the null must go. That's easier to remember.
It's a very common approach in finance.
Okay. Step 4. Decision rule, using critical values or p-values. Step 5 must be.
Step 5, collect data and calculate the test statistic.
The practical part. Get your hands dirty.
Exactly. Gather your Kirana Shop sales data or your investment returns or whatever data you need.
And then?
Plug the numbers into the formula for your chosen test statistic from Step 2. Calculate that single summary number.
Okay, do the math. Step 5. And finally, Step 6.
Step 6. Make a decision.
The moment of truth.
Based on your decision rule, Step 4, and your calculated test statistic or p-value, Step 5, you make the final call. Either we reject the null hypothesis.
Meaning we have enough evidence to support the alternative hypothesis. The ad campaign worked.
Or we fail to reject the null hypothesis.
Meaning we do not have enough evidence to support the alternative hypothesis. The data doesn't prove the ad campaign worked.
Crucially, remember this wording. We never accept the null hypothesis.
Why not? If we don't reject it, doesn't that mean it's true?
Not necessarily. It just means our current sample didn't provide strong enough evidence against it. Maybe the effect was too small for our sample size to detect. Absence of evidence isn't evidence of absence, so we only say fail to reject.
Okay, important distinction. Reject H0 or fail to reject H0. Never accept H0.
You've got it. Those are the 6 steps.
Excellent. 6 clear steps.
Now, students, let's check your understanding again. Imagine your electricity bill arrives. You have a hypothesis. Maybe H0 is, my bill is normal this month. You do some calculations, maybe comparing to past bills, and you get a p-value.
Oh.
If this p-value is smaller than the level of significance, alpha, you chose for your household budget analysis, what decision would you make about your hypothesis that the bill is normal? Would you reject H0 or fail to reject H0?
Think about our little rhyme. If P is low.
Understanding the errors in our decisions.
My dear students, even the wisest decisions sometimes come with a chance of being wrong, don't they? It's just part of life.
Unfortunately, yes. No crystal balls here.
In hypothesis testing, we must understand the 2 types of errors we might make. It's like playing cricket. Sometimes you think you hit a boundary, but you're caught just inside the rope.
Or you play a bad shot, but somehow it races away for 4 runs. Misjudgments happen.
Exactly.
When we make a decision in hypothesis testing, reject H0 or fail to reject H0, there are 4 possible outcomes when you compare our decision to the actual truth, which we usually don't know for sure.
4 outcomes.
Yes. 2 are correct decisions and 2 are errors. Let's break them down.
Okay, first the correct ones. That's good news.
Correct decisions. First, not rejecting a true null hypothesis. So H0 is actually true. For example, the ad campaign really didn't work, and our test correctly tells us we don't have evidence to say it did.
That's good. We didn't make a mistake.
Second, rejecting a false null hypothesis. H0 is actually false. For example, the ad campaign did work, and our test correctly tells us to reject H0 and conclude it worked.
Also good. We found the true effect.
These are the outcomes we hope for, but now the errors.
Okay, brace ourselves.
Errors. First, there's the type I error. This is also called a false positive.
Type I, false positive.
This happens when we reject a true null hypothesis.
So H0 is actually true, but our test mistakenly tells us to reject it.
Exactly. We conclude something is true or different, but in reality, it isn't. We raise a false alarm.
Give us an example.
Okay, imagine a new diet plan claims to make you lose weight very fast.
Yeah.
Your null hypothesis, H0, is the diet plan does not lead to significant weight loss. Status quo, right?
Right. Assume it doesn't work unless proven otherwise.
A type I error would be if your test leads you to reject H0, you start believing the diet works, you tell everyone, when in truth, the diet plan does not actually cause significant weight loss.
Ah, so you believed a false claim, a false positive.
Precisely. You've been misled by your sample data, perhaps just by chance. Now remember alpha?
Yes, the significance level from step 3, usually 5%.
The probability of making a type I error is exactly equal to alpha. We choose this risk level ourselves.
So if alpha is 5%, we have a 5% chance of making a type I error.
Okay.
Now for the second type of error.
Type 2.
Type 2 error, also called a false negative.
Type 2, false negative.
This happens when we fail to reject a false null hypothesis.
So this time H0 is actually false, but our test fails to detect it. We miss it.
Exactly. We conclude something is not true or not different, but in reality it is. We miss a real effect.
Okay. The diet plan example again?
Using the same diet plan. 8-0 is the diet doesn't work. Suppose, in reality, the diet does actually cause significant weight loss, so 8-0 is false.
Okay.
A type 2 error would be if your test leads you to fail to reject 8-0. You conclude the die doesn't work, you dismiss it.
When it actually does, you missed out.
You've missed out on something potentially good, a false negative.
Got it. Type 1, false alarm. Type 2, missed detection.
The probability of making a type 2 error is often denoted by the Greek letter beta.
Okay, alpha for type 1, beta for type 2. Now, here's the trade-off. These two errors, type I and type 2, are often in a kind of tug of war.
How so?
If you try very hard to decrease the probability of a type I error, for example, by making I smaller, maybe going from 5% down to 1% to be super cautious about false alarms,
Okay, be more strict.
you typically increase the probability of a type 2 error. Being overly cautious makes you more likely to miss a real effect.
It's a balance. If you lower the risk of one error, you usually raise the risk of the other.
Exactly. Think about saving for a big wedding. If you are extremely cautious about overspending, reducing type I error of rejecting a true budget-friendly plan as being too expensive.
You might become too frugal.
Yes, you might miss out on some really nice celebration elements that you could actually afford. Increasing type 2 error of failing to reject a false budget constraint idea. You have to balance these risks.
Based on the consequences, right? Which error is worse in a particular situation?
Absolutely. What are the costs of a false alarm versus the costs of a missed opportunity? That guides your choice of alpha and influences beta.
Can we reduce both errors at the same time?
Good question. There is one primary way. Increase your sample size.
More data.
Yes. More data generally means more clarity, more reliable information. It allows you to reduce the chances of both types of errors simultaneously. Bigger samples give you more precision.
So collect more sales data or test the diet plan on more people. Makes sense.
Finally, related to type 2 error is the power of a test. This is a very important concept, especially when designing studies.
Power, what does that mean?
The power of a test is the probability of correctly rejecting the null hypothesis when it is actually false.
So it's a probability of correctly detecting an effect that is really there.
Precisely. It's the opposite of a type 2 error. Remember, beta EBA is the probability of failing to reject a false H0, a type 2 error. Power is simply 1 minus beta. Power equals 1 more.
So high power is good.
Very good. A powerful test is good at finding what you're looking for if it actually exists. We want our test to have high power. Increasing sample size, by the way, also increases power.
Okay, power equals 1 beta. The ability to find a true effect.
You've got it. Understanding these errors and power is crucial for interpreting test results properly.
All right, my bright students, let's check this. Imagine a new medicine is being tested. In reality, it is effective against a disease. So the null hypothesis that it has no effect is actually false.
Okay, H0 is false.
But a clinical trial, a statistical test, mistakenly concludes that the medicine is not effective, meaning the test failed to reject that false null hypothesis. What kind of error has been made here? Type 1 or type 2?
Think. Was it a false alarm or a misdetection?
Parametric versus non-parametric tests. Choosing the right tool.
Now, my dear students, just as we use different types of utensils for different dishes in Indian cooking.
Yes, a tawa for roti, a kadai for sabzi, a pressure cooker for dal.
Exactly. Each suited for a specific purpose. We also have different types of hypothesis tests depending on the nature of our data and what we want to test.
Different statistical utensils.
Precisely. We categorize them broadly into two main families, parametric tests and non-parametric tests.
Okay, let's start with parametric tests. You mentioned these earlier, right? The t-test, f-test.
Yes, these are often the first ones people learn. They are concerned with parameters of a population.
Parameters. Like the population mean average or variance, spread, like the average return or the risk level of an investment.
Exactly those. They make inferences about these specific population characteristics.
And they have requirements, don't they? Assumptions.
Yes, that's the key point. Parametric tests typically rely on specific assumptions about the population from which your sample data comes.
Like what?
The most common and important assumption is that the data is normally distributed. It should roughly follow that symmetrical bell-shaped curve.
The bell curve. Okay. So parametric tests like the mean and variance and assume normality.
Generally, yes. Examples we've mentioned include the t-test for means, f-test for variances, and the chi-square test, often used for single variance tests or goodness of fit tests.
Okay, that's parametric. Now what about the other family, non-parametric tests?
These are incredibly useful. They are our go-to tools when the assumptions of parametric tests are not met. They offer more flexibility.
How so? What makes them different?
Well, non-parametric tests either. are not concerned with a specific parameter, like the mean or variance.
They test something else, like
Ah.
ranks or patterns.
Yes, sometimes. Or, and this is often the main reason we use them, they make minimal assumptions about the distribution of the population data. They don't require that normality assumption.
Ah, so they work even if the data isn't bell-shaped. That sounds very useful for real-world data, which isn't always perfect.
It is very useful. So, when do we use non-parametric tests? There are about 4 main situations.
Okay, number 1.
1. When data do not meet distributional assumptions, if your sample size is small, or if you look at your data maybe with a graph and it's clearly not normally distributed, perhaps it's very skewed or has multiple peaks.
Like maybe the monthly returns of a very volatile small mutual fund.
Perfect example. In such cases, a non-parametric test is more appropriate and will give you more reliable results than forcing a parametric test onto data that violates its assumptions.
Okay, so if normality is questionable, think non-parametric. Number 2.
2. When there are outliers. Outliers are those extreme values, way higher or lower than the rest of the data.
Like if 1 month's electricity bill was unusually high due to a mistake or a faulty meter?
Exactly. Parametric tests relying on the mean can be heavily skewed, pulled away by these outliers. Non-parametric tests are often less sensitive because they might use the median, the middle value, instead of the mean, or work with ranks. The median isn't affected much by one extreme value.
So, better for data with wild swings or errors. Got it. Number 3.
3. When data are given in ranks or use an ordinal scale, this is very distinct. If your data isn't precise numbers, but rather categories that have an order.
Like maybe student performance rated as excellent, good, average, poor.
Yes, or rankings of cricket players based on performance, first, second, third.
Or maybe bond ratings like AAA, AA.
Perfect examples. These are ordinal scales, they have an order, but the difference between categories isn't a consistent numerical amount. You can't average good and excellent numerically. Parametric tests need numerical data where averaging makes sense. Non-parametric tests are designed for this kind of ranked or ordered categorical data.
Makes sense. And the last situation, number 4.
4. When the hypothesis does not concern a parameter, sometimes your research question isn't about the average or the spread at all.
Like what?
For example, maybe you want to test if a sequence of stock price changes is random. Does it follow a pattern, or is it unpredictable day to day, like a random walk? This hypothesis isn't about a mean or variance.
Ah, testing for randomness itself.
Yes. For such questions, you'd use a specific non-parametric test, like a runs test.
Okay, so non-parametric tests are versatile. What are some examples? You mentioned names.
Yes, common examples include the Wilcoxon-signed rank test, the Mann-Whitney U test, which is also known as the Wilcoxon rank sum test, and the sign test. They test things like medians or differences in distributions without assuming normality.
Wilcoxon. Mann-Whitney.
Oh.
Okay, lots of options. Is there a downside? Should we always use non-parametric?
An important note. If the assumptions for a parametric test are actually met, if your data looks reasonably normal, sample size is decent, no crazy outliers, then the parametric test is generally preferred.
Why?
Because it usually has more power. Remember, power.
Yes, the ability to correctly detect a real effect. 1 beta.
Parametric tests, when their assumptions hold, are generally better at finding those real effects. They are more sensitive, more efficient, so don't jump to non-parametric unless you have a good reason based on the data or the hypothesis.
Okay, use parametric if you can, non-parametric if you must.
That's a good way to think about it. Check your assumptions first.
Very good, my smart students. So let's apply this. If you are comparing the satisfaction ratings of customers for 2 different mobile phone service providers, and these ratings are given as categories like very happy, happy, neutral, unhappy. These are ordered categories, not exact numbers. Which type of test would you most likely choose to compare the satisfaction levels? Parametric or non-parametric?
Think about the type of data. Ordered categories.
Applying hypothesis testing and finance real-world examples.
Wonderful. Now that we understand the recipe, the 6 steps, the types of errors, the different tests.
And the ingredients, the data, the hypotheses.
Let us try our hand at cooking some real-world financial problems. This is where it gets really interesting, students, applying these concepts.
Exactly. We'll walk through several examples just like solving problems in our math class, but using financial data. We'll see how to formulate hypotheses, choose the right test, and make decisions based on the evidence.
Let's start with the first one.
Example 1. Test of a single mean analyzing a mutual fund's performance.
Imagine we are analyzing Sendar Equity Fund.
A mutual fund, okay.
Over the past 24 months, its average monthly return was 1.50%, and the sample standard deviation of those returns was 3.60%.
Okay, 1.5% average return, 3.6% standard deviation over 24 months.
Now, a financial model based on the fund's risk level expected it to earn 1.0% per month.
So expected was 1.10%, but actual average was 1.5%. It looks better? No.
It looks better numerically, but the question is this difference statistically significant? Or could the fund's true average return actually be 1.1%, and the 1.50% we saw was just due to luck or random market movement over those 24 months?
The core question, is the difference real or just chance? So step 1, state hypotheses.
Right. H0, null hypothesis. The fund's true population mean return is equal to 1.1%, each true 1.1%. We assume the model is correct.
And high alternative hypothesis.
The fund's true population mean return is not equal to 1.1%, me 1.1%. We're testing if it's simply different, higher or lower.
So a two-tailed test.
Okay.
Step 2, identify test statistic.
Since the population standard deviation is unknown, we only have the samples 3.60%, and we generally assume monthly returns are roughly normal.
We use the t-statistic, right?
Correct. With degrees of freedom, N11 is 24, 1, 123.
Step 3, specify significance level. Let's use the common one.
Let's use I for 5%, 0.05. Since it's two-tailed, we split this, 2.5% in each tail.
Okay. Step 4, state the decision rule. We need critical t-values.
For 23 degrees of freedom and 2.5% in each tail, the critical t-values are 2.069.
So we reject H0 if our calculated t-statistic is less than 9 at 2.069 or greater than plus 2.06.
Exactly, if it falls outside that range.
Step 5, calculate the test statistic. The formula was...
So sample mean, hypothesized mean, sample 60 bevel.
About 3-point sample size.
So 2.50%, 1.10%, 3.60%. 3.60 there?
0.44. Let's see. 0.40 divided by 3.60, about 4.9.
Do the calculation, and you get a t-statistic of approximately 0.544.
0.544. Okay, step 6. Make a decision. Compare 0.544 to our critical values, 0.069.
So our decision is?
We fail to reject the null hypothesis.
Correct. And what's the conclusion?
There is not sufficient evidence to say the fund's true mean monthly return is different from 1.10%.
Exactly. The observed 1.50% could easily be just due to chance, random variation. It doesn't statistically prove the fund is outperforming the model's expectation.
So even though 1.5 looks better than 1.1, the statistics tell us not to get too excited based on this data alone. It's not a significant difference.
Precisely. It's like a parent expecting their child to score 80% on a test. If the child scores 82% and the S statistic shows this difference isn't significant, it means 82% is within the normal range of fluctuation around 80%, not truly different in a statistical sense.
Good analogy. And you mentioned we could use a confidence interval too.
Yes, we could construct a 95% confidence interval for the true mean return. If we did that, it turns out to be roughly 0.0204%, 3.0204%.
Okay, and our hypothesized mean was 1.10%.
Does 1.10% fall inside that interval?
Yes, it does. It's between 0.02% and 3.02%.
Since the hypothesized value is within the confidence interval, that also tells us to fail to reject the null hypothesis. It's a consistent result.
2 ways to reach the same conclusion.
Yeah.
Very clear.
Yeah.
Okay, next example.
Example 2. Test of a single variance analyzing a mutual fund's risk. Let's continue with Sendart Equity Fund. Remember, its sample standard deviation was 3.60%.
Yes. Standard deviation measures risk or volatility, right? How much the returns jump around.
Correct. Now, let's say we want to test if its true variance, which is just standard deviation squared, is less than a certain trigger level. Maybe the fund manager has a rule. Variance must be below 0.00016.
Where does 0.00016?
That corresponds to a standard deviation of 4%, because 0.04 squared is 0.0016. So we're testing if the true standard deviation is less than 4%.
Okay, testing if the fund's risk is below a certain threshold, variance 0.0016 or a CETO-DEV 4%. Step 1, hypotheses.
8-0 null hypothesis. The fund's true variance is greater than or equal to 0.00016. The status quo is that it's at least as risky as the threshold.
And alternative.
Haha, the fund's true variance is less than 0.0016, 0.0016. This is what we want to find evidence for, that it is less risky.
This time it's less than, so it's a one-side left-tailed test.
Okay.
Step 2, test statistic.
For a single variance test, assuming normality, we use the chi-squared statistic. Degrees of freedom are still N1 and what's 23.
G-squared for variance, got it. Step 3, significance level.
Let's stick with any solid 5%. Since it's left-tailed, all 5% is in that one tail.
Step 4, decision rule. We need the critical chi-square value.
For 23 degrees of freedom and 5% in the left tail, the critical shot value is 13.09051.
Okay, so we reject H0 if our calculated chi-square is less than 13.09051.
Correct, only if it's very small.
Step 5, calculate the test statistic. We need the sample variance first. STDEV was 3.60%.
So sample variance is 0.0360 through 0.01296. The hypothesized variance is 0.00016.
The formula is 23 times about 0.00016, 0.00016. Feels like it will be somewhere around 20.
Calculation gives approximately 18.63.
18.63. Okay. Step 6, make the decision. Compare 18.63 to the critical value 13.09051.
Is 18.63 less than 13.09051?
No, it's greater.
So the decision...
We failed to reject the null hypothesis.
Exactly. And the conclusion.
There is insufficient evidence to say the fund's true variance is less than 0.0016, or standard deviation less than 4%.
Right. Even though the sample standard deviation, 3.6%, was numerically lower than 4%, the difference wasn't statistically significant enough to confidently conclude the true risk is below the threshold.
So the manager can't claim it's proven to be a low-risk fund based on this threshold and data. The risks might still be 4% or even higher.
Precisely. It's like checking if the volatility of your share market investment is truly lower than a safe level you set. Here, the evidence doesn't strongly support that claim.
Okay, testing means and testing variances. What about comparing two different groups?
Example 3. Test concerning differences between means, independent samples, ACE High Yield Index.
We want to know if the mean daily returns of the ACE High Yield Total Return Index were different during two independent time periods.
Independent means the days in one period don't relate to the days in the other.
Correct. Let's say period 1 had 445 days with a mean return of 0.01775%. Period 2 had 859 days with a mean return of 0.01134%.
Okay, different sample sizes, different means. Looks like period 1 was higher again, but is it significantly higher?
That's the question. We'll also need to assume for this specific test that the population variances are equal in both periods.
Okay, equal variances assumption. Step 1, hypotheses.
Mean return period 1, mean return period 2, mean return period 2, mean return period 2. There's a difference. Two-tailed test.
Step 2, test statistic. We're comparing two independent means, assuming equal variances.
We use a t-test for the difference in means. This version requires calculating a pooled variance first.
Pooled variance, what's that?
It's a weighted average of the two sample variances, giving a combined estimate of the single variance we assume they share.
Okay, calculate that first, then the t-test. Degrees of freedom.
It's N1 plus N2, 2. So 445 plus 8592 is 1,302 degrees of freedom. Quite large.
Step 3, significance level. Let's use any 12%. Okay. Step 4, decision rule. For 1,302 degrees of freedom, which is very large, so it's close to the Z distribution, the critical t-values for a two-tailed 5% test are approximately 1.962.
Reject H0 if calculated as outside minus 1.962 to plus 1.962.
Correct. Step 5, calculate. First, the pooled variance. Let's say the calculation gives asymptotic 0.1330. Then plug into the t formula for difference in means.
Mean 1, mean 2, standard error, which uses the pooled variance.
The calculation gives a t statistic of approximately 0.3009.
0.3009. Okay, step 6, decision. Compare 0.3009 to 1.962.
Is it outside the range?
No, 0.3009 is very much inside, close to 0 actually.
So,
We failed to reject the null hypothesis.
and the conclusion.
There is insufficient evidence to say that mean returns are different for the two time periods. The observed difference, 0.01775% at 0.01134, could just be random chance.
Exactly. It's like comparing the average profit your Kirana shop made in the first 6 months versus the last 6 months. Even if one period's average is slightly higher, this test tells us if the difference is significant enough to be considered a real trend or just normal business fluctuation. Here, it looks like fluctuation.
Okay. What if the samples were not independent? Like comparing two things over the same time period.
Example 4. Test of mean differences. Dependent samples paired comparisons test. Excellent question. Scenario. Now we want to compare the returns of the ACE High Yield Index and another index, the ACE BBB Index, but this time over the same 4,304 days.
So for each day, we have a return for both indexes. They are paired. Dependent samples.
Correct. We test if the mean of the differences between their returns on each day is 0.
So we calculate the difference each day, then test the average of those differences.
Exactly. Find the difference. D, return high-yield return BBB for each of the 3,304 days. Then test if the average of these BBB values is 0.
Why is this better sometimes? You mentioned power.
Yes, this paired test is generally more powerful if the observations are naturally paired. Because it accounts for the common factor, the same day's market conditions affecting both indexes, it reduces the noise or random variation. We focus just on the difference between the pair.
Okay, removes background noise. Step 1, hypotheses.
H0. The mean of the population differences is 0. On average, no difference.
The mean of the population differences is not 0. Ijiro 0. Two-tailed test.
Step 2. Test statistic.
We use a t-test again, but this time it's applied to the differences. Degrees of freedom, N1 equals 1304, 1 equals 1303.
Step 3. Significance level. Let's use I to a 5%.
Okay. Step 4, decision rule. With 1,303 degrees of freedom, again very large, critical t-values for a two-tailed 5% test are 1.962. Reject H0 if it's outside this range.
Step 5. Calculate. We need the mean and standard deviation of the differences. Let's say the data shows the average difference was 0.00021%, and the standard deviation of these differences was 0.3622%.
Okay, so T, mean of differences, hypothesized mean difference. C, day of differences, sample size.
TEG 0, 1.0210.3622 at 1304. Calculate that.
The result is a t-statistic of approximately net of 0.20937.
Net is 0.20937. Step 6, decision. Compare net 0.20937 to edema 1.962.
Inside or outside?
Inside again, very close to 0, even closer than the last example.
So we fail to reject the null hypothesis.
Conclusion. There is insufficient evidence to say the mean of the differences is different from 0.
Correct. So these two indexes perform quite similarly on average day to day. The small negative average difference isn't statistically significant.
It's like comparing the performance of two students on a mock exam and then the actual exam. Since it's the same student, we look at the difference in their scores between the two exams. If the average difference isn't significant, it might suggest the mock exam was a good predictor, maybe.
Good analogy. The paired test helps control for the student's individual ability. Okay, we've compared means. What about comparing variances of two groups? Example 5. Test concerning the equality of two variances, volatility and regulation.
We want to see if the volatility variance of stock market index returns changed after a new market regulation. We have weekly data for 418 weeks before and 418 weeks after the regulation, independent samples.
Okay, comparing volatility before and after. Let's do two parts. First, are they just different?
Part A, are the variances different?
Hypothesis.
Variance before, variance after, no change in volatility.
Variance before, variance after, before is after, volatility change, two-tailed test.
Step 2, test statistic. Comparing two variances.
We use the F-test. It's the ratio of the sample variances. Degrees of freedom are N1 and N2 so 417 and 417.
Step 3, significance level, Estimate 5%.
Step 4, decision rule. For an F-test with 417 degrees of freedom, two-tailed at 5%, we need two critical F values. These turn out to be approximately 0.82512 lower and 1.21194 upper. Reject H0 if F is outside this range.
Okay. Step 5. Calculate. Let's say the sample variance before ants 4.644 and sample variance after 3.919.
As sample variance before, sample variance after, it goes 4.644, 3.919. This gives
about 1.185.
Step 6. Decision. Compare 1.185 to the range, so from 0.82512 to 1.21194.
1.185 is inside that range, just slightly below the upper critical value.
Yeah.
We fail to reject the null hypothesis.
Conclusion for Part A.
There is not sufficient evidence to say the weekly variances are different before and after.
Okay, now Part B is the variance of returns greater before the regulation change. We suspect maybe the regulation reduced volatility.
A specific direction. One-sided test now.
Step 1, hypotheses.
Variance before, variance after. Volatility didn't decrease.
Variance before, variance after. Volatility was greater before, meaning it decreased after. One-sided right-tailed test.
Step 2. Test statistic is still the F-test, calculated the same way. FQ is 1.185.
Step 3, significance level is still a 5%.
Step 4, decision rule. Now we need the critical F value for a right-tailed test with 5% significance and 417 degrees of freedom.
That critical value is 1.17502. We reject H0 if our calculated F is greater than 1.17502.
Step 5, calculated F was 1.185.
Step 6, decision. Compare 1.185 to 1.17502.
This time, 1.185 is greater than 1.17502. Just barely, but it is.
So the decision.
We reject the null hypothesis.
And the conclusion for Part B.
There is sufficient evidence at the 5% level to conclude that the weekly variance of returns before the regulation change was greater than the variance after.
Exactly. So the regulation appears to have successfully reduced volatility. This shows how framing the question, two-tailed versus one-tailed, can lead to different conclusions, even with the same data.
Fascinating. The one-tailed test focused on the specific question of reduction and found significance. It's like checking if driving on a certain road was more dangerous, higher variance of accidents, before a new speed limit was put in compared to after. The second test suggests it was more dangerous before. Okay, one last example.
Example 6, analyst forecasting quality, zero mean test, and difference in means.
Investment analysts forecast earnings per share, EPS. A good, unbiased forecast should have a mean forecasting error of 0. Error, predicted EPS, actual EPS. Let's test two analysts, A and B.
Part A. Does analyst A's mean forecast error equal 0?
May A dri 0 ha, euro, 0, two-tail.
And 10 forecasts, mean error 0.05, STD dev with 0.1.
T test with 9DF, alpha 5%. Critical T equals nit euro 0.262, calculated T 0.1050, 0.10, oval 1.58114.
1.58114 is inside ENI 2.262, so fail to reject A0. Not enough evidence to say A's mean error isn't 0.
Part B, does analyst B's mean forecast error equal 0?
A0 near euro. Yeah, near here. A0, two-tailed.
N15 forecasts, mean error 0.02, STD dev equals 0.09.
T-test with 14DF, alpha 5%. Critical T is 2.145. Calculated T counting 0.020.09 care overlist.
0.86066.
For both analysts, there's not sufficient evidence to conclude their mean forecast error is different from 0. On average, they seem unbiased, like checking if the average daily attendance at your school is truly 100%. If it's slightly less but not statistically different, the assumption holds.
Okay, Part C. Is analyst A's mean forecast error larger than analyst B's? Comparing the two analysts now.
Testing if A is worse than B on average. Hypotheses. H0 gay AA0. A's error is not larger than B's. Ha. ADB, 0P. A's error is larger than B's. One-sided, right-tailed. Assume independent samples equal variances.
Test. T-test for difference in means using pooled variance. Degrees of freedom, 10 plus 15.2 equals 23. Alpha equals 5%. Rejection point, critical T for right-tail test is 1.714.
Calculate pooled variance. Result is being 0.0088435. Then calculate T. Calculated T with 0.05, 0.02, 0.08843551 plus 0.00884315, which will 0.78142.
0.78142 compared to the rejection point 1.714.
Is it greater?
No, 0.78142 is much smaller than 1.714.
Decision.
Failed to reject 80.
Conclusion for Part C.
There is not sufficient evidence to indicate that the mean forecast errors of analyst A are larger than analyst B's. The difference we saw, 0.05 versus 0.2, could just be due to chance. We can't say A is statistically worse than B based on this data.
Excellent walkthrough of various common tests in finance.
Excellent work, my intelligent learners. That covered a lot of ground. Now, a final question on these examples. If you are examining the average daily earnings of two street food vendors who operate independently.
Okay, vendor 1 and vendor 2.
And your calculated T statistic for comparing their average earnings falls exactly within the allowed critical values for your chosen alpha level. What would your conclusion be? Are their earnings truly different or not?
Think about where the T statistic falls relative to the rejection region. Beyond the basics. Common pitfalls and considerations in financial hypothesis testing. So we've covered the mechanics, we've seen the applications. Very good. However, it's really crucial to understand that just running the numbers isn't quite enough.
There's more to it than just the calculations.
Definitely. There are common pitfalls, traps you can fall into, and important things to consider when applying hypothesis testing, especially in the messy, complex world of finance.
That's a vital point. It's not just about getting the right statistical answer, but understanding the context, the limitations, potential misinterpretations. So what are some of these key traps or nuances we should be aware of?
Well, one of the most common pitfalls, I think, is misinterpreting the p-value. Talked about the rule, if p is low, the null must go.
Yes, if p alpha, reject H0.
Right. But what does that low p-value actually mean? It tells you that your observed data, or something even more extreme, would be unlikely if the null hypothesis were true.
Okay, unlikely under H0?
It does not tell you the probability that the null hypothesis is true or false. That's a different question altogether. And it certainly doesn't tell you the probability that your alternative hypothesis is true.
That's a common mistake, isn't it? thinking p-value is the probability H0 is wrong.
It is. A p-value of, say, 0.04 for a new investment strategy doesn't mean there's only a 4% chance the strategy doesn't work.
What does it mean then?
It means that if the strategy truly had no effect, if H0 were true, you'd only expect to see results as good as what you observed, or even better, about 4% of the time, just by random chance. It's about the rarity of the data assuming H0 is true.
Okay, it's a measure of evidence against the null, not a direct probability of the null. Subtle, but important. What else?
Another really significant issue, especially in finance with lots of historical data, is data snooping, or sometimes called data mining bias.
Data snooping. Sounds sneaky.
It kind of is, even if unintentional. It happens when analysts test many different hypotheses on the same data set until they finally find one that shows up as statistically significant.
Like trying countless trading rules on past stock prices until one looks like it worked.
Exactly. If you test enough patterns or combinations, you're almost guaranteed to find something that looks significant purely by chance, even if there's no real underlying economic reason for it.
It's like finding shapes in the clouds. Look long enough, you'll see something.
A perfect analogy.
Yeah.
This leads to building investment strategies or models that look fantastic in backtesting on historical data.
But then fail miserably when used with new real-world data.
Precisely. Because the significant result found was likely just a fluke in that specific data set. You need to be very careful about testing predefined hypotheses, not just fishing for significance.
A critical point for anyone building models. Okay, what about significance itself? You can have statistical significance, but does it always matter?
You're leading into the next crucial point. The difference between statistical significance and practical or economic significance.
Right. Just because it's statistically unlikely to be chance doesn't mean the effect is large enough to care about.
Absolutely paramount in finance. A result can be highly statistically significant, maybe a p-value of 0.0001, very strong evidence against H01, but the actual size of the effect might be tiny.
Like?
Imagine a new complex trading algorithm. Your test shows its average return is statistically significantly higher than the old one, maybe at the 1% level. But the actual difference in average return is only 0.001% per trade.
That sounds tiny.
It probably is. After you account for trading costs, commissions, potential slippage, management fees, that minuscule difference might completely disappear or even become negative. It's economically irrelevant.
So statistical significance tells us if an effect is likely real, but not if it's meaningful in practice.
Correct. We must always ask, okay, the effect seems real, but is this difference large enough to matter financially? Will it actually improve my bottom line after costs? Investors need meaningful returns, not just statistically detectable ones.
Always look at the effect size alongside the p-value. Great reminder. What about the assumptions we talked about, like normality for parametric tests? Financial data often looks a bit wild, no?
You've hit on a key practical challenge. Many financial return series don't follow a perfect normal distribution. They often exhibit fat tails.
Meaning more extreme events, big gains or big losses, happen more often than a normal bell curve would predict.
Exactly. And also skewness, where the distribution is lopsided, not symmetrical.
So if our data has fat tails or is skewed, can we still use those t-tests and f-tests?
Well, parametric tests are often described as robust to minor violations of normality, especially if you have a large sample size. But significant departures can really invalidate the results, leading to incorrect p-values and conclusions.
And that's where
our discussion of non-parametric tests becomes so important again. If your data clearly violates the normality assumption or has severe outliers, using a non-parametric alternative, like Wilcoxon or Mann-Whitney, can provide much more reliable and trustworthy inferences.
because they don't rely on that normality assumption.
Correct. They work with ranks or medians, which are less affected. However, it's also important to remember that even non-parametric tests have some assumptions, just usually less restrictive ones. You still need to choose the appropriate test for your data structure and question.
So the message is, know your data, check assumptions before choosing your test. Don't just blindly apply a t-test to everything.
Excellent summary. One more related point.
Please.
Remember that famous phrase, correlation does not imply causation.
Ah, yes. Just because two things move together doesn't mean one causes the other.
Hypothesis tests are great at revealing relationships, differences, or correlations between variables. They can tell us if two things are associated statistically, but they don't, on their own, tell us why that relationship exists or if one variable directly causes the change in the other.
Like your example earlier, ice cream sales and stock market rallies might be correlated in the summer.
but neither causes the other.
Huh.
Both are likely influenced by a third factor, like warm weather and general optimism. In finance, there are often many hidden or confounding factors. So even if you find a statistically significant relationship between, say, a company's R&D spending and its stock price,
You can't immediately conclude that spending caused the price increase. Other market factors could be at play.
precisely, be very wary of drawing causal conclusions just from statistical significance found through hypothesis testing. It's a great tool for finding associations, but proving causation usually requires more sophisticated analysis or experimental design.
Understand the tools, but also understand their limitations. Very wise advice. Outro.
Wow, my dear students, what an incredible journey we've had today. We started by exploring the very essence of making smart decisions with data. It's not just about maths, is it?
Not at all. It's about critical thinking. Understanding how to use numbers to separate signal from noise, real effects from random chance.
Like our elders making crucial decisions for a family's future, perhaps saving for a child's education. They use experience and evidence? No. Hypothesis testing gives us a formal way to do that with data.
Indeed. We've really dissected hypothesis testing today, from stating our beliefs clearly with null and alternative hypotheses to navigating those 6 crucial steps for conducting a test. We've also faced the realities of potential errors, type I and type 2.
The false alarm and the misdetection. And alpha and beta.
Yes, and understanding that trade-off. And, crucially, knowing when to choose the right tool. Parametric tests when assumptions hold, non-parametric when they don't. And we saw how these tools apply directly to real financial questions, evaluating a mutual fund's performance, assessing its risk, comparing different investment periods or strategies, even checking if regulations changed market volatility.
And importantly, we touched upon those common pitfalls, misinterpreting p-values, the dangers of data snooping, and the vital difference between statistical significance and real-world economic importance.
So here's a thought for you as you go about your day. Maybe you're checking your electricity bill for unexpected charges or looking at your favorite cricket team statistics. What do you think? Where else in your daily life can you spot a hypothesis being tested, even if informally? Someone makes a claim, someone has a belief.
And what evidence would convince you to change your mind about something you currently believe to be true? How strong does that evidence need to be? That's hypothesis testing in action.
It really is everywhere once you start looking.
Always remember, my young friends, knowledge is most valuable when it is truly understood and thoughtfully applied. Don't just memorize formulas. Understand the concepts.
Keep learning, keep questioning assumptions, including your own, and keep honing those critical thinking skills. The world needs clear thinkers.
Indeed it does. Until our next deep dive, Dhanyavad. Thank you. And keep that curiosity burning brightly.
Thank you, everyone. Keep learning.
Namaste, my dear students, and a very warm welcome to the Deep Dive. Today we have a very special lesson for all of you, a deep dive into the fascinating world of numbers. See, numbers in finance, they are a lot like people, actually. Sometimes they behave like friends, moving together. Sometimes they are completely independent, doing their own thing. And understanding these connections, or maybe the surprising lack of connection, is truly crucial for making smart financial decisions, whether you're planning for a business or even, your own household budget. So are you ready for our deep dive into understanding how financial variables interact?
Indeed. It's a fundamental concept, really, much like understanding the relationships in your own family or your community. Knowing if one thing affects another, or if they are truly independent, well, it helps us to predict, to plan, and importantly, to make informed choices. Imagine, for example, maybe a village elder deciding where to invest for the community's future. They would certainly want to know if a drought affects crop prices, correct? Or if the cost of building a new school is related to the number of children in the village. Today, my dear students, we will learn about different tests of independence and tests of correlation. Now, these sound like fancy names, but they're simply clever methods that help us figure out these relationships. We will look at the statistical tools, the methods, that tell us if a relationship we observe is just by chance or if it's something real and reliable, something we can use for our financial planning and forecasts. So, let us begin our classroom session.
Right, students. Before we dive into the more complex terms, let's start with a very basic, everyday idea. In finance, just like in life, we often see things happening together, don't we? For example, if you use more electricity in your home, what happens to your electricity bill? It goes up. Correct. That is a simple relationship.
Exactly, a very clear one.
In finance, we want to know if, say, the returns of one investment tend to move in the same direction as another, or perhaps they move in the opposite direction. This idea of things moving together is called correlation. And if they don't influence each other at all, well, we call them independent. Could you please explain why understanding these financial relationships is so very important for us, especially when we are making important money decisions?
Of course, understanding these relationships is absolutely crucial because it allows us to build what we call financial models. Think of these models as simplified maps or maybe like blueprints that help us understand how different parts of the financial world connect.
Okay, like a plan.
Precisely. And these models then help us with forecasting, which is simply predicting what might happen in the future. For example, if you are planning a grand wedding in your family, a very important event, you might want to know if the cost of the venue is related to the number of guests.
Right, makes sense.
If they are related, then inviting more guests means you'll need a bigger budget for the venue, and you can plan for that. Now, in the world of investments, it's similar. If the returns of two companies tend to move together, like maybe two-star cricketers, scoring runs in a strong partnership,
Good example.
we might treat them differently in our portfolio than if their performances are completely independent. Perhaps like two individual athletes competing in completely different sports. This relationship can be a linear relationship, meaning as one variable goes up, the other tends to go up or down in a relatively straight line. Or it can be a more general connection, simply whether two things are connected at all. For investors, knowing this helps in diversifying your portfolio, reducing risk, or even identifying hedging opportunities. For instance, if two stocks are highly correlated, buying both might not reduce your risk much. You see?
Right, because they move together.
Exactly. But if they are negatively correlated, one going up when the other goes down, they can help balance your portfolio, much like a good dal-chawal meal balances your diet.
That's a brilliant example. Truly clarifies the practical side. So the first big question we ask is always, is this relationship we are seeing happening purely by chance, or is it a true underlying connection that we can rely on? And to answer that, we use special statistical tests. Can you tell us about the two main types of tests, or maybe the two main magnifying glasses we will learn about today to examine our data?
Absolutely. We essentially have two major statistical approaches. Think of them like two different kinds of specialized tools in our financial toolkit. We have parametric tests and non-parametric tests. Let's understand the difference simply. Think of parametric tests as those that make certain assumptions about your data. A bit like how a doctor might assume that most people's body temperature falls within a normal range.
Okay, assumptions.
Yes. These tests are often used when your financial data is numerical and tends to follow a clear, predictable pattern, especially something called a normal distribution. A normal distribution is that familiar bell-shaped curve you might have seen, where most of the data points cluster around the average and fewer points are found further away, making it perfectly symmetrical. When our data truly fits this kind of pattern, parametric tests are very powerful and efficient at detecting relationships.
So they work best with well-behaved data.
You could say that, yes. Now, non-parametric tests, on the other hand, are more flexible, like a tailor who can make clothes for people of all shapes and sizes without assuming a standard figure. They don't make as many strict assumptions about the underlying distribution of the data.
More adaptable.
Exactly. These are incredibly useful when your data is categorical, meaning it falls into distinct groups or types like small, medium, large for a shop's products, or classifying investment funds as value, growth, or blend. They're also useful for discrete data, like the number of goals in a football match, which can only be whole numbers, or when your data has extreme outliers values that are very different from the rest. Perhaps like one student who scored 100 marks in an exam while everyone else got average marks. That one score can skew averages, you see.
I see.
For these types of data, where values are distinct categories or counts and might not be normally distributed, the usual correlation methods might not work well. Non-parametric tests come to our rescue in such situations. They allow us to find relationships without forcing our data into assumptions it doesn't meet.
Very good, students. Hopefully that distinction between parametric and non-parametric tests is clear. It's really about how much assumption you can make about your data, isn't it? Now, can you think of an example, perhaps from managing a shop or your family expenses, where you might need to use a non-parametric test? Because your data is in categories or ranks and not perfectly numerical like a bell curve. Think about classifying something, not just measuring it. Maybe take a moment.
Good question to ponder.
Now, before we start any financial investigation, my dear students, we need to frame our question very clearly, very precisely. In statistics, we call these precise questions hypotheses. They are like our educated guesses or formal statements that we want to test using our data. Could you explain what a hypothesis is in our financial context and why we always start with something called the null hypothesis?
Yes, of course. Let's imagine you are running a small kirana shop, a local grocery store, and you just introduced a new discount offer. You might have an initial idea, a starting assumption that says, the new discount offer has no effect on my daily sales. This is what we call our null hypothesis. We write it as H0.
Big zero.
Yes. It's our default assumption that nothing interesting or new is happening. No relationship, no change, no effect. Then you might have another idea, a guess you want to prove. This is your alternative hypothesis, written, this might be, the new discount offer does increase my daily sales. This is what you're hoping to find evidence for, the opposite of the null hypothesis.
So H0 is no effect, is there is an effect.
Exactly. We always begin our statistical test by assuming there is no relationship or no effect. That's our H0. Then we collect data and analyze it to see if there's enough convincing evidence to reject this null hypothesis, reject it in favor of our alternative hypothesis, which is the one proposing a relationship or an effect. It's very much like a court case, actually, where you always assume the accused person is innocent, that's your null hypothesis, and you need to present strong, compelling evidence to prove their guilt, which would be your alternative hypothesis.
That's a very clear way to put it. The innocent until proven guilty principle for data. So for correlation, our null hypothesis usually assumes there is no linear relationship between the two financial variables we are examining, correct?
That's right.
This means that the population correlation coefficient, that's a mouthful. We use the Greek letter hu, right? It's like a fancy P.
Yes, Ro.
So the null hypothesis says φ is equal to 0, and this φ represents the true correlation for all possible data, the whole universe, not just our small sample. And our alternative hypothesis then suggests that there is a relationship. Could you tell us about the different ways we can state our alternative hypothesis? Because sometimes we are looking for a specific kind of relationship.
Indeed. It depends on what we suspect or want to test. Just like when you are predicting the outcome of a cricket match, you might say, the score will be exactly 200. That's very specific. Or you might say, the score will be more than 200, or the score will be less than 200. Similarly, for our HO, the population correlation coefficient, we have three common ways to set up our alternative hypotheses. First, we have the two-sided alternative. Here, our null hypothesis, H0, says rho equals 0, rho equals 0. And our alternative hypothesis, ha, says rho is not equal to 0. This means we are interested if there is any relationship at all, positive or negative. We don't mind which direction, just if it exists.
Any relationship at all, okay.
Second, there's the one-sided alternative, right side. This is where H0 is. Rho is less than or equal to 0 versus hot rho is greater than 0. Here, we are only interested if there is a positive relationship. For example, if we believe that increased advertising spending should only lead to higher sales, never lower.
We're looking specifically for a positive link.
Precisely. And third, the one-sided alternative, left side. This one states H0, RO is greater than or equal to 0, versus HARO is less than 0, R0. In this case, we only look for a negative relationship. For instance, if we expect that higher interest rates should lead to lower stock prices.
So specifically looking for a negative link.
Exactly. And we use our sample correlation, which is the correlation we calculate from the specific data we actually have, our value to test these hypotheses about the whole population correlation, the rho. Our sample gives us the clue, the evidence, to make a decision about the bigger picture.
Excellent explanation. So, my dear students, can you tell me what the null hypothesis usually assumes when we are testing for a relationship between two things? What is our starting assumption, the one we try to find evidence against? Think about H0.
What does H0 usually say about the relationship?
All right, let's move on. Let's start with our first type of magnifying glass, the parametric test for correlation. The most common and widely used one is called the Pearson correlation, or sometimes just the bivariate correlation. This test is great when our data is numerical, like stock prices or company earnings, and ideally normally distributed, following that nice bell-shaped curve we spoke about earlier. Could you explain what this R value, which is our sample correlation coefficient, actually tells us when we calculate it?
Certainly. The sample correlation coefficient, denoted by the letter R, is a very powerful number indeed. It tells us two key things about a linear relationship between two numerical variables. Let's call them X and Y. First, it tells us the strength of the relationship, how closely they move together. Second, it tells us the direction of the relationship. Do they move in the same direction, positive or opposite directions, negative.
Strength and direction. Got it.
Imagine we are looking at the prices of mangoes and the number of mangoes sold at a fruit stall in a local market. Our R value would tell us if, as prices go up, sales tend to go down. That would be a negative relationship, which is common. Or if they tend to go up, a positive relationship, perhaps for luxury goods. Or maybe if there's no clear linear pattern at all. Now, the formula for R involves two important concepts: covariance and standard deviation.
Okay, covariance and standard deviation.
Yes. First, covariance, SXY. Think of this simply as how much two variables vary together. If both mango prices and sales tend to be above their averages at the same time or below their averages at the same time, they have positive covariance. They move together. If one is above its average when the other is below, they have negative covariance. They move opposite. The sign of the covariance, positive or negative, directly determines the sign of our correlation R.
So covariance tells us the direction.
Correct. Second, standard deviation, SXSY. This just measures how spread out the data points are for a single variable. A small standard deviation means values are clustered closely around the average, like most students scoring marks very close to the class average. A large standard deviation means the values are very spread out, more variability. So the R value cleverly combines these two, how they vary together versus how much they vary individually, to give us a standardized measure, a measure of linear relationship that always ranges from -1 to +1.
Ah, standardized.
Yeah.
That's why it's always between -1 and +1.
Exactly.
Yeah.
-1 means a perfect negative linear correlation. As one goes up, the other goes down perfectly in a line. +1 means a perfect positive linear correlation. They move up and down together perfectly. And 0 means no linear correlation. It's important to remember, though, a zero LAR doesn't mean no relationship. There might still be a nonlinear relationship, like a curve, that Pearson R's just cannot capture.
That clarifies it nicely.
Yeah.
So once we calculate this R value from our sample data, how do we then decide if this relationship is actually significant? Is it a real dependable connection or just a random fluke that happened in our particular sample? Can you introduce us to the T statistic, which helps us make this important decision?
Yes, absolutely. If our two variables are normally distributed, remember that bell-shaped curve assumption, we can use a P statistic. We use it to rigorously test if our FRO, the true population correlation, is truly different from 0. This T statistic is a special number that we calculate using our sample correlation R and our sample size N, which is the number of observations we have. The formula is T equals R times the square root of N2 divided by 1 R squared.
Okay, that's the formula.
Yes, and this calculated N statistic then follows a specific statistical pattern called an EAT distribution, and it has something called N minus 2 degrees of freedom. Now, degrees of freedom might sound very complex, but think of it simply like this. It's about the number of independent pieces of information that go into calculating a statistic. Imagine you have a cricket team of N players, and you know the total runs scored. If you know the individual runs of N2 players, the runs of the last two players can still vary, right? But once you know one more player's score, the last one's score is fixed because you know the total. So it's about how many values in a calculation are truly free to vary after certain constraints, like an average or total, are established.
That's a helpful way to think about it. Less mysterious now.
Good. And an important point, students, is about the sample size N. As our sample size N increases, the magnitude or size of R we need to reject the null hypothesis actually becomes smaller.
Ah, so with more data, even a weaker correlation can be significant.
Exactly. This is because with more data, our test becomes more powerful. It's better at detecting a true relationship if one exists. Imagine asking more and more people their opinion about a new movie. The more people you ask, larger N, the more confident you are in your conclusion about the movie's popularity, even if the general opinion isn't super strong, maybe just slightly positive. A larger sample gives us more reliable information, reducing the chance that our observed correlation is just random noise.
That's a crucial insight. More information leads to clearer, more reliable pictures. Makes perfect sense. Let's look at a real-world example to make this concrete. Can you walk us through example 1? An analyst is examining the relationship between returns on 2 investments over 33 years. How does she use these concepts?
Certainly. Let's follow her process. Here, an analyst has collected the annual returns for investment 1 and investment 2 over 33 years, a good long period. She calculated a sample correlation R of 0.43051 between them. It's positive, But is it significantly positive? She wants to know if there's a significant positive correlation in the population, and she sets her confidence level very high at a 1% level of significance. This means she wants to be 99% certain.
Very strict test.
Yes. So step 1, state the hypotheses. Since she is specifically interested in a positive correlation, it's a one-sided test on the right side. Her null hypothesis H0 is H0. The true correlation is 0 or negative. No positive relationship. Her alternative hypothesis, Ha, is the true correlation is positive.
Their hypotheses.
Step 2, identify the appropriate test statistic. Assuming normality, it's our 8-statistic formula. T and U is R, S core T, 1 R2.
Got it.
Step 3, specify the level of significance. She chose 1% or 0.01, a very low chance of being wrong if she rejects 8-0.
Okay, 1%.
Step 4, state the decision rule. We have n equals 33 years. So degrees of freedom is n2, which is 3 d 2 equals 31. For a one-sided test, right side, at 1% significance with 31 degrees of freedom, we look up a critical value from a t-distribution table. This critical value acts as our boundary. It's 2.45282. So her rule is reject 8-0 if our calculated t is greater than 2.45282.
If it is bigger than 2.45, reject 8-0.
Step 5. Calculate the test statistics. She plugs in her numbers R equals 0.43051 and NN equals 33 into the formula. After the calculation, the result is a t-statistic of approximately 2.65568.
2.65568.
Step 6. Make a decision. Now we compare. Our calculated t is 2.65568. Our critical value is 2.45282. Is 2.65568 greater than 2.45282?
Yes, it is.
Correct. So the analyst can confidently read the null hypothesis. There is enough strong evidence, even at the strict 1% level, to conclude that the correlation between the annual returns of these two investments is indeed positive. This is a significant finding. It means these two investments tend to move together, important for managing risk in a portfolio.
Wow, that's a thorough analysis. It's clear how each step leads to a very practical conclusion for an investor. Now, let's quickly look at another practical example. Example 2. Tell us about this one, where they test the correlation of mutual funds with the S&P 500 index.
Certainly. In this example, an analyst looked at 4 different mutual funds and the S&P 500 index. The S&P 500, as you know, is a major U.S. stock market index, often used as a benchmark, like a general market scorecard. The data was based on 36 months of returns. The goal was to see if each fund's returns are correlated with the S&P 500 or perhaps with each other. This time, the analysts used a two-sided test, 8-0 versus Ha over 0, interested in any correlation, positive or negative, and they chose a 5% significance level. With n equal 36 months, our degrees of freedom, n2 is 362 equals 34. The critical t-values for a two-sided test at 5% significance with 34 degrees of freedom are OVONO 2.032.
Plus or minus 2.032 this time.
Exactly. Reject H0 if the calculated t is greater than plus 2.032 or less than minus 2.032. The analyst calculated the sample correlation R for various pairs. Let's focus on the correlation between Fund 3, a large cap value fund, and Fund 4, an emerging market fund. The sample correlation R between these two funds was found to be 0.3102. To test this, the analyst calculates the t-statistic using our formula. For Fund 3 and Fund 4, with R 0.3102 and N equals 36, the calculated t-statistic comes out to be approximately 1.903.
1.903.
Okay. Now, the analyst did this for all the pairs. What they found was interesting. For most of the pairs, the calculated t-statistics were outside the critical values of 2.032. This means most correlations were significantly different from 0. Clear relationships existed. For example, maybe Fund 1 was strongly correlated with the S&P 500.
So most funds showed a real connection.
Yes. However, for the correlation between Fund 3 and Fund 4, the calculated t-statistic was 1.903. Where does 1.903 fall relative to 12.032?
It's inside. It's between minus 2.032 and plus 2.032.
Precisely. Because 1.903 falls within the acceptance region, there was not enough evidence to reject the null hypothesis that their correlation is 0. So their correlation was not significantly different from 0 at the 5% level. This is very important. Even though the sample showed some positive correlation, R equals 0.3102, it wasn't strong enough, given the sample size, to be statistically significant. It implies these two particular funds, the large cap value and the emerging market fund, move somewhat independently, which for an investor can be a good thing for diversification, right? Their ups and downs might balance out.
Excellent point. Just seeing a number isn't enough. We need to test if it's real. So my dear students, if our calculated null statistic for a parametric test falls within the critical values between the boundaries, what does that tell us about our null hypothesis? Do we have enough evidence to say there's a relationship or not? Take a moment to think.
What do we conclude if the t is inside the critical values?
Okay, let's switch gears now.
Now, let's move on to our second type of magnifying glass, non-parametric tests. As we mentioned earlier, these are truly useful when our data doesn't quite fit the strict assumptions required for parametric tests. Remember those?
Yes, like the data needing to be normal, bell-shaped.
Exactly. So if the data is not normally distributed, or if there are significant outliers, those extreme values, or sometimes our data is already in ranks, like when we rank our preferred brands of tea from best to worst. One very popular non-parametric test for correlation is the Spearman Rank Correlation Coefficient. We denote it as RS. It's particularly useful because it doesn't assume normality, which is a big advantage with real-world financial data that's often skewed or messy.
Ranks. We all understand ranks, don't we? Like ranking students from tallest to shortest or ranking our favorite food items. This sounds much simpler than dealing with exact numbers that might be messy. So how do we calculate this Spearman rank correlation? It must be a different process since we are not using the raw numbers directly.
It's quite clever, actually. Instead of using the actual numerical values, we first convert them into ranks. That's the key. Here are the systematic steps. 1. Rank the observations. For each of your two variables, say Fund A returns and Fund B returns, you rank them independently. So for Fund A, you find the year with the highest return, give it rank 1, second highest gets rank 2, and so on. You do the exact same thing separately for Fund B's returns. Now, what if there's a tie? Maybe 2 years have the exact same return for Fund A and they are tied for third and fourth place.
What do we do then?
You give both of them the average of the ranks they would have shared. So for third and fourth, the average is 3n plus 4, 2 equals 3.5. Both tied values get rank 3.5. This keeps it fair.
Okay, average rank for ties.
2. Calculate differences. Once you have ranks for both Fund A and Fund B for each year or observation, you find the difference between their ranks. Let's call it di. Then you square that difference, di squared. We square it to get rid of negative signs and emphasize larger differences in rank.
Find the difference in ranks and square it.
3. Calculate RS. Finally, you use a special formula that sums up all those squared differences. That's the sum di2 part. The formula for the Spearman rank correlation coefficient, RS, is RS equals 1 minus 6 times the sum of d2, divided by n times n squared minus 1, where n is your sample size, number of years in this case, and sum d2 is the total sum of all those squared rank differences you calculated. This formula, while looking a bit complex, essentially converts how well the ranks agree or disagree into a correlation coefficient, just like Pearson's R. And just like R, Spearman's RS also ranges from -1 to +1.
That looks like a very systematic way to handle data that's a bit unruly. It smooths out the impact of extreme values by just considering their order. Very practical. Let's look at an example. Please guide us through the example of funds A and B in Exhibit 4. The analyst was worried about the assumptions for a parametric test, so she used Spearman's method.
Certainly. An analyst is looking at the relationship between two investment funds, Fund A and Fund B, over 35 years. She's concerned the returns data might not be normally distributed, or maybe there are outliers, issues that make Pearson's R less reliable, so she wisely chooses Spearman rank correlation. Her hypotheses are H0, RS, no correlation in ranks, versus RS A0. There is a correlation in ranks, positive or negative.
Okay, testing for correlation in ranks.
The source provides a partial table, Exhibit 4, showing how they rank the returns for Fund A and Fund B each year. It also shows the difference D between their ranks, and then it's squared. For example, in year 1, Fund A had ranked 27, Fund B had ranked 31. The difference D is 2731 equals 4, and its squared is -42 equals 16. This was repeated for all 35 years.
Okay, rank, find difference, square difference for all years.
Yes. After doing this for all 35 years, the sum of all squared values, sum D is 2, turned out to be 2,202. Now we use our formula for RS with n is 35, and sum D is 2,202. RS proves 16, 2202, 35, 352, 1. After calculating this, the Spearman rank correlation coefficient RS is found to be approximately 0.6916.
0.6916. That seems quite high and positive.
It is. It indicates a fairly strong positive relationship in the ranks of the fund's returns. Generally, if Fund A ranks highly in a given year, Fund B also tends to rank highly and vice versa. Now, is this statistically significant or just chance? For large samples, like 35 observations, usually over 30 is considered large enough, we can still use our familiar test statistic formula to test significance, but we use RS instead of RST equals RS scored and 2, 1 RS2.
We can still use the t-test for significance even with ranks.
For large samples, yes. Here n equals 35, so degrees of freedom, grilled 35.2 equals 33. For a two-tailed test, Harrow-Pias 0.6900 and 33 degrees of freedom, the critical values are MEDO 2.0345. Now we calculate the t-statistic using RS 0.691 and N equals 35.
0.505, and the critical values were 2.0345.
Correct. So is our calculated t 5.5005 outside the critical values?
Yes, definitely. 5.5 is much bigger than 2.0345.
Exactly. So we confidently reject the null hypothesis. There is sufficient statistical evidence to say that the correlation between the returns of Fund A and Fund B is significantly different from zero, even when we consider only their ranks. This is powerful. We found a significant relationship without needing the data to be perfectly normal.
That's wonderful. It means even if the actual numbers are messy, looking at ranks can reveal a clear pattern. So practical. Let's briefly look at example 3 with exchange rates to solidify this.
Good idea. In example 3, an analyst looked at exchange rate data for 5 currencies against the US dollar over 180 days. Why Spearman? Because she observed a significant departure from normality. The data wasn't bell-shaped. Some series showed skewness asymmetry. This is very common in financial data. Such non-normal data is perfect for a non-parametric test like Spearman's.
So non-normal data points to Spearman.
Generally, yes. She calculated 10 unique pairwise correlations among these 5 currencies. For example, the Spearman rank correlation between EURUSD and AUD-USD was 0.6079. Using the t-statistic formula with N180, a very large sample, this correlation gave a t-statistic of approximately 10.2144. The critical t-values for a 5% significance level with 178 degrees of freedom, 182, were N at 1.973338. After calculating all 10 t-statistics, the analyst found that all of them fell well outside these critical bounds. 10.2 is much larger than 1.97.
All of them were significant.
Yes. She concluded that all the exchange rate pair correlations were significantly different from zero at the 5% level. This really shows the power of Spearman rank correlation. Even with skewed, non-normal data, ranking allowed her to confidently establish relationships between currency movements, extremely valuable for understanding global market dynamics and managing currency risk.
So, my dear students, if you have financial data that doesn't look normal or has outliers, those unusual values, which type of correlation test would you prefer to use? Parametric like Pearson's or non-parametric like Spearman's? Which one handles messy data better?
Think about robustness to assumptions.
All right, students, we have talked about correlation for numerical data, Pearson for normal data, Spearman for ranks, or non-normal data. But what if our financial data isn't numbers at all, but categories, like classifying clothes in your shop as small, medium, large, or customers by preferred payment method, cash, card, UPI? We can't calculate a numerical correlation like R or RS for these descriptive categories. So what do we do in such situations? How do we see if categories are related?
That's an excellent question. When we have categorical or discrete data and we want to see if one classification is independent of another, meaning they don't influence each other, knowing one doesn't help predict the other, we use a different, very powerful tool called a test of independence using contingency table data. And it uses something called the chi-square test statistic. It's like Joe.
Chi-square. Okay, for categories.
Yes, imagine again you're categorizing items in your Kirana shop. You classify by product type, biscuits, rice, soap, and by shelf location, top, middle, bottom. You might want to know, is the type of product independent of its shelf location? Do biscuits just randomly end up anywhere, or do they tend to be on certain shelves? A contingency table, also called a two-way table, helps us organize this data. It shows the counts for each combination.
A contingency table. So like a grid with rows and columns, and each box shows the count for that combination.
Precisely. Look at Exhibit 7 in your material. It shows 1,594 ETFs, exchange-traded funds. These ETFs are classified based on 2 dimensions: size, small cap, medium cap, large cap, and investment type, value, growth, blend. This table shows the observed frequencies, the actual count of ETFs in each combination, like small cap value, medium cap growth, etc.
The actual observed counts.
Okay. The chi-square test then does a crucial comparison. It compares what we actually observed, the number in each box, with what we would expect. What we'd expect in each box if size and investment type were completely independent. If there were absolutely no relationship, what distribution would we expect?
Observed versus expected, assuming independence.
Exactly. If the observed numbers are very different from these expected numbers, it strongly suggests they are not independent. There is a relationship. The formula for the chi-square statistic basically sums up these differences across all cells. Chi-square exposes sum of observed expected squared expected for all cells.
Sum of squared differences scaled by expected.
Yes, and the degrees of freedom for a chi-square test on a contingency table is calculated very simply. R 1 times C1, where R is the number of rows and C is the number of columns. In our ETF example, 3 rows investment type and 3 columns size. So degrees of freedom 3, 1, tie 3, 1, 3, 2 equals 4. This number is crucial for finding the critical value later.
Okay, degrees of freedom rows 1 times cols 1. But how do we calculate these expected frequencies? Aish, that sounds like the key part. How do we figure out what we should expect if there's no relationship?
It is indeed the key. And the logic is quite simple. The expected number for any cell, assuming independence, is calculated by IJR, total for that row, total for that column, overall total.
Row total times column total divided by grand total. Okay.
Let's take the small cap value cell from the ETF example, Exhibit 7. The total for the value row is 503 ETFs. The total for the small column is 148 ETFs. The overall total of all ETFs is 1,594. So expected small cap value, 503, 148, 894, these will 46.73. If size and type were independent, we'd expect about 46.7 ETFs in this box. We do this calculation for all 9 cells, get all our expected frequencies. These are shown in Exhibit 8, Panel A.
Calculate expected for every cell.
Got it. Then for each cell, we calculate that observed expected piece for small cap value. Observed was 50, expected was 46.703. Difference, 50, 46.703 equals 3.297. Squared difference, 3.2972, divided by expected. Divided by expected equals 10.8702, 46.703 equals 0.233. We do this for all 9 cells, shown in Panel B of Exhibit 8. Finally, we sum up all these values from all the cells. For this ETF example, the total chi-square statistic is approximately 32.08025.
So the chi-square value is like a single number summarizing how much our actual data deviates from the independence expectation. A bigger value means a bigger deviation. So how do we use this 32.08 number to make our decision? What are the final steps?
First, the hypotheses. H0 null hypothesis. ETF size and investment type are independent, not related. Alternative hypothesis. ETF size and investment type are not independent. They are related. We set our level of significance, let's say 5%.
Okay, AGR is independent, House is not independent, 5% significance.
Now, the decision rule. The chi-square value is always positive. A larger value means more deviation from independence. So we only have one rejection region on the right side of the chi-square distribution. With 4 degrees of freedom, we calculated that in a 5% significance level, we look up the critical value from a chi-square table. Our critical value is 9.4877. This is our threshold. If our calculated chi-square is greater than 9.4877, we reject H0.
Reject H0 if chi-square 9.4877.
Our calculated chi-square was 32.08025. Decision. Is 32.08025 greater than 9.487?
Yes, much greater.
Correct. So we confidently reject the null hypothesis. We conclude that ETF size and investment type are related. They are not independent. There's a statistically significant connection. For investors, this means knowing an ETF's size gives you clues about its likely investment type. Useful information. We can even visualize this with a mosaic plot shown in Exhibit 10. It uses shaded boxes to show where observed counts are significantly higher or lower than expected under independence. For example, it shows medium-sized growth ETFs had more than expected observations, a strong connection, but large-sized growth ETFs had fewer than expected. It helps us see where the relationship lies, like seeing the pattern in a beautiful Rangoli.
That's very insightful. The mosaic plot helps visualize the relationship. Let's practice with another example quickly, the ESG ratings one.
Yes. Example 4. Very similar. 500 companies classified by environmental and governance ESG ratings. Progressive, average, poor. Again, a 3x3 table. The process is identical. 1. Calculate all expected frequencies assuming independence. For example, progressive governance and progressive environmental. Observed was 35. Expected was calculated to some 5580, 524.80. 2. Calculate observed expected for each cell. For that cell, it was about 4.195. 3. Sum all these values for all 9 cells. The total calculated chi-square statistic was approximately 35.74415.
35.74.
4. Degrees of freedom is, again, 3 to 1, 3 to 1, 4. But 5, the critical value at 5% significance with 4DF is still 9.487729. 6. Compare. Our calculated chi-square, 35.74415, is much greater than the critical value, 9.487729. 7. Decision. Reject the null hypothesis. Conclusion. Environmental and governance ratings are not independent. There is a statistically significant relationship between them. Companies strong in one often tend to be strong in the other.
Very clear. Same process, different context. Finally, let's quickly look at that question set from the source material about dividend payment history and financial leverage groups. Can you summarize the problem and solution?
Certainly. An analyst classifies 250 firms into two categories. First, dividend groups, 1, 2, 3, based on dividend history and forecasts. Second, financial leverage groups, 1, 2, 3, based on debt levels. Question: are these two classifications independent? Hypotheses: 8-0. Dividend and financial leverage groups are independent. They are not independent. Test statistic. Categorical data, so chi-square test, calculation. They had a table of observed frequencies. They calculated expected frequencies. For div group 1, lev group 1, observed was 40, expected was 38.4. They calculated the scaled square deviations for each cell. Conclusion: the sum of these deviations, the calculated chi-square statistic, was 46.3223. Degrees of freedom equals 4. Critical value at 5 per 7 equals 9.4877. Since 46.3223 is much larger than 9.4877, they rejected the null hypothesis. Finding: there is a relationship between a firm's dividend group and its financial leverage group. They are not independent. Useful for analysts.
Wonderful, students. Did you notice how chi-square helps us find relationships in categories, just like correlation helps us with numbers? Another powerful tool. So now, if you are classifying companies by their industry type, tech, healthcare, and their profitability category, high, medium, low, and you want to know if industry type affects profitability category, which test would you use? Pearson correlation, Spearman rank correlation, or a chi-square test of independence? Think about the type of data.
Categories versus numbers, which test fits?
Okay, let's wrap up today's session.
So, my dear students, today we have opened a very important chapter in understanding financial data, a really crucial one. We started by understanding why we need to assess relationships between variables, whether for forecasting stock prices or just managing a family budget. We learned about two big ideas: correlation for numerical data and independence for categorical data. We explored parametric tests like Pearson correlation, which work well when data is, normally distributed, and we're looking for linear links. We also learned about non-parametric tests like Spearman rank correlation, are superheroes when data is not normal, has outliers, or involves ranks. And finally, for our categorical data classifying things into groups like ETF types or ESG ratings, we discovered the power of chi-square tests with contingency tables to see if different classifications are truly independent or if they are associated. Each of these tools, whether it's a statistic or a chi-square value, helps us cut through the noise, cut through the randomness, and find the real story hidden in the numbers. Remember, knowing how to ask the right questions about data. That is the very first step towards truly understanding finance, and indeed, the complex world around us.
Absolutely. Well said. And my dear students, think about this. In today's world, we are just surrounded by so much information, so much data. It's everywhere. Whether it's deciding which investment to make for your family's future, understanding large economic trends affecting our country, or even just planning your personal finances for your child's education, or maybe buying a new house. The ability to look at two different pieces of information and objectively determine if they are truly related or if they just happen by chance, that is such a powerful and liberating skill. It moves you from just guessing, from intuition alone, to making informed, data-driven decisions. So the next time you see two things happening together, maybe the price of onions in the monsoon rains, or the success of one type of business and another, always ask yourself, is this a true relationship, or could it just be a coincidence? This simple question, backed by the solid knowledge you gained today about these tests, can truly change the way you perceive the financial world. Keep exploring, keep questioning, and keep learning. We look forward to our next deep dives with all of you. Dhanyavad.
Welcome, everyone, to another deep dive into the fascinating world of finance. Today, we're going to unpack a foundational, yet incredibly powerful tool.
Yes, absolutely. It helps us understand the hidden connections between different financial variables. Things we might feel are related, but we want to know how related.
Exactly. Have you ever wondered if a company's investment in new infrastructure, what we call capital expenditures, actually translates directly into higher profits, or return on assets, as it's known?
Or maybe, thinking bigger picture, how a country's interest rates influence its inflation levels. We need to quantify these relationships, not just guess, isn't it?
That's the goal. We're not just speculating today.
Indeed. Our mission today is to take a stack of important information, could be research reports, company data, economic numbers, and really extract the most valuable insights.
We'll be diving deep into simple linear regression. Sounds a bit technical, maybe?
A little, perhaps, but think of it like a shortcut. A shortcut to being truly well-informed about these connections. It lets us measure the strength, the direction of a relationship between two things.
And even make some educated guesses, some predictions based on that relationship.
Precisely. So let's explore this together, step by step. We'll see how it applies directly to the sometimes complex world of finance using examples you might relate to.
All right, let's unpack this. Imagine you're running a small kirana shop, yes, a local grocery store. And you notice that maybe when you spend a bit more on putting ads in the local newspaper, your monthly sales seem to go up.
You instinctively feel there's a connection there, right? You might even think, okay, more advertising should lead to more sales.
But how much more? Is it always the same increase? Is the relationship strong? Or just a coincidence sometimes? Regression analysis is the tool that helps financial analysts and even us in our everyday thinking move beyond just that feeling.
It helps us examine whether one thing, one variable, is truly useful for explaining another. It puts numbers to that feeling,
Giving us precise, measurable insights into those relationships, not just guesswork.
That's precisely it. For instance, a financial analyst might have a strong feeling and intuition that a company's earnings growth is a key driver of its stock market value.
Makes sense. No, higher earnings should mean higher value.
It makes sense intuitively, yes, but they need solid proof, empirical evidence to back that up before making investment decisions. Simple linear regression, or SLR, is our starting point for this kind of quantitative check.
And we're focusing today specifically on simple linear regression.
Correct. Simple here means we are rigorously examining the relationship between just two variables, only two. One that we want to explain.
And one that we think does the explaining.
Exactly. It's the most basic form, but don't underestimate it. It's incredibly powerful for uncovering these fundamental connections. Now, to get a bit more formal, we need some terms. The variable we are trying to explain or predict is called the dependent variable. We usually call it y.
Dependent.
Okay.
Because its value depends on other factors, right?
Precisely. Think of it as the effect or the outcome you're interested in. Now, the variable that we use to explain or predict this dependent variable is known as the independent variable. We usually call this one x.
So x is our cause, or our explainer, the thing we think influences y.
That's the idea. X influences y. So in our source material, there's a classic financial example: return on assets, or ROA, and capital expenditures, or CapEx.
Okay, ROA is how much profit a company makes from its assets, and CapEx is how much it spends on things like new factories, equipment.
Correct. In this example, ROA is the dependent variable y. We want to explain why some companies have higher ROA than others, and CapEx is the independent variable, x. We're testing the idea that maybe companies spending more on CapEx see higher ROA.
So my intelligence students, let's think about another example. Suppose we wanted to see if the number of hours you spend studying for your finance exam, let's call that X, helps explain the marks you get in the exam. Let's call that Y. Which one here would be our dependent variable Y, and which would be the independent variable X? Think about what's influencing what.
Excellent point. Once we figured out our Y and X, our dependent and independent variables, the first really useful step is often to just look at the relationship. Visualize it.
How do we do that?
We use something called a scatter plot. Some people call it a scattergram. Imagine a simple graph. One axis, maybe the vertical one, represents our dependent variable ROA, Y. The other axis, the horizontal one, represents our independent variable, CapEx.
Okay, a standard graph.
Yes. And each point on this graph represents one observation. So one dot could be company A's ROA and its CapEx. Another dot is company B's ROA and CapEx, and so on.
So you get a cloud of points.
Exactly, a cloud of points. Our source material in Exhibit 3 shows just such a plot for ROA and CapEx.
Sure.
And just by looking, you can often see a general trend.
Like in that cricket example, maybe plotting a team's total score, Y, against the number of boundaries, 4s and 6s, they hit X. You'd probably see that teams hitting more boundaries generally score higher, wouldn't you?
You probably would. And in the Rocapex plot in Exhibit 3, we can see a sort of upward slope to the points. Companies with higher CapEx generally seem to have higher ROA. This visual check is so important before we dive into calculations. It tells us if a straight line relationship even seems reasonable.
Right, because if the points look like a random mess or maybe a big curve, then trying to fit a straight line might not be the best idea from the start.
Precisely. So we have this cloud of points on our scatter plot. Now, here's where it gets really interesting, as you said. We want to draw a single straight line through this cloud that best represents the average relationship.
The line of best fit, you call it.
Yes, or the regression line. This line helps us summarize the trend. It tells us, on average, how much y changes when x changes. It simplifies potentially thousands of data points into one clear visual trend.
But there must be countless lines you could try to draw through that cloud of points.
Yeah.
How do we decide which single line is truly the best? What does best even mean here?
That's the fundamental question, isn't it? How do we define best? We use a very clever method called the least squares criterion, or more formally, ordinary least squares regression, usually just called OLS.
Ordinary least squares. Okay. How does it work?
Imagine each data point, each company's Rocapex pair, is, say, a small child standing somewhere. And our line is like a long, straight string we want to place among them. OLS tries to place this string so that the total distance from each child to the string is as small as possible.
Okay, minimize the total distance. Seems logical.
Almost. It minimizes the sum of the squared vertical distances. So for each data point, we look at the vertical distance between the point, the actual observed y value, and the line, the predicted y value from our model. This distance is the error, or residual, for that point.
And we square these errors before adding them up. Why square them?
Very important point. We square them for two main reasons. First, if we just added the distances, positive errors where the point is above the line and negative errors where the point is below the line could cancel each other out. You might get a total error of 0 even if the line is a terrible fit. Squaring makes all errors positive.
Okay. Avoids cancellation. What's the second reason?
Second, squaring gives much more weight to larger errors. A point far away from the line contributes much more to the sum of squares than a point close to the line. This forces the OLS method to work harder to avoid big mistakes. It pulls the line towards fitting the bulk of the data well, penalizing large deviations.
So it really tries to find a line that minimizes those overall squared prediction mistakes.
Exactly. It finds the unique line that makes the sum of those squared vertical distances as small as it can possibly be. That's our best fit line, according to the OLS criterion.
My dear students, let's pause here. Can anyone tell me again, why do you think we square those distances, those errors, instead of just adding them up directly? What specific problem does squaring help us solve when finding the best line?
So we have this idea now of finding the best fit line using OLS. Mathematically, we need an equation to describe this line. It's a simple equation, actually, that captures the relationship between our dependent variable y and our independent variable x. It looks like this. Y equals b0 plus b1 xi plus I.
Okay, let's break that down. Y, b0, b1, g, ge. What do they all mean?
Right. Let's take it piece by piece. Y represents the observed value of the dependent variable for the ith observation, like the ROA for the ith company. G is the value of the independent variable for that same observation, the capex for the ith company.
Okay, y and x for each specific data point. Got it. What about b0 and b1?
b0 is the intercept. This is the predicted value of y when x is exactly 0. Think of it as the starting point where our regression line crosses the vertical y-axis.
And b1?
b1 is the slope coefficient. This is usually the most interesting part. It tells us how much we expect y to change, on average, for every 1 unit change in x. So if x goes up by 1, y is expected to change by b1.
It measures the steepness of our line, the relationship strength and direction.
Exactly. It quantifies that relationship. And finally, we have sunny. This is the error term, sometimes called the disturbance term.
Ah, the leftover bit.
Precisely. It represents the difference between the actual observed value of y, i.e., and the value predicted by the true underlying linear relationship, b0 plus b1xi in the entire population. It captures all the other factors affecting y that aren't included in our simple model, plus any inherent randomness or measurement error.
Okay, let's think about that error term with an everyday example, like your monthly electricity bill, perhaps. You might predict a large part of your bill based on how many units of electricity you consumed. That's your x, the independent variable. Your prediction uses a sort of mental model, maybe like b0 plus b1x.
Right. You have a baseline cost, b0, and a cost per unit, b1.
But your actual bill, y, might be slightly different, maybe a few rupees higher or lower than your prediction. Why? Well, maybe there were small voltage fluctuations you didn't measure, or maybe a fan ran for an extra hour you forgot about. These small, unmeasured things.
They contribute to that difference between the actual bill and your predicted bill. That difference is like the error term, error coche. It's the bit our simple model, just based on units consumed, couldn't explain.
So in finance, we often just say y is regressed on x. That implies this whole equation, this whole model trying to explain y using x.
Exactly. Now, a very important distinction. We can never truly know the exact values of B0 and B1 for the entire population. Those are the true parameters. We can only estimate them using the sample data we have collected.
So we get estimates, not the perfect true values.
Correct. And we denote these estimated values with a little hat symbol on top. So B0, read as B0 hat, is our estimated intercept, and ED1, B1 hat, is our estimated slope. These are our best guesses from our sample data, calculated using that OLS method we discussed.
How are they calculated? Is it complicated?
The formulas can look a bit daunting, but the concept isn't too bad. The estimated slope, B1, is basically calculated as the sample covariance between y and x, divided by the sample variance of x.
Covariance over variance.
Think of it this way. Covariance measures how y and x tend to move together in our sample. Variance of x measures how much x varies on its own. Dividing them helps isolate the specific impact of a change in x on the change in y, removing the effect of just x's own variability.
Okay, that helps. And the intercept?
Once we have our estimated slope B1, calculating the estimated intercept is easier. We know the regression line must pass through the average point, the mean of x and the mean of y. So we just plug the sample means of y and x and our calculated B1 into the equation and solve for do.
Right. Let's make it concrete with our ROA and CapEx example from the source, Exhibit 6. They did these calculations for us.
Yes. After applying the OLS formulas to their sample data, they found an estimated slope, B1, of 1.25 and an estimated intercept of 4.875.
So the equation for their specific estimated line is?
The estimated regression model is Y 4.875 plus 1.25 SE. This equation represents the average relationship between ROA and CapEx found in their sample of companies. Y is the predicted ROA for a company with a given CapEx level, SHE.
Now remember how we talked about OLS minimizing the sum of squared distances? Those individual distances for each data point have a name, don't they?
Yes, they do. Those individual distances between the actual observed Y value, like company A's actual ROA, and the Y value predicted by our regression line, the predicted ROA for company A based on its CapEx, are called residuals. We denote them as I.
Residuals,
Well,
like the leftover.
Exactly. The part the model didn't predict. So mathematically, the residual for the ith observation is simply EI. It's the actual value minus the predicted value, is how much our model missed for that specific data point.
So if the actual ROA was 15%, but our line predicted 11%, the residual is positive 4%.
Precisely. And if the actual is 10%, but the model predicted 12%, the residual is negative 2%. That's spot on. And a fascinating property of OLS is that, by design, if you sum up all these residuals, the positive and negative ones, across your entire sample, the total will always be exactly 0.
The overpredictions and underpredictions perfectly cancel out on average.
Correct. But remember, OLS doesn't minimize the sum of residuals, that's always 0. It minimizes the sum of the squared residuals, SSE, that's the key.
And Exhibit 7 in our source actually shows these residuals for each company in the RoCapex example.
Yes, it does. For instance, it shows Company C had an actual ROA of 15.0%. Based on Company C's CapEx, our model, RO 4.875 plus 1.25 XI, predicted an ROA of 11.125%. So the residual for Company C was 15.0%, and 11.125% is that vertical distance on the scatter plot for Company C. Exactly that vertical distance. Understanding these residuals is crucial. They tell us where our model fits well, small residuals, and where it fits poorly, large residuals. Analyzing patterns in residuals is key to checking if our model is actually appropriate, which we'll discuss later.
So let's try another example. Imagine you are planning a wedding, a big family wedding. Your regression model, based on past weddings, predicted the cost for the wedding hall rental, Y would be $5,000, based on the number of guests. But the actual cost turned out to be $5,050,000. What would be the residual for this prediction? And what does a positive residual like this tell us about your model's prediction for this specific wedding hall? Was it too high or too low?
Okay, now that we have our estimated intercept, zeros, and slope, understanding what they mean is absolutely crucial for interpreting our model's findings and drawing useful conclusions. Let's delve into that interpretation. First, the intercept, 0. As we said, it's the predicted value of the dependent variable, y, when the independent variable x is exactly 0.
In our ROA example, the intercept was 4.875%. So what does that mean?
It means that, according to our model based on this sample, a company's return on assets is predicted to be 4.875% if that company undertakes 0 capital expenditures, if CapEx equals 0%.
But Is it always meaningful to talk about X being zero? Like, can a company really have absolutely zero capital expenditure?
That's a very important practical point. Sometimes X equals 0 is perfectly meaningful, example, 0 minutes of extra practice. But other times, it might be practically impossible or economically nonsensical. For example, if you regress country GDP growth, Y, on money supply, X, the intercept would represent predicted GDP growth when money supply is literally 0, which is impossible.
So we need to be careful about interpreting the intercept if X equals 0 is outside the range of our actual data or doesn't make real-world sense.
Absolutely. Always consider the context. Now, the slope, RO, is often the star of the show. It quantifies the expected change in the dependent variable, Y, for a 1-unit change in the independent variable.
That's sensitivity, right? How much Y reacts to X.
Precisely. For our ROA example, the estimated slope was 1.25. What does this 1.25 tell us?
It means if CapEx increases by 1 unit, say from 4% of assets to 5% of assets.
Yes, if CapEx increases by 1 percentage point.
Then ROA is expected to increase by 1.25 percentage points, on average.
Perfect interpretation. It shows a positive relationship. As CapEx goes up, ROA tends to go up, and it quantifies how much. If the slope had been, say, minus or 0.5, it would mean a 1-unit increase in X leads to an expected decrease of 0.5 units in Y.
So the sign, plus or blank, tells us the direction, and the number tells us the magnitude of the effect.
Exactly. This slope coefficient is often the key piece of information financial professionals are looking for.
Okay, let's try applying that. Suppose we built the model to predict how many extra runs a cricket batsman scores in a match, that's Y, based on how many extra minutes they practice batting in the nets that week, that's X, and the slope coefficient, PLIM1, came out to be 0.5. What would that tell us about the effect of practice, according to this model? If a batsman practices 1 extra minute, how many more runs would we expect them to score, on average?
Good question. Now, one final point in this section. Let's briefly touch upon the types of data we commonly use in regression analysis, because the type of data affects the questions we can answer and potential issues we need to watch out for. We mainly deal with 2 types: cross-sectional data and time series data.
Cross-sectional and time series.
Okay, cross-sectional data involves observations from many different entities, like different companies, different investment funds, different countries, all measured at the same single point in time.
Like taking a snapshot.
Exactly. For example, if we collect the price-to-earnings ratios for 100 different companies listed on the stock exchange today, that's cross-sectional data. We're comparing many different subjects at one specific moment. It helps us understand variations between entities at that time.
Okay, and time series.
Time series data involves observations collected over different time periods for the same single entity.
Like tracking one thing over time.
Precisely. For instance, tracking a single company's monthly sales figures over the last 10 years is time series data. Or tracking India's quarterly GDP growth rate over the past 20 years. We're observing how one specific thing changes over time. This helps us understand trends, cycles, and dynamics within that entity.
So they answer different kinds of questions.
Yes, both are incredibly useful in finance, but they often come with different statistical challenges. For example, time series data often has issues with observations not being independent, which we'll discuss soon. Cross-sectional data might have issues with differences between entities that aren't captured by our X variable.
Let me try an analogy. Cross-sectional data is like going to a large Indian wedding feast and taking a photo of all the different dishes laid out on the buffet table at one moment. You see the variety across dishes then. Time series data is like picking one specific dish, say the biryani, and taking notes on how its taste and texture evolve at different stages of cooking over several hours. You're following one thing through time. Both give valuable information, just different kinds, isn't it?
That's a very good analogy, actually. It captures the difference quite well.
Okay, everyone. We've learned how to build the model, how to get the equation for that best fit line. But just like building a house, having the structure up isn't enough, is it? We need to be sure the foundation is strong and stable.
Exactly. Our regression model, that equation we derived, relies on some fundamental assumptions to hold true. If these assumptions are violated, meaning if they are not met in our data, then the conclusions we draw from our model might be unreliable or even completely misleading.
Like building on shaky ground.
Yeah.
Your results might look okay on the surface, but they could be flawed underneath.
Precisely. So for our simple linear regression model to provide valid and trustworthy results, especially for making statistical inferences like hypothesis testing, we need to make 4 key assumptions about the error term and the relationship itself.
4 key assumptions. Let's list them out.
All right. First, linearity. The true underlying relationship between y and x is assumed to be linear. Second, homoscedasticity. The variance, or spread, of the error terms is constant for all observations. Third, independence. The error terms are independent of each other. And fourth, normality. The error terms are normally distributed.
Linearity, homoscedasticity, independence, normality. Okay, these sound important. How do we check if these assumptions are actually met? We can't see the true errors, can we?
That's right. We can't see the true errors, but we can see our calculated residuals, EIE, remember those.
Yeah.
The difference between actual and predicted y. We use these residuals as a proxy for the true errors.
So we analyze the residuals to check the assumptions about the error.
Exactly. We often rely heavily on residual plots, simple graphs that plot our residuals against the independent variable x or against the predicted values, or sometimes against time if it's time series data. These plots can visually reveal violations of the assumptions.
It's like looking for cracks or strange patterns in the foundation of our model using these residual plots. A very practical check.
Very practical, yes. Let's look at each assumption more closely and what happens if it's violated. First, linearity.
We are fitting a straight line, so we assume the real relationship is a straight line. Makes sense.
Yes. If the true relationship between y and x is actually curved, maybe like an exponential growth curve or an S-shaped curve common in market adoption, then forcing a straight line onto it will obviously be a poor fit.
It'll miss the mark systematically.
Exactly. Our source in Exhibit 10 shows a clear example of an S-curve relationship. A straight line fitted through it will consistently underpredict in the steep middle part and overpredict in the flatter start and end parts. This leads to biased estimates of our slope and intercept, making our model unreliable. In finance, things like the relationship between risk and return, or maybe the effect of R&D spending on future profits, might not be perfectly linear.
So what's the check using residuals?
When we plot the residuals against the independent variable, they should look completely random, like a cloud of points scattered around zero with no discernible pattern. If you see a clear pattern like the residuals forming a U-shape or an inverted U-shape or any systematic curve, that's a strong sign that the linearity assumption is violated. Exhibit 11 in the source shows exactly this. A clear curved pattern in the residuals indicating the linear model was inappropriate for that data.
My students, think about this. If we plot your savings over time, and it looks like it's growing slowly at first, then maybe very fast when you start earning well, and then maybe it slows down again as you approach retirement, sort of like a stretched S shape. Would a simple straight-line regression model truly capture that pattern of saving? Why or why not? What might the residual plot look like?
Okay, second assumption. Homoscedasticity. It's a bit of a mouthful.
Homoscedasticity. What does it mean simply?
It simply means same variance. It assumes that the spread or variability of our residuals, our prediction mistakes, is consistent across all levels of our independent variable x. Imagine your prediction errors are always roughly the same size, whether x is small or large.
So the accuracy of our prediction doesn't systematically change depending on the value of x.
Exactly. If the variance of the residuals does change, we call it heteroscedasticity. Hetero meaning different. This is a very common problem, especially in financial data.
Heteroscedasticity, different variance. Give us an example.
Sure. Our source uses an example of regressing short-term interest rates, y on inflation rates, x over 16 years, Exhibit 12. Now, imagine if halfway through that period, say after 8 years, there was a major change in central bank policy that kept interest rates artificially low, regardless of inflation.
So the relationship between inflation and interest rates might have fundamentally changed.
It might have, or at least the variability around that relationship might have changed. The model might fit differently, and the size of the errors might be different in the first 8 years compared to the last 8 years.
How would we see this in a residual plot?
If you plot the residuals against the independent variable, x or time, you might see the spread of the residuals widening or narrowing. Exhibit 13 shows this visually. The residuals are clustered tightly around zero for the first 8 years, but then they spread out much more in the second 8 years. It looks like a cone or a fan shape.
Like your predicted electricity bill is always very close to the actual bill in winter, low variability. But in summer, when usage is high and varied, your predictions are sometimes way off, high variability.
That's a good analogy. That fan shape is a classic sign of heteroscedasticity. Why is it a problem? Because it makes our standard errors incorrect, which messes up our hypothesis tests, like the t-test for the slope. We might think a variable is significant when it's not, or vice versa. There are ways to correct for this, like using robust standard errors, but first, we need to detect it.
So if our model predicts sales for small Kirana shops with very small errors, but for big shopping malls, our prediction errors are sometimes very small, but sometimes very, very huge, what assumption might our model be violating? Think about the consistency of the error spread.
All right, third assumption, independence. This one assumes that each pair of XY observations, and more specifically their error terms, are independent of each other.
Meaning one error doesn't tell us anything about the next error.
Exactly. The residual from one observation should not be correlated with the residual from another. If there is a pattern or correlation between consecutive errors, especially in time series data, it's called autocorrelation or serial correlation.
Autocorrelation.
Yeah.
Correlation with itself over time.
Yes. Think about a company's quarterly revenues regressed over many quarters, say 10 years or 40 quarters, like in Exhibit 15. Revenues often show seasonal patterns, don't they?
Oh yes, like sales booming in the festival season, maybe Q4, and being lower in Q1.
Exactly. If our simple linear model uses only a time trend, like x equals 1, 2, 3, 40, and doesn't specifically account for this seasonality, what will happen to the residuals?
The model will probably underpredict in Q4 when sales jump, giving positive residuals, and maybe overpredict in Q1, giving negative residuals.
Precisely. And this pattern will repeat year after year. So if you plot the residuals against time, Exhibit 16, you'll see a clear wave-like pattern jumping up every fourth quarter and then falling. The error in one quarter is related to the error in the previous quarters due to this uncaptured seasonality. That's autocorrelation.
Why is autocorrelation bad?
Like heteroskedasticity, it messes up our standard errors, usually making them appear smaller than they really are. This inflates our t-statistics, making us think our variables are more significant than they truly are. It leads to false conclusions about relationships. It's a very common issue in financial time series, like stock returns or inflation rates.
My smart students, think about this. If your favorite cricket team's performance in one match heavily influences their performance in the next match, maybe high confidence after a win leads to another win, or fatigue after a loss leads to another loss, then those match outcomes, and maybe the errors in predicting them, are not truly independent. What kind of problem might this create if we're trying to build a model to predict future match results based on past ones?
Okay, the final assumption, normality. This assumption requires that the regression residuals, EI, our estimates of the error terms, are normally distributed. They should follow that classic bell-shaped curve centered around 0.
The errors should be normal. Does the original data, y and x, also need to be normal?
That's a common misconception. No, the original dependent, y, and independent x variables do not necessarily need to be normally distributed for OLS to give good estimates of the slope and intercept. It's the residuals that we assume are normal primarily for the validity of our hypothesis tests, like the t-test and f-test, and confidence intervals, especially when our sample size is small.
It's about the distribution of the mistakes our model makes.
Exactly. We expect most mistakes to be small and close to 0, with fewer large mistakes symmetrically distributed. One thing that can disrupt normality is the presence of outliers, extreme values in your y or x data that are far away from the rest. These outliers can pull the regression line strongly towards them, distorting the slope and intercept and resulting in non-normal residuals. So always be aware of and investigate outliers.
But what if the residuals aren't perfectly normal? Is our model useless?
Not necessarily, especially if the sample size is large. Thanks to a wonderful statistical property called the central limit theorem, even if the underlying errors are not perfectly normal, the sampling distribution of our estimated coefficients, like 1, tends towards normality as the sample size n gets larger.
So with large financial data sets, we can often relax this normality assumption somewhat.
Yes, for large samples, often considered N30 or 40, though there's no strict rule, the results of our t-tests and f-tests are generally considered approximately valid, even if the residuals show moderate deviations from normality. But it's still good practice to check the residual distribution, your example, using a histogram or a formal test, to ensure there aren't extreme violations or influential outliers.
So to recap, we want our errors, approximated by residuals, to have a linear relationship underlying them. Constant variance, homoscedasticity, be independent, and ideally be normally distributed. And we check these mainly using residual plots. Phew, seems like a lot to check.
It is, but it's crucial for building reliable models. Skipping these checks is like not checking the foundations of your house risky.
All right, we built our model. We've carefully checked its foundation, those assumptions. Now, the big question is, how good is this house we've built? How well does our model actually fit the data? Did our chosen independent variable X really help explain our dependent variable Y?
Exactly. We need objective ways to measure the model's performance. How much explanatory power does it have? Is the relationship we found statistically meaningful, or could it just be due to random chance in our sample?
We need some scores, some metrics, right?
Precisely. To understand these measures, we first need to think about the total variation in our dependent variable. Why? Why do different companies have different ROAs? Some are high, some are low, some are average. There's a total spread, a total variation.
Okay, the overall difference in ROAs we observe.
We quantify this total variation using something called the sum of squares total, SST. It's calculated by taking each observed Y value, finding its difference from the average Y value, squaring that difference, and summing up all those squared differences. It measures the total variability of Y around its mean.
So SST is our starting point, the total puzzle we're trying to explain.
Exactly. Now, the magic of regression is that it decomposes this total variation, SST, into two parts. The part our model explains and the part it doesn't explain.
Explained and unexplained variation. Okay.
The variation in Y that is explained by our independent variable, X, through our regression line is called the sum of squares regression, SSR. It measures how much the Y values predicted by our model, Y, vary around the average Y value.
So SSR is the part of the puzzle our model solves.
Correct. And the variation in Y that remains unexplained by our model is the sum of squares error, SSE. We've already met this one. It's simply the sum of our squared residuals, EI equals EE. It's the leftover variation, the part our model couldn't explain.
The unexplained piece of the puzzle.
And here's the fundamental equation. SST equals SSR plus SSE. Total variation equals explained variation plus unexplained variation. This always holds true. Our source materials Exhibit 19 shows this breakdown quite nicely visually.
Let's look at the numbers from our ROA and CapEx example in Exhibit 20.
Okay. In that example, the total variation in ROA SST was calculated to be 239.50. Our regression model managed to explain SSR equals 191.63 of that variation. The remaining unexplained variation was SSE equals 47.88.
Then if we add them up, 191.63 plus 47.88. It's roughly 239.51. Very close.
Yeah.
Just rounding, probably.
Exactly. It shows the decomposition in action. Total, explained, plus unexplained.
Let me try another analogy. Imagine your total score in a semester for all your finance courses. That's SST. Some of that score variability is explained by factors we can measure, like how diligently you studied, how many classes you attended. That's SSR. But some of it is unexplained. Maybe you had a sudden fever during one exam, or there was an unexpected family event, or just some random luck on difficult questions. That's SSE. The total variation in scores comes from both explained and unexplained parts, isn't it?
That's a perfect analogy for understanding the SST decomposition. Now, using SSR, SSE, and SST, we can calculate specific measures of goodness of fit.
Finally, the scores for our model. What's the main one?
The most common and perhaps most intuitive measure is the coefficient of determination, universally known as R squared, or simply R2. You'll see this reported everywhere in financial analysis.
R squared. What does it tell us?
R squared tells us the percentage or proportion of the total variation in the dependent variable, Y, that is explained by the independent variable X through our regression model. It's calculated very simply as R2 equals SSR SST.
Explained variation divided by total variation. Okay.
Yeah.
What's the range for R squared?
It ranges from 0 to 1 or 0% to 100%. And R2 of 0 means our model explains absolutely none of the variation in Y, and R2 of 1, or 100%, means our model explains all of the variation in Y perfectly, which rarely happens with real-world data.
So a higher R squared means a better fit. Our X is doing a better job of explaining why.
Generally, yes. A higher R2 indicates that your independent variable accounts for a larger chunk of the variation in the dependent variable. It signifies stronger explanatory power.
What was the R squared for our ROA and CapEx example?
For that model, R2 is calculated as a 191.625, SSR 239.501, or 80.01%.
80%. That sounds quite high.
It is. In many financial contexts, explaining 80% of the variation with just one independent variable is considered a very strong fit. It suggests that CapEx is indeed a highly significant driver of ROA for the companies in that sample.
So this R squared gives us a nice, simple percentage measure of how much our model explains.
Yes. And an interesting side note for simple linear regression with only one x, R2 is exactly equal to the square of the pairwise correlation coefficient R between x and y.
Oh, really? So if we calculate the correlation between ROA and CapEx and square it,
You'll get the R2 value. In the source, the correlation R was 0.8945. If you square that, 0.8945 is 0.8945, you get 0.801 exactly R2. This only works for simple linear regression, but it confirms the strong linear association.
my bright students, let's think about R squared. If you built a model to predict your family's monthly electricity bill, Y, based on the number of people living in your household, X, and the R squared came out to be 0.75 or 75%, what does that percentage specifically tell you about how well the number of household members explains the variation in your electricity bills? Is 75% good? What about the remaining 25%?
Now, R2 tells us how much variation is explained, but doesn't directly tell us if the model is statistically significant overall. Is the relationship we found real, or just a fluke in our sample? For that, we use the F statistic.
The F statistic.
Yeah.
Another test.
Yes. It tests the overall significance of the regression model. In simple linear regression, it specifically tests the null hypothesis that the slope coefficient B1 is equal to 0.
So it tests if X has any linear explanatory power for Y at all.
Exactly. The F statistic is calculated as the ratio of the mean square regression, MSR, to the mean square error, MSE. MSR is just SSR divided by the number of independent variables, which is 1 in SLR. MSE is SSE divided by its degrees of freedom, which is N2 for SLR, where N is the sample size.
MSR over MSE. What does a high F statistic mean?
A higher F statistic indicates that the variation explained by the model, MSR, is large relative to the unexplained variation, MSE. This suggests a better overall fit and provides stronger evidence against the null hypothesis that the slope is 0. It tells us our model is likely statistically meaningful. We compare the calculated F statistic to a critical value from the F distribution to make a formal decision.
So think of the F statistic like asking that big overarching question again. Is this entire financial model with CapEx as our chosen explainer truly useful in explaining ROA, or is the apparent relationship just random chance? The F test gives us a statistical answer to that overall question.
Precisely. Now, beyond the overall model, we often want to zoom in and test the significance of individual coefficients. This brings us to hypothesis testing of individual regression coefficients, particularly the slope. We almost always want to know, is our estimated slope coefficient B1 significantly different from 0? Because if the true slope B1 could be 0, it means our independent variable X actually has no linear relationship with Y in the population.
It means X is not a useful linear predictor of Y.
Correct. To test this, we use a t statistic. The formula for the t statistic for the slope is T B1 B1.
Let's break that down. B1 is our estimated slope. B1 is the value we're hypothesizing for the true slope, usually 0, and C1 is.
C1 is the standard error of the slope estimate. It measures the precision or uncertainty around our estimate B1. A smaller standard error means a more precise estimate.
So the t statistic is basically our estimated slope, hypothesized slope, uncertainty of our estimate.
That's a great way to think about it. It tells us how many standard errors away our estimated slope is from the hypothesized value, 0. A larger t statistic in absolute value provides more evidence against the null hypothesis that the true slope is 0.
What was the t statistic for the slope in the ROCAPEX example, Exhibit 21?
The calculated t statistic for the slope, AB01 equals 1.25, was 4.00131.
Is that large? How do we know?
We compare it to critical t-values from the t-distribution table based on our chosen significance level, say 5% or 0.05, and the degrees of freedom, N2. For this small example with N6, the degrees of freedom are 4, and the critical t-values for a two-tailed test at 5% significance are roughly 2.776.
Our calculated t, 4.00131, is much larger than 2.776.
So we confidently reject the null hypothesis that the true slope is 0. There is sufficient statistical evidence to conclude that CapEx is a statistically significant explanatory variable of ROA at the 5% level. The relationship is not just a random fluke.
It's like we asked, does preparing for the family event really affect its success? And the statistical test came back saying, yes, the evidence strongly suggests your preparation makes a significant difference.
Exactly. And interestingly, as mentioned before, in simple linear regression, the t-statistic for testing if the slope is 0 happens to be mathematically identical to the t-statistic for testing if the correlation coefficient R is 0. They lead to the same conclusion.
Okay, we can test the slope. Can we also test the intercept?
Yes, we can also perform testing the intercept coefficient, B0. We might want to test if it's significantly different from 0 or from some other specific value. For the ROA example, Exhibit 24, the source tested if the intercept 4.875% was statistically greater than 3%.
Why 3%? Maybe that was some minimum expected ROA, even with zero investment.
Perhaps the source doesn't specify the reason, but it's a valid hypothesis to test. They calculated the t-statistic for this test as 0.7905. The critical t-value for this one-sided test, greater than 3% at their chosen significance level, was 2.132.
0.7905 is less than 2.132. Normally, that would mean we failed to reject the null hypothesis, wouldn't it?
That is typically the decision rule, yes. Calculated less than critical it means fail to reject. However, the source material explicitly states for Exhibit 24, reject the null hypothesis.
Oh, that seems contradictory based on the numbers provided.
It does appear inconsistent in the source's explanation versus the calculation shown. For our purpose of explaining the material, we must follow the source's stated conclusion precisely, even if it seems unusual. So, based only on the source's final stated conclusion for Exhibit 24, they concluded there is sufficient evidence that if CapEx is 0, ROA is greater than 3%. We should note this discrepancy, but adhere to the source's final word here.
Okay, good point. We report what the source concludes, even if we spot a potential inconsistency in their working. Important lesson.
Now, what if our independent variable isn't a number like CapEx, but a category, like does a company pay dividends? Yes, no. Or is an investment strategy based in India versus abroad?
How do we handle categories in regression?
We use indicator variables, which are also very commonly called dummy variables. These are variables we create that take on numerical values, usually 0 or 1, to represent the different categories.
So 1 for yes, 0 for no. Or 1 for India, 0 for abroad.
Exactly. Let's look at the source's example in Exhibit 25. They want to see if stock returns are different in months when a company announces its earnings compared to months when it doesn't.
Okay, so the dependent variable y is the monthly stock return, RET. What's the independent variable x?
They create a dummy variable called earn. Earn equals 1 if there's an earnings announcement in that month, and earn equals 0 if there is no earnings announcement.
Simple enough. 1 for announcement month, 0 for non-announcement month. Now, how do we interpret the regression coefficients, 0 and B1 in this case? RET equals 0 plus B1 earn.
This is where dummy variables are clever. Think about the two cases. Case 1, no earnings announcement, earn near 0. The equation becomes RET 0 plus B1 0 plus B1 0. So the intercept represents the predicted or average stock return for non-earnings announcement months.
Okay. The intercept is the average return when the dummy is 0. What about when earn is 1?
Case 2, earnings announcement month, earn is 1. The equation becomes RE1 plus B11 equals 0 plus B1. So the predicted return is the intercept plus the slope. This means the slope coefficient D1 represents the difference in predicted or average returns between announcement months and non-announcement months.
So B1 tells us how much more or less, if it's negative, the average return is during announcement months compared to other months.
Precisely. Exhibit 26 shows this interpretation clearly. Dummy variables are incredibly useful for comparing average outcomes between two groups within a regression framework. Analysts use this all the time to assess the impact of events, policies, or characteristics.
So my keen learners, if we used an indicator variable, let's call it new product, where 1 means yes, the company launched a major new product this year, and 0 means no, and we regress the company's sales growth, y, on this variable. Sales growth equals B0 plus B1 new product. What would the intercept B0 represent in this model? And what would the slope B1 tell us about the effect of launching a new product on sales growth?
Finally, just to be very clear on the terminology used in hypothesis testing, we have the level of significance.
Usually 5% or 0.05.
Often, yes. It's the probability threshold we set for rejecting a true null hypothesis. It's the risk we're willing to take of making a type I error, saying there's an effect when there isn't one. We choose alpha before we do the test.
Okay. And the other value we always see is the p-value.
Yes. The p-value is calculated from our data and our PES statistic, like the t-statistic or f-statistic. It represents the smallest level of significance at which we could possibly reject the null hypothesis. Think of it as the probability of observing our data or something more extreme if the null hypothesis were actually true.
So a smaller p-value means?
A smaller p-value means our observed data is very unlikely if the null hypothesis is true. Therefore, a small p-value provides strong evidence against the null hypothesis.
And the decision rule is simple, right?
Very simple. If the p-value we reject the null hypothesis. If the p-value we fail to reject the null hypothesis.
Let's look at our Rokopek slope test again. The t-statistic was 4.00131. The source says the corresponding t-value was 0.016.
Right. Since our p-value, 0.016, is less than our chosen significance level, arrow-wise 0.05, we reject the null hypothesis that the slope is 0.
It confirms our earlier conclusion based on comparing the t-statistic to the critical value. The p-value just gives us that direct probability measure.
Exactly. Many researchers prefer reporting p-values because they convey the strength of the evidence more directly than just saying reject or fail to reject at a single alpha level.
My curious learners, think of the p-value like the doubt percentage for the null hypothesis, the idea that there's no relationship. If the p-value is really tiny, like 0.0001, it means there's almost no statistical doubt. The null hypothesis looks very unlikely. But what would a very large p-value, say 0.70, suggest about our independent variable's relationship with the dependent variable? Does it support the idea of a significant link, or does it suggest any link we see is likely just random chance? Okay, fantastic. We built our model, y_0 plus box. We've checked its assumptions. We've measured how well it fits R2 and tested if the relationship is statistically significant using t-tests, f-tests, p-values. Now comes the really practical and exciting part, isn't it? Using our model to make predictions about the future.
Exactly. This is often a primary goal in finance. We want to forecast future outcomes based on the relationships we've uncovered in past data. Just like maybe predicting the final score of a cricket match based on the run rate in the first 10 overs, our regression model helps us forecast financial outcomes.
So, how do we make a prediction? Let's say we want to predict y for a new value of x that we expect to see in the future.
It's actually quite straightforward. A forecasted value for the dependent variable, y, is usually denoted as yf, y hat f for forecast. We get this by simply plugging our forecasted value for the independent variable, let's call it xf, into our estimated regression equation, yf equals 0 plus b1xf.
So just use the equation we already estimated.
Precisely. Use the intercept, b0, and slope b1 we calculated from our sample data, and plug in the specific value of xxf for which you want to make a prediction.
Let's use our ROA example again.
Oh.
ROA 4.875 plus 1.25 CapEx. If a financial analyst forecasts that a particular company's CapEx next year, XF will be 6%.
Then the predicted ROA for that company would be YF 12.875 plus 1.256.
1.25 times 6 is 7.5. So 4.875 plus 7.5 equals
12.375%. That's our point estimate, our single best guess for that company's ROA next year, based on our model and the forecasted CapEx.
Simple enough, but is that prediction guaranteed to be exactly right?
An excellent and crucial question. No, it's definitely not guaranteed. Remember, our regression line only describes the average relationship. Individual data points will always scatter around the line due to those error terms or residuals. Our model isn't perfect.
So just giving one single number, the point estimate, might be a bit misleading. It doesn't convey the uncertainty.
Exactly. It's much more informative and statistically sound to provide a prediction interval. This is a range calculated around our point estimate within which we expect the actual future value of y to fall with a certain level of confidence, commonly 95% or 99%.
Like saying, we predict the ROA will be 12.375%, but we are 95% confident the actual ROA will fall somewhere between X% and Z%.
Precisely that. It gives a realistic sense of the forecast's reliability and the inherent uncertainty involved.
What determines how wide or narrow this prediction interval is?
Several factors influence the width of the prediction interval. First, the overall fit of the model, measured by the standard error of the estimate. The C is basically the typical size of the residuals. A smaller C means the data points are generally closer to the line, our model fits better, and thus the prediction interval will be narrower.
Better model fit leads to tighter predictions. Makes sense. What else?
Second, the number of observations N used to build the model. More data generally leads to more precise estimates of the intercept and slope, which reduces the uncertainty and leads to a narrower prediction interval.
More data, more confidence. Okay.
Third, and this is very important, how far our forecasted X value, XF, is from the average of the X values, X bar, in our original sample data.
How far our prediction point is from the center of our data.
Exactly. The closer XF is to the mean of X, X bar, the narrower and more reliable the prediction interval will be. As you try to predict y for values of x that are further and further away from the average x used to build the model, i.e. as you extrapolate more, the uncertainty increases significantly and the prediction interval becomes much wider.
Exhibit 35 in the source shows this, doesn't it? The prediction band around the regression line gets wider as you move away from the average x.
Yes, it illustrates that point perfectly. Predicting within the range of your data is safer than predicting far outside it.
My keen students, let's go back to the electricity bill example. Your model predicts your bill based on usage. A single number, say the year 1000, is a point estimate. But saying your bill will likely be between 2,500 and 3,500 is a prediction interval. Now, why do you think that interval, 2,500 to 3,500, might get much wider, say 2,000 to 4,000, if you're trying to predict the bill for a month where your electricity consumption XF was unusually high or unusually low, far from your typical average monthly usage X bar? What does that widening interval tell us about our confidence when we predict under unusual circumstances?
So how is this prediction interval calculated? The formula looks like this. YF D critical SF.
Okay, YF is our point forecast. What are the other parts?
T critical is a value from the t-distribution table determined by our desired confidence level, you're around 95%, and the degrees of freedom, N2. SF is the standard error of the forecast. This SF cleverly combines the uncertainty from the model's overall fit, the sample size N, and the distance of XF from X bar.
So SF captures all the sources of prediction uncertainty.
Essentially, yes. For our ROA example, where YFF was 12.375% for XF equals 6%, the source calculates the 95% prediction interval, using the appropriate t-critical of 92.776 for N equals 6, as ranging from 2.0013% to 22.7487%.
Wow, that's a very wide range.
Yeah.
2.0% ROA, 22.7%.
It is quite wide, partly due to the very small sample size N6 in this illustrative example. With more data, the interval would likely be narrower, but it correctly reflects the significant uncertainty in predicting a single company's ROA. It tells us that while 12.375% is our best single guess, the actual ROA could realistically be much lower or much higher. This is much more useful for decision-making than just the single point estimate.
So far, everyone, we've been working under the big assumption that the relationship between y and x is best represented by a straight line. Our first assumption was linearity, wasn't it?
Yes, it was. We assumed u plus WO plus B1 both sides describes the true relationship.
But in the real world, especially in finance and economics, things aren't always so straightforward, are they? Relationships can be curved.
Absolutely. Think about how a company's revenue might grow over its entire life cycle. In the beginning, maybe growth is slow. Then, as its products gain popularity, growth might accelerate very rapidly. But eventually, as the market becomes saturated or competitors emerge, that growth might slow down again.
It sounds like an S-shaped curve, maybe. Definitely not a straight line. Trying to fit a straight line to that would miss the story completely.
Exactly. A simple straight line just won't cut it in such cases. Our source in Exhibit 38 shows an example of exactly this company revenues over time that clearly follow a curve, not a straight line. If you try to force a linear model, y equals b0 plus b1 time, it will systematically underpredict during the rapid growth phase and overpredict during the slow phases. The fit will be poor.
So if the relationship isn't linear, do we have to throw away our simple linear regression framework? We need completely different, complicated methods.
Fortunately, not always. This is where a clever technique comes in. We can often still use the machinery of simple linear regression by first transforming one or both of our variables, y and x.
Transforming them.
A very common and powerful transformation is using the natural logarithm, ln. Taking the log of a variable can often linearize a relationship that is inherently curved. For example, if something is growing at a constant percentage rate, its logarithm will grow linearly.
Ah, logarithms turn multiplicative changes into additive changes, right?
That's the key idea. By transforming the variables, we might be able to make the relationship between the transformed variables linear, allowing us to use our familiar OLS regression. We'll look at 3 common functional forms that use logarithms. The first common functional form using logs is the log-ln model. Here, the dependent variable y is transformed into its natural logarithm, ln y, but the independent variable x remains in its original linear form, so the equation looks like ln y equals b0 plus b1x.
Log y on the left, linear x on the right. Log-ln. How does the interpretation change here, especially for the slope, b1?
The slope coefficient, b1, now tells us the approximate relative or percentage change in y for a 1-unit absolute change in x. Specifically, a 1-unit increase in x is associated with an approximate b1 100% change in y.
So b1 gives a percentage change now. That's useful for growth rates.
Exactly. It's very useful for modeling exponential growth or decay. Let's look at Exhibit 39 in our source. They took the curved revenue data from Exhibit 38 and regressed the natural log of revenue, LN revenue, on time X.
And what happened? Did the fit improve?
Dramatically.
Wow.
Visually, you can see the straight line now fits the transformed log data points much, much better, and the R2 value jumped significantly. In the original linear model, Exhibit 38, R2 might have been low, but in the logline model, Exhibit 39, it jumped to 0.9808.
98%. That's a huge improvement. It means time explains 98% of the variation in the log of revenue.
Yes, indicating this logline functional form is a much better representation of the company's growth pattern than the simple linear model.
My sharp students, think about this. Transforming a variable using a logarithm is like changing our perspective. Instead of looking at absolute changes, like your savings increasing by 10,000ers, we look at percentage changes, like your savings growing by 10%. So in what kind of financial scenarios do you think it might be more insightful to describe relationships using percentage changes rather than absolute rupee or dollar amounts, maybe when comparing investments of different sizes?
Okay, the second common form is the lin-log model. Here we flip it. The dependent variable, y, remains linear, but the independent variable x is transformed into its natural logarithm, lnx. The equation is y equals b0 plus b1 ln x.
Linear y, log x, ln log. What does the slope b1 mean now?
The slope b1 here tells us the approximate absolute change in y for relative or percentage change in x. Specifically, if x increases by 1%, y is expected to change by approximately b1 100 units.
Absolute change in y for a percentage change in x. When might this be useful?
This model is often useful when the impact of x on y diminishes as x gets larger. Think about advertising again. Maybe the first 1% increase in advertising budget gives a large boost to sales, Y, but the next 1% increase from a much higher base gives a smaller absolute boost.
The effect flattens out.
Exactly. Our source provides an example comparing fitting operating profit margin Y against unit sales, X. In Exhibit 40, they use a simple linear model Y on X, and the R2 is 55.10%. Decent, but not great.
Okay. What happens in Exhibit 41?
In Exhibit 41, they use the lin-log model, regressing profit margin Y on the natural log of unit sales, lnx. R2 jumps dramatically from 55.9% to 97.17%.
Wow. Another huge improvement just by taking the log of the independent variable.
Yes, it clearly shows that the relationship between profit margin and the log of unit sales is much closer to linear than the relationship with unit sales itself. The lin-log model was much more appropriate here. And the third common form is the log-log model. As the name suggests, here both the dependent y and independent x variables are transformed using the natural logarithm. This is also sometimes called the double log model. The equation is ln y equals b0 plus b1 ln x.
Log y on the left, log x on the right, log. This seems useful for.
This model is particularly powerful in economics and finance for estimating elasticities. An elasticity measures the percentage change in one variable resulting from a 1% change in another variable.
Like price elasticity of demand, the percentage change in quantity demanded for a 1% change in price.
Exactly. In a log-log model, the slope coefficient B1 directly estimates this elasticity. So B1 tells you the approximate percentage change in Y for a 1% change in X. It's incredibly convenient for elasticity calculations.
Let's see the example from the source, Exhibit 42 versus 43.
Right. They regress company revenues, Y, on advertising spending. First, using a simple linear model, Y on X, in Exhibit 42, the R2 was very low, only 20.89%. Advertising spending didn't seem to explain much of the revenue variation linearly.
Okay. Then they try the log model.
Yes. In Exhibit 43, they regressed LN revenues on LN advertising spending. Look what happened to the R2. It jumped more than 4 times, from 20.89% to 84.91%.
Amazing. And the F statistic also jumped hugely, indicating a much more significant model.
Absolutely. The log-log transformation dramatically improved the model's fit, suggesting that the relationship between the percentage change in advertising and the percentage change in revenue is much stronger and more stable than the linear relationship between their levels. The slope, B1, in Exhibit 43, would directly estimate the advertising elasticity of revenue.
So we have these different options: linear, log-lin, log, log. How do we choose the best functional form for our specific data and research question? This seems like a critical decision.
It is a critical decision. There's no single magic rule, but we use a combination of theory, visual inspection, and statistical measures. First, think about the underlying theory. Does economic or financial theory suggest a relationship in levels, growth rates, or elasticities? That can guide your initial choice. Second, always look at the scatter plot of your original y and x. Does it look roughly linear, or does it show a clear curve? Visual inspection is key.
And if it looks curved, we should definitely consider transformations.
Yes. Then, after fitting different potential models, linear and maybe one or more log forms, we compare their goodness of fit measures.
Like R-squared, F-statistic, and that standard error of estimates.
Exactly. We generally prefer the model with a higher R2, meaning it explains more variation, and a higher F-statistic, meaning it's more statistically significant overall. We also prefer a model with a smaller standard error of the estimate, as this indicates the predictions are, on average, closer to the actual values.
So compare the stats, but you mentioned something else being crucial.
Yes, perhaps the most crucial diagnostic check is to examine the patterns in the residuals for each model you fit. Whichever functional form you choose, you want the residuals from that model to look random. No curves, no fan shapes, no systematic patterns when plotted against the predicted values or the independent variable.
Back to the residual plots again. They tell us if the assumptions are met for the chosen model form.
Precisely. If the residuals from, say, your log-log model look randomly scattered around 0, like in Exhibit 44 in the source, while the residuals from your linear model showed a clear curve, that's strong evidence that the log-log model is the better functional form for your data. Statistical software makes generating these plots very easy.
My dear students, let's put this together. If your initial simple linear model, y on x, gives a very low R-squared, say only 10%, and when you plot its residuals against x, you see a clear curved pattern, like a U shape. What should be your very next logical step in trying to improve your model? What kind of transformations might you immediately consider trying, based on what we've just discussed? Hashtag my own outro. Everyone, what a comprehensive and, I hope, insightful deep dive we've had today. We really covered a lot of ground, didn't we?
We certainly did. We started right from the basics, understanding how one variable might help explain another, identifying those crucial dependent and independent variables.
Then we moved into building the model itself, finding that best fit line using ordinary least squares, and understanding the meaning of the intercept, and very importantly, the slope.
And we didn't stop there. We spent significant time on the crucial step of checking the model's foundation, those key assumptions. Linearity, homoscedasticity, independence, and normality. Remembering to check these is so important for reliable results.
Absolutely. Then we learned how to measure how good our model is using R-squared to see how much it explains, the F-statistic for overall significance, and t-tests and p-values to check individual coefficients.
And finally, we saw how to use the model for its practical purpose, making predictions. Not just single-point estimates, but also those more realistic prediction intervals that account for uncertainty. We even touched upon how to handle nonlinear relationships using transformations like logarithms.
We've seen how powerful even this simple linear regression tool can be. From understanding the link between a company's capital spending and its profitability, right through to modeling more complex curved relationships in finance.
Indeed. The ability to quantify these relationships, to move beyond just intuition and actually measure the strength and direction of effects, and then to make data-driven, reliable predictions. This is truly invaluable in the world of finance and investment.
So the next time you read a financial news report, or hear an analyst talk about the correlation between two market factors, or the impact of interest rates on stock prices, you'll have a much better understanding of the kind of analysis that likely lies behind those statements.
You'll understand the thought process, the importance of the underlying assumptions, and the crucial checks that need to be performed to draw valid conclusions. You can ask yourself, how strong was that R-squared? Were the residuals checked? How wide might the prediction interval actually be?
You'll be able to engage with financial information much more critically and intelligently.
And remember, this journey into simple linear regression is really just the first step. It's a fundamental building block for understanding much more advanced statistical techniques used in finance. Keep exploring, keep learning, and always, always keep asking those important why and how questions when you encounter data.
Knowledge is most valuable when it's not just memorized, but truly understood and then applied, isn't it? Perhaps you could even try a fun little project. Maybe try to build a simple model to predict something you're interested in, like the final score of the next big cricket match based on the score after 10 overs, or maybe even your own monthly expenses based on some factor.
That's a great idea. Always be curious, my dear students. Continue to build your strong foundations in finance piece by piece. Thank you for joining us today.
Yes, thank you all. We look forward to our next deep dive together.
Namaste, my dear students. Welcome to another fascinating deep dive. Today, we have a very special session planned for all of you.
Yes, indeed. We're going to explore something truly amazing.
We are. It's all about how technology is, well, really changing the world of money, finance, and even our everyday lives here in India.
It truly is remarkable.
You see, finance and technology, they are coming together in ways we couldn't have imagined even just a few years ago. It's a bit like when we first started getting mobile phones, remember that? How it changed everything for us.
Oh, absolutely. From talking to family far away, clicking pictures,
Yeah.
everything changed.
Exactly. Well, what we're going to discuss today is, I think, even bigger and more impactful in some ways.
Absolutely. And we, your teachers, promise we'll go slowly, step by step, just like we would in our classroom back home.
Yes, no rushing.
Our goal is for each of you to feel, well-informed and confident about these exciting topics.
We'll use simple examples, things from our everyday Indian life, to make sure these important concepts really stick with you.
That's the plan. Make them easy to understand and remember. Today, we're diving into a wonderful collection of insights from well-known experts like Robert Kissel and Barbara J. Mack.
They've done some excellent work explaining these new developments in finance.
They have. So let's begin our exploration together, shall we?
Okay, let's begin our deep dive. Our first big word for today is fintech.
Ah, fintech.
What exactly is this fintech that everyone seems to be talking about? Let's break it down.
Good place to start.
So, my dear students, fintech is simply a combination of two words, finance and technology.
Finance plus technology. Simple as that.
It refers to any innovation, really, any new idea in financial services that uses new or emerging technology. Think of it as using clever new technological tools to, well, design and deliver financial services and products.
And this often makes these services more efficient, right? Faster, maybe.
Exactly. More convenient or even more accessible to everyone, not just a select few.
That's important. Accessibility.
And when we say fintech, we also often mean the companies themselves, the companies that are developing these amazing new technologies and finding new ways to apply them in the world of money.
Right, the innovators.
These innovations are really challenging the traditional ways that big banks and financial institutions have been working for many, many decades. They're changing the very landscape of how we handle our money.
They certainly are.
Let's take a simple example, something from our daily lives. Think about your electricity bill.
Yes. The electricity bill.
Earlier, many of us, or perhaps our parents and grandparents, would stand in long queues at the payment counter, right? Waiting for your turn.
Oh, I remember those days. Handing over the cash or a check.
Exactly. But now, many of us pay it instantly using an app on our phone, maybe Google Pay or Phone Pay, or through online banking portals.
Just a few clicks. So much easier.
That online payment system, that digital and convenient way of doing things in finance, that's a simple example of fintech in action.
Perfect example. It saves so much time and effort.
It really does. So, my dear students, can you think of another example, maybe something you or your family uses, where technology has made handling money easier here in India? Just take a moment to think.
That's a wonderful way to explain it, making it so relatable. And to add to that, the evolution of fintech has been quite fascinating to watch.
It really has.
In the very beginning, fintech was quite basic, much simpler than what we see today.
Right, not like these complex apps we have now.
No, not at all. It was primarily about processing data and automating routine tasks within banks.
Okay.
Imagine it like this. In the early days, fintech was like a simple calculator that helped the shopkeeper at your local Kirana store add up his daily sales quickly.
Useful, definitely useful for counting things up.
Useful, no doubt, for quickly totaling up numbers or for automating repetitive tasks, like a bank's computer system automatically calculating the interest on thousands of savings accounts every month. But its functionality was, well, quite basic.
Just doing the simple math faster.
Precisely. However, my dear students, fintech has advanced tremendously over the years. We've moved far, far beyond just simple automation.
Right. It's much smarter now.
Much smarter. Now, it involves very sophisticated decision-making applications based on what we call complex machine learning logic.
Machine learning logic.
Okay.
This means that computer programs are actually able to learn how to complete tasks over time without us having to explicitly program every single step for them.
So they learn from experience, like we do.
In a way, yes. So now it's like that same Kirana shop calculator, not just adding up sales, but also maybe predicting how much sugar you will sell next month based on past sales records, understanding customer behavior, and even considering external factors like the weather.
That's amazing, doing things that needed a human brain before.
Exactly. And often it does them even better and faster. This amazing advancement has truly transformed the financial services industry in countless ways.
I can see that.
It has given rise to new and efficient systems for things like giving personalized investment advice.
Helping people plan their finances for big life events like a wedding or buying a home.
Very important in India.
Very important.
Yeah.
Making it easier for small businesses to get loans. And of course, completely revolutionizing how we make payments, just like that electricity bill example you heard.
Right.
And a really key area where fintech has had a very significant impact is in the analysis of very, very large collections of data.
Ah, the data. That's fascinating. So if we want to understand how computers can learn and do all these amazing smart things, we must first understand this concept of big data.
Exactly. It's the fuel.
It's the fuel that powers these intelligent systems.
Indeed. Big data refers to the vast, truly enormous amount of information that is generated constantly.
Constantly.
By industries, governments, individuals like you and me, and all the electronic devices around us. Think about it.
Every click, every search.
Every online transaction you make, every search query you type into Google, every photo you upload to social media, every sensor reading from a factory, or even the data from your smartwatch. It all creates data.
So much data.
This big data includes information from traditional sources, which are the ones we've historically relied on.
Okay, the usual places.
The usual places. Things like stock exchanges, giving us security prices, say for Reliance or TCS shares, and trading volumes, company reports detailing sales figures and earnings, and government economic figures like trade statistics or employment numbers. These are like the official records we've always kept.
Got it. The formal stuff.
But then, my dear students, there's also a rapidly growing category called non-traditional or alternative data.
Alternative data.
This is information that arises from the everyday use of electronic devices, social media platforms, sensor networks, and even what we call company exhaust.
Company exhaust? What's that?
It's just information generated in the normal course of doing business, like supply chain details or sales records. Not the official reports, but the daily operational data.
I see. The behind-the-scenes data.
Exactly. Imagine trying to keep track of every single cricket score, every ball bowled, every run scored from every single match played in India over the last 50 years.
That would be a huge amount of information.
Enormous, isn't it? Now, if you add player statistics, weather conditions during each match, fan sentiment expressed on social media during live games, and even how many people are watching on different streaming platforms.
Wow, it just gets bigger and bigger.
It becomes truly massive. That's the idea behind big data. It's not just big, it's overwhelmingly large and complex.
Excellent point. Now, to truly understand big data, we often talk about its 3 V's.
The 3 V's, yes. Very important.
Some experts even add a 4th V, which we will discuss in just a moment. But let's start with the original 3, my dear students.
Okay.
The first V is volume. This refers to the sheer amount of data we are collecting.
The quantity.
The quantity. We're talking about millions, even billions of data points being collected every second. It's not just a little bit of data, it's a colossal quantity.
Hard to even imagine sometimes.
Think of it like this. If you used to save your family photos in small physical albums, maybe a few hundred pictures neatly placed.
Yes, the old way.
Now imagine saving every single photo ever taken in India in one giant digital vault. From megabytes, we move to gigabytes, then terabytes, and now even petabytes. The amount of data is just growing bigger and bigger, exploding every single day.
It's an explosion, truly.
So, my dear students, in your own words, just take a second. What does volume mean when we talk about big data? Think about that sheer size.
Good question to pause on.
The second V is velocity. This describes the speed and frequency at which data is collected and transmitted.
How fast it comes in.
Exactly. In today's world, data that is processed in real time or near real time has become the normal expectation in many areas.
We expect things instantly now.
We do. This is like knowing the cricket score of a match happening right now, live, ball by ball, possibly even seeing the replay milliseconds after it happens, versus reading about it in tomorrow's newspaper. The speed of information flow has increased tremendously.
Huge difference.
Financial markets, for example, rely on data that updates in fractions of a second so traders can make quick decisions. This high speed is crucial.
Absolutely critical in finance.
And the third V is variety. This means that data comes from many different sources and in various formats.
Not all the same type.
Not at all. It's not all neatly organized in one place or in one simple way. Imagine collecting not just the cricket scores from a match,
Okay.
but also recordings of the live commentary, photos of the players in action, millions of social media comments about the match from fans all over the world, and even sensor data from the stadium pitch itself.
How much moisture is in the ground?
Exactly.
Yeah.
Or the wind speed. Data can be structured like a neat table of scores with rows and columns that fit perfectly into a database. Organized. It can be semi-structured, like a web page, which has some organization but isn't as rigid as a table. Or it can be completely unstructured, like a video recording of the match or a voice message from a fan expressing their excitement.
Photos, videos, voice notes.
Yeah.
All sorts. All sorts. So my dear students, when we talk about big data, what do we mean by variety? Think about all those different types of information. Very well explained, those 3 V's: volume, velocity, variety. You've grasped the core ideas, my dear students.
Good.
Now, when we use this big data for making important predictions, for example, predicting how a stock like TCS might perform in the market, or how a business trend might evolve.
Okay, the important decisions.
Yes, we must think about a very important 4th V, veracity.
Veracity. Okay, what's that?
Veracity refers to the credibility, accuracy, and reliability of data sources. It's about how trustworthy and correct the data is.
So can we trust the data? Is it true?
Exactly. This is crucial. Imagine you hear a rumor that a new Kirana shop is open nearby, selling everything much cheaper than usual.
Sounds good.
Sounds good. But before you believe it completely and rush there, you would naturally want to confirm if the rumor is true, wouldn't you?
Of course. I'd ask someone, check if the shop really exists.
Precisely. You'd check if the source of the information is trustworthy and accurate. That's veracity, making sure the data is reliable and not misleading.
Okay, that makes sense. Trustworthiness.
This challenge of veracity becomes critically important for big data because, as we discussed, these large data sets come from so many varied and diverse sources.
Right, from everywhere.
It amplifies the age-old challenge of trying to separate quality information from sheer quantity. With traditional structured data, like official company reports, it's often easier to verify its source and accuracy.
You know where it came from.
Yes, but with alternative, unstructured data, which can come from social media, random websites, or even sensor readings that might be faulty or incomplete.
Much harder to check.
Much harder. Ensuring veracity becomes a much bigger and more complex task. We need to be careful not to make important financial decisions based on unreliable information. Otherwise, the results could be quite problematic.
That's a very important point, especially today with so much, misinformation sometimes floating around. Now, let's dive a little deeper into where all this big data comes from. Let's use examples that might feel closer to home for you, my dear students, just to illustrate how vast and diverse these sources really are.
Good idea. Let's ground it.
First, we have data from financial markets. This is data from stock exchanges, like the Bombay Stock Exchange or National Stock Exchange. Share prices of companies like Reliance or TCS.
The big names.
Yes. Trading volumes, how many shares are bought and sold, and the live bids and offers. This is like the scoreboards at the stock exchange, constantly updating every second, telling us the live performance.
Helping investors make quick decisions.
Right. This is traditional structured data, but the sheer volume and velocity make it a major source of big data.
Definitely big.
Then there's data from businesses. This includes corporate reports like the annual financial statements of big companies, sales figures from large retail chains like Big Bazaar.
When they were around, yes. Or Reliance Retail now.
Yeah, right. Or even details of individual credit card purchases you or your family make. This is like your local shop owner meticulously keeping track of all his daily sales and expenses in his ledger book.
But on a massive scale.
Exactly. On a much, much larger scale for huge corporations. This data helps investors understand how well businesses are doing, not just overall, but in fine detail.
Getting the inside picture almost.
Our governments also generate a lot of big data. This includes data on trade between states or countries, the overall economy of India, and employment figures across different sectors.
Important national statistics.
Imagine our government collecting data on how many people are employed across different states, how much goods are being traded across borders, or how prices of common goods like onions or tomatoes are changing.
This helps them make important policy decisions.
Yes, and helps economists understand the big picture of the nation's health. Next, there's data generated by individuals like you and me. Every time you use your debit card or write a product review online for something you bought on Flipkart or Amazon.
Or post on Instagram or Facebook.
Exactly. Or even perform an internet search for a new recipe, say for paneer tikka. You are generating data.
We're all data creators now.
We are. Every time you like a post on Instagram about a new clothing brand or search for that recipe, you are contributing to this massive pool of individual data. This data, collected in large quantities, gives very valuable insights into consumer behavior, preferences, and even market trends.
What people like, what they're interested in.
Precisely. We also get data from sensors. These are devices that collect information about the physical world around us.
Things measuring the real world.
Right. This includes satellite imagery, which can show us things like traffic patterns on our busy roads, or even how many cars are in a shopping mall parking lot.
Which can tell us if a shop is doing well, maybe.
It could hint at it. If the parking lot is always full, it suggests the shop is attracting customers. There are also RFID readers used in inventory management in warehouses, or smart traffic lights that collect data to manage traffic flow in cities like Mumbai or Delhi.
Satellites can even show crop growth, right? For agriculture.
Yes, exactly. Showing the growth of crops in different agricultural regions, which is important for predicting food supply and prices.
Very useful.
And finally, a very important and growing source is the Internet of Things, or IoT.
IoT. We hear this term a lot, too.
Yes. This refers to data from smart devices and interconnected physical objects. Imagine your smart home in India if it were to track how much electricity you use.
Or if you left a light on accidentally.
Or how frequently you use your smart appliances, like a smart refrigerator or AC. It's a constant stream of information from everyday objects that are embedded with electronics and sensors and connected to the internet.
Making our homes and cities smarter.
Yes, this data helps in managing resources efficiently and understanding usage patterns at a very detailed level.
That's a fantastic overview of the diverse sources, and it's important to understand the distinctions, especially with these alternative data sources.
Right, the non-traditional ones.
Yes. We generally categorize them into three main areas, as you just touched upon. Data generated by individuals, data generated by business processes, and data generated by sensors. These alternative sources are becoming increasingly important for investment professionals looking for an edge.
So let's look at those three again.
Okay. Data generated by individuals includes information in various formats like text, video, photo, and audio. It also comes from actions like website clicks, the time you spend on a web page, or even your personal data shared through web searches and emails.
Mostly unstructured, right? Messy data.
Yes, this type of data tends to be unstructured, meaning it doesn't fit neatly into traditional rows and columns in a database. And the volume is growing dramatically because people are participating in online activities more frequently, e-commerce, online reviews, social media.
Every tweet, every blog post.
Exactly. All contribute to this massive data set that can reveal collective sentiment or emerging trends.
Okay, that's individuals. What's next?
Next, we have business process data. This involves information flows from corporations and other public entities. Unlike data from individuals, this tends to be structured data.
More organized.
More organized. It includes direct sales information, such as credit card transaction data, what was purchased when and where. It also includes that corporate exhaust we mentioned.
The byproduct information.
Right. Internal operational data from a factory, customer relationship management, CRM, system logs showing interactions, supply chain tracking data, or retail point of sale, POS, scanner data from every item sold in a supermarket.
Like the daily sales report from a big chain?
Precisely. It's structured, precise, and can tell you if a new product is selling well right now, not just after the quarterly report comes out. This near real-time data can be a leading indicator, unlike traditional metrics, which often lag behind.
So it gives a faster signal.
A much faster signal. And finally, sensor data. This comes from smartphones, cameras, RFID chips, satellites usually connected wirelessly.
Mostly unstructured, too.
Yes, can be largely unstructured, and its volume is often many, many times greater than data from individuals or business processes. It's growing exponentially because tiny microprocessors and networking technology are increasingly embedded everywhere.
In our phones, cars, on the roads.
Exactly. Think of road cameras monitoring traffic, sensors in your modern car giving real-time info about tire pressure or engine health. This data, in huge amounts, gives deep insights into physical activities. And when you connect buildings, homes, vehicles, all with sensors, you get the Internet of Things, this vast network sharing information.
Individuals, business processes, sensors.
Got it.
Got it.
These three sources truly represent the frontier of alternative data that investment professionals are now using to find those hidden insights.
That truly helps us visualize these sources much better and understand just how much data is out there. Now, collecting so much data sounds incredibly powerful.
It does.
But it also comes with its own challenges, doesn't it? It's like managing a very big family event, maybe a large Indian wedding.
Huh. Yes, that's a good analogy. Lots to manage.
You have hundreds or thousands of guests, ensure everything runs smoothly, deal with unexpected situations. Big data has its own management issues.
Very true.
One of the biggest challenges is quality. We need to ask, does the data have selection bias?
Meaning, is it representing the whole picture fairly?
Right. Is there missing data? Are there outliers, those strange, unusual data points that might skew the results? Imagine you're trying to figure out the average height of students in a class, but you only measure the tallest students who sit in the front row. That's selection bias. Your average will be much higher than the actual class average, giving you a wrong picture.
Misleading.
Or what if some students didn't provide their height at all? That's missing data. We need clean, unbiased, and complete data to get the right picture.
Otherwise, our conclusions will be flawed.
And any financial decisions based on them could be flawed too. Then there's the challenge of volume and appropriateness.
Is it the right data?
Exactly. Is there truly enough data for the specific analysis we want to do? Or maybe there's too much irrelevant data, just adding noise and confusion.
More isn't always better if it's the wrong kind.
Right. Sometimes, even with massive amounts of data, it might not be the right kind for our analysis, or it might just be too overwhelming to manage effectively.
You can drown in data.
You can. And most importantly, my dear students, before any analysis can happen, this raw, vast data needs to be sourced, cleansed, and organized.
A preparation step. Crucial.
This cleaning and organizing process can be extremely difficult, especially for that unstructured alternative data, texts, photos, videos, which are often qualitative, descriptive, not neat numbers.
Very time-consuming.
It's just like cleaning up after that big wedding. Hundreds of plates to wash, decorations to pack, gifts to sort. It can be a huge, messy task.
Unnecessary chore.
Absolutely essential before you can make any sense of it and derive meaningful insights for smart financial decisions. These challenges, my dear students, they lead us directly to the need for powerful new tools.
Exactly. Tools like artificial intelligence and machine learning.
Yes.
Precisely. Given the immense size, sheer volume, and complexity of these alternative datasets, traditional analytical methods often just fall short. They can't cope effectively.
They weren't designed for this scale.
No.
Yeah.
So to address this very challenge, advanced techniques like artificial intelligence or AI and machine learning or ML have emerged. They're specifically designed to support work on such large and complex sources of information.
Helping us manage and understand.
Helping us to not just store and clean, but also understand and predict using big data.
So how do we make sense of all this big data and overcome its challenges? This is where artificial intelligence, or AI, comes in, my dear student.
AI, another big term.
Yes. Artificial intelligence, or AI, refers to computer systems that are capable of performing tasks that traditionally required human intelligence.
Tasks that need thinking, reasoning.
Exactly. And what's truly remarkable is that sometimes these AI systems can perform these tasks at levels comparable to or even superior to human beings, and often much faster.
Faster and sometimes more accurate.
Remember how we learned about expert systems in computers, which could follow if-then rules to solve specific problems, like a diagnostic tool?
Yes, I remember those. Early AI.
That was an early form of AI designed to simulate human expert knowledge. But now, AI is far more advanced. It's capable of learning.
The learning aspect is key.
Think of your virtual assistant on your phone, like Google Assistant or Siri. When you ask it a question, what's the weather like in Delhi? It understands your voice, processes your query, and gives you an answer. That's AI at work, performing a task that needs human intelligence, like understanding language and retrieving information.
Making technology feel smart.
Yes, it makes our lives easier every day.
Building on AI, we have machine learning, or ML. This is a very exciting part, as it shows how computers can truly learn.
Okay, ML, how does it work?
Machine learning involves computer-based techniques that aim to extract knowledge, patterns, and insights from large amounts of data, without us, the humans, having to explicitly pre-program every single assumption or rule.
So we don't tell it exactly what to look for.
Not always, no. The core goal of ML algorithms is quite simple to understand, though the tech is complex. They aim to find the pattern, apply the pattern.
Find the pattern, apply the pattern. Okay.
They learn from known examples in the data and then use that learning to generate structure or make predictions on new, unseen data.
Like learning from examples.
Exactly. Imagine you are teaching a child to identify different types of fruits. You show them many pictures of apples, bananas, and mangoes. You point to an apple and say, this is an apple.
Okay, showing examples.
After seeing many examples, the child learns what an apple looks like, right? Even if they then see a new apple they've never seen before or an apple from a different angle.
They recognize it's still an apple.
That's exactly what ML algorithms do. They learn from examples in the data. They're given inputs, which are variables or data sets, and sometimes outputs, which are the target data or labels, like apple.
Input and sometimes the answer.
Right. The algorithm then learns from this provided data, how best to model the relationships between inputs and outputs, or how to identify underlying data structure if no outputs are given. This training occurs as the algorithm continually identifies relationships and refines its learning.
It adjusts itself based on the data.
Yes. So if you feed the computer thousands of pictures of dog inputs and tell it this is a dog, output label, it will learn to identify a dog on its own. It's like a student learning from many solved examples to solve new problems.
And then using that knowledge for new questions.
Precisely. And for ML to be truly effective, my dear students, it requires massive amounts of data for this training process.
That's where big data comes back in.
Exactly. Historically, many ML techniques existed, but they were limited because there just wasn't enough data available. But with the recent explosion in big data, these algorithms now have sufficient data to significantly improve their modeling and predictive accuracy,
Making them practical now.
making their broader use now possible in fields like finance, healthcare, and many others.
Okay, so data is crucial for training.
Crucial. And an important part of machine learning involves how we prepare the data for the algorithm to learn from. We typically split the entire data set into three distinct subsets:
3 parts.
a training data set, a validation data set, and a test data set. This is very much like preparing for your crucial board exams, students.
Ah, an exam analogy. Good.
The training data set is where the algorithm learns. It identifies relationships between inputs and outputs based on historical patterns in this data.
This is like studying from textbooks and practicing problems.
Exactly. This is where you study diligently from your textbooks and practice problems repeatedly to understand the concepts and how to solve different types of problems. The algorithm builds its fundamental knowledge here.
Okay, learning the basics.
Then we have the validation data set. After the algorithm has learned from the training data, we use this data set to check how well it understood the relationships and how well it's performing.
Like taking a mock test or a practice exam.
Perfect analogy, like you taking a mock test to see how well you understood. Based on your performance, you might adjust your study method, focus on weak areas, or try a different approach.
Okay.
The algorithm uses this validation data set to tune itself, making fine adjustments to its internal workings to improve its performance and ensure it's learning effectively.
Fine-tuning based on practice.
Yes. Finally, we have the test data set. This data set is completely new. The algorithm has never seen it before, neither during training nor validation.
This is like the actual board exam.
Exactly, the actual board exam. It tells us how well the algorithm can predict outcomes on real, unseen data, which is crucial for its real-world application. A good performance on the test data set shows the model has truly learned the patterns and can generalize.
So it works on things it hasn't seen before.
That's the goal. So, my dear students, quiz check. Why do we divide our data into these 3 parts: training, validation, and test for machine learning? Think about the purpose of each step.
That's a very clear analogy showing how the model, like a diligent student, improves over time. However, just like a student can study too much or too little for an exam, ML models can also have problems, right? We call pitfalls. It's important to understand these to build reliable systems.
Absolutely. No system is perfect.
One common problem is overfitting. This happens when the model learns the training data too precisely.
Knows it too well.
Yes. It's like a student who memorizes every single word of a textbook, including the page numbers and maybe even the printing errors, without truly understanding the underlying concepts.
Rote learning, not understanding.
Exactly. The model learns not only the true patterns, but also the noise, the unimportant random details or errors present only in that specific training data.
It learns the mistakes too.
Which means the model becomes too complicated and won't perform well on new, different data because it's memorized the specifics, not the general rules.
Like preparing for an exam by only memorizing past year papers.
Right. And then when the actual exam has new but conceptually similar questions, you are unable to answer them accurately because you only knew the exact answers to the old questions, not the concept.
Fails on new data.
So, my dear students, what happens if an ML model is overfitted? Think about its performance on new data.
And the opposite problem.
The opposite problem, my dear students, is underfitting. This occurs when the model is too simplistic and doesn't learn the true patterns from the data at all.
Too simple. Doesn't capture enough.
It's like a student who barely studies and misses all the main concepts needed for the exam. They just haven't learned enough.
Didn't learn the relationships.
This model also won't make good predictions because it hasn't understood the underlying relationships in the data. It's simply not complex enough. So finding that right balance, not too complex, not too simple, is key.
The Goldilocks zone, you could say. It's just right.
Exactly.
Those are indeed critical pitfalls to avoid in ML, my dear students, because they lead to inaccurate predictions. Another important point about these advanced ML techniques is that sometimes they can seem like a black box.
A black box? What do you mean by that?
Well, because ML algorithms learn from data and discover patterns rather than being explicitly programmed for every single step or rule.
Right, they find their own way.
The precise process of how they arrive at a particular outcome or prediction might not be fully understood or easily explainable to a human.
We know the input and the output, but not exactly what happened inside.
Sometimes, yes. It's like a very talented chef who makes a delicious biryani. You know, the outcome is wonderful. The biryani tastes amazing.
Biryani.
But the exact secret recipe, the precise amount of each spice, or the specific way they stirred the spices at each stage, they might not be able to explain every single step perfectly.
Or maybe they don't want to tell you their secret.
Perhaps. The outcome is clear and excellent, but the how can sometimes be mysterious. In finance, this can be a challenge, especially when decisions have significant consequences.
You need to explain why.
Exactly. You need to explain clearly why a particular prediction or recommendation was made, perhaps to a client or a regulator. This opacity is often referred to as the black box challenge.
That's a fascinating way to describe it. Now, my dear students, let's talk about the different types of machine learning, because they are used for various purposes.
Depending on the data and the problem.
Right. First, we have supervised learning. This is where the computer learns from labeled data.
Labeled, meaning we know the right answer beforehand.
Exactly. Labeled means that for each input we give the computer, we also provide the correct output or answer.
Like the fruit example with labels.
Precisely. Like showing a child many pictures, each clearly labeled, "This is an elephant," or "This is a lion." After seeing enough examples with correct labels, the child learns to identify new elephants or lions.
Learns from the supervision.
In finance, this could be predicting if a stock will go up or down tomorrow based on historical data, where the outcome, whether it went up or down, was already known. The algorithm learns from these past labeled outcomes.
To predict future labels. Okay.
Then, my dear students, there's unsupervised learning. In this type, the computer is not given labeled data.
No answers provided.
No answers. Instead, the algorithm is given only the raw data, and its task is to find patterns, structures, or relationships within the data itself without any predefined answers.
Finding patterns on its own.
Yes. This is like giving a child a large basket of mixed clothes, shirts, trousers, saris, kurtas, and asking them to group them without telling them what each item is.
Okay. How would they group them?
The child might group them by color, maybe put all the red clothes together, or by fabric, all the cotton ones here, silks there, or by size. They find their own way to categorize them.
Ah, I see. The computer finds its own groupings.
Similarly, the computer finds its own groupings or patterns. In finance, this could be used to group companies into similar categories based on their financial characteristics, even if they are from different industries.
Discovering hidden segments or relationships.
Exactly. Helping analysts discover new peer groups or market segments they hadn't thought of.
Interesting. And the third type?
And a very powerful and advanced type of ML is deep learning.
Deep learning. This uses neural networks, right?
Yes. It uses something called neural networks, which are loosely inspired by the structure of the human brain. These networks often have many hidden layers that perform multi-stage, nonlinear processing to identify patterns.
Many layers of processing.
Deep learning can use both supervised or unsupervised approaches. Think of it like learning to read. First, you learn to recognize individual letters A, B, C, a simple concept. Then, you combine letters to form words ATDOG, then words to form sentences, and so on, building up complexity.
Building understanding layer by layer.
Exactly. Deep learning works in layers, understanding simple concepts and building up to more complex ones. This is what helps computers recognize faces and photos so well now.
Or understand human speech much better.
Right, or even play complex games like chess or Go at a superhuman level. In finance, deep learning is used for very complex tasks like advanced fraud detection or sophisticated market prediction using huge data sets.
For the really tough problems.
Yes.
Exactly. And it's important for you to realize, my dear students, that these advances in AI are not just confined to finance, although they're profoundly impacting it.
They're everywhere.
They really are. These technologies are all around us. For instance, we saw IBM Watson winning the general knowledge game show Jeopardy way back in 2011.
I remember that. Amazing.
Showcasing its ability to process vast amounts of unstructured text and answer complex questions. Then Google's DeepMind famously defeated the world champion in the ancient Chinese board game Go in 2016.
A game thought too complex for computers.
Far more complex than chess for computers, yes. AI has even achieved successes in games with imperfect information, like poker, with programs such as DeepStack.
Wow.
Beyond these strategic games, AI is behind the rise of virtual assistants that many of you might use every day, like Siri or Google Assistant.
Asking for directions, setting reminders.
It powers translation apps that can instantly translate languages like Hindi to English, and it drives product recommendation engines like the ones Amazon or Flipkart use to suggest what you might want to buy next.
Based on what I looked at before.
Based on your past purchases and browsing history. You see, these technologies are everywhere, making our lives easier. And they are increasingly shaping the world of finance, moving beyond simple automation to complex analysis.
It's really transforming everything. So, my dear students, all this big data, AI, and machine learning, they all come together under a big umbrella.
A unifying field.
Yes, called data science. It's a very important field in today's world.
Extremely important.
Data science can be defined as an interdisciplinary field. That means it combines knowledge from different areas.
Like computer science statistics.
Exactly. It uses advances from computer science, including machine learning, plus statistics, mathematics, and often knowledge from a specific domain like finance. Its main purpose is to extract valuable information and insights from big data.
Finding the hidden value in the data.
Data scientists are like expert detectives, you could say, sifting through mountains of information to find those hidden clues and insights that can help in business and investment decisions.
Like Sherlock Holmes with data.
Exactly. And as we discussed earlier, alternative data sources often have that unstructured nature, which means they require specialized treatment before they can be used. This is a key area where data science really shines, transforming raw, complex data into something meaningful.
Turning mess into meaning.
Perfectly put.
Indeed. And before this treasure trove of data can be analyzed, it typically goes through a carefully planned journey.
Like a process, a pipeline.
Yes. Much like how a letter goes through many steps, sorting, transport, delivery before it reaches its destination. Data scientists use various data processing methods to manage this journey.
Okay, what are the steps?
First, there's capture. This refers to how the data is collected and then transformed into a format that can be used by the analytical process.
Getting the data in the right shape.
Right. For super-fast trading in financial markets, for example, we need low-latency systems. This means systems that operate on networks communicating huge volumes of data with very minimal delay, milliseconds sometimes.
Like getting those live cricket scores instantly for betting or trading.
Exactly. High-latency systems, slower ones, are fine for applications that don't need real-time data, like retrieving old company reports. The speed of capture depends on the need.
Okay, capture that.
Second is curation. Data curation is the process of ensuring the data's quality and accuracy through a thorough data cleaning exercise.
The cleaning part again. Vital.
Absolutely vital. Imagine trying to cook that delicious meal for your family, but your ingredients are mixed with dust, or some are missing or rotten. You first need to meticulously clean and sort them right.
Of course, you can't cook with bad ingredients.
Data curation is exactly that, reviewing all data to detect errors or inaccuracies, adjusting for missing data where possible, making sure our data is clean, consistent, and perfect before we use it.
Garbage in, garbage out, as they say.
Precisely. Without clean data, even the smartest AI model can give wrong predictions. Then we have storage.
Where do we keep it all?
This refers to how the data will be recorded, archived for future use, and how it will be accessed. An important consideration is whether the data is structured, neat tables like your school timetable, or unstructured, like emails or videos in your family photo album.
And how quickly we need to access it.
Yes, whether analytical needs require low-latency solutions, how quickly we need to pull the data out. Storing data effectively is crucial for quick retrieval later.
Capture, curation, storage. What's next?
Fourth is search. This refers to how we query and find specific data within these vast quantities.
Finding the needle in the haystack.
Exactly. Imagine you have millions of books in a very large library, perhaps the National Library of India in Kolkata. You need a good search system to find the exact book you want, quickly.
A good catalog or search engine.
Big data needs advanced applications that can examine immense amounts of data to locate precisely the content requested, going beyond simple keywords to understand meaning and context.
Smart search.
And finally, transfer. This refers to how the data will move from its storage location to the analytical tool that will process it. Seamless and efficient movement is crucial, especially with massive data sets across different systems.
Getting it to the place where the analysis happens.
Yes. Each step, capture, curation, storage, search, transfer, is a vital part of the data's journey to becoming useful information.
Now, my dear students, once we have processed all this data through these steps, how do we actually understand it? Because just looking at millions of numbers or lines of text, it can be overwhelming.
It's very hard for our brains to grasp.
Right. That's where data visualization comes in. It's about displaying and summarizing data in graphical form, charts, graphs, maps, making it much easier for our human brains to see patterns, trends, and insights.
Turning data into pictures.
Exactly. For traditional structured data, we often use familiar visualizations like simple tables, bar charts showing sales figures, or line graphs showing stock price trends over time. We've all seen those.
The common charts.
But for non-traditional, unstructured data, new and innovative techniques are needed. These include interactive three-dimensional 3D graphics, where users can zoom in, rotate the data, look at it from different angles to spot trends.
Like exploring the data visually.
Imagine looking at complex financial numbers, but instead of just rows and columns, you see a vibrant, moving 3D chart. It helps you see patterns you couldn't before.
Making hidden relationships visible.
Yes. We can add color, shapes, sizes to these charts to represent even more variables. Other examples include heat maps, using color intensity maybe to show which areas of a city have higher spending.
Or tree diagrams for hierarchical data.
Like showing a company's structure.
Yeah.
And network graphs to show connections, maybe how different companies are related through investments or board members.
Visualizing connections.
Another very valuable technique, especially for text, is a tag cloud.
Ah, the word clouds.
Yes. In a tag cloud, words from a text are sized based on how often they appear. More frequent words appear larger. If you look at Exhibit 3 in our materials, you see words like data, ML, learning, AI, techniques are much bigger.
Showing they're the main topics.
Exactly. It's like looking at a word puzzle where the most important words jump out at you. A mind map is similar, but shows how concepts are related, like branches from a central idea.
Different ways to visualize different data.
So, my dear students, quick thought. Why is data visualization so important for understanding big data, especially in finance? Why turn numbers into pictures?
Excellent question. Data visualization is truly essential, my dear students. It transforms that complex raw data into accessible, actionable insights. It enables quicker, more informed decisions.
Makes the invisible visible.
Perfectly said. It makes the invisible visible. And with these tools, big data, AI, ML, visualization, fintech, is being used in numerous areas of investment management, transforming how financial professionals make decisions.
Okay, let's talk applications.
One of the most significant applications is in text analytics and natural language processing, NLP.
Analyzing text and language.
Yes. Text analytics involves using computer programs to analyze and derive meaning, typically from large unstructured text or voice-based datasets. Think of official company filings, detailed reports, transcripts of quarterly earnings calls.
Where company leaders talk about performance.
Right. social media posts, emails, internet postings, news articles. All public corporations worldwide generate millions of pages of reports and thousands of hours of earnings calls each year.
Impossible for humans to read it all.
Impossible. No individual analyst or even a very large team can possibly read and listen to all of that effectively, let alone in real time.
So computers have to help.
This is where natural language processing, NLP, comes in. NLP is a specialized field, computer science, AI, linguistics, focusing on developing computer programs that can analyze and interpret human language.
Understanding what we write and say?
Within text analytics, NLP is a critical application. It performs automated tasks like translation, speech recognition, spoken words to text, text mining, extracting facts from text, sentiment analysis.
Sentiment, like positive or negative feeling.
Exactly. Understanding the emotional tone, whether people are feeling positive or negative about a company, a product, a stock, and also topic analysis, identifying the key themes being discussed.
What are people talking about?
NLP, especially when aided by advanced machine learning, can analyze all these reports, social media posts, news articles, much faster and more accurately than any human team. It can detect that sentiment even before an official analyst recommendation changes.
Getting an early warning signal from the public mood.
It's like understanding the general mood of an entire city by quickly analyzing all the tweets and social media posts, instead of asking each person individually. This gives financial professionals early signals.
That's powerful. Any other uses?
Yes, beyond investment analysis, NLP is also used in compliance functions.
Checking rules are followed.
For example, it can review employee communications emails, chats to ensure adherence to company policy, detect potential fraud or inappropriate conduct, or ensure private customer information is kept confidential.
Helping institutions avoid trouble.
Helping them avoid large fines and maintain trust. Consider this specific example: NLP monitoring analyst commentary.
What the experts are saying.
Financial analysts give earnings per share forecasts, numerical predictions. But focusing only on the numbers might miss subtle insights in their written reports. Analysts often don't change their buy, hold, or sell recommendations frequently.
They might stick with hold for a long time.
Right, but they might offer nuanced commentary or subtle shifts in their language in the text. NLP can analyze this commentary, assign sentiment ratings, very negative to very positive, and detect these subtle shifts.
Picking up hints before the official rating changes.
Potentially, yes. Detecting shifts in sentiment even ahead of a formal recommendation change. Machine capabilities allow this analysis to scale across thousands of companies worldwide, work previously done manually.
It's like trying to understand if your parents are hinting at something important just by their choice of words or tone, even if they don't say it directly.
Exactly. NLP can pick up these nuances and use them to inform financial strategies.
That's incredibly powerful. It truly shows how technology helps us gain insights much faster. Now, my dear students, for all this amazing work with data collecting, cleaning, analyzing, visualizing, computers need special instructions.
They need a language they understand.
Yes, a language they understand. These are called programming languages in databases.
The tools of the trade for data scientists.
Let's talk about programming languages first. Think of these like different human languages we speak: Hindi, English, Tamil, Marathi. Each is good for different kinds of conversations with the computer.
Different tools for different jobs.
Python. This is very popular, free, and open source. It's relatively easy to learn. Even for beginners, you don't need deep programming knowledge.
Accessible.
Yes. Python is the basis for many fintech applications. It allows people to develop powerful applications for advanced analysis in finance, like building prediction models.
Widely used in data science.
R, another free open source language. R has traditionally been used more for statistical analysis. It has many packages specifically for stats, machine learning, optimization, econometrics.
Strong in statistics and finance modeling.
Right. If you're doing heavy number crunching and statistical modeling, R is a great choice. Java. Java is versatile, runs on different computers and systems. It's used in many internet applications, from big bank systems to mobile banking apps.
Reliable and scalable for big applications.
C and C+++. These are specialized languages optimized for speed, superior calculation speed, and performance.
Made for speed.
Because of their incredible speed, C and C++ are often used in applications like algorithmic trading and high-frequency trading, where every millisecond counts.
For those super fast decisions.
For the high-speed traders. Excel VBA. This is a programming language within Microsoft Excel, Visual Basic for applications. It helps bridge the gap between complex programming and manual work by letting users run macros, small programs, to automate tasks in Excel.
Automating things in Excel.
Yes, updating tables, running queries, collecting web data, performing calculations. It makes Excel even more powerful for financial analysis.
Different languages for different needs.
Now, my dear students, where do we keep all this data safely and organized? That's where databases come in.
Storage systems.
Like different types of organized storage units, each suited for different kinds of data. SQL, structured query language. This is mainly for structured data in neat tables with rows and columns.
Like an organized ledger book.
Exactly, like keeping bills perfectly categorized. SQL databases usually run on a server and are accessed using SQL queries. Excellent for managing large amounts of organized transactional data, like bank transactions.
For the neat, tidy data.
Squalate, similar to SQL for structured data, but much smaller, designed to be embedded directly into a program or mobile app.
Doesn't need a separate server. Good for apps.
Right. Common for mobile apps needing quick local data access, like a banking app storing some preferences locally. NoSQL. This stands for not only SQL. NoSQL is used specifically for unstructured data, emails, videos, social media posts, things that don't fit rigid tables.
With the messy, varied data.
It's like a very large, flexible storage space where you can just dump all kinds of different things, photos, handwritten notes, voice recordings, and still find what you need.
Flexible storage.
NoSQL databases are ideal for handling the huge variety and volume from modern web applications and social media, crucial for things like sentiment analysis and finance.
So SQL for structured, NoSQL for unstructured, broadly speaking.
Broadly speaking, yes. Understanding these languages and databases is key to managing and extracting value from all this data.
They're the essential tools that bring big data, AI, and machine learning to life in the financial world, my dear students.
Wow, what a journey we've had today, my dear students. Quite a lot we covered.
We did cover a lot of ground.
We started by understanding how technology is transforming finance with fintech, learning it's about innovation in financial services.
Using tech to make finance better.
Then we took that deep dive into the vast ocean of big data and its 3 or 4 V's. Remember, volume the amount,
Velocity the speed,
variety the different types,
and veracity the trustworthiness.
crucial.
Absolutely crucial. We also saw how artificial intelligence and machine learning are like brilliant brains helping us make sense of this information.
Learning patterns, making predictions.
Without being explicitly programmed for every step, we explored how ML models learn, the training, validation, and testing.
And the pitfalls like overfitting and underfitting.
Yes, important to remember those. And we discovered how text analytics and natural language processing are helping us understand human language.
From millions of pages of reports, social media posts.
Extracting sentiment and insights no human could process alone. Remember, my dear students, the goal isn't just knowing these words.
Not just memorizing terms. It's about understanding their power and how they are shaping our future, from big investment decisions to how you manage your own finances on your phone every day.
Indeed, my dear students. The world of finance is changing rapidly, very rapidly. And knowing about these technologies gives you a significant advantage. Whether you're planning for a wedding, saving for your child's education, or maybe thinking of starting a small business someday. The ability to leverage and understand data will only become more important.
Absolutely.
As we conclude this deep dive, perhaps consider this, my young learners. If technology can now analyze vast amounts of data and predict market trends, or even help manage your personal finances, what new skills do we humans need to develop?
That's a deep question.
How can we work alongside these powerful technologies and truly benefit from them? Think about skills like critical thinking, questioning the data, questioning the AI's output. Think about creativity, finding new ways to apply these tools. Problem solving.
Things machines maybe can't do as well.
Perhaps. How can these uniquely human abilities become even more valuable in a world where machines are doing more and more of the routine tasks? Something to reflect on.
A wonderful thought to ponder upon, my dear students. Thank you so much for joining us on this deep dive today.
Thank you all for your attention.
We truly hope you feel more informed and maybe even a little excited about this intersection of finance and technology. Keep learning, keep exploring, and always keep asking questions.